100%.
We are very unhappy, I am, with Russia, but we'll discuss that maybe a different day. But we're very, very unhappy with them, and we're going to be doing very severe tariffs if we don't have a deal in 50 days. Tariffs at about 100%. You'd call them secondary tariffs. You know what that means. I use trade for a lot of things, but it's great for settling wars. It's a horrible war, and it should be stopped. And so if it's not done, if we don't have an agreement in 50 days, that's what we're doing, secondary tariffs. And they're biting. And I hope we don't get to the point where we do, but I've been hearing so much talk. It's all talk. It's all talk, and then missiles go into Kiev.
Meanwhile, Ukrainian President Volodymyr Zelensky confirmed that he held a call with Trump to discuss defense solutions for Ukraine. This follows Trump's authorization of more arms shipments to Kyiv as tensions continue to mount on the Eastern Front. And more on the trade front, the US is now targeting Mexican tomatoes. The Commerce Department has announced new anti-dumping duties of 17.09% on most imports of fresh tomatoes from Mexico. Now, this follows the termination of a 2019 agreement that previously prevented such tariffs. Washington cited unfair trade practices as the reason behind this. Moving on, President Trump says he's still open to negotiations, signaling willingness to reopen trade talks, including with the European Union, even as he insisted that the letters he has sent threatening new tariffs rates are, in his words, the deals for U.S. trading partners. And another geopolitical developments, Iran has rejected the idea of new nuclear talks with the U.S. if they are conditioned on halting uranium enrichment. The statement came on Monday as diplomatic efforts between Tehran and Washington stay at a stalemate. In more news from the US Supreme Court has cleared the way for Trump's administration to resume dismantling the Department of Education, which will impact 1,400 employees. Now, this is part of his bid to shrink the federal government's role in education in favor of more control by the states. And lastly, President Trump is doubling down on tech and energy. Later today, he's set to unveil $70 billion in investments in AI and energy sectors, which is a major move aimed at accelerating innovation. That's all for today. Now back to you.
Well, thanks so much for that, Dia. But staying with the Wall Street and Trump's latest tariff salvo, let's listen in to some market experts and economists share their views on the outlook for the U.S. markets.
U.S. is concerned. I think what's going on is that some of the exporters this time, particularly the Chinese, appear to be absorbing a lot more of the costs than they did, let's say, last time in 2019 when they faced higher tariffs. The second thing which is happening in the U.S. is obviously the AI mania. The animal spirits coming from that is offsetting any hit that's coming from the tariffs, and that we can see even the sector breakdown of what's outperforming in the US market. And if there's any other factor out there, which is also that the fiscal bill, which was just passed, that has some tax cuts in there. So the corporates, sure, it gives them the better ability to absorb some of the tariff hits.
What's going to happen is that there's going to be big price effects now, but as we get more production into the U.S., then those price effects will go away. And so I think most people expected that if there were going to be a price effect, that it would be front-loaded before the U.S. supply chains adjust and more production is done into the U.S. So the fact that in the period where, in January, everybody was saying the price effects were going to be the largest, we've seen negative price effects. And so now people are speculating they're going to get worse and worse somewhere off into the future. But I think, again, the best intuition for it is that they're taking a hit, that people are exporting into the country. And Americans have recognized that their friends and neighbors are better off when they buy the products that they make.
Well, that's all the global market action, but how will all of these overnight cues impact our own Indian market? We now have our research team joining in with how the trade setup looks like and the stocks that are likely to be in the news. First up, let me first start off with how the trade setup looks. Well, the market started off the week on a very weak note. The Nifty slipped around 68 points and extended its losing streak for the fourth consecutive session. However, it did manage to defend that crucial 25,000 mark. Keep in mind that this was largely driven by renewed global trade tensions, which drove the benchmark indices lower. But on the other hand, the mid-cap as well as the small-cap end of the market, that continued to be vibrant. The mid-cap index, small-cap index saw a good uptick in yesterday's trading session despite the fall that we saw on benchmark indices. Most sectoral indices were in the green. The gains were led by Nifty GLT as well as Nifty Media. Pharma, PSU banks also continued to do well. But what did not do well is IT, because it was the top sectoral drag driven by Tech Mahindra as well as Wipro. Now, as far as today's session is concerned, we'll be keeping an eye out on any sort of updates that come from the Indian delegation that is in the US. An announcement is not expected before Thursday, but still, we'll be watching out for that. That's a very important factor that will drive the markets. As far as economic cues are concerned, India's trade balance data and US CPI data will be out today. Lots of earnings lined up, and most of them are from financials, HDFC Life, ICICI Lombard, ICICI Prudential, HDB Financial Services, as well as Bank of Maharashtra and GIC. Auto stocks will also be on our radar today. The first Tesla showroom in India is expected to open doors today, so we'll be watching out for that as well. Let's take a look at GIFT Nifty. It was indicating a flat start to the Indian markets. It continues to remain the same. But let's look at what the FNO setup is now indicating for us. We now have Mangalam joining in. Mangalam?
Well, for the last couple of days, there has been a grind lower for the frontline index. Earlier, we were consolidating at the upper end of the range, and now we're consolidating in the lower end of the range, with the range moving lower. But the good part yesterday was the broader markets did well, telling you that we're closer to the end of this decline that we're seeing than we are to the top or anything of that sort. The advanced decline ratio, that comes up for you. Towards the last hour of trade, we did see some perk up coming by in the Nifty Bank, and the advanced decline as well was absolutely split right down the middle, telling you that the bulls have shown in some fight, even as the bears are trying to take the market lower. There was not incremental selling coming in from the FIs in the cash market. The previous trading session was 5,000 crores. Now it's close to around 1,600 crores. But what's happening is that they are selling lock, stock and barrel in index futures. For the fifth straight trading session, they've sold more in index futures. Yesterday, they unwound about 241 long contracts, but added 17,000 short contracts on a net sell of 3,300 crore rupees. What it means is that over the last 5 trading sessions, the FII longs have fallen from 29% to 18%. Conversely, the shorts have increased from 71% all the way up to 82%. And the net contracts, which crossed the 1 lakh mark yesterday, has now gone to 1,20,000. And not only are they selling in index futures, they've sold more calls over the last 2 trading sessions than they've sold puts. Yesterday as well, close to 10,000 crore worth selling in index options, 52,000 short contracts added on the call side and 20,000 on the put side, telling you that on the way up, there could be some resistance. But I'm believing that maybe on the way up, if the market does not, face much resistance, then there could be case for short covering. Why do I say that? Because one, India VIX, which was closer to complacency levels, is now spiking up for the last 2 trading sessions. The put call ratio on the Nifty is moving towards the lower end of the range. 0.65 to 0.7 is where we see a bit of a bounce from. And thirdly, we have the Sensex weekly options expiry today. The last hour of trade on the last Tuesday as well saw a lot of volatility. Does that continue today or not is something we'll be watching out for. On the way up, 25,100 call and the 25,200 calls have been extremely active. The way down, 25,050 put and the 25,000 put equally active as well, telling you that the option writers believe that there is support between 24,950 to 25,000 and congestion between 25,220 to 25,270. For the market to sustain an up move, we have to cross and close above the 20-day moving average. A lot of short covering seen on capital market plays like BSC and MCX yesterday, and a lot of long positions added on Paytm.
Thanks for that, Mangalam. The bulls may be hoping that after 4 consecutive days of a fall, we expect to see some green. Let's see whether or not that plays out. But let's slip into a very short break. More news and updates on the other side. Welcome back. You're watching Power Breakfast on CNBC-TV18. Well, the June consumer inflation comes in at a 6.5-year low of 2.1%, lower than the CNBC-TV18 poll of 2.3%. Decrease in the prices of cereals and pulses guided the food CPI lower. My colleague Lata Venkatesh is here with more details.
June consumer price inflation number has come in at 2.1%, which is a 6.5-year low. The last we saw a number like that was in January of 2019. And it's low primarily because of food. Food, you can't even call it food inflation because it's deflation. It's come in at minus 1.06. And that's actually a little less than the CNBC-TV18 poll, which was flat. They were expecting 0.1%. So it's, even lower than that. Food CPI has fallen largely because of cereals and pulses, two weighty items in the food basket, which are lower even month on month, which is unexpected. Normally by June, prices start spiking a bit because of the rains. Vegetable prices have risen about 7% in June over May. But in year-on-year terms, they are down by some 19%, which clearly indicates that food prices are still even with monsoon dislocations, not really rising as usual. Core CPI, which is when you remove food and fuel, the balance, usually services inflation, that's up 4.4%, largely because of a low base of 3.1%. 4.4 is very much what the poll also threw up. Now, what this number does to policy is what we have to see. April, May, June average now works out to 2.7%. The Reserve Bank's forecast was 2.9%. So the market is now wondering whether this opens up space for a rate cut. July inflation is now we know, the first 14 days of July prices. The expectation is inflation will be sub 2%, 1.8%. And the expectation is that for a better part of this 2025 calendar, inflation is going to remain below 3%. For the full year FY26 average, the Reserve Bank's forecast stands at 3.7. The street believes that the Reserve Bank will have to pull it down to something like 3.3, 3.4. Now, these are ridiculously low numbers, way below the MPC's mandate of keeping inflation at 4%. So, the expectation is there scope for a rate cut? People will watch very closely what the Reserve Bank does in the next few days to liquidity as well. They may be a little more easier. But clearly, the August monetary policy suddenly becomes alive. Will they be more dovish? They may not be able to cut with having gone from accommodative to neutral just in the June policy, but who knows? The policy clearly becomes very, very important.
Well, thanks for all of those details, Lata. But moving on, let's focus in on HCLTech. The company reported a weak set of numbers in the first quarter. Rima joins us to take us through the numbers. Rima?
So the big miss this time in HCLTech is the margins. In the case of TCS, it was the muted top-line growth, but in the case of HCLTech is the margins. Margins in quarter one have declined by 160 basis points on a quarter-on-quarter basis at 16.3%, and the company has lowered the full-year margin guidance. Earlier, it was 18 to 19%. Now they're talking about 17 to 18%. The reason for the margin drop, the company says it's been impacted by lower utilization, additional generative AI, and go-to-market investments. On the top line, the full-year guidance has been narrowed. Earlier, it was 2 to 5%. Now it stands at 3 to 5%. The change is the lower end of the guidance has been increased by 100 basis points, but that comes on expected lines. Now on to Q1 and the big numbers. Dollar revenue growth for the company is up 1.4%, but on the back of the cross-currency movements, the constant currency revenue growth has declined by 0.8%. Now, this compares with a 1.1% estimate that the street had and a minus 3.3% drop that TCS, its peer, reported. Margins, as I said, is where the problem is. Margins for the company have fallen to 16.3% versus estimates of 17.3%, but compared to the prior quarter, it's a big decline of 160 basis points. Deal wins too have come in sub $2 billion. For the first time in nearly 4 quarters, and it's also the lowest deal wins in the last 8 quarters. So that is not a good sign. Other than that, headcount, the attrition numbers continue to remain muted. Attrition for the company is, marginally declined, but the bigger problem is the margin drop in Q1 and the subsequent margin guidance cut.
Thanks for that, Reema. But let's slip into a very short break. Up next, we get you updates from the launch of Tesla. So stay tuned. Welcome back. You're watching Power Breakfast on CNBC TV18, where we now have Manisha Gupta joining us with all the updates from the world of commodities. Good morning, Manisha. What are you picking up?
Hi, Mavama. Morning. Thank you so much for that. Well, I'm looking at across commodities, a bit of a profit taking in the overnight markets there. If you look at the crude oil prices, well, they declined 2%. US has given Russia a 50-day deadline to agree for a ceasefire. US also has warned Russia that further sanctions up to 100% could be coming if that doesn't happen. Now, the markets have taken a sigh of relief because there are no immediate reaction or restrictions or sanctions on Russia. We have a 50-day timeline period there, and is the reason you've seen some profit taking come in for the crude oil prices. US also putting higher tariffs for partner countries has led to markets believing that that could impact demand going forward. In the meanwhile, you also have European Union saying that they are looking to announce an 18th package of sanctions against Russia. So there's just so much happening, and the crude oil price is not able to hold above that $70 a barrel mark. And that's exactly what you have seen in other commodities as well. Gold, silver fell 0.5% overnight. Copper was down 1%. Platinum fell 4% as well. So after that persistent trade uncertainty, markets have given up some gains in the overnight space.
Thanks for that, Manisha. But moving on, this is an announcement that I think a lot of people have been waiting for. Global EV giant Tesla is ready to enter the Indian market as the company will formally open its first showroom today. My colleague Parikshit joins us from the location with more. Parikshit?
Well, yes, we're outside the Tesla showroom here in Maker Maxcity Mall. My camera person is giving you the first pictures here on CNBC TV18. Final touches being given to the showroom. You've got 3 cars on display, but it's only the Model Y which is going to be displayed and showcased and offered to Indian customers. The company is going to increase the pipeline in the next few weeks and months, but for the moment, it's only the Model 5, which is a mid-sized, compact SUV, which can give you a range of around 526 to 530 kilometers in a single charge. It has a top speed of 200 kilometers. It can go from 0 to 100 in about 4.6 seconds. So 3 cars on display. We're also learning that a Delhi showroom could come up as early as July. The company at around 10:30 this morning will also give a timeline for booking and deliveries. So here you have the pictures coming in from the Tesla showroom. We can also tell you that the Maharashtra Chief Minister, the Transport Minister, they will all be arriving at this location. So we're expecting a big rush, a lot of big noise that Tesla will make through the day. But it's an important time for Tesla to enter the Indian market for sure. There is a lot of competition in the EV space in the country and a lot of competition between Tesla and BYD as well. So let's see how the India bet takes off.
Well, thanks for that, Parikshit. Certainly, you know, the excitement will be electrifying. We'll be coming back to you for more details on that front. But that's all we have on this edition of Power Breakfast. Don't go anywhere. Bazaar Morning Call comes up next.
Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Good morning. You're with us here on another new edition of Bazaar Morning Call. We are coming to you live from the CNBC-TV18 Motilal Oswal studios. It's a Tuesday morning. Yesterday was down on the Nifty, but broader markets did just fine. And I think that's the backdrop. There's not very much new earth-shaking information from global markets, but there is some stuff which we will address right here in the next 5 or 6 minutes or so. I'm Prashant. With me, my colleagues Surabhi and Nigel. Guys, morning.
Hi, morning, folks. And, when it's tariffs, nothing is earth-shaking anymore, right? All those, what was that? The marginal diminishing utility sort of principle, yeah. That's what it's become because the market just completely brushes aside all tariff talk. But that's kind of time we're in.
Well, indeed, there's uncertainty in the air, but it seems that some of this tariff news will have to be bigger to make a bigger impact, I think. So, and I'm still smarting yesterday, after yesterday's loss. I thought India almost got there. We fought back well, but difficult times. Boys will fight back.
22 runs, just there, almost there.
Well, let's talk about markets then, right? Maybe better luck here. Last 2 days, though, markets have been down. Friday, we saw a crack. Yesterday, the market was down on the Nifty. But as I said, how would you characterize yesterday's day? Pretty okay, because the index was down, but broader markets were okay. I'll get to that in just a bit. So we'll start it from take it from the top. You've got S&P up, NASDAQ up, Russell up. So you've got US equity markets, which are flashing green this morning. And part of the reason, actually, US markets started slightly lower. But then President Trump essentially made some comments signaling openness for further trade talks with the EU. This, of course, the weekend comments of 30% tariffs on EU, etc. Even then, the euro, the dollar, etc., had not reacted big, and market interpretation has been that, well, there'll be negotiation or it'll be pushed out. The August 1st deadline will itself be pushed out. And of course, President Trump has signaled openness, which went well with what markets did. Dollar index up a little bit. The yields, 2 basis point change, nothing really. Dollar above 98, the broader dollar that is. Brent oil prices have been bouncing around. 70, 68, 70, 68. So we're back at about 60, just under in that range once again. Now, the other, and many use this as a proxy for, animal spirits in stock markets, in financial markets, risk markets broadly. Crypto, Bitcoin, of course, is the poster child there. Hit $123,000. Focus, new high, basically. Focus on crypto week in the U.S. House of Representatives. And, what markets are watching, the crypto markets are watching, is U.S. lawmakers considering crucial crypto legislation. It's a complete 360-degree turn for many around the world because U.S. is now kind of trying to, under the Trump administration, mainstreaming crypto. Crypto is okay. Crypto is well. You must have crypto in your portfolio. That seems to be the message. And we'll see. We'll track this one. But there is, of course, specifically with crypto, positive news, but I think generally there's an indicator, broader market and the risk environment, which is quite upbeat. Now, Trump, of course, also, there was that news flow expected on Russia. Trump is threatening to impose secondary tariffs of 100% on Russia. He's also pledging additional U.S. military support for Ukraine. The word used was top-of-the-line military hardware potential sales to Ukraine. Now, this is, again, a complete 360-degree turn from President Trump's stance on Russia. It was about stopping the war, but then it's not really worked out. So we'll see how this goes, because if the U.S. commits itself to supporting Ukraine, you're essentially looking at this 3-year war elongating a lot more. Now, I'll come to the market here straight up. So IT was the problem child, TCS, Infosys, etc. Actually, Wipro, HCLTech, and we'll talk more about numbers which came after market hours. So the Nifty was down because of that, but the rest of the market actually was quite buoyant. Mid-cap index was up, small-cap index was up, Nifty Bank was absolutely flat. The Nifty tested it broke the 20-day on Friday. It yesterday broke the 40-day and then showed some bounce. It tested the 40-day exponential and then showed some bounce. We need a daily positive close for the Nifty. If the 40-day exponential, the market stays under it, then you're looking at 24,940 as the next level. which is nothing but the 61.8% retracement of the recent move. Resistance, two numbers. The 20 hourly stands at 25,170, and then the 40 hourly exponential average, which is 25,275. Very near-term levels here, but that's what we're working with. If you're trading, Bank Nifty, once again, like Friday, held the 20-day moving average, 56,732, and then ended flat. We need one more day of defense of the 20-day moving average. We'll see if that happens today or not. Downside level, if that goes, is for the Nifty Bank is 56,130 or so. GIFT Nifty will give you a quick sense of how we're likely to start before we go any further. Once again, absolutely flat this morning. Surabhi.
Like I was saying, nothing is moving the market. At least the tariff talk certainly isn't. Asian markets are also fairly mixed, but they're not flat entirely, because if you're looking at the Hong Kong market, for instance, it's up about 0.5%, but the mainland Chinese market is down 0.5%. Japan is completely flat. There's lots of news to digest. And by the way, there's some very interesting news that's just breaking right now on, on the screens. Nvidia will be allowed to start its chip sales to China. Their chip sales that were blocked in April, the company's just issued a statement saying the US government is going to be granting it the licenses once again. So that's perhaps going to be playing out in the US market action later tonight when it comes back on stream. But anyway, out of China, there's plenty of data this morning, and the data is not too bad, frankly. The GDP number at 5.2% is ahead of estimates. The industrial output number for the month of June, 6.8%, again ahead of estimates. But the dark side or the underbelly is the retail sales number, consumption growth. That slowed down in the month of June. So retail sales at 4.8% in June versus 6.4% in May. And overall fixed asset investment growth has also been very muted this year for China. First half, it's up just 2.8%, which is lower than estimates. Apart from this Nvidia news that's just hit the wires, the other thing that Wall Street is going to focus on is all the key bank earnings. And it's a very heavy 2 days. Today is Citigroup, JP Morgan, Wells Fargo. Tomorrow it's Morgan Stanley, Goldman Sachs. And I think Bank of America is coming out tomorrow. So that's what the market focus is going to be on. Clearly, tariff headlines is basically not something that the market is looking at too much. But having said that, now, from an Indian perspective, this chatter about 100% secondary tariffs on countries that are buying anything from Russia, this could complicate the situation once again for India. Because remember, there's the additional 10% BRICS tariff, and now Mr. Trump is talking about 100% secondary tariffs if you're buying anything from Russia. And now all of this is happening against the backdrop of India still trying very hard to get that bilateral trade agreement, some shape or form of that trade agreement in place. In fact, the Commerce Ministry team is again in Washington. They'll continue these conversations for 4 more days. I think the talks wrap up on Thursday. So that continues to be a key watch point as well. Now, for us, the big macro cheer is inflation. The CPI number that came in yesterday continued to show more softness from the previous month. So for June, inflation, consumer inflation is at just 2.1%, slightly lower than estimates as well. And food inflation continues to fall further, which is the good news. In fact, there's disinflation when it came to food this time around, minus 1.06%. So the inflation picture has been looking good. On earnings, HCLTech, well, it's a mixed bag. I think the market will really focus on this cut in the margin guidance and what the company is saying. The revenue is also down. It's fallen 0.8%, a little less than what the street was fearing. But the margin issue, the fact that the margin itself in this quarter is down 100 basis points, plus the cut in the guidance, that's going to be a key watch point. Speaking of more stocks, M&M will definitely be on the radar because Tesla is rolling into India. The launch event is slated right here in Mumbai, BKC, and we'll get you the latest. So watch for, some chatter if there's some, change in trading positions around Mahindra and Mahindra as well. Finally, to cap it off with the flows picture, we're very range-bound. It's just time consolidation that continues in the market. And the flows, at least yesterday, were more or less offsetting each other. 1,800 crores of DII buying, 1,600 crores of FPI selling. So net-net, we had another flat session. Nigel, over to you.
Well, yesterday's trading session, a bit of an intraday dip on the Nifty got bought into. We ended with a cut, but not as deep as what it was at the low point of the day. However, there were a couple of positives because the small cap index, in fact, that put on close to 100%, telling you that there was select buying in the broader markets and telling you that the domestic money as well is still quite buoyant about the trajectory of the markets. Well, and the VIX continues to remain at very, very low levels. Given that we have fallen from around the 26,000 mark closer to 25,000, the VIX is not still suggesting any kind of fear in the system. And also another point is that the Nifty RSI that had moved to around 70, 72 odd, that's cooled down to around 47. That's the lowest that we have seen in the last 3 months or so. Let's get into what the FIs did in yesterday's trading session. Well, they added shorts. The short positions are the highest that we've seen all the way since March earlier this year. They wrote more calls than puts as well. So we have a fair bit of short positions in the system. But let's talk about the FI as well as the client positioning as of now. And the clients, they continue to add the long positions. So from around 40,000 contracts, now it's at around 80,000 contracts. So clearly they've added quite a bit of longs on that side. The FI shorts, well, that's reached the highest level since March 2025, and that's at around 1.2 lakh contracts. So we've got a fair bit of shorts in the system. In percentage terms, it's at around that 82% odd mark. So there are shorts in the system, sometimes a little dangerous, to wish for something. We wanted some shorts. Now you've got shorts loaded into the system. But I'll tell you what, if we can get any kind of positive news, these shorts will be forced to cover out. And as we have seen in the past, at around this 1,20,000 contracts odd, we sometimes see a bit of a short covering bounce that does play out. Moving to the options data, then, you had a fair bit of call writing in yesterday's trading session. And because of that, the PCR has come down to the lower end of the band. Remember, a few trading sessions ago, it was at around 1.2. Now it's come down to around 0.72 or thereabouts. And the 25,100 call, fair bit of open interest built up out there. 25,050 put as well. So both those two are very, very active. And that perfectly ties in with the key levels that we're looking at. So on the upside, the 20 DMA becomes a near-term resistance mark, which comes in at around the 25,272 odd, and support comes in a little south of the 25,000 mark. That's the near-term band, very, very crisp. A break of either which of these levels will give another 200-300 points in that direction. So we'll keep an eye out on this. The Nifty Bank as well. Well, yesterday from the lows of the day, it did see some buying, and that was doing a relative outperformance. But the Nifty, that's going to be important because on a day-to-day basis, it's making lower highs and lower lows. For today's trading session, you'll want it first to make a higher high. Let's get past this 25,150 mark, and you'll want it to protect the lower level. So I'll keep an eye out on that mark of 25,150. The Nifty Bank, as I said, did a relative outperformance yesterday. It's still protecting lower levels of 20 as well as the 50 DMA. It'll have to lead the way because the tech space could be under some pressure. And finally, the word on Mahindra & Mahindra. Yes, Tesla is going to be coming to India. But history suggests that, in fact, any kind of bad news on Mahindra & Mahindra actually has turned out to be a buying opportunity. So let's see how that goes, and let's see whether or not Mahindra & Mahindra has, a joker up their sleeve as well. I'll keep an eye out on that stock, particularly if there is some weakness.
All right, Nigel, thank you very much for that. So keep an eye, Mahindra & Mahindra in focus. Well, we'll get in Matt Orton, who is now joining us, Chief Market Strategist at Raymond James Investment. Matt, great to have you with us here. Thanks very much for your time. So just a quick word on the IT results so far. The commentary also is pretty uncertain. We got numbers from TCS, HCLTech. Of course, there will be reaction today. Infi will come later. What's your sense, and where does that leave you with IT names in India?
Hey, good morning, Prashant. It's always great to join, and the results aren't great. It's also not that surprising to have fairly weak results. When we talked a month or so ago when I was in Mumbai meeting with a number of these companies, some of them included the information technology service names. And while they were a little bit more optimistic about what demand might look like a year plus out, the near term was still very, very uncertain. So I think there's still some speed bumps that the sector needs to get over. I think it's going to take at least another quarter or two. And so this is a part of the market that I wouldn't be looking to buy on dips right now because the fundamentals aren't there. But for the Indian market overall, I think there's still a lot of really good opportunities across higher quality single stocks where you are seeing solid demand. You're seeing very strong macro tailwinds, and those are the types of names that I would want to lean into on weakness, like an M&M, for example, like you were mentioning at the start of the segment. That's a name where I've always been a buyer on dips, and I still continue to believe that the fundamentals remain strong, and I don't think any competition from Tesla is going to disrupt their launch of EVs and their ability to have success in the Indian market.
Okay, so that answers the second question that we had, Matt. You made it pretty clear that you still like Mahindra & Mahindra. You don't expect Tesla to really disrupt that market, at least their market, too much. So what else? When you're talking about high growth opportunities here in India, we've always spoken about some of the banks, the large banks that you've liked. Anything else that you're taking a closer look at right now?
Yeah, Surabhi, some of the cleanup I've been doing across my portfolios has really included aligning across some of the big thematic drivers of growth going forward. So we've talked about how artificial intelligence can play into this, names that are using artificial intelligence to better enhance margins or find client data or expand. Geofinancial has been a name that I've liked more and more. It's still working across the market. Changes to how people are consuming, so names like 197 Paytm, that's another name that I think continues to look attractive. I've been a buyer of that on dips. There haven't been too many of those over the past number of months, but that's another one that I think analysts have not liked for a long time. And you continue to see the name beat that, and people have to catch their expectations up. So I think there's a lot of opportunities across, more unique types of names, and also weakness across travel. After the Air India travel, you saw a little bit of a sell-off to Interglobe, but that's another very high-quality name. They continue to order a number of new planes, and they fulfill those orders and continue to place more. And so when I look at where the fundamentals stand there hasn't really been that much of a dent to actual travel. And when I listened to what Delta in the US was talking about last week when they reported earnings, you haven't seen too much of a change. So that's another part of the market that I like to buy on weakness.
Hi, Matt. Good to see you. And Matt, so in terms of the entire global equity setup, it appears that India is standing out for you, and you have been maintaining that stance as well. So if you're allocating fresh money to the global equity markets, how much does India get and how much the rest? If you could just break that up for us. First, if you're allocating money between debt as well as equity and gold, and then in fact, within equity, how much does India get?
Yeah, great question. And so when I look at the portfolios today, fixed income isn't as compelling as it used to be as a diversifier, particularly U.S. Treasuries, given some of the uncertainty that's out there at a macro level with respect to the Fed, the Big Beautiful Bill Act that was passed. That's going to benefit equities much more than fixed income for right now. But I like gold as a diversifier. If you're concerned about volatility in the market, I think gold continues to look compelling. You still see strong central bank buying, especially from China and Russia. I think there's a number of reasons to have support there. So a couple of percent in gold in a portfolio, I think is a great way to help diversify. When I look at an equity book overall, which I think one should be overweight equities in this market because this is a risk-on environment and the fundamentals across markets like the US, India, Europe continue to look very, very attractive. So India, for example, in my portfolio represents over 10% weight, which is the largest single country weight outside of the United States. It's very overweight relative to what it is in a global portfolio, but I think the fundamentals justify it. You cannot find the level of GDP growth that India is producing that's expected to sustain over the longer term, along with very solid earnings growth potential that's being realized and continuing to increase with respect to expectations. So I think investors are very underweight to India from a global perspective. And as flows start to catch up, I think that can benefit, especially passive flows with a weak dollar. You should continue to see money move into emerging markets, broadly speaking, which can also benefit India as you see those passive flows start to move into the market. So that's the general setup for how I would look at risk in a portfolio.
Matt, a lovely conversation as always. Thanks very much. Appreciate you joining us here on CNBC-TV18.
Thank you.
Well, let's talk about the inflation numbers here. The June consumer inflation comes in at a 6.5-year low of 2.1%, lower than CNBC-TV18 poll of 2.3%. Now, to look at these numbers, here's the editor's take with Lata. Lata, morning.
Good morning. Yes, an ultra-low inflation number. It's a 6.5-year low, the lowest since January 2019, just for the record. But importantly, it's been dragged down by food inflation. We can't even call it food inflation because it is deflation. It is minus 1.06. Prices have fallen by that much year on year. And the CNBC-TV18 poll actually expected flat, 0.1% rise. But this has come in deflation. And remember, the WPI also threw up a deflation in food. It's something we have to watch. To be sure, there is a high base, but this is an important level. The big fall is coming because of even month-on-month falls in cereals and pulses. Normally by June, this fall in prices stops because, there is monsoon dislocation of, supplies. As we look at veggies are up 7.5% month-on-month. June over May, which is normal. I mean, because again, supply dislocation, vegetables begin to rot. But if you look at the year-on-year, vegetable inflation is down by about 17%. So that's the extent to which food is not an issue. Core CPI has come in at 4.4%. Core is when you take out food and fuel, whatever is left, largely services. That's come in at 4.4. That also because it includes gold. That's also because there is a low base. All this base will evaporate. Even gold will plateau on year-on-year terms. So we are going to see core inflation also falling. The expectation is July is going to be below 2%. 1.8 is a kind of the dipstick survey for me. And there was one person with a reading of even 1.5%. So that's the kind of low for the full year. Most people are now looking at, below 3% below 4% for all of 2025 calendar. For the full year FY26, people are now looking at 3.3, 3.4. 12 month, that is 3.3, 3.4. RBI is standing at 3.7. So now the market is pretty sure there is space opening up for another cut. And more importantly, that liquidity will continue. See, if too much money is not pushing up goods prices, that's what you normally worry, too much money chasing goods and pushing up prices. If that's not happening, then, the Reserve Bank will be more relaxed with liquidity. So chances are we are going to, start seeing the bond market pricing in a rate cut. Yields didn't fall yesterday. They were open. The bond market was open when the numbers came. Yields didn't fall. That was because of US yields going up. But space for rate cut is clearly opening up.
Okay, all right. Thanks a lot for that, Lata. Well, time to slip into a quick break. On the other side, we've got a lot of stock-specific action to track for you. We get to that in just a bit in our special Top 10 segment. For the time being, I highlight the list. Sun Pharma, Rallis India, Power Mech Projects, Railtel, Oberoi Realty, Inox Wind. All of them will be reacting to positive news flow. You have HCLTech, City Gas Distribution Companies, Tata Tech, Tejas Networks will be reacting to negative news flow.
Welcome back. So like we've been telling you that cues across Asia are not too bad actually. Even some of the regional markets like the Hang Seng, for instance, is up almost 1% right now. Now, will some of it rub off on us or not is the question. The Japanese market's up, the Hong Kong market is up. Let's look at the implied open. Implied open last time was absolutely flat. Yeah, it hasn't really changed much right now. So we'll see how it plays out. But as always, lots of stocks to track. So our team is standing by with the CNBC-TV18 list of top stocks to watch. Guys, morning to all of you. Rima, let's start with you. HCLTech, a lot of focus on the margins for obvious reasons. But you tell us, what did you make of the numbers?
Well, clearly there is a margin miss. So Q1 was a mixed bag. Revenues were muted, but in line with expectations, maybe even ahead.
but margins disappointed, and the company has lowered the full-year margin forecast from 18 to 19%. It's lowered by 100 basis points to 17 to 18%. And that's because in Q1, margins declined by 160 basis points sequentially to 16.3%, impacted because in one project, there was a delayed ramp-up, but the company had already staffed strength, so utilization had declined. There was a client bankruptcy, plus higher generative AI and generally investments. The full-year revenue forecast has been narrowed from 2 to 5%. It's increased to 3 to 5%. That said, the company said they haven't seen a deterioration in demand. There were 2 large deals which, for procedural reasons, not because of macro uncertainty, got pushed from Q1 to Q2, so that is likely to close. But the interesting thing is that we'll watch in greater detail as it unfolds, is the company has planned a restructuring exercise. It's non-HR, which means they're planning to optimize some of the underutilized assets, in land, etc., or offices that they have, but also on the people side. And that is also going to impact. There's going to be a one-time cost associated with it. So with respect to people, what they plan to do is going to be of interest for everyone. Back to you.
Okay, all right, Rima. Thanks a lot for that. Well, let's hop across to Ekta. She's here to tell us about Sun Pharma. Morning, Ekta.
Well, yes, I'm watching Sun Pharma because they've announced the launch of the specialty product Lexcelvi in the US markets. This announcement of a launch is after the settlement of a patent dispute with regards to this particular drug. Lexcelvi, remember, is approved for alopecia at this point in time. And this is basically one of the key launches in the specialty segment that the street was watching out for. It has come probably a little earlier than what the street had anticipated as well. Now, analysts say it could be around a $300 million product over the next 3 to 5 years from this particular date of launch, and could probably even scale up to be the second largest product after Illumia, which is in their specialty portfolio.
Okay, all right, Ekta. Thanks for that. But going back to Rima, she's had a very, very busy evening. But Rima, you're off the blocks first. You'll be done first as well. But tell us, Tata Tech and Tejas Networks, both of them came out with numbers. How were they?
So Tata Tech Q1 was disappointing. The company's reported a revenue drop of 4.6% quarter-on-quarter. Margins missed street expectations. EBIT margins at 13.6%. But what the street may like is the commentary, because the company is optimistic about a sequential recovery in Q2 and a stronger second half of the year. Tejas Networks is a disappointing set of numbers. But here you remember that numbers are generally lumpy. But this quarter, revenues have fallen between 85 to 90%, both quarter-on-quarter and on a year-on-year basis. And the company says this is on account of the delayed purchase order from BSNL. There were certain shipment clearances for a few other customers which got delayed. Now, because revenues declined 85-90%, this time the company reported a loss of 126 crore at the EBITDA and a bottom line loss of more than 190 crore rupees. Back to you.
Well, that is Tejas for you. And, Tata Technologies, of course, is the company which we're going to focus on. And coming up at 9:30 with a conversation on the numbers. Well, city gas distribution companies are the next set we're going to focus on. Sud is here to tell us why these should be in focus. Good morning.
Morning, Prashant. So yesterday in the evening, late evening, PNGRB, that is the regulatory body for the oil and gas companies, has issued a public notice for city gas companies flagging irregularities in the pricing for the supply of gas to domestic consumers. PNGRB is saying that some of the city gas companies are following telescopic pricing structure in the supply of gas to domestic consumers. So what does this telescopic pricing structure means? It means that if you are using gas above a certain threshold, you will be charged extra. And PNGRB believes that this is in the violation of rules. It's applied to another sector like power, but as far as city gas company is concerned, it's not in the rules, so it's in the violation. Now, PNGRB has asked city gas companies to review and find out if there is anomaly and to follow a uniform rate irrespective of the usage. Now, why it is negative for city gas companies? For example, for MGL in FY25, domestic PNG had found 14% of total volumes, while for Gujarat Gas and IGL, PNG domestic formed 8% of total volume. That's the reason I'm going with red for these companies.
Okay, all right, so got it. So the regulator's watching closely, and it doesn't want any discrepancies in the way piped natural gas is priced. Thank you for that. Let's quickly move on then and talk about Rallis India. Sonal is here with the update on this one. Morning, Sonal.
Good morning. Well, it was a good set reported by Rallis after a lot of quarters of disappointment. So it was a revenue growth of 22%, EBITDA was up 57%, a margin expansion of 300 basis points to come in at 15.7%, and profits doubled on a YOY basis as well. The company says it was led by good volume growth and double-digit growth across their segments. And in terms of their segments, crop care did well, revenues up 16%, seeds revenue grew by 38%. So it was a good set. We'll be watching out for management commentary in a conversation that we'll have later on the show.
Indeed, we look forward to that. Rare voice. Thanks, Sonal, for that. We'll try to get some clarity. The management, remember, will be joining in at 9 a.m. to detail their past quarter's numbers and the way ahead. But let's wind this down with Vamakshi. She's joining in to tell us about some stocks in the news. Morning, Vama.
Good morning, Nigel. Let me first start off with a couple of order wins. Keep an eye out on power mech projects. They managed to secure 2 orders worth 551 crores. One order worth almost 500 crores from SJVN Thermal and a 53 crore order from Jabua Power Limited. RailTel is the next counter we're watching out for on the back of an order win. They've received order from the East Central Railway. This is an Kavach order which is worth almost 264 crores. So going with the green for both of these counters. Oberoi Realty, on the other hand, a consortium that was led by the company has won 919 crore resolution plan for Hotel Horizon in Mumbai's Juhu. Keep in mind that Hotel Horizon owns a prime 7,500 square meter land parcel in Juhu, and this acquisition aligns with Oberoi Realty's core business strategy. So green for this counter as well. And lastly, keep an eye out on Inox Wind, going with the green for this counter because there is a board meeting that is scheduled on July 17 to consider fundraising plans via rights issue as well as some other means. So watch out for this counter as well.
Okay, all right, we certainly will. Vamakshi, thank you very much for that. So let's quickly recap our list of top stocks to watch. The ones that have positive news flow around them are Sun Pharma, Rallis India, Power Mech Projects, RailTel, Oberoi Realty, Inox Wind. Stocks with negative news flow around them would be HCLTech, City Gas Distribution Companies, Tata Tech and Tejas Networks. Okay, that's a stock list for the day. Let's quickly move on to commodities now. We have Manisha joining in with a roundup of all the overnight action. Manisha, good morning. So what are the big headlines?
Morning, Sylvie. Thank you for that. Well, the headlines really are in sense of profit-taking that we've seen across both. The crude oil prices extending decline, 2% of a fall overnight. Markets were anticipating an immediate U.S. sanction or restrictions on Russia. But what we have is U.S. giving Russia a 50-day deadline to agree to a ceasefire. So there's no immediate action. And the U.S. while has warned Russia of further sanctions up to 100%, but that's not happening immediately. So it's 2 months away, and that is what the markets have led in sense of easing of prices. Also, U.S. putting higher tariffs for partner countries does not augur well for economies and demand going forward. That is the other reason that you have seen a decline coming in for. But it's not just about energy. When you look across at metals, it's a similar scenario here as well. Gold and silver prices fell 0.5% each overnight. Copper is down 1%. Platinum down 4% as well. What the markets will want to watch out from here is the U.S. inflation numbers, industrial production and retail sales. So there's a lot of data coming in the next 2 days, and that is what would give markets reaction.
All right. Manisha, thank you very much for that. Well, we'll take a quick commercial break here. We're going to come back with Amnish Agarwal of PL Capital for some fundamental stock conversation. We also focus on Tesla's first India showroom right here in Mumbai, which opens up. Our colleague Parikshit is standing by with details there.
Welcome back. You're with us on Bazaar Morning Call. Well, let's focus on the big event of the day, and the Tesla wheels are rolling into India. The launch event is slated for right here in Mumbai. It's going to be at BKC, and Parikshit is already on the ground to get us all the action. Parikshit, so I mean, it's become a bit like the iPhone event, right? But I don't know if people are already queuing up or not for those cars. But a big moment for Tesla.
Of course, it's a big day, and there is a lot of crowd gathering here. Right now, it's a lot of camera persons, but I'm expecting a lot of people to be here shortly, especially once the showroom opens. It's only going to be the media and influencers today. We've got the slot at 10:30 this morning. The showroom is right behind me. In a short while, you'll have the Maharashtra Chief Minister, Devendra Fadnavis, who will be coming. The Maharashtra Transport Minister, Pratap Singh Naik, who will also be here. Through the day, there are at least 3 sets of launches that will take place. Tesla will be giving a briefing as to what will be the timeline for bookings and deliveries. All of it is going to happen very soon. Tesla knows the importance. They know that there is competition building up. In fact, as we speak, VinFast has opened up bookings for the India market. VinFast is the Vietnamese EV maker. But very quickly, I'm going to ask my camera person to pan in. The car that you see over there, which is kept under wraps, it is the Model Y. For the moment, they're only launching the Model Y in India, which is a compact, mid-sized SUV. It can give you a range of around 530 to 540 kilometers. The top speed is around 200 kilometers per hour. It can go from 0 to 100 in 4.6 to 5 seconds. Will there be more products? Well, the company tells us, yes, there is a product pipeline in the Asia-Pacific region. They can bring in many more cars rapidly, but they don't want to glut the market. They want to gauge the customer response. Currently, the Model Y that is parked behind me, it has a cost of around $37,000 in America. In India, that is around 32 lakh rupees. Add to that a 70% duty, and the car would cost you around 52 lakh rupees. So that's a high price point, but you get all the bells and whistles. The latest upgrades, this car also has FSD, or full self-driving option, under the driver's supervision. So let's see if that autopilot and all these autonomous driving features are offered here as well. But some disappointment, Elon Musk is not likely to be here, but there will be some global teams which will be briefing the media about the India launch.
Very interesting indeed. Action-packed. How will India greet Tesla? And how will Tesla make sure that it perhaps does the necessary tweaks to appeal to the Indian market? So indeed, big day for the automotive sector. Thanks very much, Parikshit. We'll keep coming back to you. It's going to be a busy day for you, and we will keep coming back to you for all the updates. Well, that's the big story with the global EV giant all set to roll out in India as well. With that, let's move on to our fundamental guest of the morning, Amnish Agarwal, Director Institutional Research at PL Capital, is with us. Amnish, morning. Thanks for joining in. You know, we were just talking about this earlier as well before you joined in, because the market for now is not too worried about Mahindra and Mahindra. We just heard Parikshit talk about the price points, and it seems this particular, the first model that they're going to sell, it's going to be between 50 to 60 lakhs. So would you say that M&M current shareholders don't need to be worried at all? Or could it trigger some kind of profit taking just because the stock has done so well?
Yeah, hi. You see, if you look at, say, M&M, its portfolio and the way it is positioned, I think there will not be any impact on this. First of all, the price points are very different. Secondly, if you look at EV sales, for example, you look at Tata Motors, some of the other companies, they were rising very fast, say 12 to 15 months back. But since then, the sales have actually come off, and now the growth is not much there. Even globally, the EV sales are not rising as they used to be in the past. So I don't think that in the foreseeable future, EVs are going to fully replace or make a substantial dent in the market for, you can say, internal combustion engines. So to that extent, I think there will not be any major impact which is going to come on M&M or for any of the ICE engine companies in the near future. And I think given the fact that M&M is the only PV player which is giving you double-digit volume growth, plus, even the tractor outlook seems good. Given the monsoon outlook, I think M&M actually is a good stock to pick up at the current levels.
Okay, got it, Amnish. And in fact, history as well suggests if there is some nervousness because of a new entrant Tesla, then Mahindra, if you bought it, then you've made money. So let's see how that goes. That said, tech has started off earnings and it's actually been disappointing. What's your view on the tech stocks? And will you all be looking to buy into any of these stocks if there is weakness?
You see, we have been negative on the tech stocks, and I have been underweight on this from, say, I think at past few quarters. And my belief is that till the time there is, you can say, there is some pickup in demand from Europe, both in auto and some of the other segments, and there is, you can say, end to this geopolitical uncertainty, plus this tariff, you can say, news daily going up and down. I think the major players in US as well as Europe, they are not going to increase their tax spends. So given this backdrop, I think there is going to be uncertainty in the near to medium term, and the growth rates are likely to remain low. Given that, and the valuations for most of the companies still in a band of 20 to 25, I believe that many of these stocks are just dividend yield, and I would still tend to avoid all the tech stocks at the current juncture.
Okay, all right, got that, Amnish. In terms of more sort of stocks in focus today, we're watching out for the entire city gas distribution space, because there's some chatter on the regulatory front in terms of how they're pricing pipe natural gas and whether there's an anomaly. So the regulator is looking at the companies with the clear magnifying lens. How do you find the space overall? MGL, IGL, what's your current call?
You see, if you ask me in the longer term, the city gas distribution companies, they have not grown in a very, very significant manner, because for many of these companies now the competition is open. That is one. Secondly, the margins which they are making are already healthy. There is not big room to, you can say, increase the margins from here. These are highly cash generating companies, and the dividend deals are there for many of these. But having said that, these are not growth stocks. And so if someone who is looking to buy into these stocks from the viewpoint of making appreciation, I think that is something which might not materialize even over the medium to long term.
Okay, all right. Just coming to you with more specific questions, but HCLTech is the other one we want to talk about, right? Mixed set of numbers for the first quarter, margins coming in below expectations. In its earnings call post numbers, the CEO and managing director of the company said that margins were impacted due to lower utilization, delayed ramp-up of projects, a project actually. Listen into some of that commentary.
We observed that the environment remained stable from an overall perspective, with some variations across specific verticals. It also did not deteriorate as feared at the start of the quarter. Our operating margin came in at 16.3%, which was lower than our plan. While Q1 has been historically the weakest quarter for us, the below plan operating margin was driven by the fact that our utilization dropped due to a delay in ramp up for a specific program. We also had a one-time impact from a client bankruptcy. We had a couple of large deals in the pipeline which were expected to close in Q1. These deals have moved to Q2. This delay is unrelated to external factors or macro factors. We are optimistic about their conversion, and if all goes as per plan, the TCV number should see a step up in the coming quarter.
Sandeep Agarwal is now with us, fund manager at Sovilo Investment Managers. Sandeep, good to have you with us here. Good to have you back on the program. Prashant here. What's your sense, Sandeep? The numbers that you've seen so far, the commentary seems a little bit more grim, optimistic. I mean, it kind of sort of ties in with what your view has been for a while.
Yeah, hi, good morning, Prashant. And if you see the numbers, they were really, not what we have anticipated and the street was expecting. So lower numbers. Unfortunately, the bigger problem is that, margin guidance have been brought down. Now, if margin guidance is brought down by TCS by 1%, the impact on EPS is 4-5%. But if it is brought down by HCLTech, the impact is 7%, 6 to 7%. So that is the biggest challenge. And, it clearly reflects what we have been saying for quite some time now, that this is a mature industry for large caps to grow beyond 5-6% on a steady state basis with slight improvement in EPS due to buyback. I don't expect beyond that anything on that. And to that extent, all the stocks are very highly priced in the large cap, mid cap and small cap. While growth in mid cap is 2-3% higher and small cap is 4-5% higher, but the PEG ratios are even much higher. So I think the sector is very mature, primarily because outsourcing has peaked out. to a large extent in the major market, that is US. Now the incremental outsourcing is very, very low. We are at 96% market share already. I think, this industry is now mature for growth. I don't see big growth coming in next 4 or 5 years at least.
4 or 5 years, grim, unless the models change. Sandeep, hi. So, HCLTech is speaking about some sort of a restructuring. Now, we don't have too many details, but I think they're basically saying that it's aimed at bringing margins eventually back to above 18%. They'll look at better utilization of their facilities outside India, etc. How do you view this exercise? I mean, and they're also talking about Gen AI costs, etc., upskilling. I mean, basically my question is, how do you rate these large IT services companies' attempts at trying to remodel to capture more of this Gen AI opportunity?
So I will tell you that, last 30 years, I've seen many disruption, but nothing like Gen AI and agentic AI. This is complete disruption of the business model because efforts are going down so much. I will tell you our own personal experience. Our efforts within the organization with use of Gen AI has gone down by 70-75%. Now, if that is the pace at which we, a small firm, are able to reduce the efforts, you can imagine what kind of effort reduction would have happened. Now, what is happening right now, because of that, the bench strength or default bench strength or the utilization is showing up in numbers which is lower. What companies will do, in my view, in next 2 to 3 quarters, they will start recruiting lesser and lesser number of people. They will try to first use the bench. So some improvement in margin will show up, but growth will not come because efforts are substantially going down because of use of this newer technology, which has not happened in the past disruption. So this disruption is really killing the efforts which are going into the system.
Do you have an estimate? I know this is tough to gauge at such a wide global level, Sandeep, but you gave us an example that for your firm, the effort required is down by 70%. I mean, just in terms of sheer manpower because of Gen AI. So what is the cutback that we are perhaps going to see over the course of this year and maybe even next year in just the requirement for bread and butter type of IT services?
So I think the volume will substantially go down every year. So the growth which we were getting earlier, 7-8% kind of growth and volume or efforts, I think that growth will be muted to 4-5%. Remember, it will be a slow process because the technology itself is evolving. So as you get the new client, new requirement, which is generally 1 to 2% of total budget. So it takes 4 to 5 years to, see the whole impact. But in my view, that's the reason I'm saying 4 or 5 years, you will see 5-6% growth in best case scenario for the large names. Beyond that, I will be very positively surprised unless, these companies are able to reinvent and, bring in some platform revenues and some massive change and restructuring in the whole business model. Otherwise, 5-6% effort growth will be a very, very good effort growth in my view.
All right. Hi, Sandeep. Good morning. Good to hear your thoughts. Sounding a little bit cautious, though, and a little disappointed with the numbers that you've seen so far. I wanted to ask you particularly about, not the large IT companies, but the more mid-sized, like a Tata Tech, or a Tata Electric. Now, some have been saying, in the last 3 years, you've made no returns on big tech. But if you bought these companies, then you're actually down 35-40% as well. But still, the numbers not very, very impressive. What do you make of these stocks? Is it providing you an opportunity? Because once growth picks up, then these guys will outperform on the growth side. But in the near term, there is a lot of uncertainty.
Yeah, hi, Nigel. It's a very good question. So if you see the ER&D space and the non-traditional IT services space, they are going to grow at least 4-5% higher than the traditional IT services, which is the space where, some of the mid-caps and small caps are operating. There is some challenge in Europe, auto, and some places there are some problems. Because of that, these companies are struggling. But the question is that, even if, let's say, these companies are able to grow at 11-12% for next 4-5 years, on revenue terms, the margins cannot go up substantially because they are doing good margins and the wage cost hike is real. So in that case, if you are giving them 40-45 multiple, I think that is too much stress. So in my view, the problem is that where there is growth, the multiples are very demanding. And where there is low growth, there also multiples are demanding. The only rationale which I see today, even when we manage our PMS internally, is that, we will replace some of the FMCG stocks with technology stocks because the growth numbers are similar, but the multiples are 30-40% cheaper than FMCG. So I see only that rationale to buy technology today in my fund. Other than that, there is no fundamental rationale to buy these stocks, even after time correction, price correction, which has happened.
Guys, you should listen to the this
Says it as he feels it. Sorry.
The Anthropic CEO, who was earlier with OpenAI, his interview on CNN, this is, I think, about 10-15 days back, just absolutely, because, everything is coming from there. We are kind of sort of reacting to it from the US, essentially, from 3 or 4 large companies, right? Yeah. So, I don't know if you wanted to scare everyone, but that's...
I think Sandeep's also done a good job of that. He's sounding very dire, but I guess it's that level of disruption that we're seeing.
I mean, that's what he believes, but I know Sandeep has strong views on this as well, but we'll get him back and we continue to chat with him about this. Thanks very much, Sandeep. Great to have you with us here. Appreciate your time here on CNBC TV18. What we'll do is take a quick commercial break here. We'll come back with some technical trading ideas. Sudarshan and Mitesh on the other side. Okay, welcome back. Sudarshan and Mitesh are with us with technical trading ideas. Gentlemen, morning. Great to have both of you back with us here. Mitesh, we tested the 40-day exponential on the Nifty and then kind of sort of bounced a little bit. The Nifty bang around the 20-day. What is your sense? Will these levels hold where we are, or maybe a little bit more on the downside?
Morning, Prashant. See, my idea is that the Nifty has turned slightly negative, and there's a good chance that even if there's a pullback, I think we'll find it difficult to get past 25 to 300 zones broadly, and a good chance we will test 24,850, 860 levels to begin with. In case we break below them, we'll look for a slightly deeper correction, but the overall belief is that we are more likely to head towards 24,850, 860 to begin with, and then maybe lower. And rallies should be used to take some kind of short exposure on the index around this 24 to 300 zones.
Okay, so looking at maybe some shorting opportunities. Got it, Mitesh. A morning to you as well, Sudarshan. What would your index call be, Nifty or Bank Nifty?
Yeah, good morning. See, the Nifty has been a little bit of some kind of a tiredness has come in the Nifty. That sense of tiredness brought the Nifty down 600 points. There was no big reason. The market just got felt. It had nothing to do, so it fell. In the same way, I think the markets can rally because there's nothing to do. There's nothing upside, nothing on the upside, nothing on the downside. This rally should be used to sell, and Mitesh is quite right. If we see 200 to 300 points of an up move, that's a shorting opportunity. Buy put options at that point, somewhere around 25, 300, 350. It's difficult to give a level because you don't know where the rally will stop or end. But that is the trade. Now, intraday trades is for today, they are both, because the markets are a little confusing, you look to buy an intraday trade and look to short a positional trade at higher levels.
Both sounding a little bit cautious on the index. Good morning, gentlemen. Sudarshan, you go first. Individual stocks, what do you have on your radar?
Well, I have Fortis, and despite the big rally, there is a buying opportunity in Fortis with a stop under 739. Adani Green is a buy with a stop under 975. AB Capital has been a consistent outperformer. That's a buying opportunity still with a stop under 263. And a very unusual stock for me, Patanjali, which went into a bear market, has been moving sideways for more than a month, may be a positional buying opportunity. It's worth finding out. Keep a tight stop at 1580 and buy it.
By Sudarshan, you have any specific trades on IT names?
No, I've just heard that commentary and that was so depressing. IT is not the favorite sector. Technically, if you see the charts, you will see it making a complete underperformance.
Yeah. No, I meant trades on the sell side. I mean, maybe not. It's already kind of sort of corrected already. Mitesh, for you?
I have a mix of buys and sells today. Though on some stock side, there are buying calls, but to me, IT looks a weak sector. But I'll just cover the calls first. Hindustan Zinc, and I think there's some traction with silver prices making higher highs. Hindustan Zinc is a buy with a stop at 430 for targets of 450. Adani Green is a buy with a stop below 1,000 for targets of 1,080. A sell on AU Bank with a stop at 816 for targets of 780, and Biocon is the final buy call. Keep a stop at 372. Look for targets of 395.
Got it. All right. Thanks a lot for that, gentlemen. Well, for the time being, we take a short break. Come back, we'll get a pre-open rates. We'll also be joined by the management of Rallis to discuss their first quarter numbers. Welcome back. Well, in a few minutes, we'll get the pre-open rates that should come up for you on the screen. But let's continue our conversation with Avnish Agarwal. Avnish, what about companies like Rallis? The numbers look quite good, but a couple of brokerage reports suggest that you don't need to look at quarter one in isolation. Maybe quarter one and quarter two clubbed together will give you a better picture. Any view on this name?
You see, Rallis has been actually underdog from the past few years. And as you rightly said, 1Q and 2Q, depending upon how the monsoon plays out, how the placement in fertilizer pesticides are. So there is usually a lot of fluctuation, and one should look only at 1H and 2H for Rallis in particular. But having said that, at least in the 1Q, the numbers are better on a YOY basis, so that is positive. But the issue with Rallis has been the consistency in performance. So if they are able to sustain this kind of a performance, if they are able to show better numbers on a YOY basis, on a sustained basis, even in the coming quarters, then one should be looking at the stock.
Okay, all right, got that. Avnish, wanted to ask you about a couple of other names then. From the FMCG pack, what do you like? What's your top pick out there?
You see, currently ITC is a stock we are positive about because the stock actually corrected from above 500 to the current levels. That is one. The second is that currently it is facing a lot of margin pressure across business segments, whether it is cigarettes, whether it is paper and paperboard, and even in FMCG, both margin and sales are under pressure. So our view is that maybe by the end of 2Q, all these margin pressures will tend to abate. And there are early signs of that already visible. And once that starts happening, I think the momentum will come into this stock. And given the fact that the growth rate visibility is not there in most of the other stocks, many of our earlier recommendations, they have more or less played out. So ITC currently is the top pick in the staple space.
Top pick in the staples place at this point in time. Just a couple of more names, if you have any thoughts. And we're speaking with, by the way, this company later today. Ola Electric actually was the #1 volume-led gainer yesterday. And of course, has been a bombed-out name, ended sharply higher. Any views here, Amnish?
You see, Ola has been actually going down if you look at past 2-3 quarters, quarter on quarter. And the issue with Ola has been that over the period of time, they have lost out on volumes the way they were growing year and a half back. So they have lost back on volumes. That is one. Secondly, there were a lot of quality issues which had come with the company. So I think at the current juncture, it is more like you can say if someone wants to take a punt on the speculative news or the market, say, then one can have a look at stocks like Ola. But otherwise, I think it is very difficult to take a fundamental call at this point of time.
No, absolutely. I just want to make a quick mention. I don't know if we have the if you have the Hang Seng Index, the live rates, if we can show it up, or we can show it what's happening. I think there is a bit of a bump which we've seen come through since we even started, actually. So the Hang Seng, if you can able to pull it up. Okay. I don't know if this is live, but I think from where we started in the morning when I was looking at it, there has basically been a bit of a bump which has come through. I'll give you the news, basically. The news is that Nvidia, essentially in a blog post, has said that they are planning to resume sales of their advanced H20 AI chip to China. This is the sort of new information which has been revealed about 30 minutes back, basically. I think even there is some reaction on NASDAQ futures as well. Nvidia is a big component of the NASDAQ. This is a significant change in tone, basically, because export controls with regards to the AI technologies, AI chips, etc., have been expanded by the US government in April. So this is a change in tone and tenor that we are looking at. More on this story as we kind of go along. But it's important with, of course, the bigger global stuff which has been in focus. Amnish, just one more name, and this is largely defense, which has taken a bit of a breather. Is it just a breather after the breathless rally we've seen? Garden Reach and BEL and HAL, everything just sort of calming down over the last 2 or 3 weeks now.
Prashant, if you look at, say, from the middle of May to, say, the middle of June or even, say, end of June, so many of these stocks rallied by even, say, 25, 30, 35%. If you look at the ordering momentum, that is very strong in all the defense companies. That is one. But having said that, now the valuations are not cheap. Whatever valuation gap was created in the month of March and April, now that valuation gap has got bridged. Will these companies grow well over the medium to long term? The answer is yes. But in the near term, I think many of these stocks might have, you can say, very little room for an incremental upside. And that is why we might see sideways or the weaker movements in many of these stocks from the current levels. However, in the long term, they continue to look good. And for the investors in particular, if you want to enter the stocks now, then you need to have 2 to 3 years kind of view on these stocks.
Thanks a lot, Amnish, for joining in. Wishing you a good day ahead. We catch up soon to chat about stocks and the markets. Well, let's focus on one of the names we're just discussing, Rallis India. That's the first management on the show. It reported a good set of numbers in the first quarter. Strong margin expansion. The company says that EBITDA growth was driven by volume growth. We're now joined by Gyaninder Shukla, the MD and CEO at Rallis India. Hi, Mr. Shukla. Good morning and congratulations on a good showing. I think we'll need to look at it as quarter one and quarter two together to get a better sense. But it appears that first half of the year is going to be pretty good. Now, you speak about strong volume growth this quarter. So could you help us out? What was it in crop care as well as the seed business? And what is the volume growth you're targeting for FY26? Please go ahead, sir.
Yeah, thank you very much. Good morning to everybody and listeners. Look, yes, one of the things is that this year rain has started on time rather early and has been fairly good spread of rainfall. That obviously brings cheers to the agriculture sector. So we are beneficiary of that. We had revenue growth across all three sectors. We and have been talking about three business segments we operate. One of them is crop care, where you have crop protection products as well as soil and plant health product, and then we have a seed business. And within crop care, we have domestic business as well as export business. So there has been, yes, a significant uptick across the segment. I cannot rule out any one particular segment. And as for the fiscal year 26 forecast is concerned, as we said, our goal remains to start delivering high double-digit growth, over next horizon.
Double-digit revenue or volume growth?
Revenue growth. Now, revenue always is a more important criteria because sometimes you have to take a pricing decision. It's a combination of price and volume all the time.
All right. So double-digit revenue growth with mid-teens margins, or better than that, or a little less than that?
Well, I have been saying from the beginning we want to improve our margin from the last year, where we ended by 500 basis point on a long-term basis over a period of time.
Okay, all right, got that. If you could help us out, sir, how much were exports as a percentage of your total revenues? How did they grow? And you've been talking about the gradual recovery. Could you tell us how do you expect it to grow? And also, since we're talking about exports, just wanted to understand, will your company be better placed because of the tariffs that the US is putting on various countries in the world?
So of total 957 crore revenue we recorded, export is about 190 crore. Now, this changes from quarter to quarter. I think relative to last quarter, certainly significantly, we had a better quarter this year. But our CSM revenues were down because CSM revenues are driven more by agreements and the month you supply. But having said that, export market continues to, while it is continuing to grow on the volume side, prices have stabilized, but it's still a lot of uncertainty given the China tariff factor. So it's very, very difficult to say what will happen in the future. Having said that, we continue to develop our customer base, improve our customer base, our presence in the global market so that we can take the opportunity and be prepared for the opportunity whenever it comes.
Mr. Shukla, hi, morning. Prashant here. Two questions. One, the US-China, the US-India trade deal, right? I mean, agriculture is a thorny issue, access to markets here. And of course, the government will do everything it can to protect interests locally. But is that something you'll be watching for your business as an impact on the business? And second, has pricing bottomed across the portfolio? Different questions. Go on.
Yeah, so I think these trade deals, obviously, there's always some you gain, some you lose. So nobody knows what is there unless it unravels. So we'll talk about it when it happens. At this point of time, our focus remains on domestic business as well as export business. And on export, we continue to focus on delivering customer base, as we said, because I think we will continue to benefit in long term from China Plus One strategy, and we don't want to be left behind on that.
All right, Mr. Shukla, just to reconfirm, revenue growth in double digits is what you're targeting. Margins,
it's an ambitious target because industry grows in mid-single digit.
Yeah.
As a company, we have set out to grow ourselves, and that's goal, ambitious goal. But yeah, nevertheless, that's what our aim is.
All right, and on the export front, you said 197 crores out of the 900 odd crores is what you delivered. So more than 20% comes in for exports as of the past quarter. Yeah. And the margin improvement last year, on an average for the year, you've been doing last 2 years around 11 to 12%. So this year will be how much better? How many basis points better?
So overall margin, obviously, so gross margins more or less remain flat. I think quarter one also has a higher percent contribution coming from seeds. Seeds generally is a higher margin business. Also, yes. Plant health business is higher margin business. So that is reflected in the overall number.
So we should work with the margin number of around 13-14%. Would that be fair?
Well, difficult.
EBITDA margin, sir.
EBITDA margin, yeah, I mean, currently we are at about 10%. No, actually it's higher. Just let me see.
First quarter was around 15% because of the higher contribution.
I think as we move forward, I think quarter two is going to be more domestically important. It has less weightage on the seed. So I haven't worked out those numbers for the quarter two, but I mean, it's a mix of business that will dictate how things move forward.
But margin improvement is something that you're looking at, EBITDA margin improvement.
So as we grow revenue, we must improve our margin. That's our goal.
Got it. And you just briefly spoke about market share. You have spoken about that in the past as well. Q4, you said that, market share is something that you are going to be looking at. Give us a ballpark estimate. What is your market share in your targeted market? And how do you see that improve?
So it depends on the business segment. In India, one of the biggest challenges, nobody has a real idea about what is the market size of every segment. We don't have a systematic way of collecting data, but I can tell you, for example, in North India, where our Diggaj cotton is sold, we probably have become joint number one. That means, our volumes are up. That product is inching towards being a 100 crore brand now. So we certainly have moved our market position there, and that comes from the market share gain. Other markets, I think, is early season, is Q1. A lot of placement has happened. I think we have to wait for this further season to further play out before we can comment. I would say margin, market share we should see on a seasonal basis when Q2 numbers are out.
All right, Mr. Shukla, thank you very much, sir. Good speaking with you, and look forward to our next conversation, and hopefully by that time these deals, etc., would have been announced as well. Thank you. Well, let's just get you an important programming alert. This big CNBC TV18 exclusive coming up. The RBI Governor will be speaking with our colleague Ladha Venkatesh. And no big question, of course, is off the table. From inflation at a 6-year low to liquidity and global risks, what does it all mean for rates and growth? Catch the most definitive RBI Governor interview post-noon today only on CNBC TV18.
Okay, well, that's the big interview to watch out for. But in the meantime, let's quickly get back to the market as well. The pre-open has settled with the Nifty up just about 7 points. That's all that we're getting on the Nifty right now. Watch out for some of the earnings reactions. Rallis, the stock that we were just discussing, we're just speaking to the management, is up 5%. On the other hand, Tejas Networks is the biggest result disappointment since last evening, and therefore that stock's down 7% in pre-open. Okay, quickly getting back to our technical experts for some final trading ideas. Sudarshan, what would the 910 call be for you?
It'll be Adani Green, buy Adani Green with a stop under 975.
Okay, and Mitesh, what about you with stock?
Yeah, I'll go with a buy on Hindustan Zinc for targets of 450.
Okay. All right, gentlemen, thanks very much for that. Well, let's also revisit a couple of important notes and calls. And obviously, HCLTech is right top of mind this morning because of what's happened. I mean, on one hand, there is the top line decline, which is not as bad as the market feared, but then there is a big hit on margins. So, Rima, what's the bull versus bear case?
Well, just to revisit the key number in HCLTech this time, as you rightly pointed out, the revenue performance was not that bad. Minus 0.8%, and much better than the TCS, which was a minus 3.3%. But the company missed the mark on margins by a wide margin, and the company has lowered margin guidance by 100 basis points. It now stands at 17 to 18%. The brokerage verdict is mixed. JP Morgan downgrades HCLTech to neutral. They say AI deflation is playing out via margin erosion. Nuvama too downgrades HCLTech to a hold. Their target price stands at 1630. But on the flip side, there are upgrades to our bullish notes. So let me start with Jefferies, which has upgraded the stock to a buy 1850, because they said that while, yes, in Q1, we've cut EPS estimates very marginally, but the EPS growth for the next 2 years is seen at 10%. And this is a company which will continue to outperform peers and therefore deserves premium valuation. Nomura also maintains a buy rating, and they believe the street should ignore the near-term margin miss or the margin guidance downgrade, because by FY27, the management is saying margins will revert back to their earlier levels. Also, therefore, the street should focus on revenue outperformance, which is why Nomura has a buy rating. CLSA too has a bullish call outperform rating on HCL target price 1867.
Okay, quite interesting there. So the bull camp and the bear camp. But Rima, before you go, tell us about Tata Tech as well. Not very hot performance there either. Revenues down again for this company.
Revenues are down 4-5% on a quarter-on-quarter and on a year-on-year basis because of a negative, the revenue contraction. Margins have declined. 13.6% EBIT margins, lower than expectations. But here the management is sounding bullish. They say that we expect sequential recovery in Q2 and a stronger second half of the year. But brokerages are largely still bearish on Tata Tech. I think 17 of them look at it and only 2 of them have a buy call. Majority of them overwhelming majority have a sell call on the stock given the rich valuations and the fact that their key business, automotive, is facing challenges. So Ambit has a sell call. They're saying the current market price, implies a 34 times a forward valuation multiple. Citi is saying this is a company which is going to see a revenue decline of 5% in FY26. Goldman Sachs too has a sell call 560 as the target price.
All right, I think we're hitting market open with just a few seconds to go. So let's just look at what the opening rates are, and then we'll come back with specific stocks, etc. Indices, as always, first, and then we get into the other stuff. So 25,090 on the Nifty, absolutely flat. You got the Nifty Bank, which is absolutely flat as well. Sensex actually is all flat. 25,120 on the Nifty, 56,780 on the Nifty Bank. And like yesterday, you once again have the small cap index, which is up 0.5%. The mid cap index is up about 0.4, 0.5% or so as well. So, this is looking much better, about 0.5% roughly as far as broader markets go. And actually, even on the Nifty, after the last 2 days, there is a little bit of a bounce, which is appearing 50-odd points, 60-odd points, 25, 140 on the indices. Nifty heat map perhaps gives you a quick sense of how we are starting in one quick full sweep, and then we kind of look at some of the other, some of the individual movers and shakers as well. So if you're pulling that up, I think we'll just be able to tell you. It just gives you, a quick view of how many stocks are up and how many stocks are down as far as the Nifty is concerned. But let's get to individual stocks now. Surabhi.
It's actually not bad. It's a 60-point up move, and there you go. That screen has a lot more green than red today, so it's a good start for the bulls. Sun Pharma is in leadership position because of this drug that they're going to be launching. It's a specialty product. It's a alopecia drug in the US market at 1.5% up, makes it the top Nifty winner. On HCLTech, by the way, there's not too much disappointment. So that bull versus bear case that Rima very nicely explained, there is a bullish camp which is saying see through the near-term hiccups, and perhaps the longer-term story is not too bad, and the stock is recovering quite well. The other gainers today include Tech Mahindra. There's some buying around Jio Financial Services. Eicher Motors is up. Tata Motors is higher. Infosys is also up and about. Reliance. So a lot of big stocks actually are chipping in on the upside today. Mahindra & Mahindra, stock in focus with that Tesla launch, puts on another 0.5%. So overall, it's a really good-looking Nifty screen, you'd have to say. The downside really is not much. Eternal is losing some ground. Eternal is down almost 1% now. So Zomato is off the charts on the red side today. And that's about it. Ultratech, Cement, HCLTech, like I'm saying, is a little volatile. It's between 0.5% to 1% cut on HCLTech. But otherwise, it's not bad. 50 points for the Nifty. The question is, can the bulls hold on to this and build on to this? Nigel.
Well, a couple of stocks that deserve special mention from the broader markets. Rallis India, the management sounded quite optimistic, gaining market share. The export market is presenting an opportunity. For this year, they're going to grow in double digits with margin improvement. Street likes that. That's after the race is up 6%. The other one is Tejas Networks. The stock is down. Now it's less than half of what it was at the peak. Obviously, it comes from a very good parentage, but those orders are not coming in and execution seems to be picking up. I'll tell you what, we'll have the management of Tejas Networks sometime during the course of the day, maybe in the next 90 minutes or so. So we'll try to probe them and get further clarity on this particular name. One positive on the Nifty itself is yesterday's high has been met in the first hour itself, or the first few minutes of trade itself. So 25,151, that was the high yesterday. The last 4 trading sessions, we've been seeing lower highs and lower lows. So today, after a while, we're likely to see a higher high. That'll be a little bit encouraging as well. So explains why that one is up and about. And Power Mech, they've won an order, so the street likes that. That one is up close to around 3% or thereabouts.
All right, no, absolutely. And lots of stuff moving around. Market breadth is pretty positive. Newland Laboratories was up big time yesterday. Newland is up another 3% this morning. And it's the number 2 volume-led gainer across the board coming through. Rallis, of course, is right there at the top, as we mentioned already. Railtel is coming up with a 3% pop. Very large volumes for this point in the day. Deepak Fertilizer is up about 3.5%. Amber is up about 2%. Gillette is up 6%, 6.5%. It's got volumes as well. And that's the reason why we are mentioning it. On your screen, Triveni Turbine, Cupid has been moving, one way from $100 to 130 in 3 sessions now. So big move. Voltamp, there is Aeroflex, there is ABDL, the alcohol company, big mover yesterday. 2 days back, closed at 450, stocks at 500 plus now. AstraZeneca is up 4%, something like a Prime Focus. Prime Focus, by the way, was up, I think Circuit up yesterday. It's up another 3.5% this morning. So there is, and this is, by the way, I can go down, but then volumes start to disappear a little bit. But this is the bulk of what is going on at this stage.
Just wanted to point out, Prashant, that Rallis seems to have pulled up the entire agri/crop protection space today, because Rallis obviously is rallying on numbers. But look at fact, smaller stocks like Deepak Fertilizers, something like a Sharda Crop Chem.
Yeah.
So the whole agriculture space is definitely showing green today.
Absolutely. Well, let's, bring in our market master of the day. Mihir Vora is Chief Investment Officer at Trust Mutual Fund. Mihir, good morning. Great to have you with us here. Thanks very much. What are you seeing, Mihir, with, of course, earnings are just about kicking off and expectations are generally downbeat, muted, and IT has kind of shown the way in that sense. But what have you been busy with? Where are you focused on in finding opportunities? Because it's in large parts a fairly finely priced market. Let me put it that way.
Certainly. Good morning, Prashant. Always a pleasure to be here. So I think the market is in a no man's land, I would say. As you mentioned, there are flows which are coming in, and we've seen FIIs coming to the market. Domestic flows are strong. But on the other hand, the results season is likely to be a mixed bag. So there will be some pockets of disappointment, and there will be some good pockets. So I think it's going to be a very stock selective market, I would say. And the macro view is that liquidity, both locally as well as globally, will continue to be ample. So liquidity support will be there for the market. Fundamentals are a question mark, both in the more so, I would say, on the global markets, especially in the US, because of all the things that are happening there. There is a lot of uncertainty. China is also doing, it's a mixed bag. The Indian thesis is that while current data points are mixed on the economic front, the second half should be better because of the government initiatives and the liquidity that is flowing through. So I think for the next few weeks or few months, it's going to be a selective market and very, very stock specific. Results season should be very interesting.
But Mihir, hi, morning. The question really is, where can the pleasant earnings surprises be? The consensus is saying, I think that we'll get maybe 11-12% sort of earnings growth. But given how stocks are poised and where valuations are, where do you see maybe some pockets of pleasant surprises?
Sure. So if you look at sector-wise, my guess is that there are certain sectors which are coming off a low base last year. So these are usually the ones which we saw didn't do well in the first half of last year, linked to government spending. So some of the construction counters, the cap good counters, a lot of the government spending segments did see a slowdown, defense, railways, etc. So those are coming off a low base for the June 25 and September 25 quarters. So probably we have some kind of a base effect tailwind there. Metals also are coming off a low base, so you may see some pleasant surprises on the metals side. Banking's and NBFCs are going to be a mixed bag. So there it's going to be more a function of who has been able to manage the asset liability well. My guess is that on the whole, NBFCs on the retail side may show a little bit better results than the banks in general, I would say, because banks are still going to have some of the floating rate impact on their asset side because of rates coming down. NBFCs will be far more robust. So it's really going to be, pick and choose across the board. But in general, I would say the capex theme, the investment theme should continue to do well. Discretionary should pick up because we've seen some of the stocks really getting hammered down in the discretionary space, like some of the, consumer durables, auto stocks. So they offer good pockets of value. So while you may not have great results in some of these pockets, stock prices already are probably discounting a lot of the negatives.
All right. Hi, Meher. Good morning. Good to see you. What are you making of the recent Deal Street action? We had deals on SML Isuzu, you had AkzoNobel, and you had VIP as well. All those three deals got done at a discount in comparison to the traded price at that point of time. But all the three stocks, in fact, did well post the announcement of the deal, though the deal was at a significant discount to the traded price. Your view on some of these themes, do you believe, change of hands, change of ownerships, will you be betting on some of these stocks doing better in the time to come?
Absolutely. We've now had a good history of, in the last 10 years, we have seen some very good examples of companies either being taken over by strategic investors in the same field or by private equity funds and then done a lot of restructuring, management incentives, etc. And the outcome has been good. So in general, the outcome for the strategic stake sales has been quite good, because it does bring in a little bit of more professional approach, incentivizing the management, shaking up cultures at points in time. So there is a place for us being selective, but definitely opportunities do get created in the last 10 years.
All right, Mihir, got that. So bullish on some of these changes in management. Mihir, what about the capital market players? They were dancing away to the bank, whether you look at the CDSL stock or the stock exchanges, brokerages, wealth management. Now, some of them have pulled back considerably from the recent peak. We know that there's a long runway, but temporary volumes have fallen. Would you be looking to buy into this dip, or you say that they ran ahead of themselves, so they need to cool down more?
Certainly, there is always going to be a period of cooling off and correction, and that's what we are seeing. Though the secular story will not change, frankly speaking, we also had this, the big hedge fund issue that probably has impacted volumes a little bit temporarily. But we have seen that in secular growth stories, there is always going to be overshoot, there is always going to be undershoot. I'm not talking about stock prices, but in terms of the trading volumes, etc. But the fact remains that as income levels rise, as savings rise, more and more investors will come into the picture, and in general, the growth rate of these segments will be more than the 10-12% that we are seeing for the rest of the market. So these sectors in the longer term, at least for the next 5, 7, 10 years, will continue to grow at a rate which is faster than the rest of the industry or rest of the markets. So in general, if you say that, are these going to be, if you ask me, are these going to be pockets of outperformance for the next 3 to 5 years? I would still say yes.
Mihir, we were just discussing IT with a sector specialist a while back. And at least he had a very, very negative view, not from a quarter perspective, but, several years perspective, because Gen AI is real disruption, and perhaps it's much bigger disruption than the whole cloud migration era. You've been hearing the companies and what they're saying. You're seeing the early numbers in Q1. What's your stance? Looking to buy for the long term at all?
No, we've discussed this. Structurally, we are bearish on the large cap IT companies because even without Gen AI, if you look at the longer term sense, last 5 to 7 years, if you remove the 2 or 2.5 years post-COVID, where there was a bunching up of tech investments globally, the growth rate had come down to sub 10% levels. And when we are talking about India growing at 6 to 7% in terms of real GDP, 10 to 12% of nominal GDP, corporate profits will grow at a higher rate. So we would not really be very excited about stocks and sectors which are growing at sub 10%. That's one. Same thing happened with FMCG. In the 80s and 90s, FMCG was a very fast growth sector, but then it tapered down, and you see the large FMCG companies also struggling to grow beyond single digits. So I think unless IT services companies in India dramatically rethink their service model, their delivery model, the value addition model, I think they will be stuck in this single digit growth rate, which to us is not very exciting.
Oh, okay. I think we're getting visuals from the Tesla showroom here in Mumbai. We can see Mr. Fadnavis there with officials from the company. Of course, we don't have Mr. Musk coming down for this India launch, but I think other senior global Tesla officials are definitely present. And yeah, that's the excitement at the store over there. Okay. All right. That's Tesla for you. I don't know. Do we still have Mihir? I think. Okay. Mihir, just a quick final word before we let you go. I don't know if you're buying a Tesla or not, but I don't know whether you continue to be positive on M&M, the EV story.
Won't like to be too stock specific, but the rural segment still continues to do well, I guess, and we are seeing that the premium consumption story still continues, so SUVs, etc. So we are playing those kind of themes. But I think this is the visuals that you showed are very close to my office. Probably I should go there.
I think I think you'll walk back with a new car. Who knows, Mihir? We'll talk in the evening. I'll call you in the evening. Okay. All right.
Take me for a drive, Mihir, if you do pick up.
Yeah. Please, we'll be there for a ride. All right. Thanks, Mihir, so much for that. Good conversation as always. We look forward to catching up again soon. Okay, we have the official pricing also out of the Model Y. It's almost touching 60 lakhs. Long range RWD is 67.89. And the earlier model was just under 60 lakhs. So pricing obviously higher than some of the Indian competitors. Let's quickly move on now. We have, of course, the management of Tata Tech joining in. The company has had a slightly weak quarter. Just to quickly recap the numbers, the revenue top line is down 4.6% quarter on quarter, and margins have also compressed slightly to about 13.6%. So we have Mr. Harris joining in to tell us whether this is just a one-off. Mr. Harris, great to have you on. That's exactly, I think, what you've indicated to analysts in the call, that this was because of some delays in certain deals, certain ramp-ups. But you're sounding confident about the rest of the year. What makes you feel this way?
Yeah, we continue to be bullish about the full fiscal year. I think the first quarter we entered with a great deal of optimism, but the tariff announcements early in April, I think, interjected an element of uncertainty, and many of the customers that we've been engaging with that were looking to make investments in new products basically paused and delayed some of those decisions. Now, the good news for us is that towards the end of the quarter, we saw some of those decisions get converted, and so we're taking a strong order book into the second quarter. And again, we continue to be confident about the prospects for growth throughout the rest of the fiscal.
So does that mean what, double-digit growth in FY26? Early teens, single digit, some indication?
I think we'll calibrate our expectations as we move through Q2. The North Star for us continues to be double-digit growth. We'll work hard to endeavor to achieve that. But I think a lot of it will depend upon the trade negotiations that are currently going on between the US and various trading partners. And I think if those things resolve quickly, then I think we can be confident about getting close to that. But we'll see over the next 3 to 4 months, and then in the sort of September, October timeframe, I think we'll have a better view.
Warren, hi, morning. The JLR, can you talk to us about the JLR account? How's that doing? Has that stabilized?
Sure. We have, we've been very excited about the performance and the progress that JLR have made, not just in the recent past, but in the last 4 to 5 years. They celebrated being debt-free at the end of the last fiscal year. I think that's informed some confidence in terms of their investment in new product. There is a lot of launches that we are supporting this year. And so we're confident in the JLR story and our ability to contribute towards that. And we're also very confident about the position that Tata Motors finds themselves in. I know that there are some tactical headwinds that they're navigating through, but the company has executed extremely well in terms of its transition to EVs. And I think the investments that they've made position Tata Motors not just for success in the short term, but also in the medium to long term.
Hi, Warren. Good to see you. Ben, a quick question on growth first. Couple of quarters of negative growth. Do you think that Q2 onwards, we get back to growing ways? Point number one. And point number two, I've been looking at a couple of brokerages. The bearish ones are talking about a degrowth this year. You're ruling out that possibility?
Yeah, I'm very, very confident that we will not degrow, and certainly Q2 will be better than Q1. We will grow and we will improve our profitability position. And I'm very confident, again, given the order book that we've got, that we're going to have a very strong second half to the year. So,
all right.
again, we'll calibrate exactly what that means as we move through the second quarter. But certainly, I have no doubt that we will grow this year.
All right, endeavors to go to double-digit growth, but no doubt about growing this year, and quarter two will look far better. You briefly mentioned on profitability. I was just noticing your margins. It's come to around that 16.5 odd handle. Earlier, you were doing 18% odd. For the year on the whole, what should the margin trajectory be?
Well, one of the things that we made a decision on in the first quarter is to protect the capacity to deliver the order book that we worked hard to build for ourselves. So that's had an impact on margins tactically, but we certainly expect as growth flows through that margins will improve as well. So again, we're confident that we've interjected discipline and operational rigor into how we're running the business. And we are very, very confident that we will trend towards 18% this year, and our North Star is 20%, and certainly as we look to build momentum this year, that will be the plan that we look to affect over the next couple of years.
Okay, 18% this year, and North Star is 20%. Warren, you said that EU is looking better as compared to the US market, which has been hit by tariffs, etc., just over the weekend. And that's how fast-changing this is. I mean, the US is threatening 30% tariffs on EU. I mean, so suddenly in the last 3-4 days, I'm sure CEOs, etc., would be taking note. And it kind of sort of, again, disrupts things. 30% is significantly higher if it goes through than what many were assuming earlier. So, how confident are you that what you say now will kind of sort of, hold as you go forward? Because many of these things are not business related per se.
Yeah. I think our confidence is informed by the engagement and the discussions that we're having with our customers. Clearly the threat of 30% and with some jurisdictions higher tariffs, I think that's not helpful. But I think there is confidence that common sense will prevail. That there is a view that some of these threats are negotiating tactics, and again, our customers are increasingly confident that the uncertainty that prevails at the moment will be short term. And I think if that can be realized, we're in a very good position to really kick on from where we are at the moment. Our business is exclusively focused on the manufacturing sector. The manufacturing sector, and specifically the automotive industry, is product driven. And I think over the last 12 months, given the election uncertainty in the US, given the runoff of incentives in the EU, a lot of our customers have stalled investment in new product, and so there's a lot of latent demand that is out there. And again, we are very, very confident we're going to be able to intersect with that.
Mr. Harris, just sort of to understand this, you mentioned that you're confident of retaining full year margins at around 18%, with 20% being the North Star. So the 200 basis points dip in margins that we saw in the first quarter, was it entirely because of certain deal ramp-ups not happening, certain delays? And I'm just trying to understand if there's any change in pricing. And also just let us know what your thoughts are on wage hikes, because a lot of the larger IT services companies, they've not yet committed to wage hikes. What about you?
Well, let me just qualify that I expect to get back to a run rate of 18% as we progress towards the end of the year. Whether or not we'll be able at a consolidated full year level to get back to 18% will very much depend upon how the next three months goes. But we are very, very confident that the headwinds that we are grappling with at the moment are short term and are driven by the macroeconomic uncertainty. As far as wage hikes are concerned, we've not yet made a decision. We will be evaluating over the next couple of months what it is that we will need to do, and we'll make a decision likely in the September timeframe in terms of what will be appropriate for us to reward the teams that are working diligently to deliver value to our customers.
So basically, by the end of this year, you're hoping that margins will be at 18%, though on a full year basis, FY26, you'll have to see, right?
But we will have to see. Our commitment and the business plan that we're working to is margin preservation. But I'm certainly very, very confident that by the end of the year, we will be back to a run rate that will be consistent with what we've delivered over the last 3 years.
Well, good luck to you with those plans, and good luck to your team as well. Thank you very much for joining in and giving us some perspective on the business. Well, that's Tata Technologies sounding quite confident for the rest of the year, though the first quarter has been a bit of a bumpy start for them. Well, let's get you an important programming alert. The governor of the RBI will shortly be speaking with CNBC-TV18's Lata Venkatesh. Expect answers for all the questions that are bothering you. Does 6-year low inflation open up space for more rate cuts? Does low CPI give RBI scope to keep liquidity surplus for longer? Will tariff wars force down RBI's GDP growth forecast? Well, tune in afternoon for the most definitive RBI governor interview only on CNBC-TV18. Right, with that, it's time for a special segment, Quarter Se Quarter Tak, where we bring you earnings expectations from one sector every day. And the sector in the spotlight today is the metal space. Nigel is going to join us and tell us just how Q1 might be for a lot of the metal majors. Nigel.
Well, let's begin with the ferrous space first up, where steel companies are expected to deliver a strong performance in the first quarter. The steel EBITDA is projected to rise between 4 to around 15% on a quarter-to-quarter basis. That's thanks to two factors. One is a rise in domestic steel prices by roughly around 2,000 to 2,500 rupees per ton, and a decline in coking coal costs by around $10 to around $12 per ton. However, this margin improvement is expected to be partially offset by higher iron ore cost as well as lower sales volumes. The volumes could decline by around 3 to around 17% quarter-on-quarter, mainly due to the planned maintenance shutdowns and muted export demand. And also the early arrival of monsoons, well, that's going to be a bit of a dampener on the volumes front. On a company-specific basis, all companies will report an improvement on the EBITDA per ton. Tata Steel India, well, the EBITDA per ton is expected at around 14,500 rupees per ton, while Europe is expected to trim its losses to around a negative $28 per ton. That's down from close to around $40 per ton in the previous quarter. JSPL as well will report a solid gain. The EBITDA per ton is expected to jump up to around the 13,850 rupees odd, while JSW Steel will clock an EBITDA per ton of around 10,820 rupees per ton. SAIL, well, that'll see a modest improvement. The EBITDA per ton will move closer to around that 8,000 rupees odd mark. Jindal Stainless from the stainless pack, well, that'll report a good bounce back. Remember, quarter 4 was quite soft. This time around, there'll be a 10% quarter-on-quarter growth in the consolidated EBITDA per ton and could come in the vicinity of around 18,200. Two factors support them. One is realizations, which are higher, and the cost of production, which will be relatively lower. Moving to the non-ferrous side of things then, quarter 1 is expected to be soft. That's because of the decline that we've seen in commodity prices. The average LME prices for aluminium as well as zinc, they are down by close to around 7% on a sequential basis. That's what could weigh on the profitability as well as on the top line. However, silver has bucked the trend. It's up close to around 5 to 6% odd. It's hit its highest levels we've seen in more than 10 years. Coal India, though, they're expected to drop a 20% drop in the EBITDA. That's because of lower volumes and pricing. You have also seen the e-auction prices that are lower. The cost of production for them has moved up as well, so that's what will hurt Coal India. NMDC could see a 5% growth in the EBITDA. That's because of the higher volumes, which will jump up by mid-teens, though the benefits will be limited due to higher cost of production and lower realization per ton. Hindalco's India business, well, that'll get hit because of aluminium prices, which are down. And also we have seen that, the cost of production as well could get a hit a little bit. While Novelis, its overseas subsidiary, that will see a 9% quarter-on-quarter drop on the EBITDA per ton, should come in at roughly around $450 on a per ton basis because their operations have been impacted by tariffs on Canadian imports into the United States, rising input cost as well. Vedanta, well, on a consolidated EBITDA basis, there'll be a decline out there because of aluminium and zinc prices. Both of them are down by close to around 7%. However, gains from lower alumina cost and increased captive sourcing, that's what will help partially offset some part of that impact. To sum it up, metals sector in quarter 1 FY26 is expected to be a tale of two halves. Steel companies are poised to report strong earnings momentum supported by rising prices, falling coal cost, while non-ferrous players, they'll face profitability pressure owing to the drop in commodity prices. Let's wind this down with the valuation snapshot that we have up for you on the screen. Well, let's welcome Ravi Sood, the research analyst at Elara, who joins in on the show. Hi, Ravi. Thanks a lot for joining in. It's been a while since we had you on the show. Give us, the outliers for the sector. In the ferrous pack, which company are you expecting to report very, very strong numbers? And what is your top pick? So let's get the ferrous section first out of the way.
Yeah, good morning. So basically, on the steel front, barring JSW and SAIL, rest of the companies should report a negative volume growth. For JSW, the recovery in EBITDA should be sharper because of combination of higher volume on account of the new blast furnace as well as steel pricing. Apart from this, in steel Europe, we should see a sequential basis driven by lower losses in UK.
Right. Ravi, got a little bit of a connection issue, I think so. I just want to get a couple of numbers out of the way. For Tata Steel Europe, the EBITDA per ton loss is expected to come down, and Nuvama estimates said that it will come down by close to $10 per ton. What are you factoring in terms of an improvement, and when do they break even?
So break-even is expected in the second half. In terms of EBITDA per ton, overall Europe, so roughly about negative $32. We are expecting it to be closer to $35–36 this quarter.
Okay, got it. All right. And from the non-ferrous pack, do you think the street will look through the weakness that we've seen in prices? What is your view on a stock like Hindalco? Because Novelis yet again will get impacted, but the street is bracing for this impact, right, because of the tariffs. So $450 per ton is what some analysts are working with. What about you?
So yeah, basically there should be a hint of the tariffs, which should result into a fall in EBITDA per ton for Novelis from about 495 to closer to about $445 to $450. But what is important to look at is the fact that Q2 we should see a recovery in profits driven by improvement in energy prices that we have seen, and taking into account the demand supply situation, the sustainability of aluminum prices on the relatively higher is more likely.
Okay. All right. Ravi, appreciate you joining in. Thanks a lot for giving us all of those details. We'll touch base as the course of the metal numbers do start coming in. Short point is steel will shine brighter, while the non-ferrous pack could see some pressure because of the pressure that we've seen on LME prices. Though silver will twinkle a little bit more than the other commodities that we've seen. Well, time to slip in a short break, but after the break, we'll be joined by Bhavesh Agarwal of Ola Electric Mobility to discuss the past quarter's numbers and the ambitious guidance that they've given as well.
Welcome back. Now, Ola Electric is the next management, as we just said, coming up on the program. Earnings came in and they've improved sequentially. The market gave a big thumbs up yesterday. Gross margins are up about 1,100 basis points. Bhavish Agarwal is Chairman and Managing Director at Ola Electric Mobility. He's with us now. Bhavish, good morning. Great to have you with us here on the program as always. Prashant here. So earnings have improved, as I said, quarter on quarter, but of course from a very low base, Bhavish. You are projecting for the, auto EBITDA to turn positive, the business itself to generate operating cash flow in FY26, positive cash flow by FY26, etc. But before the financials, because the financials is the end product, the product is the first story, right? Do you believe, Bhavish, as we speak today, a lot of the product-related issues, especially on the after-sales, etc., those issues have been fixed? Because unless those are fixed, the derivative of that is financials and earnings and everything else is downstream. So just wanted to start with that, Bhavish.
Sure, Prashant. First, actually, I'll just highlight 2 or 3 key things from our earnings. Our auto business achieved the EBITDA guidance we had given for Q1. And more importantly, actually, in June, we were EBITDA positive. So in that sense, probably a very important milestone for the company to be EBITDA positive for the first time ever in our journey. A second highlight was also cash flows. Our operating cash flows also came in almost neutral at a negative 27 crores for the whole quarter. And both the profitability and cash flows has gotten to this level because of new product introductions by us over the last 3 months. Specifically, our Gen 3 scooters have done really well in the market. Almost 80% of our vehicles sold are Gen 3 products now. Consumers, and even though Gen 3 is priced slightly higher than Gen 2, consumers are really preferring our Gen 3 product. Our bike has seen very good early traction, very good interest from everybody. We are releasing the bikes into stores in a calibrated manner. So bikes are available in 200 stores now and scaling up through this quarter. By the time festive comes in, Navratri comes in, we will be across most of our stores. So some of the product comments that you shared, the service issues which were there in Q3 of last year have since largely been dealt with. Most of the service challenges that we had have been fully resolved. It was not really product linked. As I had shared, then it was network linked. Our network scale had to go up to service the extra volumes that we had sold in the last 3-4 years. And just to underline and remind everyone that we've sold almost 1 million vehicles, which is still almost 2x of our nearest competitor. So in that sense, the vehicles on road for us is much higher than our peers.
So, Bhavish, I'm morning. That answers Prashant's issue on product-related concerns. The next step is getting the products to the market, right? And here, at least over the last couple of days, the headlines out of Maharashtra seem, again, pretty confusing. Reports are indicating that 90% of the Ola stores will have to be shut down because there's an issue with licenses and permits, etc. Can you just set the record straight on this and how you're engaged with the state government? Because Maharashtra is a big state when it comes to EV sales.
Any state is important for us, Surbhi. We are, again, about a couple of quarters ago or about 4-5 months ago, we had acknowledged this issue that we had opened all these stores and some local level licensing and local level certification had to be done. And we have since then been doing it. A lot of ground has been covered across all states. Maharashtra is a slightly more nuanced state in terms of the level of local documentation, etc. required, but we are covering that ground. And we are continuing to engage with the state government and covering that ground. There's been no official communication to us of this, so maybe it's more speculative. But from our side, we've been very diligently just covering all the ground on local regulations to make sure all our stores are compliant on any local regulations across the country, not just Maharashtra.
But could it impact your second quarter sales? You're saying you've officially not received any notification from the government. You have 450 stores in the state, right?
Thereabouts, yes.
And the state government has not communicated its intent to seal the stores or shutter the stores?
See, like I said, we are going through the process of getting the local regulations. And in that process, there will be a certain set of engagements with the different authorities, state level or even local level. And we are getting through that whole process. In terms of our sales impact, a lot of our sales actually are done online. So they're not really dependent on the store. And even when we have all these large number of stores, they're largely used as places where customers come and pick up their vehicles. Because the sale happens online. A sale happens even, unlike traditional dealerships, we don't really stock inventory in our stores.
So should investors affect any impact on Q2 sales because of this or not?
No, the impact should be very minimal, if at all.
All right. Hi, Bhavesh. Good to see you. And as always, as a bike lover, you're always looking at new bikes, right? And you've entered the bike market and you're sounding very optimistic out there. Now, you've given this guidance of around 325,000 to around 375,000 or thereabouts. How much of it will come in for bikes and what's the traction you're seeing on ground?
Nigel, bikes are getting a lot of positive response on social media, in our customers, in our community. It's a great product. I myself have been riding the bike around Bangalore all day, all through the last few months, actually. And the product, like I said, we are in a calibrated way ramping it up across different stores. It's a new category for us. It's a new category for the EV industry at scale. So we want to make sure the new product establishes itself well in a phased manner. So that's our focus. Response has been very, very strong, and we feel very confident about the product doing well.
So bikes will be what? Mid-teens as a contribution of the total volumes?
For the whole year, maybe slightly higher.
Slightly higher. 15 to 20% is a gettable number?
Yes, that's what we would expect, yes.
All right. Since you spoke about the feedback and social media, service turnaround time, that's in check. We keep getting these responses to some of our earlier interviews as well that ask Bhavesh, are the customers being, taken care of in the after service? Are things better?
The things on service have improved a lot from Q3. We're continuing to focus on improving and institutionalizing our operations in the front end. I mentioned in my note also in the shareholders letter that one key area of management focus will continue to be our entire front end, which includes sales, service, fulfillment times, etc., getting more stores live for our bikes and for our Gen 3 products. So that's a very core management focus for this quarter.
So service turnaround time is 1 day?
The service turnaround times are industry standard for us also. Whatever the EV industry runs at, we will be running at the same times. We want to do better than that. So a lot of initiatives underway, to do better than that.
Bhavesh, and it'll start to show word of mouth, and you need that tide to turn, right? Because at the end of the day, it's a consumer product. People can touch and feel, and they drive and they have an experience, and that'll be organic. But you need to, in terms of sales volume, etc., have to turn that around a little bit. I mean, if you're saying that the service, etc., is now much better, it's in line with industry average, etc. I mean, people need to know about it,
Prashant, our customers know about it. We are one brand which hardly advertises, and yet people buy our products in very high volumes. And Q1 over Q4 has also increased in volume. So I think the numbers speak for themselves. And on the ground, in the community, the sentiment is generally positive.
What about discounting, Bhavesh? I mean, we saw, a spate of discounting over the last many quarters for some of the products. Have we, in a way, hit a bottom there and things have stabilized? Can you give us some perspective, context, really?
So, Prashant, instead of that, I will actually give you our gross margins. So, if you look at our gross margins in Q1, they were 26%. And this quarter was without any meaningful PLI benefit. So even without PLI, our gross margins are 24%. And this is industry leading by far. So discounting or no discounting, our business in unit economics does really well. And that's actually in June, the company turned, the auto segment turned EBITDA positive because gross margins, two reasons. Gross margins came in very good. And that's a function of our new products, Gen 3 and bike starting to scale. And second is our OPEX reduction program has also delivered on the targets we promised the street.
On the auto side, Bhavesh, EBITDA margins, you're looking at what, 5% or so?
For the whole year. Yeah.
For the whole year?
For the whole year. This quarter should be in the positive territory.
Yeah, and so the auto segment, you're EBITDA positive. Now, Bhavesh, at the blended company EBITDA level, and as well as the blended, the net profit level, where there's still a loss. The loss is reduced, but it's still about 428 crores. Can you give us some timelines? When do you turn profitable? First at the overall EBITDA level, and then eventually at the PAT level?
Surbhi, we've given a fairly detailed outlook in our shareholders letter this time. So for our auto business, we said that this full year should be EBITDA positive. Q2 itself will be EBITDA positive. Even cash flows by the end of the year, our auto segment will be making both operating cash flow and free cash flow. There is still some investment to be done in the cell business to get to the 5 gigawatt hour capacity. So we are allocating capital this year for that capex. Now, beyond that, the auto business profitability should balance out to whatever investment needed in the cell business, because the auto business is where the real volume is. So sometime next year, I don't want to give a very hard number there right now, but we'll keep sharing more specific granular updates quarter on quarter.
All right.
So FY27, you will be overall EBITDA positive.
I'm not sharing a number there, but I think if anybody reads the shareholders letter, you'll get a very good feel for it.
Bhavesh, very quickly, before we let you go, any queries coming from SEBI? Are you all, there were various allegations, source-based information that we heard as well. Have you been engaging with them? Have you heard anything? Is there something that your shareholders need to worry about?
The confusion that happened was the registration and registration numbers mismatch in February or March. And I think in our Q4 results, we actually clarified that with a proper walk of how the numbers stacked up. I think in the public domain, definitely this issue has been now behind us. SEBI and we had many conversations, and whatever questions they asked, we definitely clarified.
So nothing for shareholders to worry then?
No.
Okay, all right. Bhavesh, sounding extremely confident about the path ahead. Your shareholders will be waiting by for the turn of events and things to continue in the upward trajectory. Personally, I'm going to try one of those bikes. You've been riding around in Bangalore. Hopefully, I get a ride here in Mumbai. I'll give you feedback the next time you join in on the show. All the best.
Nigel. See you.
Some new innovations, and we look forward to try some of that.
Okay, all right. So catch Nigel on that electric bike.
Looking for something more. Dil mange more. Let's try it. Bhavesh is riding it. Might as well.
So the Tesla model first or Ola bike
Tesla
first?
I've done
He's going for the drive. Mayor is driving him, remember? All around
Maybe ride the Ola bike to the Tesla showroom.
To the Tesla showroom.
No, Tesla I've already done actually. I've driven it
in the US.
In the US.
On Bombay roads. That's the real test.
No, and that's not achievable. Tesla I cannot buy. But at the Ola, maybe, it could be a possibility because I love two-wheelers.
Well, Nigel, wait for the 70% import duty to. I'm sure it won't be 70%. It will be brought lower.
No four-wheeler, two-wheelers.
For two-wheelers. All right. Well, I think just a quick programming note on that point. So this is a big CNBC TV exclusive which is coming up. The RBI Governor will be speaking with Lata Venkatesh. All the questions with regards to growth, regulation, what ahead. Remember, inflation is at a 6-year low. Liquidity, of course, has now been pumped up. Global risks, what does it all mean for rates and growth? That's the most definitive RBI Governor interview. Post-noon today only here on CNBC-TV18. Okay, well, I think you got 30-odd points on the Nifty. We've got 25,100 as far as the indexes are concerned. Mitesh is with us, back with us with what he wants you to do. Mitesh, good morning. What do you have? Trades?
Good morning, Prashant. So the banking index and the banking stocks are looking good. I have a buy on Bandhan Bank. Keep a stop below levels of 177. Look for a target of 190 to begin with. Maybe eventually even higher, but for timing 190. And a sell on HCLTech with a stop at 1570 for targets of 1510.
Okay, all right. Got that, Mitesh. Thanks very much. So that's the trading advice now. At just about 10 o'clock, we'll take a break, come back on the other side, and Manisha Gupta will join in with all the commodity market action. Welcome back. So the equity market is having a steady morning, still about 40 points up on the Nifty. Let's find out what are the big headlines in the commodity space. Manisha is back with us. Manisha, so what's top of mind for you?
Well, I'm looking at the crude oil prices because there are just so many statements going on. By the way, the Chinese data, most of that has come into the markets has beat street expectations. It is better than and it is less slower in sense of pace when it comes to the markets there. And that clearly could be a supportive factor there. But what really has led to some profit taking in crude, and it fell nearly 2% in the overnight markets, has been that US has given Russia a 50-day deadline to agree to a ceasefire. Now, this is the markets were anticipating that you could be looking at sanctions, restrictions, some big bang announcement from US yesterday itself, but we did not see that coming. Now, this has been postponed, and US has warned Russia of further sanctions of up to 100%, but this is a warning. And knowing US, we've seen a lot of rhetoric go on and not so much on ground. So the markets do believe that this perhaps could be sorted or solved in some sense. Now, buyers for Russia are countries like China, India, and Turkey. And while US has said that the sanctions would not only be on Russia, but on the third party, that is on the buyer secondary market as well. And that is where the concern really comes in from. When you look at the month of June, the Russian oil exports have been at the tune of 9 million tons. Now, that is a big amount. Russia, remember, is the second largest producer when it comes to OPEC and allies there. And even, and it's not just about US, European Union also has said that they could be announcing an 18th package of sanctions against Russia. This could come in as early as this week itself. Now, OPEC's spare capacity is something that we keep talking about, that there's going to be more surplus going forward. And that has been keeping the crude oil prices in check. But if there are 100% sanctions on Russia and an 18th package from European Union as well, then that spare capacity that we seem to be relying so strongly right now is not going to be sufficient to fill in a gap of 9 to 10 million barrels per day. Now, the US higher tariffs for partners also is a bit of a concern. You could be looking at economies not doing so well, demand growth not so strong, and that in turn also seems to be weighing on in sense of crude oil prices there. Now, this is what Goldman Sachs has come out with in sense of its targets for this year. They're anticipating $66 a barrel for the second half, and they expect the prices to continue to decline in 2026 as well. From 66 to 56 is what they believe could be an average in the next year. But starting 2027, they believe that the crude prices will be higher. Because of these lower prices, you wouldn't see investments. Demand is expected to be stronger. So this year and the next year, it is going to be between 50s, 60s, max 70 that you could be looking at in sense of crude prices. Lack of new OPEC projects, lack of investments in the space are supportive factors going forward. But that's only expected in 2027. In the meanwhile, the European Union also has intensified its conversations with other trading partners like Canada and Japan and are looking at a collated response to US tariffs there. And then the markets also are looking at loads of US data that is coming in today. You have the inflation numbers, CPI and PPI numbers, all of that in this week itself. And then it also is about the industrial production, manufacturing activity, retail sales. All of that US data comes in this week.
All right. Thanks very much, Manisha, for that. That's commodities in focus as always. Let's focus on HCLTech. Some more detail here. Reema's going to tell us what the street made in the numbers. Reema, take it away.
Thanks so much for that. So let me quickly outline a couple of reasons why the stock is under pressure today. Reason number one is the margin miss in Q1. EBIT margins declined by 160 basis points on a quarter-on-quarter basis, 16.3%, much lower than consensus. This led to a drop. This led to the company lowering the margin guidance by 100 basis points. And now the new margin guidance stands at 16 to 18%. Two, some of the brokerages have downgraded their assessment of HCLTech. So JP Morgan downgrades HCLTech to a neutral. They say AI deflation is playing out via margin erosion. Nuvama too has downgraded the stock and cut the target price to 1630. Ambit also echoes in a way what JPM says. The results corroborate our view that margins will be the next casualty after growth. Also, the third reason is HCLTech outperforms some of its larger peers. So in the last 1 year, HCLTech was the only one with flat, no return or no contraction in share price, but its peers had underperformed. In the 5-year, HCLTech share price has gone up by nearly 150%. That said, there are many brokerages who still are upbeat on HCLTech. So Nomura maintains a buy, and they say the street should ignore the near-term margin miss because the management themselves is saying that margins will revert, come back to the original levels in FY27. And focus should be on revenue outperformance, growth outperformance, which HCLTech is doing. Jefferies too. Jefferies, in fact, has upgraded HCLTech today. Back to you.
All right. Thank you very much, Reema, for that. Well, time to quickly take a break. On the other side, our special segment is the economy. My colleague Lata discusses the ultra-low June CPI and the possibility of more rate cuts with Aurudip Nandi of Nomura, Abhishek Bisen of Kotak AMC. Coming up.
Welcome to It's the Economy, an important discussion today. India's June CPI has hit a 6.5-year low of 2.1%. We have said it ad nauseum. And it is likely to get to 1.8% in July. I even got one reading of 1.5% for July. The CPI is expected to remain around 3% for all of calendar 2025. So, does this open up space for more rate cuts? But why are bond yields not reacting much to the rate cut hoops? Yesterday, even after the announcement, bond yields stood at 6.3. To answer all these questions, I'm joined by Aurudip Nandi, the India economist and vice president at Nomura Financial Advisory and Securities, who has just written actually a superb report on rate cuts and their link to credit growth. Also joining us is Abhishek Bisen, head of fixed income at Kotak AMC. Gentlemen, thank you very much indeed for your time. Aurudip, well, to start with you, this ultra low inflation number expected to remain low. Does it open space for rate cuts? Or do you think Reserve Bank is in a mood to cut only if growth is hurt, not if inflation is low?
Well, Lata, I think Governor Malhotra said it himself pretty succinctly a week after the policy, where he said in an interview that if inflation is below the RBI's expectations, then it opens up space to cut. Now, RBI has, despite the cut in inflation outlook, it's still pretty high. It's at 3.7% for FY26. Our number is closer to 2.8%. As you mentioned, the inflation print yesterday evening was 2.1%. So I don't think there is a question in terms of the space for cuts. It's definitely there. We are, in fact, this particular quarter, our expectation is that inflation will average 1.8%, which is below the RBI's 2% lower bound. So, yeah, we have two 25 basis point cuts, which we've penciled in, not in August, but in October and December.
Okay, yeah, two rate cuts. I think that's very important. We will flash that in a bit, Aurudip. Not in August, obviously, because they've just gone from accommodative to neutral. So respect it for one quarter, one policy, and maybe cut in October and December. Now, if that's the mood, that there's at least one more cut, Abhishek Bisen, I'm surprised the market hasn't reacted yesterday, and I don't think it's reacted much today either. 6.3 is where the 10-year stands. Why?
So, Lata, if you recall, the monetary policy was one of the best policies while they cut rate by 50 basis point and also CRR by 100 basis point. But there was a twist where they gave the monetary policy outlook stance was changed from accommodative to neutral. So this has been one of the spoilers where the market is almost convinced that while the data is pointing towards a cut, but they are not convinced that there's going to be any cut, while the next move is going to be probably a hike, which is what the prices show. So this has been an issue with the market participants. They have been used to a guidance which drives the market, some expectation of a forward cut. While you should look at the underlying macros and see whether the macros are indicating towards a cut or not, which, as Aurodeep said, and we also believe that the possibility of a cut is fairly there going forward if the inflation data supports a cut. Yeah.
Is there a fear? And I asked several people yesterday and today, why is the bond yield? Actually, the bond yield at the moment is standing at almost 6.32, clearly reacting to the US yields. But I asked several people whether, why the rate cut is, expectations of rate cut is not filtering in. A large number of economists are now shifting to the mood that there is at least one more cut. People like Aurodeep and many like him are also expecting two. Their fear is that the liquidity will not go to 5. Like, repo rate is at 5.25, but liquidity will not go to 5. It will, call rate will align with the repo rate. Is that a worry at all, that Reserve Bank will take out liquidity? And I'm wondering why people should think that, because the CRR cut is coming. That's another 3 trillion nearly, 2.5 trillion that will come in. So why the worry?
Yeah, so this is what's been puzzling the market. That one hand you are giving liquidity, and the other hand the VRRs are taking away the liquidity. So the way to read it is that they are trying to just fine tune it a bit more than what probably is required. So there where the confusion is, and when the market is confused, it always go backwards. So which is what is probably triggering a profit booking or a sideways kind of movement in the market. But as in when the clarity emerges and the liquidity has to remain in the system, which because of the various actions, eventually it has to align towards the macros. So it is just a matter of time when it start aligning towards the reality, which is probably downwards than upwards.
Okay, well, good to hear that, and I'm sure the Reserve Bank governor will be good to hear that. Will feel happy to hear that. The call, in spite of all the VRRs, is at 5.3 right now. Yesterday's rate 5.35 right now. Yesterday's closing rate was 5.3. Average rate was 5.3. It's not as if call has gone up because of the VRRs. Aurodeep, to come to you and your excellent report. Can you summarize for us, when do you expect these rate cuts, 100 already in the bag, how do you expect it to come towards credit growth? When and how?
I think it's an extremely important and crucial question, because we tend to take transmission for granted. So it's like we've done the rate cuts, obviously it will transmit to the economy. And the paper that you're referring to, what we've tried to do is kind of get into what this actually means. Now, 2 or 3 things come out pretty strongly. One is that for 100 basis points of repo rate cuts, we estimate around 65 basis points transmits to weighted average lending rate on outstanding loans, and around 80 basis points to weighted average deposit rate on the outstanding balances. Now, we saw that the impulse of a repo rate hike or cut takes around 12-13 months to transmit through to lending rates and to the other rates. The impact is probably going to be first on fresh loans and later on outstanding loans. The other thing we found is that it takes around 8 to 9 months from a shock in the lending rate to then start transmitting through into credit growth. But I think what we found pretty interesting is that it's not same across all credit categories. So when you look at MSMEs, when you look at the small, micro, medium enterprises, we see that kind of credit growth quite sensitive to shocks in lending rate. What we found very curious was that retail isn't actually that sensitive to changes. So things like auto, home, credit card isn't that sensitive. And in the case of vehicle loans and credit card loans, actually there is a big component that is based on fixed interest rates. Narrative which...
Okay. 1 minute. What you're saying is that if there is a rate cut, then MSMEs are more lured to demanding credit, but you don't see demand for home loan, auto loan and credit card loans simply because the rates are lower. Correct? That's your finding.
So, econometric studies kind of suggest that when rate cuts have happened, even after 12, 13 months, it hasn't really led to a sharp rise in home loan credit or auto loan credit. So this is based on past data.
No, I agree with you. I mean, if I want to buy a house, I would buy depending on my situation. And how many times will I take a home loan in my life? Max 2. I mean, for most of us, it would be once. So you can't really time it. And anyway, these are floating rates. So even if you enter at a lower rate, you're going to pay more later. But Aurodeep, what I found even more intriguing was your credit growth number. You're saying credit growth will fall from the current 10.5% to 7 to 8%. We're going to be, I mean, that's a little serious.
Oh, well, absolutely. I mean, look, one is that it takes time from your rate cuts all the way to lending rates, and from lending rates to credit growth. So there is a lag. It's not going to be immediate. So it's not like at the end of this year, we'll suddenly see everything starting to pick up. And I think the view on credit growth, there are 2 points. One is the first point which you alluded to, which is for good transmission, you need great communication and you need all your actions to be aligned in a particular way. What we've seen from the RBI, as Abhishek mentioned, is that there's been a lot of mixed messaging, right? There's 50 basis points cut, but a change in stance, but withdrawal of liquidity, but there is space to cut. So there's actually a lot of mixed messaging there. And secondly, it's also the state of the economy, right? So you would have credit growth when you would see strong domestic demand, which in our view is missing. So urban consumption growth has been weak. The IP growth numbers have been relatively weak. CapEx demand on the private side isn't that broad-based. So I think it's a mix of all these factors.
Okay, fair point. Actually, I will be speaking to the Reserve Bank Governor later today, and the interview should be relayed by about 2 o'clock. Let's see if the messaging is still mixed, or mixed in which direction. Maybe we will get a better direction. But Aurodeep, your credit growth number is 6.2%. Sorry, your GDP growth number is 6.2%, right? That is not a terrible number. If RBI is fixed that we will intervene more only if growth really breaks down, 6.2 is not a bad number at all.
It isn't, but again, 6.2 is lower than the RBI's projection of 6.5%. And the inflation side, there is a big undercut, right? As I mentioned, 3.7%, our number is around 2.8%. Okay. So the point is that, do we need rate cuts? The answer is yes, right? Okay. And then is there space for rate cuts? The answer is also yes.
Well, the point is the Reserve Bank Governor, when I asked him about the real rate that he would be comfortable with, he said that, okay, we have got a 3% inflation this year, but next year it is 4.5, according to the MPR. So if you're looking at a 12-month forward, I think we are the real rate at 150 basis points is not bad. But anyway, let's see whether they have a different trajectory of inflation going forward. Abhishek, will there be a big difference if there is the government borrowing program were to concentrate less on the 30 and 50 year? The last borrowing program, in anticipation of insurance demand, I think, they gave about 35% to the very long paper. If that is reduced and brought more towards 10-year, is that better, or will that be even worse for the benchmark?
So that's a very good point. So we've been highlighting this point for some time now. So yes, the supply on the longer end has been fairly high, which is in absence of demand, it appears that the supply is very high, and which is taking the yields higher on the longer end. So in a way, if you look at retail loans are being lent at 775 or so, and the government of India is borrowing at 7/4 on an annualized basis. So which appears that the government is borrowing at slightly expensive rate because of the demand supply issues. So if they are able to correct this demand supply imbalances by giving some readjustment towards the shorter end, so overall it will be good for the markets.
I want to squeeze one last question simply because I'm going to meet the governor. Abhishek, even if the rate cut comes, there is another rate cut. The bond market case seems to say that, oh, there is no more further rate cut, so it's not falling. Is there any point in the Reserve Bank really following the bond market so much? And let us assume that he indicates there is space. Let us assume when he is speaking to me, he looks dovish. Do you think there will be a fall?
Yeah, I believe so. If the communication becomes much more clearer, there will be a follow through. And much more than that, just let me highlight one more point. Clear guidance on liquidity is more important than cuts. We were of the opinion that instead of using cuts, you can use liquidity as a tool to influence bond yields. That will be a very positive factor, because that impacts transmission in much better way than just the cuts. Because if you constrain liquidity,
despite all the VRR, the liquidity in the market is about 3 lakh crore. And look at the TREPS today. TREPS is at 5/4. I mean, I don't know what the bond market wants. You've got all the liquidity. But anyway, that is between you and the Reserve Bank Governor. I will have to call it a day because, we are at the end of the show. Abhishek, Auradeep, thank you very much for a very fruitful conversation and for prepping me up for an important interview. Thank you for joining me. And let me just repeat this very important programming alert. The Governor Reserve Bank will shortly be speaking to me. Expect answers for all the questions that are bothering you. Does the 6-year low inflation open up space for more rate cut or rate cuts? Does low CPI give Reserve Bank scope to keep liquidity surplus for longer? Will tariff wars force down Reserve Bank's GDP growth forecast? Tune in post-noon for the most definitive RBI Governor interview. Only on CNBC TV18.
So disappointing quarter for earnings in IT space. After TCS, we have HCLTech, which reported the numbers as well. The top loser on the Nifty after revenues and margins miss expectations. The company has lowered its margin guidance from 18 to 19% earlier to 17 to 18% now.
Rallis surges over 8% after delivering strong margin expansion in the first quarter. The management tells CNBC-TV18 that they expect to benefit from the China Plus One theme going ahead. They guide for revenue growth in double digits with margin improvement in FY26.
Tejas Networks declined 6% after a weak first quarter. Revenue declines nearly 90% sequentially. The company records a loss of over 190 crore rupees. You stay tuned to Chartbusters because the management joins in shortly to discuss their first quarter numbers.
Bandhan Bank rallies close to around 3%. It's higher after the new Chief Risk Officer, Biju Punachalil, who earlier held a role in South India Bank, has come on board. Hello and welcome to Chartbusters. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Nigel. With me is Mangalam. And earnings are trickling in thick and fast. So I think, Mangalam, we've got a couple of managements. Let's get straight to it.
We have a couple of managements. Let's talk about Tejas Networks. That stock actually is trading with deep cuts after a weak first quarter. The revenue declined nearly 90%. And, it was quarter on quarter. We saw the company post a loss of nearly 200 crores. Arnab Roy, who's the COO and Executive Director, as well as Sumit Dhingra, who's the CFO of the company, joined in. Arnab, Sumit, thanks a lot, gentlemen, for joining in. The street obviously visibly disappointed by the numbers that you posted. The stock is lower. But what we want to understand from you is how much of this quarter's performance was a one-off, because you have alluded to a couple of challenges that you all faced during the quarter, a couple of things that have moved into the second quarter. Some of the things that were happening in the first quarter will be reversed in the second quarter. If you could just put a number to that, had it not been for those one-offs, how would the numbers look? And going forward, what is it that you're targeting? Let's start with Arnab. Arnab.
Yeah, so thanks for having us. So first of all, I think we wouldn't like to give a guidance on what the numbers would be, but I'd like to really set the context of what this year and the quarter and the subsequent quarters are going to be. So first of all, let's see. We came off in FY25. We came off on the back of a really large project, this BSNL 100,000 sites, which we had to deliver in a very accelerated way, and that kind of resulted in a huge bump up of our revenues from FY24 to 25. So obviously, we are all been very clear that FY26 is not going to be in the background of FY25, and we should look at our business in the context of FY24 and so on. So from that point of view, I think one of the main reasons why the Q1 was behind our plan was, some of the POs that got shifted, because one of the big business that we were about to log was this BSNL expansion of from the 100,000 sites to the next phase of expansion, and we were expecting to close the PO and shipment of another 18,000 sites, add-on sites, and that got delayed a bit. Plus, a few other customer shipments got a bit delayed because of inventory and clearances. So in a way, yes, this is a one-off quarter where things got pushed out more than anything else, and we should be able to see the results, the catch-up of this business in Q2 and Q3. That's going to happen. The other important thing is that this year is kind of a transformational year for us, as you've seen our announcements during the last few months, where we have set up air partnerships with international companies like NEC, like Rakuten, and so on. So we are kind of setting up the company. We are investing in our business for growing our product portfolio, kind of making it complete and really cutting edge, state of the art, and also putting a lot of emphasis in our global business growth, in the international business growth. So with all these factors put together, I think we see a very strong future, business growth for us over the next, several quarters and the next few years. And it has been a kind of investment and transformation mode for us as well.
All right. Everyone is aware there's a big potential for the company. The problem is, when is it going to come? So let's get a couple of basic details out of the way. On growth, you're seeing is still a little bit uncertain. But let's focus on the margin number. Is quarter one the rock bottom quarter and things recover from here on? In that sense, will you be EBITDA positive in the second quarter? Point number one. The other point is on receivables. It's close to around 3,000, 3,500 crores, little in that vicinity. When do you see this receivable number come down? Margins and receivables. Please go ahead.
Yeah, sure. I think on margins, I think we need to look at two levels. One is at the material margin level or the gross margin level, which if you see quarter on quarter, there's been a improvement compared to the previous quarter. As we've been talking about in our past conversations and our calls as well, I think a lot of our material margin level movement gets driven by the product mix or the project mix during the quarter. And because of the lumpiness in revenue that is visible right now, I think that adds to the margin movements at the material margin level across quarters. So as we see a normalization or diversification of revenue play out for us across our customer base and projects, we should see slightly more predictable margins, both at the material margin level and at the EBITDA or EBIT level. I think beyond, if you look at beyond material margin, a lot of our costs are fixed in nature. So if you see, a lot of it is employee cost and administrative expenses. If you see over the past few quarters, as the scale picked up, there was a visible improvement in profitability because of these factors. Now, as we go along, over the next few quarters and ramp up our revenue, particularly from international business, we should see the improvement in margin come through.
And receivables?
Yeah, see, receivables, I think there are 2 points to sort of highlight here. I think what you see as reported receivables are to a large extent or significantly on account of the BSNL 4G project that got executed over the past few quarters. In fact, the last quarter was the completion of the project. Now, those receivables are expected to be collected over a period of time based on certain milestones related to implementation of the project. So we should see that coming down over the next few quarters within this financial year. Also, a part of these receivables are essentially against that. We also have received an advance on this project of about 1460 crores. Now that lies in the other liabilities because some of the milestones that were to be delivered are yet to be completed. So on a net basis, I think the actual receivable number is much lower than what you see on the reported statements.
Got that, Sumit. Let's go back to Arnab because Sumit, you said something which was important. One, international orders will pick up in your overall revenue mix. And secondly, the BSNL part itself. Arnab, BSNL, it was earlier 100,000. Now it's scaled down to 18,000. For how long does BSNL continue to give you orders? Because it's been scaling down the scope of business that it's been given to other vendors as well. So that's point number one. And secondly, international, which is close to around 19% of your revenues, how much does that contribute to your revenues, say, over the next 2 to 3 years?
Yeah. So first of all, regarding BSNL, I mean, while we are actively trying to grow our business so that it is not heavily dependent on the BSNL business, but as far as the network plans are concerned, if you see, they have deployed 100,000 sites, and which is not adequate for a pan-national network. So there will be expansion in their network, and the initial phase was they were planning to do 25, 26,000 sites as an add-on, and they have come with the initial offer for 18,000 sites. But for a nationwide deployment, they will definitely need more sites, and then there is a 5G upgrade which is planned across the country when they launch their 5G services and so on. So BSNL itself has a long roadmap to upgrading the network, with 4G and 5G and so on. So that should be a good opportunity for us. But having said that, I think our plan is not to build our own business, the complete business based on BSNL. It is a good stepping stone for building our technology and really proving it in a very tough conditions. So that's the reason why you see all our partnerships and all announcements with the NEC, with Rakuten and so on, because international markets and global operators is what our target really is. And this is the year where we want to see the results of all those efforts that have been going on.
So how much? International is 19% now. How much does that go to by the end of this year and by the end of next 3 years? What's the aspirational number here?
Yeah, so it's hard to give a number, but I would say, we certainly want to see, close to 30-40% of our business going to international as soon as possible. That would be a good milestone, and then going forward from there.
All right. Since you're speaking about TAM, this is one number you can at least give us. BSNL, BharatNet. Put it together, what is the potential TAM for y'all, if you could tell us on that front? And also R&D spend, if I got the number correct, I think you're spending around 80 million. You could correct me on that number. How ready are y'all to, penetrate further and take much of that TAM? So TAM, and what is the R&D spend that you're looking at from here on?
Yeah. So as far as TAM is concerned, I mean, our business is not just the BharatNet and BSNL. If you see our business, I mean, there's a lot of other India private operators where we had our historical wireline business. There are the utilities, the power, gas, rail sectors. There are the ISPs in India. And then there are the operators internationally. So just BSNL and BharatNet is one part, a significant part of this business. So from an absolute number point of view, you can only guess that if the initial project for 100,000 sites was a certain number, I mean, it will be proportionate to that in terms of...
Give us the number, sir. Give us the number, sir. I mean, according to you, what could the rough TAM be?
Yeah, so I think the initial 100,000 site projects was what, 7,000 crores?
Yeah.
Or around 8,000 crores. So depending on how many sites they expand to, if it is like 20,000, if it is 50,000, if it is more than that, we have heard announcements about BSNL might need another 100,000 sites. Those are announcements that we heard. So you can calculate a TAM based on the initial number, which is like 8,000 crores for 100,000 sites. You could look at it. And, BharatNet, our addressable opportunity is only the active electronics, the routers which get into the project. Of course, the total spend on fiber, on deployment, on NOC, those are far more, but our proportion is only for the routers, which is...
What would that number be, sir?
I think that totally, it would turn out to be, maybe 1,000 crore or, a little more than that kind of a thing.
All right, we take that point. Thank you so much, Sumit and Arnav, for joining in. Your TAM would be close to 1,000 crores of the 8,000 crore opportunity that there is in the BharatNet business. But beyond that, more importantly, you're looking at improving your revenue coming in from the international business. The aspirational number here is 30 to 40%. And you do believe that margins are likely to normalize going forward. The first quarter impacted by a couple of delays, etc. as well. We will most definitely keep an eye out on how growth pans out, not in FY26, which you've called out to be a transformational year, but FY27 onwards as well as your portfolio changes. Thank you for joining in. With that, let's move on and tell you an important programming alert. A big CNBC TV18 exclusive coming up. The RBI Governor will speak to Lata Venkatesh. And no big question is off the table. From an inflation standpoint, 6-year low, liquidity and global risks, what does it all mean for rates and growth to come by? Catch the most definitive RBI Governor interview post noon today, only on CNBC TV18.
Welcome back. Well, the markets are doing a bit of a bounce, particularly the Nifty Bank. Actually, even yesterday's trading session, the Nifty Bank was the outperformer. Even today, it's doing fairly well. And the good point today is that the Nifty is making a higher high after 4 sessions. On a day-to-day basis, we're seeing that the Nifty has been making a lower high and a lower low. Now that's turned around a little bit. Let's welcome Somil Mehta from Mirae Asset Sharekhan, who joins us on the show. Hi, Somil. What's your take on the Nifty? 25,000 is an important mark. We went to that mark yesterday and we bounced up there. Now all eyes on the 20-day MA. Well, what view would you have?
Good morning. Good morning. Absolutely, I agree. All eyes on 20 daily moving average, which is around 25,300 levels, which is also very close to 40 hourly exponential moving average. So yes, all eyes on that average. But the first thing we need to consider is that Nifty has started making lower top, low bottom formation on the daily charts. The swing low of 25,330 was broken last week, and that was the first sign of reversal. Now we have also closed below the 20 daily moving average, which is the short-term moving average, and that is broken on the downside. On the hourly charts today, we are bouncing back, and I'm expecting this bounce back to continue till 25,300. Take resistance at 20 daily moving average, and again continue the downtrend. So my view is a little negative in the short term, where my targets would be around 24,800, 24,700 levels. Now the resistance is, of course, 20 daily moving average, which is 25,300 levels, and a little higher, which is 25,400. 25,400, you remember we have this very strong support previously, but now it will become a resistance going forward. So that will be the resistance. So view is negative.
Right, your view is negative. You are looking at 24,800, but you look to short the index only closer to 24,300 sort of levels. And if it does cross by, then perhaps we will see some sort of short covering out there. 24,300 is a stiff resistance, is what you're saying. But meanwhile, as we speak, the IT index should come up for you. The IT stocks, after seeing a bit of a drubbing over the last 3-4 trading sessions, ever since TCS's numbers are out, we have seen that IT index reverse, and that's also supporting the frontline index. So the Nifty Bank, which has been doing well for the last few trading sessions, continues to do well, and now is getting support from an erstwhile underperforming sector, the IT space as well. So we'll keep an eye out on how that pans out. Any individual stock ideas that you have for us this morning, Somil?
Just for this bounce back of 200 points, I have two stocks, Shriram Finance. Again, a small consolidation, which is broken on the upside on the hourly charts. Stop loss would be 660. Targets would be 710. The second stock is DLF, has taken support at 40 daily moving average. Stop loss would be 810 and targets would be 870.
All right, Somil, thank you so much for joining in and giving us your views on the individual stocks as well as the index. So just pull up the intraday chart of Patanjali Foods. That stock's moved to the high point of trade. The company obviously has announced to the exchanges yesterday that the board meets on July 17th to consider a bonus issue along with their numbers as well. So to that extent, now the street is seeing some up move on that stock at the high point. We'll get you some more ideas for profit coming in from our colleagues at Money Control Pro. Today we have Neha Dave joining in with the stock. Neha.
Today's stock idea is LIC Housing Finance, the largest housing finance company focused on retail home loans to salaried segment with asset under management of over rupees 3 lakh crore as of March end. Growth has been an issue for the company in the past. In its loan assets have seen a compounded annual growth rate of just 7% and disbursements have seen a mere 4% CAGR in the last 4 years. Management is, however, guiding for disbursements to grow by 10 to 12% at least and loan book to grow in double digits for FY26. The guidance looks promising given the large asset base and stiff competition from the banks. Asset quality has been improving for the company and its funding cost has significantly eased. However, the cut in the lending rate could put pressure on the margins. Management intends to maintain a spread of 2% going forward. Despite wafer-thin margins in the home loan business, LIC Housing Finance's profitability improved in FY25 with company posting return on asset of 1.83%, the highest in the last decade. The improvement in ROA was driven by low credit cost and a very low operating cost structure, which is the moat for the company. Now, in terms of valuation, the stock is currently trading at around 0.7 times book value estimated for FY27 and is trading below a trailing book value for FY25. But the low valuation should not be the only reason to consider a stock. In addition to undemanding valuation, upbeat guidance on loan growth, improving asset quality, and most importantly, significant easing of liquidity and a sharp fall in the policy rate makes us positive on the company's outlook. LIC Housing Finance could command a valuation of at least 1 time forward book value, which could translate into a meaningful upside.
Neha, thank you so much for that. With that, let's move on and tell you about a short break that we're taking. And as we do that, let's tell you about CNBC-TV18 Prime, which is our latest offering. Brings you insights from policymakers, business leaders and economists shaping both the world and India's future. CNBC-TV18 Prime decodes global shifts and their impact on Indian businesses, gives you unparalleled insights. You can tune into CNBC-TV18 Prime at 12 noon for the Global Reset, 1 p.m. for the Big C and Global Lens at 8:30 p.m. Even as the Nifty bank is doing well, IDFC First has moved to the low point of trade, and we are seeing some bit of weakness in a couple of other financial names as well, M&M Financial for one. But let's talk about something more exciting. It's Tesla. The Indian market is opening for Tesla because Tesla has opened its first showroom in Mumbai today. Parikshit joins us from the location out there. Parikshit, I see a lot of crowd behind you. There's rains and there's just a lot of excitement. The Chief Minister was there too.
Yeah, of course, Mangalam. Yes, there's a lot of chaos here outside the Tesla showroom. In fact, the crew, they're having a hard time controlling the crowds because of the heavy rains, the security. We're just about to get entry into the showroom, but we can tell our viewers that the pricing for the Model Y is out. It's going to be between 62 lakhs for the entry-level rear-wheel drive and 69 to 70 lakhs for the long-range version. So you get a 500-kilometer charge with the rear-wheel drive and about 622 kilometers of range with the long-wheel version. 200 kilometers per hour is the top speed. Deliveries are going to begin very soon. You get this in 8 color options. Stealth black is all included in the price, but if you want to go for, say, something like a pearl white or a bright red, that can cost you upwards of 1,80,000. FSD or full self-driving option is also available, but the website shows that will cost you an extra 6 lakh rupees. So let's see how the company is factoring that in. But very soon we'll get to know about the booking timelines, about the delivery timelines for the product. Currently it's only the Model Y, but very soon more models could be showcased and brought to India.
So which color have you decided for your Tesla, Parikshit?
Mangalam, I have no intention of buying a new car. I've bought mine 3 years ago. But if you like, I'll definitely and also put in a word.
It'll take me a long time to get to the level where I will be able to afford a 60 lakh rupees car. And even if I do have that money, I don't think I'll be able to spend it on a car, which is a depreciating asset. But that conversation
Why not? We should always keep our hopes high.
We'll keep our hopes high indeed. Nigel, which color?
No, two-wheeler, I would take Parikshit's help if in case I'm not getting to jump the line. But we'll keep coming back to you, Parikshit. Have a good one. In case you're carrying your checkbook, then maybe you can pay the deposit.
And for now, I don't think even Parikshit is getting to jump the line with the kind of crew that there is, the crowd that there is in the Tesla showroom. With that, what we'll do is we'll take a short break and give you an important programming note. The RBI Governor will shortly be speaking to Lata Venkatesh. Expect answers for all questions that are bothering you. Does 6-year low inflation open up space for more rate cuts? Does low CPI give the RBI some more scope to keep liquidity surplus for longer? Will tariff wars force down RBI's GDP growth forecast? For all of this, tune in post-noon for the most definitive RBI Governor interview only on CNBC-TV18.
Hello and welcome to Trading Hour, live from the CNBC-TV18 Motilal Oswal studio. I'm Sonal Bhutra. With me as always, Hormuz Patakia and Reema Tendulkar. Hey guys, good morning. Well, after a while, we're seeing some green across all the indices, right? So Nifty above that 25,100 mark currently. It's a 75-point uptick that we are sitting with. The mid-caps outperforming 0.4% there. And Bank Nifty is the one which is lending support to Nifty today. So that one is up 0.5%. And it's all about earnings. It's all about Tesla. It's all about the India-US trade deal. So a lot happening. Continues to be a busy day again.
And Asia again is on the positive side. Yeah. So on the whole, you've got green on the Asian markets green. And not to forget, I think the biggest skew is India's CPI print at 2.1%. That has raised, hopes that at some point another rate cut could be forthcoming, even though the RBI, governor was very clear that he's front-loaded the rate cuts. But I guess the hope still stays alive. So that's the big macro trigger. And it's good to see that, despite HCLTech missing the mark on margins this time, the rest of the IT stocks are moving higher. So Infosys, Wipro reports numbers on Thursday, Infosys next week on the 23rd. But the rest of the IT pack, X of HCLTech, is actually higher, which means that maybe in the near term, the bad news could be in the price and for HCLTech being priced in.
Or maybe just looking at the fact that they've raised the lower end of their revenue guidance, which means that maybe the momentum is still on the positive side and is giving some hope that maybe Infosys or maybe even Wipro could do something similar in their results. But yes, the recovery in the IT names is what is propelling the index higher as well. And you can see in their intraday charts as well, all of them have started moving higher post 10 a.m. after making that intraday low. And then the IT index now at the highest point of the day, 0.8% higher. And some of the other movers then within the broader markets, there are plenty of them. Look at Sterlite Tech, 8.5% higher on that stock, among the top gainers on the BSE small cap today. And Nesco is the other one, almost 7.75% higher on that name as well. Some of the MFI names like Spandana Spurti doing very well, almost 7% higher today. And of course, some of the earnings reactions. Rallis at one point was up 6%, still holding on to those gains. And of course, Tejas Networks has recovered from the lows of the day, was at one point down almost 8% at the start of the trading session. We just heard from the management a few minutes earlier, 5% lower now on that stock, continuing to recover from the lows. And the stock of yesterday's trading session, Ola Electric, up 20% yesterday, seeing some bit of profit booking from higher levels now, down 3.5% in today's trade as well. But as Reema was highlighting, IT has been the focal point early in the morning, and HCLTech is the stock in focus, was down 4%, is recovering from the lows, and that recovery has pushed the IT index too at the highs. Is there some optimism here, Reema?
Well, first, let's start with the big picture that it's still down close to about 3%. And there are a couple of reasons for that. One, in Q1, the margins of the company disappointed. Margins came in at 16.3%, down 160 basis points. The company has lowered the margin forecast for the full year by 100 basis points. The new margin guidance stands at 17 to 18%. So that's reason number one. Reason number two is some brokerages have downgraded the stock. So JP Morgan downgrades it to a neutral. They're saying AI deflation is playing out via margin erosion. Nuvama also a downgrade. And Ambit is saying that first, the growth of IT companies got hit, and now the next casualty is going to be margins. Remember, even TCS has refrained so far on giving a wage hike. The third reason is that the HCLTech share price has outperformed its peers. On a year-to-date basis, for instance, TCS is down 20%, HCLTech is flat. In the last 5 years, HCLTech has gained 150%. But as you said, there is a bit of an intraday recovery, and the reason for that could be because while in FY26 margins are hit for a variety of factors, there's the macro uncertainty, the investment, there's a client bankruptcy, the company is undergoing a restructuring, but the company is saying by FY27, 1 year later, margins will get back to the earlier level. So therefore, Nomura says that maybe it makes sense to ignore the margin pressures in the near term because eventually it's going to come back in FY27 and focus instead on the revenue outperformance. And HCLTech, amongst the large cap peers, is likely to outperform on the top line. And that is also the reason why Jefferies has upgraded HCLTech despite a miss in Q1. And Jefferies' target price, as you can see, is at 1850.
Okay, all right. So that is about HCLTech. In fact, in its earnings call, post the numbers, C. Vijay Kumar, CEO and Managing Director of HCLTech, says margin impacted is due to lower utilization and delayed ramp-up of a project. Listen into his comments.
We observed that the environment remained stable from an overall perspective, with some variations across specific verticals. It also did not deteriorate as feared at the start of the quarter. Our operating margin came in at 16.3%, which was lower than our plan. While Q1 has been historically the weakest quarter for us, the below plan operating margin was driven by the fact that our utilization dropped due to a delay in ramp up for a specific program. We also had a one-time impact from a client bankruptcy. We had a couple of large deals in the pipeline which were expected to close in Q1. These deals have moved to Q2. This delay is unrelated to external factors or macro factors. We are optimistic about their conversion, and if all goes as per plan, the TCV number should see a step up in the coming quarter.
Okay, all right, that's about HCLTech, but the other stock which is doing really well is Rallis India. Doing well on trade, and this is after a lot of quarters that we've seen some recovery that has come by. Revenues are up 22% on a YY basis. The EBITDA also went higher by 57%. Margins, they were higher this time, came in at around 15.7%, which compares with 12.2% in the quarter gone by. Profits almost doubled, came in at 95 crore rupees, which compares with around 48 crore rupees in the quarter gone by. The company said that they have seen double-digit growth across their business segments, and EBITDA growth was driven by volume growth as well this time. In terms of their segments, the crop care business, there the revenue was up 16% at 652 crore rupees. Seeds, which is the higher margin business, that saw a growth of 38% at 305 crore rupees, and the management did indicate that Q1 saw strong margins because of the growth in the seeds business. They also gave commentary on the outlook going forward. We spoke to Gyanendra Shukla, MD and CEO at the company. Listen in to what he had to say.
Overall margin, obviously, so gross margins more or less remain flat. I think Q1 also has a higher percent contribution coming from seeds. Seeds generally is a higher margin business. Our soil and plant health business is higher margin business. So that is reflected in the overall number. I think as we move forward, I think Q2 is going to be more domestically important. It has less weightage on the seed. So I haven't worked out those numbers for the Q2, but I mean, it's a mix of business that will dictate how things move forward.
No, other than these IT names that have recovered from the lows of the day, one of the stocks that is doing well though is Hero MotoCorp, and that is after the company put out its annual report where there were some comments with regards to some of the plans for the future. At the highest point of the day is Hero MotoCorp, 3.5% higher, and Sudarshan is here to tell us what exactly did that entail, Sudarshan.
So it's top Nifty gainer because the company has released annual report, and in that it has given the basically strategies for FY26. So few points, basically few headlines if I can mention. First one is global expansion. Second, unlocking new value in the core segment. Third, focus on premiumization. And fourth, expanding footprint in electric mobility. Also, company has termed FY26 as the year of acceleration. So now first talking about the global expansion. In FY25, company has achieved 43% growth in international markets. That includes South Asia and Latin America. Now in FY26, company is saying that it will be expanding its presence in Germany, France, Spain and UK in Q2 of FY26. On the premiumization front, it's saying that Harley Davidson X440 joint offering continue to be strong, and now on the base of that, it's expanding the collaboration with new platform that company is looking to launch very soon. On the retail market front, it's saying that it's on upward trajectory in the calendar year, and now company is looking to maintain that growth during the year, that is FY26. And on the retail finance penetration part, it's saying that it remains steady at the level of 65%, and even inventory levels remain well calibrated. Now on the market share front, it's saying that in 125cc segment, in which company is the leader, and in FY25, it had seen a rapid market share gain, and it believes that going forward, even in FY26, that market share gain trajectory will continue. So on the back of these commentaries that company has given, you are seeing a big move in the stock, and currently it's up more than 3%.
Oh, absolutely. top gainer on the Nifty. Sudarshan, thanks a lot for that. And speaking of top gainers, the index is now nearing the 25,225 mark, almost 150 points higher now for the Nifty, almost a 500-point uptick on the Sensex as well. Take a short break. All things commodities on the other side with Manisha Gupta. Stay tuned. Welcome back. Fertilizer stocks are doing fairly well for themselves in the first couple of hours of the trading session. Fact is the top gainer on the Nifty 500 right now. Fertilizers and chemicals, Travancore, 8.5% higher on that stock. Of course, mind you, this stock has very little float in the market, so keep that at the back of your minds. RCF is the other one, 4% higher on that stock as well. And Deepak Fertilizers is the other one with a 3% gain. So fertilizer stocks doing fairly well for themselves. But a shifting focus now to commodities. Manisha is here with us, and it is today the focus on the Health Ministry's advisory on the sugar and edible industry, Manisha.
Oh, well, Hormuz, we saw those statements come in from the ministry yesterday itself, and I've been talking to a lot of industry participants, FMCG companies since then. And well, they don't really like the language here. What the industry tells me is that the push should be more towards perhaps work-life balance, because internationally the consumption of these commodities is much higher, but then they have the time to go to gym, etc. And for the Indian markets, it also should be about eating in moderation. Well, yes, educating, but not scaring them away. And promoting health and fitness should be on cards rather than telling them to not eat certain essential commodities. So this is the kind of feedback that I have from various companies. But just going back to what you said, well, yes, the Health Ministry has put advisory to government institutions, hospitals, ministries, departments, even schools for that matter, to ply boards with warnings and educating them about health risks perhaps from eating or overeating many of these commodities like sugar and edible oil. It also is to make people aware about health issues, and that extra consumption can lead to some damages here. The Health Ministry estimates also put out, remember yesterday, those numbers as well, that in 2021, 18 crore Indians were obese or overweight and unwell, and that number can go to 44.9 crores by 2050 if nothing much is done. I want to take now, you through on the kind of numbers that we see in sense of per capita consumption. So when it comes to sugar, India's per capita consumption per annum per person is 19 kgs, which is much lesser than the global average of 27 kgs. So we're not exactly there, but it is concentrated one, and there is no fitness regime that Indians have, is the reason we are called the diabetes capital of the world perhaps. The next screen should come in on your screens, and that tells you about our edible oil consumption as well. So for India, it's 18 kgs. Global average for edible oil consumption is 24 kgs. And the highest that you have in sense of global consumption is also 35 to 40 kgs. So we are much below in sense of global averages in sense of consumption for many of these commodities. But again, as I said, we have very relaxed or no work-life balances, and is the reason the threats here are more.
You know, the minute everyone started smiling the minute you said, I think the focus needs to be on work-life balance. But you know, similar to the way we have those tobacco warnings on cigarette packs.
But people really don't follow it. So I don't know how much will they follow this advice as well. But at least we'll not have ads which will say meetha hai khana aaj pehli tarikh hai or stuff like that, because now they're like no meetha or meetha in moderation.
Imagine having a statutory warning on a chocolate packet. Like, consumption of sugar is injurious to health.
I mean, what do you have to say that about that, Manisha? Are you a person who likes sweets?
Well, you know, I'm really watching it. I've been talking to the cross-sector companies as well and industry. There are importers and processors and exporters and value addition products as well. And they're all trying to come out with their quotes on this, their reactions to this, on what they think about it. Also, when you look at the last few years, the sugar and the edible oil consumption in the Indian markets has kind of plateaued. So earlier, if it was 500,000 tons per annum, it is at 0.2 million tons. So we already are looking at that slow there. But the market doesn't expect it to degrow. There could be a slower growth.
Okay, there'll be a slower growth. Maybe people will contribute to that slower growth. We'll have to see which way things go. Thank you, Manisha, for joining in as always. And an interesting update, right? Talking about work-life balance and balanced diet as well. Very important, absolute need for the hour as well. But on that note, we'll slip into a short break. When we return, we'll discuss market technicals with Mitesh Thakkar and also discuss his top trading bets.
Welcome back. Just before we go to Mitesh Thakkar for a quick chart check, some flashes on your screen. Swaraj Engines, the first of the earnings of the day, and that stock has now come sharply off the day's high after its earnings performance. So you just saw the EBITDA number a few seconds earlier, 16% higher on the EBITDA front and 16% higher on the sales front, and sales were up 16%, but then the stock has come off sharply from the highs of the day. Now at one point was up 4.5%, now just up 2%. So you get more details on your screens now. Net profit up 16% at 50 crore rupees. You get more details on the EBITDA front, on the sales front as well. Sales were up 16%. The EBITDA up 12.5%. on a year-on-year basis. So that too at 67 crores, but the stock is off the highs of the day. Mitesh Thakkar joins in for a quick chart check. Mitesh, thank you for joining in again. We've seen that move past that 25,150 mark, at least for now, back above that 25,200 mark. Do you use that to exit your longs, if any, or do you see this moving further higher towards the 25,350 zones, and your stock recommendations as well?
Look, I think around 25,300 is where I believe the market will face a lot of supply. One, there was a falling gap between 25,340 to about 25,320, which was on Friday. And a couple of moving averages are around this 25,300 zone. So I think this is the level, maybe another 40-50 points higher, where you would want to start taking some short positions with a stop about 25,350. And in case we don't get past those levels, then good chance that we'll retest 25,000, possibly 24,850 as well. So in that sense, my negative view on the index. And on the stock, I have one buy and one sell call. ITC is something which has come on the radar on the buying side. It's breaking out of a good consolidation, so keep a stop at about 417. And look for targets of around 430 on the upside. And on the negative side, I have a sell call on Mazgaon Dock if it breaks levels of 3,100. So it's about at 3125, 30 zones. Sell below 3,100, make a stop at 3135, targets for around 3,020.
Okay, take that point, Mitesh. That is about a technical check on the market levels and individual technical picks as well. Let's talk about the oil and gas space. There is a public notice which is issued by PNGRB, which is the regulator for the oil and gas space. They have flagged irregularities when it comes to the PNG price, the domestic PNG, which basically we use in our homes, in our kitchens as well. They say that all these companies must have a uniform rate irrespective of domestic household consumption that these consumers are doing. So basically, once the consumption increases, the rate changes. And that is something that they are not liking right now, the regulator that is. Now remember, 10% of MGL's volumes are coming in, the PNG volumes are coming in. And for Gujarat Gas, around 8% volumes are from the PNG segment itself. In their note, PNGRB says that they need to, certain CGDs are implementing a telescopic pricing structure for PNG consumers. That means that once a threshold for consumption is crossed, they increase the pricing or change the pricing. But PNGRB is of the view, since it is going to consumers, final consumers, there should not be a volatile pricing which is dependent on consumption. They say such practice leads to unauthorized use of subsidized APM gas by commercial consumers, because largely APM gas is for PNG and CNG, which basically caters to an individual or final consumer, not for commercial usage. So they are saying that they need to review this pricing and there need to be changes to pricing so that the final consumer tends to benefit. There's no volatility in pricing and it is not for commercial use. So it has just come in as a warning, or I would say it's just a public notice where they are looking at this irregularity. There's no impact as such because it's just a public notice yet. There is no final decision, but important to track, because if it does come through, there could be some impact on margins going forward.
Thank you for explaining that. Get into a break. On the other side, we'll discuss market fundamentals. Devang Mehta from Spark Capital Private Wealth joins in next. Welcome back. In the thick of the earnings season, it's kick-started with IT, but soon all the other sectors and companies will follow. So it's a good time and it's a good way to prep you up for the metal sector. This is Quarter Se Quarter Tak. We'll get you the earnings expectations from Nigel, who will tell us how Q1 is likely to pan out for the metal and mining sector. Nigel.
Let's begin with the ferrous space first up, where steel companies are expected to deliver a strong performance in the first quarter. The steel EBITDA is projected to rise between 4 to around 15% on a quarter-to-quarter basis. That's thanks to two factors. One is a rise in domestic steel prices by roughly around 2,000 to 2,500 rupees per ton, and a decline in coking coal costs by around $10 to around $12 per ton. However, this margin improvement is expected to be partially offset by higher iron ore cost as well as lower sales volumes. The volumes could decline by around 3 to around 17% quarter-on-quarter, mainly due to the planned maintenance shutdowns and muted export demand. And also the early arrival of monsoons, well, that's going to be a bit of a dampener on the volumes front. On a company-specific basis, all companies will report an improvement on the EBITDA per ton. Tata Steel India, well, the EBITDA per ton is expected at around 14,500 rupees per ton, while Europe is expected to trim its losses to around a negative $28 per ton. That's down from close to around $40 per ton in the previous quarter. JSPL as well will report a solid gain. The EBITDA per ton is expected to jump up to around the 13,850 rupees odd, while JSW Steel will clock an EBITDA per ton of around 10,820 rupees per ton. SAIL, well, that'll see a modest improvement. The EBITDA per ton will move closer to around that 8,000 rupees odd mark. Jindal Stainless from the stainless pack, well, that'll report a good bounce back. Remember, quarter 4 was quite soft. This time around, there'll be a 10% quarter-on-quarter growth in the consolidated EBITDA per ton and could come in the vicinity of around 18,200. Two factors support them. One is realizations, which are higher, and the cost of production, which will be relatively lower. Moving to the non-ferrous side of things then, quarter 1 is expected to be soft. That's because of the decline that we've seen in commodity prices. The average LME prices for aluminium as well as zinc, they're down by close to around 7% on a sequential basis. That's what could weigh on the profitability as well as on the top line. However, silver has bucked the trend. It's up close to around 5 to 6% odd. It's hit its highest levels we've seen in more than 10 years. Coal India, though, they're expected to drop a 20% drop in the EBITDA. That's because of lower volumes and pricing. You have also seen the e-auction prices that are lower. The cost of production for them has moved up as well, so that's what will hurt Coal India. NMDC could see a 5% growth in the EBITDA. That's because of the higher volumes, which will jump up by mid-teens, though the benefits will be limited due to higher cost of production and lower realization per ton. Hindalco's India business, well, that'll get hit because of aluminium prices, which are down. And also we have seen that, the cost of production as well could get a hit a little bit. While Novelis, its overseas subsidiary, that will see a 9% quarter-on-quarter drop on the EBITDA per ton, should come in at roughly around $450 on a per ton basis because their operations have been impacted by tariffs on Canadian imports into the United States, rising input cost as well. Vedanta, well, on a consolidated EBITDA basis, there'll be a decline out there because of aluminium and zinc prices. Both of them are down by close to around 7%. However, gains from lower alumina cost and increased captive sourcing, that's what will help partially offset some part of that impact. To sum it up, metals sector in quarter 1 FY26 is expected to be a tale of two halves. Steel companies are poised to report strong earnings momentum supported by rising prices, falling coal cost, while non-ferrous players, they'll face profitability pressure owing to the drop in commodity prices.
Okay, take that point. Thank you so much, Nigel, for lining up those expectations from the sector. It's all about earnings and what we're expecting from the numbers. Yash is joining in now. It's all about the insurance space now. HDFC Life reports its numbers. Yash, what is the expectation?
Well, that's correct. So HDFC Life, of course, a Nifty company reporting its numbers today. The numbers are expected post-market hours, so about 4 o'clock is when we are expecting the numbers. In terms of expectations, the APE growth is expected to remain muted, though, the ULIP share will be higher in that, and that could impact the margins or keep them range-bound. In terms of specific numbers, the total new business premium, the expectation is that we could see a 15% growth. The number that we're looking at is about 7,489 crore rupees. Total annualized premium equivalent, that could see a growth of about 11%. The number that we are eyeing here is about 3,186 crore rupees. Retail APE could see a similar growth of about 10% at 2717 crore rupees. Value of new business, the improvement here could be higher. About 14% growth is what we're expecting at 817 crore rupees. And most important, as I said, the ULIP share could pick up, which could keep the margins range bound. So the margin improvement that we're looking at is just about 53 basis points. The margins could come in at about 25.63% versus 25.1%. Important to point out that the stock has seen a very strong rally in the last 3 months. In the last 3 months, the stock is up 8%. In the last 6 months, the stock is up 23%, trading at about 2.2 times forward price to embedded value. So the numbers in context with how the stock has behaved becomes very important today.
Yes, thanks a lot for that. Of course, we watch out for HDFC Life, one of the two insurance majors reporting results today, ICICI Prudential being the other one. What's the street expecting there?
Well, of course, ICICI Prudential is going to be the next life insurance company reporting its results today. As far as numbers are concerned, the total new business premium expected to see a muted growth of just about 6% at about 4,000 crore rupees approximately. Total annualized premium equivalent, that is expected to see a stronger growth and largely coming from the group business. So the growth that we're expecting on total APE is 23%. The number that we're looking at is about 2419 crore rupees. Retail APE, as I said, the group business is going to expected to perform. Retail business is going to be difficult in this quarter. So we are expecting a contraction of about 19%. The number that we're looking at is 1,356 crore rupees. Value of new business growing by 34% at 620 crore rupees. Margins, though, are expected to remain on the softer side, down 43 basis points at 23.57% as compared to 24%. Out of the entire life insurance pack, ICICI Prudential Life and LIC are only the two stocks which haven't rallied very strongly. So ICICI Prudential Life, that has gained up just about 1% in the last 6 months, 16% though, as far as the last 3 months is concerned, trading at a valuation of 1.6 times forward price to embedded value.
Thank you very much for that. Let's quickly talk about Tejas Networks. That is one of the casualties of the day. And that's because the numbers have been very, very disappointing. The company's top line has fallen between 85 to 90%, both on a quarter-on-quarter and on a year-on-year basis. So the top line has come in only at 200 crore rupees. It's a sharp decline compared to the prior quarters. Now, the reason for that is they were expecting the BSNL order to come through. But that purchase order came through only after the quarter closed. And that also, as of now, it's the purchase order. I think the final deal is yet to be signed. So that was reason number one. But even outside of that, the company did say that there were certain delays in the shipments. So delayed inventory arrival, shipment clearances for a few customers, all that impacted the top line. Now, courtesy the big drop in the revenue, the company also reported a big EBITDA loss of 126 crore. And that resulted in a big profit decline of nearly 194 crore rupees. We tried to chat, we spoke to the management, and this is not a management we often, speak to, but they did indicate that, one, on BSNL, the street fears that, what if this BSNL comes to an end, right? You can't be a one-trick pony. So, to which they said that, BSNL, if it has to be a pan-India player, it needs a lot of 4G, 5G upgradation of the network. So basically indicating that the opportunity is there for BSNL. Secondly, they also said that, but we don't want to be only dependent on BSNL. We want to increase our international share. In fact, the focus of the company is to get in global operators also. So they're saying their aspiration is that the contribution of international revenues will go up from the current 18-19% to about 30 to 40%. But I think this year is still going to be a little bit of, a challenging and a transformation kind of a year. In fact, let's listen in to what the management had to tell us.
In FY25, we came off on the back of a really large project, this BSNL 100,000 sites, which we had to deliver in a very accelerated way. And that kind of resulted in a huge bump up of our revenues from FY24 to 25. So obviously, we are all been very clear that FY26 is not going to be in the background of FY25, and we should look at our business in the context of FY24 and so on.
What you see as reported receivables are to a large extent or significantly on account of the BSNL 4G project that got executed over the past few quarters. In fact, the last quarter was the completion of the project. Now those receivables are expected to be collected over a period of time based on certain milestones related to implementation of the project. So we should see that coming down over the next few quarters within this financial year. Also, a part of these receivables are essentially against that. We also have received an advance on this project of about 1460 crores. Now that lies in the other liabilities because some of the milestones that were to be delivered are yet to be completed. So on a net basis, I think the actual receivable number is much lower than what you see on the reported statements.
Okay, that's Tejas Networks for you. Get into a break. As promised, on the other side, we'll talk about the markets, where we're headed, individual stocks with Devang Mehta of Spark Private Wealth.
Welcome back, and as promised, Devang Mehta from Spark Capital Private Wealth is now joining in to discuss the markets and some of his top ideas. Devang, good morning. Thank you for joining in. The conversation all around has been with the IT results that we have reported so far, and they flattered to deceive, to say the least. Now, would you believe that, okay, the first half might just be the bottom that the sector has been looking for a while now, and then we start seeing growth from the second half courtesy of the low base?
Good morning. Thanks for having me on the show. I think clearly the last 1.5, 2 years, we have been a bit underweight on IT, to say the least. In fact, actually has not favored the large cap IT sector all through. Now, the reasons for that are clearly there are more headwinds than tailwinds, as we all know. Somebody who probably grows at a single digit, and just because the valuation has collapsed from what it used to trade in terms of its P multiples, I don't think it makes a sort of a bargain hunt. There are so many sectors, there are so many themes, there are so many micro themes in India which are doing well. So I guess that buying it at a value zone somewhere, but with no growth, it would just probably be a bounce back or a momentum which would just sometimes come into the proceedings. But otherwise, I don't see any such reason. Maybe the commentary and the body language are still weak. People are guiding towards lower margins. Yes, I can't paint the entire picture for the entire sector. One can be selective, but ideally, as I said, there are more domestic-centric stories than something where you need to depend on exports. And I think a lot of innovation will go into the proceedings. The typical software exports, I think people need to innovate. They need to sort of get into digitalization, which a lot of companies are doing. But I am not seeing a lot of revenues coming out of those streams. So as I said, I'll not be very bullish on IT per se. Yes, at some price points, some valuations, it would become attractive, but not a conviction buy at all.
Got that. But what about mid-cap IT? So if the big concern with frontline IT for not buying is that there is no growth, but many mid-cap IT companies are giving you growth. But here the valuations are expensive. So what are you doing with mid-cap IT? And which IT stocks do you have in your portfolio? Or is it a zero exposure?
Yeah, so ideally, as I said, I have a zero exposure towards the IT stocks.
Zero.
But a stock like L&T Technology Services, just an example, LTTS, right, which is not a pure play IT. You would understand it's more digital, it's more AI, it's more ER&D. If I could make a point, I think these are companies where you will have lumpy quarters. But there is where the growth will come in, right? People want to improve their efficiency, their productivity. These are innovation-driven companies. So my sense that somebody wanting to buy pure play IT can probably wait for some time and have companies like LD Technology. I'm not suggesting, as I say, but it's a portfolio company that we hold for a lot of our clients. So that's an interesting play that one could probably look into.
Got it. Devang, you also mentioned that you would be looking at some proxy plays when it comes to consumption, when it comes to some of these broader market themes. Can you explain the reason to us, and which are some sectors that you are liking currently?
Very interesting. I think, see, what has happened is today, if you probably buy something in the benchmark indices, particularly Nifty or Sensex, we all know that 35% is the traditional financials that you get, 14-15% IT, 8-10% is the traditional oil and gas, and again 8-10% is the typical non-discretionary consumption type of ideas. So 65-70% of Nifty is spread into this. So I think it's very important that one focuses on the broader market. In broader market, there are so many interesting themes, right? From discretionary consumption, of course, we know which is on the rise since COVID days. It's sort of slowed down a bit, but again, it seems on the up move. Most important part of this broader markets is where I use a word, and I've been repetitive over here, is something driven by capex. Now, by capex, I mean the entire capital expenditure that the government is doing. The private sector is probably also started to jump on the bandwagon. Now, the LIs and the proxy plays here are the last mile proxies. Be it power automation, be it liquid insulation, be it engineering, be it ER&D, which we talked about. There is lamination, stamping, casting. These are certain companies which are sort of never present in the Nifty at this point. But whether in the next 3 to 5 foreseeable years this will be part of indices, some of these companies will be part of indices. I think there are a lot of proxy plays here where you get one, ordering activity, second, the execution has picked up. Most of these companies have sort of reduced their debt, or these companies are debt free. Every incremental capital that is generated over here is put to work and generates more ROE. So my sense, a confluence of factors, be it lower inflation, be it supportive RBI, be it government policies, be it sentiment, liquidity, I think is making that domestic centric stories and the broader market stories more interesting towards capex, towards discretionary consumption, and some towards even financials, or I can say lesser known financials, which are proxy plays of financial penetration and density.
Since you're on the subject of proxies, what about the capital market plays? Devang, how would you play that theme? Would you play it directly from an exchange like BSE? Would you use the depositories like CDSL? Or would you use the asset managers or the likes of the HDFC, AMCs and the Nuamas? Where does your preference lie within this space?
Honestly, we find this entire space, the names you talked about, the sectors or the subsectors or the micro themes you talked about, all look interesting. But if you ask me today that what are the favorites over here, clearly we feel that the depository participants, exchanges, now clearly there is a duopoly, there is a sort of a oligopoly in this, and you know that there is a durable competitive advantage available to this type of companies where there are ROEs, there are ROCs, there is a bit of pricing power, there is a bit of moat which is available in this type of businesses, and we know that the penetration is going to rise, right? With 18-20 crore demat account, demat accounts are going to rise. You see a lot of capital market activity. You're seeing IPOs, you are seeing OFSs, you are seeing deals happening in the market. So I think the entire space, right from millionaires to billionaires, by the hour we see the market size increasing. There's a huge size of the opportunity with companies having dominant market shares, and consolidation is going to happen in this type of a space. So my sense, yes, a lot of these financial proxies, ex-banks look very interesting. Yes, banks will do good, but that would be around 10, 12, 14% type of growth over a period. But this financials, the financials that we talked about, the intermediaries, they could probably grow at 18, 20, 22% and more the merrier, that type of growth.
Got it, Devang. Thank you so much for joining us with your insights and telling us which sectors and stocks or themes could be in focus going forward as well. By the way, for the markets, it's a 140-point uptake. The mid-caps have also picked up pace. It's up around 0.7%. And it's really the pharma space or the chemical space, so to say, which is doing really well. So we have something like a Rosari Bio, which is up 6.5%. Aether Industries is up 5%. RCF, NFL, India Pesticides. So this theme continues continues to do really well in trade. So we'll have to see which way things go as far as the Q1 results are this time around for these names. But we'll slip into a break now. As we do that, here's some good news for our viewers. India's business news leader is now click away. Introducing CNBC-TV18's all-new app. Get instant access to breaking news, in-depth articles, and financial world updates at your fingertips. Download the CNBC-TV18 app now from the Apple Store or Google Play Store, or just scan the QR code on your screen.
Welcome back. Tata Tech is higher in trade, up by nearly 1%. Now, Q1, no doubt, was a muted set of numbers. The company's revenues dropped by 4.6% quarter-on-quarter. Year-on-year, revenue contracted by 5.2%. Margins came in lower than street expectations at 13.6%. Then why is the stock higher in trade? Well, the key reason is the management is still very optimistic. They're talking about all the headwinds that hurt them to be temporary, short-term in nature. In fact, even though the analysts believe the company's top line will degrow by about 5%, and some of those estimates will come up for you on your screen, the management very clearly in our interviews said that we're confident that we will not degrow in FY26. They're confident that Q2 will be better than Q1 and of a strong H2. Also on margins, because margins, remember, declined quite sharply. They said that margins will improve. It will further improve once growth comes back. But the aspiration is margins will trend towards the 18% by Q4 of FY26. Full year margins will not be 18%, but they will trend towards the 18% mark. These are the EBIT margins. The company, I think, was looking at the EBITDA margins when they talk about 18%. But they also said that the North Star on margins remains 18%. So that's the reason why the stock is higher in trade, because the company is still very optimistic that things will improve. Even its peer Tata Elxsi, which reported muted numbers last week, is actually higher by close to about 3.5%. And many analysts had pointed out that, even it'll take a while for the auto ER&D companies to bounce back, spends will recover. It'll take a time, but valuations perhaps in the near term may have bottomed out, which is why even to a weak set of numbers, it's not that the stocks are reacting adversely. Now, the question is whether what the management says plays out, the recovery in Q2, a strong H2, or the macro uncertainty continues to, pull them lower.
Okay, take that point. So that explains the move on Tata Tech. But the other big story has been the June consumer inflation number, which has come in at a 6.5-year low of 2.1%, and it is lower than the CNBC-TV18 poll of 2.3% as well. Lata is joining us with her editor's take. Lata.
An ultra low inflation number, it's a 6.5-year low. the lowest since January 2019, just for the record. But importantly, it's been dragged down by food inflation. We can't even call it food inflation because it is deflation. It is minus 1.06. Prices have fallen by that much year on year. And the CNBC-TV18 poll actually expected flat, 0.1% rise. But this has come in deflation. And remember, the WPI also threw up a deflation in food. It's something we have to watch. To be sure, there is a high base, but this is an important level. The big fall is coming because of even month-on-month falls in cereals and pulses. Normally by June, this fall in prices stops because, there is monsoon dislocation of, supplies. As we look at veggies, veggies are up 7.5% month-on-month, June over May, which is normal. I mean, because again, supply dislocation, vegetables begin to rot. But if you look at the year-on-year, vegetable inflation is down by about 17%. So that's the extent to which food is not an issue. Core CPI has come in at 4.4%. Core is when you take out food and fuel, whatever is left, largely services. That's come in at 4.4. That also because it includes gold. That's also because there is a low base. All this base will evaporate. Even gold will plateau on year-on-year terms. So we are going to see core inflation also falling. The expectation is July is going to be below 2%. 1.8 is a kind of the dipstick survey for me. And there was one person with a reading of even 1.5%. So that's the kind of low for the full year. Most people are now looking at, below 3% for, below 4% for all of 2025 calendar. For the full year FY26, people are now looking at 3.3, 3.4. 12 month, that is 3.3, 3.4. RBI is standing at 3.7. So now the market is pretty sure there is space opening up for another cut. And more importantly, that liquidity will continue. See, if too much money is not pushing up goods prices, that's what you normally worry, too much money chasing goods and pushing up prices. If that's not happening, then, the Reserve Bank will be more relaxed with liquidity. So chances are we are going to, start seeing the bond market pricing in a rate cut. Yields didn't fall yesterday. They were open. The bond market was open when the numbers came. Yields didn't fall. That was because of US yields going up. But space for rate cut is clearly opening up.
Lata, thanks a lot for that. Hopes rising for another rate cut from the RBI. Now, Tamasic India head Ravi Lamba has said that the private equity firm aims to invest around $10 billion in the country over the next 3 years. Now, speaking to Ritu Singh, Lamba added that the Indian market is a favorable environment for the company and accounts for 8% of its global portfolio. Listen into a slice of that conversation.
Financial services is a sector we've always been focused on. We've invested in the banks for a couple of decades now. We've invested in them. We truly see them as proxies for economic growth, and more importantly, as we see the sector expand, we are finding opportunities in insurance, which we have investments in both general and life insurance in the listed space and in the unlisted space. We had a portfolio company, Niva Bhupa, go public last year, so that's another good example of an insurance company that's matured to go to the public markets. And going forward, we see new categories of investment in the financial services space. I mean, we see opportunities in life insurance and general insurance, and beyond that, we see wealth management and asset management as well as emerging categories where we will look to deploy capital. Future consumption is changing rapidly, and short of the restaurants and the home delivery of food, the cloud kitchens are back. We invested in Rebel Foods last year. These are all playing to that same vertical, which is expanding very rapidly. So I see a lot of future here. The key question in all of these businesses, as you rightly point out, is to make sure you develop a business that's profitable and can stand on its own feet and does not constantly need equity capital to fund its growth. Because if that happens, then the burn rate can get to you. So you have to be careful about how you build these businesses. You have to calibrate the long term with the short term. And from our perspective, we are very happy and comfortable with our position in Zomato. It's done really well for us as an investment, but more importantly, from an execution perspective as well. So we see the long term. Quick commerce is something here to stay. Our exposure this year in March 25 in India on a mark-to-market basis is at $50 billion US, and it was $37 billion last year. So it's grown quite well. And what happened 2 years ago when we said, looking forward, we can see the potential to deploy $9 to $10 billion over the next 3 years. And, we've been well on track on that. We deployed just under $3 billion in the first year, and, we've deployed more than $3 billion last year. And this is not a number that we are so fixated on. It's a number which we are hoping to deploy. Going forward, we can deploy more than the 9 to 10 billion that we talked about. Depends on the opportunities we find.
Well, that's the big interview for the day. For the market, still holding up with a gain of about 0.5%. The Nifty's gained more than about 100 points after getting precariously close to the 25,000 mark yesterday. 25,002 was the intraday low. Markets have recovered nearly about 200 points. Auto is leading from the front. So we spoke about Hero MotoCorp, the annual report takeaways. That's your top gainer, 4% up. It's even surpassed the 200-day moving average. So technically important. But look at Bajaj Auto, Eicher Motors, M&M. Across the board, these stocks are higher. It also helps that, IT is not dragging today. So there is one HCLTech which is under pressure, but the rest of the IT pack is higher in trade. In fact, the Nifty IT index itself is also up in the green. Realty is another big mover. PSU banks up and about. Capital markets strong for the second day in a row. And Pharma too is contributing on the way up. Well, that brings us to a close on this edition of Trading Hour. From the entire team, thank you for watching. Don't go anywhere. Halftime report is up next.
Stocks gain as her hope of a mini India-US trade deal revives. Auto and realty are prominent gainers, even as utilities and metals sulk.
HCL Technologies posts some muted revenue, but the margin miss and cut in guidance are a big negative surprise. Delayed execution and investments in AI dent first quarter margins. Restructuring costs will crimp margins in the coming quarters as well.
Hero MotoCorp Chairman Pawan Munjal unveils a plan to accelerate growth in FY26 by expanding in Europe, growing presence in the EV and premium segments, strengthening the three-wheeler EV portfolio and expanding the collaborations with Harley. The stock reps up.
Tesla opens its first India showroom at BKC in Mumbai today. On offer are two Model Y variants at an on-road price of rupees 63 lakhs and rupees 71 lakhs. The prices dispels concerns of an impact on local EV makers.
Hello and welcome to Halftime Report, live from the CNBC-TV18 Motilal Oswal studio. I'm Ekta Batra, with me is Manglam Malu as well as Vinny Motiwala. Well, it is turning out to be a session where we are seeing good amount of gains coming in as of now for the markets. So no complaints really. We have a lot of stocks to focus on in the next 1 hour odd. But if you ask me, it's a lot on the auto space that we all have our eyes on. Obviously, you know, the sparkle that Tesla comes with in the auto space and what kind of ramifications that would have on the Indian automakers is something that we will be discussing in the next 60 odd minutes. As of now, we have the Nifty Auto Index, which is up around 1.5%. We have the Nifty, which is up around 58 odd points. Hi, guys.
Hi. You know, there are three colors in the studio here right now with Vinny, you and me. The important part is Parikshit said that there are 8 color options in the Tesla cars that they've launched. I wonder if you've decided on your color, Ekta. Which one would be, if at all? 62 lakh rupee car and the longer range one, a few hundred kilometers more, you pay 70 lakh rupees. And with some more customizations, you can add another 7 lakh rupees, which I think is the budget for my car.
I think Uber was the best. I think Uber was the best invention ever.
Yeah, I agree to that.
I'm a Kali Pili person.
Okay, that is also good. But yes, a lot that is going to be happening here in terms of competition. I think the pricing is much higher than it. But that's what we'll be discussing later on in the show as well. Today, in terms of the markets also, like you're saying, it's a good day that's coming in. But chemical stocks, and fertilizer stocks, they are buzzing in trade. So whether you look at FACT or whether you look at something like a Rallis on the back of its numbers, they all are holding on to good gains. Sumitomo Chemicals among some of the names that are managing to hold on to gains in today's trading session or in the broader end of the market. But we'll keep an eye out on the auto pack today. And Hero MotoCorp, that is the one that we're keeping an eye out on. That's surging in trade. And this is why the company is expecting an FY26, that the FY26 year will be better with in terms of acceleration coming in for the company. What more are we expecting here, or what is the word coming in there? Sudarshan is joining in with us to give us those details. Good afternoon, Sudarshan.
Good afternoon, Vinay. So while you guys are talking about the cars, I'm here to talk about the bike segment and about the bike maker, which is leader in the entry-level segment, and that is Hero MotoCorp, which is top Nifty gainer currently and up more than 3%. And it's on the back of the annual report details that company has given yesterday in the evening, in which company has termed FY26 as the year of acceleration. And also it has laid out few strategies that company will be working out in FY26. So first one in that one is global expansion. Second one is unlocking new value in the core segment. Third, focus on premiumization. And fourth, the expanding footprint in electric mobility. So now first talking about the global expansion. In FY25, in the international market, company has seen growth of 43%. And that has come mainly from two markets, that is South Asia and Latin America. Now, by the end of Q2 FY26, company is saying that it will be expanding its presence in countries like Germany, France, Spain, and the UK. On the premiumization front, you know that company has a partnership with Harley Davidson, for which company is saying it has been performing as per its guidance and as per its expectations. Now, on that, through that partnership only, company is looking to launch a new platform very soon. Now, on the retail market, it's saying that it's been gaining market share, and in the calendar year, it has been on the upward trajectory, which it believes that it will continue even going forward. On the retail financing part, for which all the other companies had raised concerns in the last few quarters. But Hero Moto is saying that for company, it has been steady at the level of 65%, and it's going to be around the same level going forward also. And in 125cc segment, in which company is the leader, and it says that in 2025, it has been gaining market share in a rapid pace, and believes that even in the remaining calendar year, and to say for FY26 whole year, it will continue to gain the market share. So all the strategies that company has laid out for FY26, I believe that on the back of that, you are seeing a big move in today.
Right, Sudarshan, thanks a lot for that. You have spoken about two-wheelers, but you're not speaking about the more expensive ones. You're talking about Harley, etc. as well. So I think while we just debate on the color of the cars that we will buy, you will perhaps go ahead and buy the Harley out there. Is that what you're going to do?
No. If I have to go for the premium segment in the bike space, I still prefer the Royal Enfield.
Okay, be Indian, buy Indian. But what about Ola Electric? That's the stock under pressure.
So after seeing a big move in yesterday's trade post Q1 earnings and the optimistic outlook that company had given for FY26, it's seeing a minor profit booking today.
Okay, seeing a minor profit booking today, but let's also listen in to what the management of the company had to say, because some bit of a pressure, right? Sudarshan is mentioning also right now. We spoke to the CMD Bhavesh Agarwal on what he had to say in terms of their Q2 EBITDA margins, the SEBI warning on the registration number mismatch as well. What is the update coming in here? Listen in from the management.
We've given a fairly detailed outlook in our shareholders letter this time. So for our auto business, we said that this full year should be EBITDA positive. Q2 itself will be a EBITDA positive. Even cash flows by the end of the year, our auto segment will be making both operating cash flow and free cash flow. There is still some investment to be done in the cell business to get to the 5 gigawatt hour capacity. So we are allocating capital this year for that capex. Now, beyond that, the auto business profitability should balance out to whatever investment needed in the cell business, because the auto business is where the real volume is. The confusion that happened was the registration and registration numbers mismatch in February or March. And I think in our Q4 results, we actually clarified that with a proper walk of how the numbers stacked up. So I think in the public domain, definitely this issue has been now behind us. SEBI and we had many conversations, and whatever questions they asked, we definitely clarified.
Right, let's talk about HCLTech under pressure post a mixed set of earnings. Margin comes in below expectations. Rima joins in with more on that one. Rima.
Thanks so much for that. So let me quickly outline a couple of reasons why the stock is under pressure today. Reason number one is the margin miss in Q1. EBIT margins declined by 160 basis points on a quarter-on-quarter basis, 16.3%, much lower than consensus. This led to a drop. This led to the company lowering the margin guidance by 100 basis points, and now the new margin guidance stands at 16 to 18%. Two, some of the brokerages have downgraded their assessment of HCLTech. So JP Morgan downgrades HCLTech to a neutral. They say AI deflation is playing out via margin erosion. Nuvama too has downgraded the stock and cut the target price to 1630. Ambit also echoes in a way what JPM says. The results corroborate our view that margins will be the next casualty after growth. Also, the third reason is HCLTech outperformed some of its larger peers. So in the last 1 year, HCLTech was the only one with flat, no return or no contraction in share price, but its peers had underperformed. In the 5-year, HCLTech share price has gone up by nearly 150%. That said, there are many brokerages who still are upbeat on HCLTech. So Nomura maintains a buy, and they say the street should ignore the near-term margin miss, because the management themselves is saying that margins will revert, come back to the original levels in FY27. And focus should be on revenue outperformance, growth outperformance, which HCLTech is doing. Jefferies too. Jefferies, in fact, has upgraded HCLTech today. Back to you.
Okay, all right, Rima. Thanks very much for that. So joining the list in terms of negative reactions post-earnings, the first was TCS and now HCLTech. But in its earnings call post the numbers, C. Vijay Kumar, who's the CEO and Managing Director of HCLTech, says that the margins were impacted due to lower utilization and delayed ramp-up of a project. Listen in to his comments.
We observed that the environment remained stable from an overall perspective, with some variations across specific verticals. It also did not deteriorate as feared at the start of the quarter. Our operating margin came in at 16.3%, which was lower than our plan. While Q1 has been historically the weakest quarter for us, the below-plan operating margin was driven by the fact that our utilization dropped due to a delay in ramp-up for a specific program. We also had a one-time impact from a client bankruptcy. We had a couple of large deals in the pipeline which were expected to close in Q1. These deals have moved to Q2. This delay is unrelated to external factors or macro factors. We are optimistic about their conversion, and if all goes as per plan, the TCV number should see a step up in the coming quarter.
Okay, hopeful of deal momentum to pick up. That's the word coming in from HCLTech. But on that note, we're going to slip into a very short break. But here's an important programming alert for you all. The governor of RBI will shortly be speaking to CNBC TV18's Lata Venkatesh. Expect answers for all the questions that are bothering you. Does 6-year low inflation open up space for more rate cuts? Does low CPI give RBI the scope to keep liquidity surplus for longer? And will tariff wars force down RBI's GDP growth forecast? Tune in post-noon for the most definitive RBI Governor interview only on CNBC TV18.
Welcome back. Well, for the markets, it's holding quite steady. We have the Nifty, which is up around 124 odd points. The advanced decline ratio is also managing to hold at around 2:1. So good going for the broader markets at this point in time. So definitely some portfolios are doing better in today's trading session. But all eyes are on the auto space and what that could hold in terms of competition, because Tesla has opened its first India showroom in Mumbai's Bandra Kurla complex. On offer are two Model Y variants at ex-showroom prices of 59.89 lakhs and 67.89 lakhs. To discuss more, we have with us Shirish Chandran, who's the editor at EVO India magazine. Shirish, thank you very much for joining in. Well, it's definitely a landmark day considering that Tesla is now finally launched in India. But wanted your sense in terms of the kind of pickup we'll see in terms of sales, considering the price points and the given rising competition within the EV space.
So after a lot of back and forth, will it, won't it, they finally are here. So that is a big deal. Now, obviously, they were going to manufacture in India. That's not happening as of now. Hopefully, it'll happen in time. But right now, it is all imported CBUs. And that's why, obviously, the pricing is on the higher side. But look at it this way. There's so much of anticipation around Tesla. So many people are talking about Tesla. And there is no dearth of money in the country. So even at these prices, like I said, on the higher side, you will still see a fair bit of takeoff for the Tesla, at least as of now.
At least as of now, you're expecting some bit of a takeoff coming in here. Shirish, good afternoon. But other than that, one more news flow that came in, that VinFast, they are also planning to launch here as well. So there is surely going to be increased interest coming in here. In terms of pricing, obviously, we still don't know the range of pricing, but that would still be lower than Tesla. So how would that work overall for the Indian EV markets as well?
Well, VinFast 100% has to be lower than Tesla. Yeah. They have to be super aggressive on pricing because, see, Tesla, everybody knows about it. Whether you can afford a Tesla or not, everybody knows about it. They don't have to invest anything in terms of brand building. VinFast, on the other hand, is brand new. Nobody knows what it stands for. Nobody even knows anything about the Vietnamese car market. So a lot of, confidence that you would need to invest in a VinFast. So the VinFast story, it will work if the pricing is super aggressive. If not, then I'm actually curious to see who will be the first adopters for the VinFast. I don't think anybody is curious, and nobody really will be surprised to see the first adopters for the Tesla, because honestly, there's a whole line of people who will be ready to put the cash down on a Tesla.
What's interesting is I was looking at some data. The average price of a passenger vehicle in India has risen from 7.5 lakh rupees in 2019 to about 11 lakh in 2024. That's the average price, which obviously includes extremities, which will have a little more in terms of an upward skew. The entry-level prices are a lot lower. Do you think Tesla's entry into India would actually be beneficial for all the other lower-priced EV variants because the category is expanding as against Tesla eating into their market share?
If Tesla had come maybe 2 years ago, 3 years ago, then yes, they would have benefited because Tesla would have really aided the awareness for electric vehicles. But today, I don't think EVs lack in terms of awareness. What the government has done in terms of the green plates has really worked wonders because everybody notices electric cars on the road. Now there is no curiosity about, oh, you bought an electric car. People know about EVs. So obviously, every new player coming in is going to improve the visibility, is also going to help the category. Right now, EVs are under a certain amount of stress. This month, things have started to pick up. Otherwise, the rate of growth has been flat, so it hasn't been growing. There is a bit of negative conversation also around EVs, down to the fact that EVs in terms of resale value are much lower than combustion engines. And that is a big factor that is stopping people from adopting EVs. I think it's a temporary blip. And again, the momentum will start because there's just so much that is happening. This morning, I was driving the Tata Harrier EV that's going to rival the Mahindra XEV 90 and the BE6, the Mahindra electric cars, excellent cars and actually good pricing. And like you said about the average buying or ticket size of cars going up, now the growth is in the SUVs. SUVs are obviously more expensive than hatchbacks, and more growth is happening in the mid-size SUVs, which are more premium over that sub 4 meter category. So people are spending more on cars. In the past, everybody wanted cheap. Today, Indians don't want cheap. They obviously want value, but they're willing to spend on technology, willing to spend on bigger engines or more power from EVs, more range from electric cars. So there is no dearth of spending appetite. You just need to find that sweet spot to make people spend.
Okay, so Shirish, I just want to compare the BYD versus the Tesla, because that would probably be the closest comparison in terms of pricing as well as product. BYD has in fact overtaken Tesla sales in Europe, at least for the month of April. So there is neck-to-neck competition there. Do you think that that's probably going to play out in India as well?
The BYDs are very good. The Sea Lion, which they recently launched at that price and at that offering, and plus that is an SUV. And SUVs are better suited to Indian roads. Also, Indian customer appetites are skewing towards SUVs. So BYD as a product, it's really good. It's so good, in fact, that a lot of our Indian manufacturers are buying components from BYD, including their batteries. So the only drawback for BYD is Tesla in terms of perception as of now is right up here. Now, BYD will take some time to catch up to that in terms of perception. Also, BYD's network in terms of their showrooms, dealerships is not that widespread. And that's why the whole offtake for BYDs is a little slow. fact of the matter is also that they have not been allowed to invest to grow their footprint in India, to start proper manufacturing. I'm sure they want to do that, but they can't because of all the rules that are there in place. But product-wise, what BYD offers is very good.
Okay, Sarish, interesting conversation there. We'll be watching out for which one you're going to be buying out of all these EVs. And given that Mangalam was saying there are 8 colors also that are mentioned right now, anything that you are looking at over there for Tesla?
Well, grey is included in the base price. Every other color you have to pay for. So the red, I believe, is 1.75 lakhs more.
Okay, Sarish, thank you so much for joining in with us this afternoon and giving us such an insightful conversation. On that note, we're going to slip into a very short break. And after the break, we'll be discussing some technicals with Satchidanand Tekar from Table. So stay tuned in for that.
Welcome back. You're watching us here on Halftime Report. The Nifty has hit a century right now. Just as we look at it, the Nifty Bank is doing extremely well, 250 points. And over the last few minutes, if you just look at the IT index, that's the one that has picked up some pace as well. So the FNO setup in the afternoon is just that. We have the Nifty Bank, which is doing well, which has been doing well for the last few trading sessions in comparison to the Nifty. It was the IT index that had dragged the index lower. And the reason why we're seeing so much bright green on the screen today is because the IT index has come off the lows and perhaps maybe, seeing incremental buying after the sell-off that we've seen, and that's positioning the Nifty above what we saw in terms of yesterday's highs as well. The broader markets, that was a spike in yesterday's latter half of trade, and that spike continues. We have more stocks advancing than the number of stocks declining, and those red and green lines have been parallel like a train track through the trading session so far, with nearly 2,000 stocks advancing for about 700 stocks which are lower as well. What's also interesting right now is the two-wheeler stocks. They are flying off the wheels. We have Hero MotoCorp. The commentary coming in from Hero MotoCorp has had its rub-off on Bajaj Auto and TVS Motors as well. We've been talking about Tesla's entry into India, not perturbed the other auto stocks, all of them higher. So the auto index too has moved to the high point of trade. Now with the Nifty very close to the 25,200 mark, the next support to watch out for, or the next market cross on the way up, would be the 20-day moving average, which it broke below a couple of trading sessions ago. So 25,272 is a mark that I will be keeping an eye out on. What's also going to play out today is some short covering in calls, because in the second half, we'll have the Sensex weekly options expiry that will take place. Ahead of that, the 25,100 call writers on the Nifty are already covering their positions. We are seeing put writers come into their place, 25,100 put and 25,200 puts, both of them seeing a fair amount of activity. So telling you that the support of the market has now moved higher to around 25,050 to 25,100. And we are seeing some punt buying take place at the 25,250 call. So let's see whether the market goes ahead and sustains those levels or not. The put call ratio, which in the morning was close to 0.68, 0.7, has now inched back to 0.9. And a couple of long positions added on Piramal Pharma and PG Electroplast. We also see RBL Bank as a possible FNO ban exit candidate today, because we've seen some open interest reduction. very close to the threshold level of 80%. So that's RBL Bank and a lot of stocks which are in focus.
Okay, all right, Mangalam. Thanks very much for that. Satchidanand Uttikar joins in now to discuss what he's tracking in terms of the technical. Satchidanand, welcome to the show. Well, good amount of traction in the broader markets today. So let's start with that. What would you be recommending in terms of specific stocks from the broader markets?
Good afternoon, Ekta. Good afternoon, Mangalam. I think clearly, if you look at both the indices, they are trending well and they are in a very strong, locked in a very strong bullish trend. So if you look at the Nifty, I think as Mangalam said, 25,230, 200 would be a very decisive level to watch out because there are multiple averages which are converging near that particular level. But on the lower side, the support which we saw at 25,100, I think that particular support should hold on for this particular week. We have seen a very strong recovery from those lows. The 25,000 mark has been very significant from a put writer's perspective. And on the higher side, we still have trajectory open towards 25,500. So from a trading perspective, we expect that this particular move may eventually break out above that 25,200 to 80 hurdle. And we may see the Nifty, scaling towards 25,330, 25,550 kind of a zone. So we continue to be on the bullish side, keeping a trading stop loss at 25,120 on a closing basis. We still recommend, buying positions in Nifty. When it comes to Bank Nifty, the range has been very significant. 57,300 is an immediate resistance. On the lower side, 57,000 looks like a decent support. So even here, keeping a stop loss somewhere close to around 56,820, one can still look for buying opportunities. When we look at stocks, clearly, I think Nifty Auto is something significant, and we are expecting that there could be a significant rally within this particular space. From this particular space, Uno Minda is something from a trading perspective now looks significant. We have already seen a very strong recovery, a V-shaped recovery on its 30-minute scale. There has been a flat wave kind of a completion on the daily chart, and we are expecting that the uptrend has again resumed after this correction. So we are expecting this rally to continue towards 1240 on the higher side, and hence we are recommending building long positions here, keeping a stop loss at 1,088 on closing basis. The other stock which has displayed a significant breakout is Blue Star. Now, if you look at the overall recovery, we already saw a good breakout from a rounding bottom formation. After that, we have seen a continuation pattern, a bullish flag formation on the daily scale, again signifying that the trend strength is here to stay. We are expecting this particular rally to continue towards 2040 eventually, and hence we are recommending still building fresh long positions, keeping a stop loss at 1850. Disclosure would be that we have also recommended this trade setup to our clients.
Okay, Satchidanand, thank you so much for joining in with us on the show, as well as, talking to us about which are the interesting stock bets right now as well. But on that note, we're going to slip into a very short break. On the other side, we have Manisha Gupta joining in with us with Purvi Mehta of Gates Foundation. Stay tuned in for more on the commodities front and what's happening there.
Welcome back, and joining us on the show now is Purvi Mehta. She's professor at Cornell University. Purvi, hi, thank you so much for joining in. And there's just so much to talk about with you. But first of all, the latest advisory that the government has come out with in sense of obesity and overweight and how sugar and edible oil perhaps should be eaten in moderation. We've been talking to a lot of FMCG companies and an industry impact on that. But how would you look at these statements and an impact on agriculture?
So, thank you, Manisha. I think sugar is suddenly not good for anything and anybody, right? I mean, from a consumer perspective, as we know, the demand for sugar is going down. Also, not just because people are cutting down on sugar, because there are a very large number of substitutes, natural as well as non-natural, that are being constructed. So, if one looks at last 10 years, there are about 17 new sugar substitute which are commercialized at a very large scale, which has been come in the market. And so that there are certain factors there. But so that's from a consumer perspective, as you said, from a health perspective and so forth. But from an agriculture perspective also, sugarcane per se, I would not call it the most climate resilient and most climate adaptive crop. While I'm saying that, I'm extremely mindful of the kind of livelihood sugarcane generates, especially in a country like ours, especially in certain states like Maharashtra and Gujarat and UP and so forth. So the livelihood aspect of sugarcane is extremely important to this country. But only looking at it from a climate perspective, from its water consumption perspective and things like that, it's not just about the spoon of sugar, it's also about the amount of water that goes in creating that spoon of sugar, right? And so there needs to be a proper balance of how do we cut down on sugarcane growing as well, because also in response to its slightly reducing demand. But at the same time, it is also very important to see, okay, so instead of sugar, what is it that we bring in? And there is a huge opportunity for diversified crops, because a lot of areas in India, the sugarcane is growing in pretty good soil conditions and pretty good water availability and irrigation availability conditions. A large part of it is rain-fed, but still. And so balancing those resources with sugar is going to be very important. So the consumer benefits, the environment benefits, the livelihood benefits, and also the industry benefits, where bringing in alternate products instead of sugar, bringing in various different kind of processing capacities within sugar industry, huge opportunities there.
Oh, well, absolutely. Dr. Mehta, the other thing that I want to talk about also is the inflation numbers. Those came in just yesterday. And after that big spike that we saw in many of those food commodities in the previous year, clearly and thankfully hasn't carried forward. But what does it really mean? Because the MSP has continued to increase and inflation declines.
Yeah, I think you know, the retail inflation going down and now at about 2.10, 2.3%, I think is a good sign, right? I mean, it is a good sign of various things. It indicates a lot of things. It indicates higher demand of diversified food, which is a good thing. It indicates a demand for better value chain management, because it is not, you know, a food price is not just a factor of how much more food has been produced, but it is also the factor of how well that food was then brought through the value chain to the consumer. And so, you know, classically, typically in India, for example, we used to say 10 years ago, that about 38% of the food that we produce gets lost in post-harvest technology, right? Or in the process of bringing the food from the farm to the fork. But we seem to have done better in terms of managing our value chains and all that. We are probably protecting our produce much better than what we used to do, and I think so. So the value chain probably is getting better, and so there are a large number of factors that probably influences this, and of course the monsoon, and of course the factors that influence agriculture has influenced this. So retail inflation or the lowering of it indicates a lot of other factors, which are agriculture and non-agriculture factor. So from a consumer perspective, this is really very good because it will create higher demand. It will create better nutrition for our people, better affordability, better access, all of that. From a farming perspective, for a farmer's perspective, it can be seen as a mixed blessing, right? Higher food prices often also would mean, and I say not always, but often, would also mean probably higher price for the farmer, which doesn't happen in every commodity, but so that also. And so higher competition in farming is what this indicates also. And so from a farming perspective, it is a mixed blessing. But from, I think, diversification perspective, because as we know, the staple crops like the rice and wheat and those crops, there is not a huge difference in the prices in terms of how the prices have changed. A lot of the lowering of inflation is because of the diversified commodities or the non-staple crops like vegetables and fruits. Vegetables, I believe, is at they say about 3-year lower price indicator and so forth. So the lowering of the pricing is in diversified commodity, and diversification is always good for the consumer because India needs more calories from diversified food, but it is also good for the farmers because diversified cropping systems gives farmer much more income. Honestly,
absolutely, and better remuneration perhaps as well.
It is also good for private sector because it creates huge opportunities for diversified seed businesses and lot of those agriculture input supplies.
Yes, it does.
Okay, all right, Manisha as well as Purvi, for a very enriching conversation there. We'll need to take a break with the news that the mid-caps have picked up a little bit of pace. So at the high point of the day currently for the mid-cap index, up around 0.7%. We'll take a short break. More on the stocks and markets once we're back. Stay tuned.
Welcome back. We were speaking about some of the auto names. Look at Tata Motors. That's the one that has surged to the high point of today's trading session so far. And alongside that, we have a couple of other stocks as well, not ones that we usually speak about, but pull up the intraday chart of something like a Healthcare Global, which is up around 3%, and the intraday chart of Dollar Industries. Dollar Industries is the other one, which is up 5% right now. In fact, the entire innerwear space, we have Dollar Industries, Rupa, all of them moving to the high point. And we have Anantraj as well. Anantraj is the other one, data center play. That stock has moved higher, up around 4.5%. But one of the stocks which is gaining in trade today is Rallis India, on the back of a solid set of numbers and the management commentary that came in as well. Sonal joins in with more details on that one. Sonal.
That's right. Good set of numbers reported by Rallis India, and it's been a while since we saw that improvement in margins and profits as well for the company. Revenues were up 22% to come in at 957 crore rupees, EBITDA 57%, margins have expanded around 350 basis points to come in at 15.7%, and profits have almost doubled on a YOY basis. It was across the board that we saw good growth coming in. The company said EBITDA margin expansion came in on the back of good volume growth, and they did see double-digit growth across segments as well. That aided their profitability this time around. For the segments, their crop care revenues were up 16%. The seeds revenues were up 38%. Now remember, seeds is the higher margin business for the company, and hence we can see that improvement in margins on a YOY basis as well. However, from Q2, the seeds business will not contribute as much. The crop care business will do that more. And that's why the management said that margins could come off in coming quarters, but they are largely cautiously optimistic on the future going forward. In fact, we spoke to the management today. Let's listen into what they had to say.
Overall margin, obviously, so gross margins more or less remain flat. I think Q1 also has a higher percent contribution coming from seeds. Seeds generally is a higher margin business. Our soil and plant health business is higher margin business. So that is reflected in the overall number. I think as we move forward, I think Q2 is going to be more domestically important. It has less weightage on the seed. So I haven't worked out those numbers for the Q2, but I mean, it's a mix of business that will dictate how things move forward.
Okay, that is Rallis India for you all. But let's just focus and talk about another company that reported the numbers. That is Tejas Networks, and that is trading with deep cuts after a weak set of numbers was reported by the company in Q1 FY26. Revenue declined nearly 90% sequentially. Earlier, we spoke to the management of the company, Arnab Roy, who is the CEO and Executive Director, as well as Sumit Dhingra, the CFO at Tejas Networks. Listen into what they had to say in terms of expectations for FY26.
In FY25, we came off on the back of a really large project, this BSNL 100,000 sites, which we had to deliver in a very accelerated way. And that kind of resulted in a huge bump up of our revenues from FY24 to 25. So obviously, we are all been very clear that FY26 is not going to be in the background of FY25, and we should look at our business in the context of FY24 and so on.
What you see as reported receivables are to a large extent or significantly on account of the BSNL 4G project that got executed over the past few quarters. In fact, the last quarter was the completion of the project. Now, those receivables are expected to be collected over a period of time based on certain milestones related to implementation of the project. So we should see that coming down over the next few quarters within this financial year. Also, a part of these receivables are essentially against that. We also have received an advance on this project of about 1460 crores. Now, that lies in the other liabilities because some of the milestones that were to be delivered are yet to be completed. So on a net basis, I think the actual receivable number is much lower than what you see on the reported statements.
Okay, and that's Tejas Networks down around 4%, 5% today and down 40% this year. We need to take a short break, but as we do that, here is some good news for our viewers. India's business news leader is now just a click away. Introducing CNBC-TV18's all-new app. Get instant access to breaking news, in-depth news articles and financial world updates at your fingertips. Download the CNBC-TV18 app now from the Apple Store or the Google Play Store, or just scan the QR code on your screen. Welcome back. Well, for the market stable, but we do have the Bank of Maharashtra numbers. Gross NPA unchanged at around 1.7%. The provisions are lower at around 867 crores versus 983 crores on a Q-on-Q basis. The asset quality didn't look too bad. Net profit has also risen on a year-on-year basis, 1593 crores versus around 1293 crores year-on-year. NII up around 18% So overall, looking like a good set of numbers. Stock is up around 2% reacting to the initial P&L of Bank of Maharashtra. Gross NPA, as you can see, even the net NPA unchanged sequentially. But let's shift focus now. HDFC Life will report its Q1 earnings later today. Yash is here with the key expectations from that insurance major. Yash, over to you.
Well, that's correct. HDFC Life to report its first quarter results today. The results are expected post-market. Expect them around 3:45, 4 p.m. today. As far as the numbers are concerned, the total new business premium, the total premium collection by the company is expected to grow by 15% at 7,489 crore rupees. The total annualized premium equivalent is expected to grow by 11% at 3,186 crore. Retail AP, that is expected to see a similar growth as total AP of about 10% at 2,717 crore rupees. Importantly, value of new business, the growth there is expected to fasten at about 14% growth at 817 crore, and margins, they are expected to remain range bound with slight improvement, up about 53 basis points. The number on the margin front that we're expecting is 25.63%. The reason why margins are expected to range to be range bound with just a slight improvement, that's because the street is expecting ULIP to advance as a part of total product mix, and that could have some negative impact and keep the margins very, very range bound. As far as brokerages are concerned, they expect APE growth to be driven by ULIPs and non-par, margin expansion to be limited as product mix is likely to be ULIP heavy, and VNB to largely remain stable on a year-on-year basis. Do remember that the stock has gained about 8% in the last 3 months and 23% in the last 6 months, trading at about 2.2 times FY27 price to embedded value.
Okay, Yash, thank you so much for that. Important to keep an eye out on HDFC Life's numbers. But what we're looking out for in terms of the markets as of now, Nifty is trading almost near the day's highest point where it is 25,200. Above that mark is what the Nifty is continuing to trade at, up 0.5% in today's trading session. And obviously in terms of the Nifty 50 as well, we have Hero MotoCorp, Tata Motors that are managing to hold on to gains in terms of the auto sector. But in our special segment today, we are going to be putting the spotlight on the metals pack, and this is the quarter tuck where we are bringing you earnings expectations for each sector. And Nigel is joining in with us to tell us what are we expecting this time in Q1 FY26 from the metals and mining sector. Nigel, over to you.
Let's begin with the ferrous space first up, where steel companies are expected to deliver a strong performance in the first quarter. The steel EBITDA is projected to rise between 4 to around 15% on a quarter-to-quarter basis. That's thanks to two factors. One is a rise in domestic steel prices by roughly around 2,000 to 2,500 rupees per ton, and a decline in coking coal costs by around $10 to around $12 per ton. However, this margin improvement is expected to be partially offset by higher iron ore cost as well as lower sales volumes. The volumes could decline by around 3 to around 17% quarter-on-quarter, mainly due to the planned maintenance shutdowns and muted export demand. And also the early arrival of monsoons, well, that's going to be a bit of a dampener on the volumes front. On a company-specific basis, all companies will report an improvement on the EBITDA per ton. Tata Steel India, well, the EBITDA per ton is expected around 14,500 rupees per ton, while Europe is expected to trim its losses to around a negative $28 per ton. That's down from close to around $40 per ton in the previous quarter. JSPL as well will report a solid gain. The EBITDA per ton is expected to jump up to around the 13,850 rupees odd, while JSW Steel will clock an EBITDA per ton of around 10,820 rupees per ton. SAIL, well, that'll see a modest improvement. The EBITDA per ton will move closer to around that 8,000 rupees odd mark. Jindal Stainless from the stainless pack, well, that'll report a good bounce back. Remember, quarter 4 was quite soft. This time around, there'll be a 10% quarter-on-quarter growth in the consolidated EBITDA per ton and could come in the vicinity of around 18,200. Two factors support them. One is realizations, which are higher, and the cost of production, which will be relatively lower. Moving to the non-ferrous side of things then, Q1 is expected to be soft. That's because of the decline that we've seen in commodity prices. The average LME prices for aluminium as well as zinc, they are down by close to around 7% on a sequential basis. That's what could weigh on the profitability as well as on the top line. However, silver has bucked the trend. It's up close to around 5 to 6% odd. It's hit its highest levels we've seen in more than 10 years. Coal India, though, they're expected to drop a 20% drop in the EBITDA. That's because of lower volumes and pricing. You have also seen the e-auction prices that are lower. The cost of production for them has moved up as well, so that's what will hurt Coal India. NMDC could see a 5% growth in the EBITDA. That's because of the higher volumes, which will jump up by mid-teens, though the benefits will be limited due to higher cost of production and lower realization per ton. Hindalco's India business, well, that'll get hit because of aluminium prices, which are down. And also we have seen that, the cost of production as well could get a hit a little bit. While Novelis, its overseas subsidiary, that will see a 9% quarter-on-quarter drop on the EBITDA per ton, should come in at roughly around $450 on a per ton basis because their operations have been impacted by tariffs on Canadian imports into the United States, rising input costs as well. Vedanta, well, on a consolidated EBITDA basis, there'll be a decline out there because of aluminium and zinc prices. Both of them are down by close to around 7%. However, gains from lower alumina cost and increased captive sourcing, that's what will help partially offset some part of that impact. To sum it up, metals sector in Q1 FY26 is expected to be a tale of two halves. Steel companies are poised to report strong earnings momentum supported by rising prices, falling coal cost, while non-ferrous players, they'll face profitability pressure owing to the drop in commodity prices.
All right, Nigel, thanks a lot for that. So that sets us up for the steel companies, the metal companies in the first quarter, how they will be reporting their numbers. With that, we're out of time on this edition of Halftime Report with the news that all the four indices atop our heads doing extremely well. The Nifty as well as the Midcap Index along with the Nifty Bank at the high point of today's trading session so far. Thank you for watching.
Again, as hope of a mini US-India trade deal revives, auto and realty are prominent gainers, even as utilities and metals sulk.
HCLTech's revenues are muted, but the margin miss and cut in guidance are a big surprise. While delayed execution and investments in AI dent margins in the first quarter, restructuring costs will crimp margins in the coming quarters as well.
Hero MotoCorp chairman Pavan Munjal unveils a plan to accelerate growth in FY26 by expanding in Europe, growing presence in the EV and premium segments, strengthening the three-wheeler EV portfolio and expanding the collaboration with Harley. The stock revs up.
Tesla opens its first India showroom in BKC in Mumbai today. On offer are two Model Y variants at on-road prices of 63 lakh and 71 lakh rupees respectively. The pricing dispels concerns of an impact on local electric vehicle manufacturers.
Hello and welcome to Business Lunch live from the CNBC-TV18 Motilal Oswal studio. I am Vamakshi Thoria and with me is Hormas Patakia. Well, good afternoon to you, Hormas. This is finally a screen that the bulls will like to look at. It's green across the screen. You know, when you look at the Nifty, it is trading close to the day's highest point, 130 points higher.
Oh, well, absolutely. And finally, some moves that are coming in. Defended that 25,000 mark in yesterday's trading session. And you're building on to that. And it's been fairly steady so far. Of course, mind you, today is the weekly expiry of the Sensex contract. So keep that in mind as well. But for now, above the 25,200 mark is where the index stands and holding on to gains of around 130 points. At the broader markets too, there are, of course, plenty of stock-specific activity that is taking place in the broader markets. They were outperformers yesterday. They're continuing to build on to that. 0.7% higher for the mid-cap index. The small-cap index too was an outperformer in yesterday's trading session, while the benchmark indices were sulking, and that too is at the highest point of the day now, 1% higher for the small-cap indices, of course. And there are plenty of stock-specific movers today. Earnings reaction, we just saw results from the Bank of Maharashtra a few minutes ago. Just pull that stock up, and asset quality remaining stable, the profit growth of around 23%, and this is despite a lower other income component from last year, so 2% higher on Bank of Maharashtra. But otherwise, we are counting down to some really important earnings now, Amakshi.
Well, absolutely, Hormas. A couple of earnings from the financials back that are lined up today. But take a look at GM Breweries as well, because that counter as well reported its numbers just a short while ago. While Bank of Maharashtra is 2% higher, GM Breweries is actually 2% lower. There you go, 2.3% down. And that is because the company has reported a net profit of 25.8 crores. But moving on then, one pack that is in focus is HCLTech. The company reported a mixed set of numbers in the first quarter, with margins coming in below their estimates. In its earnings call post the numbers, C. Vijay Kumar, who is the CEO and Managing Director of HCLTech, has said that margin was impacted due to lower utilization and delayed ramp-up of a project. Listen in to his comments.
We observed that the environment remained stable from an overall perspective, with some variations across specific verticals. It also did not deteriorate as feared at the start of the quarter. Our operating margin came in at 16.3%, which was lower than our plan. While Q1 has been historically the weakest quarter for us, the below plan operating margin was driven by the fact that our utilization dropped due to a delay in ramp up for a specific program. We also had a one-time impact from a client bankruptcy. We had a couple of large deals in the pipeline which were expected to close in Q1. These deals have moved to Q2. This delay is unrelated to external factors or macro factors. We are optimistic about their conversion, and if all goes as per plan, the TCV number should see a step up in the coming quarter.
Recovering from the lows of the day is HCLTech, and that recovery has pushed a lot of these large cap IT stocks higher as well, and that has been a key contributor to the Nifty doing well for itself today. But the other earnings disappointment today was Tejas Networks, and that too is seeing some recovery from the lows. At one point was down almost 8%, now currently trading with losses of around 6%. First quarter revenue declined nearly 90% from the previous quarter. We spoke to the management earlier, and to understand the company's expectations for the the full financial year. Here's what they had to say.
In FY25, we came off on the back of a really large project, this BSNL 100,000 sites, which we had to deliver in a very accelerated way. And that kind of resulted in a huge bump up of our revenues from FY24 to 25. So obviously, we are all been very clear that FY26 is not going to be in the background of FY25, and we should look at our business in the context of FY24 and so on.
What you see as reported receivables are to a large extent or significantly on account of the BSNL 4G project that got executed over the past few quarters. In fact, the last quarter was the completion of the project. Now, those receivables are expected to be collected over a period of time based on certain milestones related to implementation of the project. So we should see that coming down over the next few quarters within this financial year. Also, a part of these receivables are essentially, against that, we also have received an advance on this project of about 1460 crores. Now, that lies in the other liabilities because some of the milestones that were to be delivered are yet to be completed. So on a net basis, I think the actual receivable number is much lower than what you see on the reported statements.
Well, that's the management of Tejas Networks. But let's put the spotlight on the auto space then. Let's look at Ola Electric. That stock is under pressure after the company reported its Q1 earnings. Keep in mind that the earnings were reported yesterday. They came in weak on a year-on-year basis, but improved sequentially. We caught up with the management on the back of their first quarter earnings. Listen in to what CMD Bhavesh Agarwal had to say on their margins, as well as the SEBI warning on registration number mismatch. Take a look.
We've given a fairly detailed outlook in our shareholders letter this time. So for our auto business, we said that this full year should be EBITDA positive. Q2 itself will be a EBITDA positive. Even cash flows by the end of the year, our auto segment will be making both operating cash flow and free cash flow. There is still some investment to be done in the cell business to get to the 5 gigawatt hour capacity. So we are allocating capital this year for that capex. Now, beyond that, the auto business profitability should balance out to whatever investment needed in the cell business because the auto business is where the real volume is. The confusion that happened was the registration and registration numbers mismatched in February or March. And I think in our Q4 results, we actually clarified that with a proper walk of how the numbers stacked up. So I think in the public domain, definitely this issue has been now behind us. SEBI and we had many conversations, and whatever questions they asked, we definitely clarified.
The management of Ola Electric, the stock was up 20% yesterday, seeing some bit of profit booking in today's trading session. But the big news of the day has been Tesla entering the Indian market with the launch of its maiden showroom located in Mumbai's BKC. The massive showroom is spread over 4,000 square feet and commands a rent of 36 lakh rupees a month. Now, the EV maker has marked its India entry with the Model Y, which is priced at 63 lakh rupees. The Model Y will be available in both the rear-wheel drive and the long-range versions. Maharashtra Chief Minister Devendra Fadnavis also visited the showroom at the inauguration earlier today. Parikshit is now here. He's at the showroom amidst very heavy downpour in the city, and he's joining in with more on this. Parikshit, tell us how has the response been so far? How has been the launch, and what is happening currently on ground?
Well, we were one of the first people to enter and preview the showroom. We were there for about 1.5 hours, Hormuz. So, Isabel Fan, who was the director for Southeast Asia for Tesla, she gave a lowdown what the company is looking to do. The company is launching only Model Y in India for now. The starting price is going to be around 61 lakhs. This is including of GST and all other local taxes in Delhi. This is for the rear-wheel drive version. The long-range version, which can give you a range of 622 kilometers, that will cost you 69 lakh rupees. What we must also tell our viewers that Tesla is famous for full self-driving features, autonomous driving features, but the FSD, the full self-driving under driver supervision function is not available in India currently. The website shows you that this option is available at an increased cost of 6 lakh rupees. But we're told by company sources that Tesla is going to test the FSD on Indian roads and then offer it to the Indian customer in a few months. There are 6 color schemes that are on offer. The Stealth Grey is included in the cost, but if you buy any other color, for as pearl white or blue or black or red, that could cost you anywhere between 95,000 rupees to 1,85,000. In fact, the red car that is showcased in the Experience Center, that costs 1,85,000 rupees extra. In terms of interiors, if you go for all black interiors, that is inclusive of the cost. But if you go for all white interiors, that could cost you 95,000 rupees extra. Now, in terms of charging, there will be 4 charging centers that Tesla will bring here to Mumbai. You'll get it in BKC, where I'm standing. You'll get it in Navi Mumbai, in Thane as well, and in Lower Parel. There'll be 16 superchargers which will be installed around Mumbai, 16 destination chargers which will be around the city as well. Superchargers can charge your car up to 250 kilometers in 15 minutes. Every Tesla customer also gets a home charger for free, and you can charge your car overnight. Very soon, within this month, they will be launching in Delhi, and they will have 16 superchargers, 16 destination chargers, and 4 charging stations in Delhi as well. The company said that they will be only hiring Indian talent. They don't want to get people from abroad. They'll hire Indians to run the India operation. So a big message from Tesla. They're going to start small. Deliveries are going to begin by September this year. That is Q3, calendar year 2025. The long-range version will be delivered in Q4. They're not commenting on where these cars are coming from, even though we believe it's from China. But if the duties were to come down, or if India and Europe were to sign an FTA, or US and India were to sign an FTA, and the automobile duties come down, then they could possibly get the cars from US and Europe as well in the coming months. So it's a big litmus test for the company.
Sure. Thanks so much for all of those details, Parikshit. Indeed, an electrifying start for this EV maker. But earlier on, we also spoke to Dan Ives of Wedbush Securities and Sean Campbell of Camelthorne Investments to get their views on the Tesla showroom launch in India. Listen in to what they had to say.
They're going to continue to expand. I'd expect 3-4x the amount of showrooms as you see starting off, probably in the next 18 months. I mean, like, look, when you look at India, me and you've thought about this for years, this is the day that has finally come for Tesla to aggressively go after India. And there's been a lot of starts and stops, but I believe Musk is viewing this as a key strategic market, as well as just even when you think about the broader region. Sub 30K, when I look out over the next few years, I think that's. Now, look, are they going to go aggressively at the same price point as the China players? No. I mean, some of those prices are basically not attainable. And you could argue that's something where Tesla never wants to go down further that price point. But I believe over time they're going to get to a sub 30K price point.
Well, I think it's important to have manufacturing close to where your end demand is. And I think it would make a lot of sense for Tesla to manufacture in India their more affordable EV product. But it's all going to be a function of demand. So if the sales are there, then I think you will definitely see the manufacturing there in India. I think the fact that Tesla has been displaced as the #1 seller by BYD is evidence that they have an issue they need to address. I think the biggest issue is the delays in this more affordable EV. You call it the Model 2 or the Model Q. I think it's going to be very important to Tesla's success in the India market to launch this more affordable EV to compete against the Chinese entrants.
Here is an important programming alert. The RBI Governor will be shortly speaking to CNBC-TV18's Lata Venkatesh. Expect answers for all the questions that are bothering you. Now, does a 6-year low inflation open up space for more rate cuts? Does the low CPI give RBI scope to keep liquidity surplus for long? And will tariff wars force down RBI's GDP growth forecast? Tune in for the most definitive RBI Governor interview only on CNBC TV18 in just a few minutes from now. Welcome back. Now, Tamasic India head Ravi Lamba has said that the private equity firm aims to invest around $10 billion in India over the next 3 years. Speaking to Ritu Singh, Lamba added that the Indian market is the favorable environment for the company and accounts for 8% of the global portfolio. Listen in.
Financial services is a sector we've always been focused on. We've invested in the banks for a couple of decades now. We've invested in them. We truly see them as proxies for economic growth, and more importantly, as we see the sector expand, we are finding opportunities in insurance, which we have investments in both general and life insurance in the listed space and in the unlisted space. We had a portfolio company, Niva Bhupa, go public last year, so that's another good example of an insurance company that's matured to go to the public markets. And going forward, we see new categories of investment in the financial services space. I mean, we see opportunities in life insurance and general insurance, and beyond that, we see wealth management and asset management as well as emerging categories where we will look to deploy capital. Future consumption is changing rapidly, and short of the restaurants and the home delivery of food, the cloud kitchens are back. We invested in Rebel Foods last year. These are all playing to that same vertical, which is expanding very rapidly. So I see a lot of future here. The key question in all of these businesses, as you rightly point out, is to make sure you develop a business that's profitable and can stand on its own feet and does not constantly need equity capital to fund its growth. Because if that happens, then the burn rate can get to you. So you have to be careful about how you build these businesses. You have to calibrate the long term with the short term. And from our perspective, we are very happy and comfortable with our position in Zomato. It's done really well for us as an investment, but more importantly, from an execution perspective as well. So we see the long term. Quick commerce is something here to stay. Our exposure this year in March 25 in India on a mark-to-market basis is at $50 billion US, and it was $37 billion last year. So it's grown quite well. And what happened 2 years ago when we said, looking forward, we can see the potential to deploy $9 to $10 billion over the next 3 years. And, we've been well on track on that. We deployed just under $3 billion in the first year, and, we've deployed more than $3 billion last year. And this is not a number that we are so fixated on. It's a number which we are hoping to deploy. Going forward, we can deploy more than, the $9 to $10 billion that we talked about, depends on the opportunities we find.
Well, that was Tamasic India's head Ravi Lamba speaking to CNBC-TV18 and sharing his optimism on India as a growth market. Now, moving on then, in a policy reversal, US President Donald Trump has announced new weapons for Ukraine and threatened to hit buyers of Russian exports with sanctions unless Russia agreed to a peace deal in the next 50 days. This is a major shift in policy brought on by frustration with Moscow. Take a look at this report.
So in a nutshell, we're going to make top-of-the-line weapons, and they'll be sent to NATO.
President Donald Trump announced on Monday that the U.S. will provide billions of dollars worth of weapons destined for Ukraine, as he voiced frustration with Russian President Vladimir Putin.
We are very unhappy, I am, with Russia.
Sitting beside NATO's Secretary General Mark Rutte in the Oval Office, Trump said the weapons would include Patriot air defense missiles and that NATO allies would pay for them.
We are going to be sending them weapons, and they're going to be paying for them.
Patriot missiles in particular are weapons Ukraine has urgently sought to defend its cities from Russian airstrikes. Trump's announcement, greeted with cautious optimism by many Ukrainians, came after Ukraine's emergency services got to work extinguishing fires they say were caused by Russian drone strikes overnight.
I've been hearing so much talk. It's all talk. It's all talk, and then missiles go into Kiev.
Trump on Monday also threatened to hit buyers of Russian exports, including oil, with sanctions unless Russia agrees to a peace deal in 50 days.
And we're going to be doing very severe tariffs if we don't have a deal in 50 days. Tariffs at about 100%. You'd call them secondary tariffs. You know what that means.
A White House official said Trump was referring to 100% tariffs on Russian goods, as well as secondary sanctions on other countries that buy its exports. Putin has yet to accept a proposal from Trump for an unconditional ceasefire. And Russia has used hundreds of drones to attack Ukrainian cities in recent days.
And take a short break for now. More news and updates continue on the other side. Stay tuned. Welcome back. Let's now also get you some updates on the Air India plane crash investigation. The Boeing 787's fuel switches and shutoff valves are under scrutiny. Regulatory agencies have also in the past put out notices to inspect these instruments. Madhiha is joining in with more on this. Madhiha.
Well, a May 2025 notice from the UK aviation regulator has put the spotlight back on something the US FAA warned about way back in 2015. A problem with fuel shutoff valve actuators on Boeing aircraft, including the 787 Dreamliners. Now, here's why that matters. These valves are what actually stops the flow of fuel to the engine when the pilots pull the fuel switch in the cockpit to cut off. The FAA had flagged a risk in 2015 that these valves might have hidden faults, what they call latent failures. So they might look fine but not work as needed. The directive said that airlines needed to test these valves every 10 days, swap out faulty parts and update their maintenance manuals. The UK aviation regulator's notice in May basically said, make sure you've done all that to the airlines in the UK. Now, why this is significant? The AIB's preliminary report on the AI-171 crash says the fuel control switches flipped from run to cutoff, causing engines to lose power. The report also mentions a 2018 FAA safety bulletin that warned about fuel switches possibly moving on their own due to disengagement of the locks. Now, as the final report is still some time away, these older safety directives from the FAA might hold key cues and key clues to what really went wrong with the flight that crashed in Ahmedabad seconds after taking off on the 12th of June, killing at least 260 people.
Well, thanks so much for that, Madhiha. But moving on, after spending nearly 3 weeks in space, Subhanshu Shukla and his fellow crewmates from the Axiom 4 mission will return to Earth in a few hours from now, after finishing their 18-day mission on board the International Space Station. After splashdown off the coast of California at 3:01 p.m. IST, the crew will undergo a week-long rehabilitation program to adapt back to Earth's gravity.
On to the world of sports then. Few would have imagined the carnage caused by the Australian cricket team on the West Indies as pace bowler Mitchell Starc claimed the quickest 5-wicket haul in Test cricket history, wrapping the Caribbean team to a measly 27 runs, marking the lowest Test match total in 70 years. Starc's partner Scott Boland also added to the tally, claiming a hat-trick which left the West Indies in danger of equaling the lowest total in Test cricket history. Starc's incredible performance propelled Australia to a 176-run win and a 3-0 series whitewash as the West Indies bowlers' efforts went in vain.
That's all the time we have on this edition of Business Lunch. Don't go anywhere. Midcap Radar comes up next.
Good afternoon. Welcome to Midcap Radar, live from the CNBC-TV18 Motilal Oswal studio. I'm Sonal Bhutra. With me, as always, is Vivek Iyer. Vivek, good afternoon. Some trend reversal for today, at least. So far, Nifty is in the green. It did see higher highs. It has come up from those levels, but nevertheless, mid-caps continue to outperform and banking names lending some support.
That's right. Good afternoon to you. And it's a green screen. As you can see, yesterday, only the mid-cap index at this point of time was trading the green. But today, all the indices are up and away. Well, we have a lot lined up on the show, so let's start off with the top headlines. Stocks gain as hope of a mini India-US trade deal revives. Auto and realty are prominent gainers, even as utilities and metals sulk. Mid-caps gain.
Tejas Networks declined 6% after a weak first quarter. Revenue declines nearly 90% sequentially, while the company also records a loss of over 190 crore rupees. The management tells CNBC-TV18 that expectations for FY26 should be moderated due to the strong base set in FY25.
Rallis surges over 8% after delivering a strong margin expansion in the first quarter of the year. The management tells CNBC-TV18 that they expect to benefit from the China Plus One theme going forward.
Tata Tech is in focus after Q1 revenue declines 4.6% sequentially. EBIT margins have missed street estimates. Management, however, tells CNBC-TV18 they are very confident that they will not see a decline in FY26. Okay, those are the top headlines for the markets. As we've been pointing out, it's a green-looking screen today. Nifty is up 106 points. The mid-caps are the one which are outperforming today. A 400-point uptick on the mid-cap index. The advance decline ratio is in favor of advances currently. And we do have a lot of sectoral movers specifically today, be it the chemical space, be it the fertilizer space. Of course, Hormuz will talk about more stocks in just a bit. But, you know, the main theme, of course, is reaction to earnings. We have seen some recovery in terms of Asian markets as well. Also, the CPI print that came in, that is something that is quite refreshing for the markets. So all in all, looking decent for the markets today.
Absolutely. Agrochem space, like you mentioned, just recovering. Well, a couple of stocks on the radar, whole host of insurance companies will come out with their results. And ahead of the results, quite a few of them are actually under pressure. ICICI General, that particular name under pressure, SBI Life, HDFC Life, as well as ICICI Prudential, all of these names under pressure. But these stocks and a whole host of other stocks is what Hormuz has. This is a special segment, Midcap Movers. Hormuz is standing by the wall to take us through the midcaps that are moving around in the session.
The second day of outperformance for the broader markets, both the mid and the small cap indices doing very well for themselves. They start off with some of the gainers then in the mid caps arena, and you can see Sobha there at the highest point of the day, 5.5% higher, as is Anantraj now gaining up to 7%. TBO Tech, Godfrey Phillips has cooled off from the highs, but now is heading towards that 10,000 mark is Godfrey Phillips. The fertilizer stocks, as we just highlighted, they are doing very well today. Fact, of course, has very little free float, but still trading with gains of around 8%. RCA, Deepak Fertilizers, Best Agro Life, all of these names doing fairly well for themselves. Auto is the top sectoral gainer today, and news flow as well. Samvardhana Motherson among the top gainers, 3% higher, as is TVS Motors. Bharat Forge 2 at the highest point of the day. Take a look at some of the volume-led movers then in today's session. And Piramal Enterprises off the highs of the day, but Piramal Pharma continues to remain at the day's high, 3.5% higher. Yet another day of gains for both these companies. And Domes Industries was the one that I wanted to highlight. That too is trading with gains of around about 3.5% on very strong volumes. And lastly, stocks at a 52-week high. Look at Nippon Life. The spike that has been coming in the last few minutes has taken the stock to a 52-week high. What's also at a 52-week high is Nesco. PSP Projects is up 5%, and Mass Financial saw a block deal earlier in the day in the pre-open window and is now trading with gains of around 3.5% at a 52-week high as well. Back to you.
All right. Thank you so much for joining us with all those details, Hormuz. With that, we'll do one thing. We'll move on and get Shrikant Chauhan of Kotak Securities for a technical check on the markets. Shrikant, good afternoon. Well, do you think we'll build on to this recovery or we'll consolidate at these levels?
Good afternoon, Sunal. Good afternoon, Vivek. Well, for Nifty, we are of the view that it is into corrective mode and it is correcting from the highs of 25,600 to, let's say, around 25,000, or in the worst case scenario, we may even see the levels of 24,800. So I'm expecting this correction to continue for at least next few days because overall the strength is still missing. although we saw a good amount of buying pressure at 25,000 levels, but there is equal amount of selling pressure at 25,200 and 300. So till the markets are not crossing 25,300 confidently, I am of the view that the market is going to consolidate. And whenever there is a consolidation in the market, we see buying interest in mid-cap and small-cap companies. So we need to be more and more stock-specific instead of focusing more on the indices.
Understood that. Srikanth, you said you need to be more stock-specific. So which are the stocks that you are focusing on?
So Vivek, today we saw a good amount of buying interest in real estate stocks, especially mid-size real estate companies. In that, Anantaraj is doing well. We also like Ajmera Realty, which is around some 910, 915 sort of levels. From here, Ajmera can again move back to the levels of 1,000. But in case if we consider its overall long-term pattern, then I'm of the view that the stock is heading for at least 1150. So it will take some time. But if there is a medium to long-term view, then certainly we should look for adding Ajmera Realty even at current levels. The other stock which we like is Suzlon. And this time again, we are expecting some buying interest in renewables or in wind energy sort of stocks. Suzlon is currently trading at 67, 68 sort of levels. But based on its technical formation and weekly formation, I'm going to say on long-term frame, the stock is suggesting us that it is heading for the levels of at least 75 or 78. So it's a decent upside that we are expecting based on its technical formation. But very short term, the stock can even touch the levels of 70. So it's a buy at current levels, and we can keep a stop loss somewhere close to 64 for the same.
Thank you so much, Srikanth, for joining us, giving us your view both on the markets as well as your individual trading picks. Before we slip into a short break, here's an important programming alert. The Governor, RBI, will shortly be speaking to CNBC-TV18's Lata Venkatesh. Expect answers for all the questions that are bothering you. Does 6-year low inflation open up space for more rate cuts? Does low CPI give RBI scope to liquidity surplus for longer? Will tariff falls force down RBI's GDP growth forecast? Tune in post-noon for the most definitive RBI Governor interview, only on CNBC-TV18.
Welcome back. You're still tuned into Midcap Radar on CNBC TV18. Now, let's get a corporate conversation now. Amit Ramani, who is the chairman and MD at Office Space Solutions, is joining us now. The company has partnered with Zinnov for an event which is catering to global capability centers, and the market size currently is around $46 billion, which is expected to grow to $85 billion by 2030. What is the opportunity for Office in this case? Let's have that conversation. Amit, good afternoon. Thank you so much for joining in. Well, I know you cater to these GCCs, MNCs as well. You have an offering called Elite by Office. How much does that contribute to your overall offering or your revenues? Is this tie-up going to aid revenues in some sense? Are you looking at more clients in terms of GCCs for your portfolio?
So, Sonal, thank you for having me on the show. I think the partnership that we have evolved with Zinnov is clearly a testament to our focus on making sure that these global capability centers that are being set up are set up in the right fashion. We are a workspace partner with Zinnov on this, and it shows our commitment to creating some of the best workplaces for these companies. Clearly, GCCs have changed. They used to be, back offices primarily, but over the last 3 to 4 years, we have seen that this is going towards setting up the front of the house process, as well as innovative and new kind of initiatives are being set up in India. And hence, what you require is a space that is commensurate with any international standards. And hence, these GCCs are a key part of our focus for the next few years. Elite offering was specifically created for GCCs, which are expecting a much premium workspace, and that's what we deliver for our clients. For us, this business currently is Elite as a business is a young offering for us. We have currently about 4 centers that are live under this umbrella out of the 230 odd centers. But this year we will add another 5 to 6 centers. So ultimately, Elite will end up being about 10% of our overall revenue pool for the business. And currently we are servicing multiple GCCs that we are addressing. We have Meltwater in Hyderabad. We also have AVC Fitness. We also have Zinnov, which is our partner in Hyderabad, again, in one of our gold centers. So I think this is a key, just the beginning. And we feel that today, almost 60% of our business comes from global capability centers and large enterprises, and that'll continue to grow as we go forward.
Amit, so you said that going forward, you expect this particular segment to contribute close to 10% of your revenues. Could you specify the timeline for that? Last time when you joined us, you said that you're targeting a revenue of close to 1,500 crore in FY26, indicating a 30% revenue growth. Do you stand by that number? Any upside risk there? And the timeline for this particular segment contributing 10% of your revenue?
Yeah, so we clearly are focused on that same number. We are working towards that 30% growth. Currently, the Elite and Gold, which are both our premium offerings, are already almost touching 10% of our overall revenue. And this probably will grow to somewhere around 15%. And the timeline for that would be somewhere around the next 12 to 18 months.
Okay. Amit, when we talk about Gold Plus Elite segment, how does it differ from the standard segment in terms of margins, and second, in terms of rental escalation? How often are you able to do it, and how higher are the margins in this segment?
So, the margins are almost similar, right? Because even in our flagship product, the key ingredient for any pricing is the rental, right? Because that is the one big differentiator, typically 35 to 40% of the overall revenue. So if we are going into a Gold or an Elite center, the base rental is higher. So the margins are almost similar. Margins do not change. In terms of escalations, all of them command similar escalations, about 5% on a year-on-year basis. And that's consistent across the various offerings that we have.
Okay, so Elite and Gold are different in terms of the clientele, not really pricing. Just wanted to confirm that.
Pricing is different. So the flagship product, Gold is about 20% higher, and Elite is another 20% from Gold. So the pricing differs between the 3 models. It's about the kind of infrastructure that we provide and the kind of services that we provide, which kind of differentiates the 3 service offerings.
Exactly why I wanted to ask, if service is different, is it not costing higher to the company as well? That's exactly why I wanted to ask you if there is any margin difference generally.
Primarily, no, I would say, because I think in general, our service offerings are very, very good. Experience that we offer in our flagship product and Gold and Elite are almost similar and consistent. It's just that in Elite, we have different kind of offerings like training rooms. There is a clubhouse. There is, those kinds of services. So the margin improvement might be there a little bit, but it's pretty much consistent from our standpoint.
Understood that. Amit, I wanted to ask you one more thing. Last year, you pivoted away from the traditional straight lease model to the managed aggregation model. Yeah. However, there are concerns that this particular model that you're following will have lower margins compared to the earlier model. So going forward, blended margins, what can we expect?
So currently, if you look at our portfolio, 67% of the portfolio is managed aggregation and about 33% is straight lease. That will continue to be the mix that we have. Now, as far as the managed aggregation goes, obviously the contribution margin is lower because our landlord partner is taking a higher risk, right? And plus he's putting new capital towards the fit out. But if you look at my return on capital employed, last year it was 62%, right? So I think it's always a mix between, contribution margin and return on capital employed. And given a choice, we would love to have much higher return on capital employed.
Okay, last question before we let you go, Amit. I wanted to understand the mobility vertical as well. We are now talking about not the core business so much, but the other business which would be contributing more going forward. What is the plan to scale that up? How much is it contributing now? Will you be making more investments here? Give us some numbers.
Yeah, so clearly, if you look at our current business, about 75% revenue came from co-working, of which about 11% was from allied services. Another 25% came from design and build. The intent this year is to grow all of these allied services. So we have now a vertical called Office Cafe, which basically will do food and beverage for third-party clients as well. We are also building backward integration, doing our own furniture manufacturing, which will help improve some margins. We are also tied up with Ecos Mobility for providing transportation solutions. And then finally, the design and build vertical, we have invested this year to grow that vertical as well. So I think all of these will start contributing more. But the core, obviously, business of co-working, because of the markets doing well, because of the expansion happening with GCCs and large corporates, that will also continue to grow in similar proportion. So I think the allied services, our intent would be to grow that from the current 11% to roughly about 15% over the next 12 months.
Thank you so much, Amit, for joining us. We wish you all the best as you head into FY26. But before we slip into that short break, just have a look at the flashes on your screen. ICICI Prudential Life has just come out with its Q1 numbers. Now, the most important number that we watch out for is the VNB margin, or the margin of the value of the new business. Now, that particular margin has come in almost 100 basis points higher than what the CNBC-TV18 poll was anticipating. The VNB margins had come in at close to 24.5% versus the poll of close to 23.6%. So that's one positive takeaway. More details will emerge once the company does upload the investor presentation. In fact, a lot of the parameters were known given the fact that the company does upload monthly data. But the key point is the VNB margin has come in above what the poll was anticipating and also above what the street was anticipating. And the stock is clearly reacting to that particular positive surprise. Now, we also have Yash, who's crunched the numbers. And once, if Yash is ready, we could go to him. Before that, the other important development. Yeah, Yash is standing by. Yash, how do the numbers look? VNB margin is a surprise.
The expectation, first of all, from the street was, for subdued numbers. But the numbers which have turned out are very, very strong. I'll just take you through those numbers and, just compare those numbers what have come out to what the street was expecting. The total annualized premium equivalent, that has come much ahead of CNBC-TV18 poll. That is 1864. Value of new business, another parameter that has come at about 457 crore rupees. The poll was 440 crore rupees. So VNB is also ahead of what the street was anticipating. Finally, the most important number in terms of the margin performance that has come through. The margin, VNB margin, has come at 24.5%. The poll was 23.57%. So almost 100 basis points beat has come as far as VNB margins for the first quarter are concerned. Probably this is largely going to be a favorable product mix which has helped ICICI Prudential to achieve better margins, better than what the street was anticipating. These are strong set of margins, 24.5%. VNB also coming ahead of what the street anticipated. So overall, in terms of all three parameters, the numbers look very strong for ICICI Prudential. And the stock hasn't moved much in the last 3 months, in the last 6 months as compared to other life insurance companies. So that's another advantage, coupling with the strong numbers which the companies put out.
Okay, all right. Thank you so much, Yash, for making sense of those numbers. The stock spiked slightly off those highs, but VNB margin, that is something that the street seems to like. We'll do one thing. We'll slip into a short break. We'll get you more on the markets and stock-specific action on the other side. Stay tuned.
Welcome back to Midcap Radar. Well, the midcap side of the market continues to remain quite strong. One particular stock or one particular company from the tractor space that just declared its numbers was Swaraj Engines. Sudarshan joins in with the intricate details of that particular numbers.
So in a seasonally weak quarter, Swaraj Engines, which is primarily engaged in the sale of diesel engines and diesel engine components and spare parts, has reported a steady set of earnings. And on the back of that, you can see a big move in the stock, currently up almost 11%. It has reported highest revenue that it has ever reported in a quarter. Also on the profit front, it's the highest number that company has seen in Q1 of FY26. Both profit and revenue were up 16% each. Even EBITDA has increased increased by 12%, while on the margin front, it was steady, but it has seen a slight dip of 50 basis points. It has come in at 13.6% versus 14.1% same quarter last year. Gross margin too was steady, and it has held on to levels above 21%. So overall, it's a steady set of earnings, and that's the reason it's a big move that stock is seeing.
That's right, Sudarshan. Quite a strong up move that you're seeing as far as Swaraj engine is concerned. Almost 11% higher on decent volumes. Well, just immediately post the numbers of ICICI Prudential Life. Just have a look at some of the life insurance names. Have a look at ICICI Prudential itself, once again scaling near the day's highest point. Bajaj Finserv, that particular stock too, has spiked up to the day's highest point. And it'll be interesting to see how HDFC Life has also reacted post those particular numbers, and LIC too is in a similar space. But the VNB margin positive surprise is something that the street will take and street will really like. But with that, it's all the time we have on this edition of Midcap Radar. Our mega exclusive interview with the RBI Governor comes up next.
and welcome to the most important interview for financial markets. I have with me the Governor, Reserve Bank of India, Mr. Sanjay Malhotra. The Governor who has stunned the market in the last 6 months by giving 10 trillion rupees almost in liquidity, by cutting the repo rate by 100 basis points, all in 6 months, cutting the CRR by 100 basis points again in the last 6 months, effective September. With all this, the market still wants more, like Oliver Twist. So, Governor, thank you very much for your time. First up is the Tuesday inflation number, June inflation number coming in at 2.1%, lower than most market expectations. And now the April, May, June number is 2.7. Reserve Bank's forecast was 2.9. And on the street, the expectation is July will be 1.8. And the full year will be way below the 3.7 that Reserve Bank forecast, probably close to 3. Therefore, does it open up space for a rate cut? In fact, for rate cuts?
See, we are in a neutral stance, as you are already aware. So, the MPC, this is of course, first of all for the MPC, not for me. But you are right that the MPC has decided to change the stance to neutral. And so what this means is that we can go in either direction. It gives us the flexibility to move upwards or downwards depending on how the outlook, more importantly, rather than the current data which we have now only for Q1. Rightly you have said that it has come down. But how is it going to look like going ahead? And we do our own internal assessments. Whether it will be 3%, I really don't know, because those calculations we are still in the process of doing them. We will certainly come out with our latest projections. And the MPC, as always, will factor in the evolving situation, the outlook, and then therefore take a call as to whether the economy really needs what kind of a policy rate it needs. If the inflation is lower, the forecast therefore, the outlook is lower, growth is lower, certainly the policy rates can be cut, but that is something that we have to wait and watch.
Okay. What is the trigger for a rate cut? Will it be more lower inflation or will it be lower growth?
It's a mix of the two. It's a mix of the two, really. One can't really say that it is inflation which is more important than growth numbers. For us, as you are aware, it is primarily we look at price stability. That is our core mandate. That is the primary objective. And then we look at growth also. Both are equally important. And I would not say that, we would give more emphasis as of now to either numbers. We also need to be aware of the composition of the inflation, and especially when I say composition, I mean, the momentum and the base effect. Of course, core and food is another way of looking at it. But how is this inflation going to look forward in future? That will be more important rather than the 2.1% or the current inflation that we have.
Inflation is likely to be around 3%. That is well below 4% for practically all of 2025 calendar. And that makes it 2.5 percentage points, 250 percentage point real rate. For a good 9 months, from March, it is at 3% and it will be that way all the way till December. More importantly, sir, now the WPI has come in negative. So, that also impacts manufacturers, that level of deflation. So I'm asking, when you say neutral, is it one third hike, pause, cut, or will the percentage of cut be a little more, given the kind of deflation number we are getting in WPI and stuff?
See, firstly, let me say that monetary policy, as I've mentioning, it is forward-looking. At the point of time when the MPC met last in June, The inflation numbers, even though at that point of time were about 3% or so, right? But forward looking was 3.7%. So even if you want to give, weightage, again, going back to your question of this real rate of interest or neutral rate of interest, even if you were to give importance to that, which I'm not saying is not relevant at all, of course it is relevant, the difference was about 1.9, it's less than 2%, it's very much, within the band. And neutral, as I've already mentioned, it doesn't mean that we can't, move up, move down. We can certainly, move down. But for that, yes, the outlook has to change. Whether it will go down to 3%, I don't know. We will let you know.
The average of the street is 3.3 now for the full year, FY26.
Yeah, so we'll be coming out with our numbers. You're right, there is an expectation, correctly so, that the inflation will be perhaps, for this year, not 3.7%, but lower than that. That's certainly on the cards. And if that happens, the monetary policy will have a look at it and take a call. I don't want to preempt, what the MPC is going to do, but I'm only emphasizing that we will continue to look, we'll continue to be data dependent and continue to look at the incoming data, and especially, the outlook, and the situation so warrants, we can move either ways, which can, even be downwards.
Okay. So what will be the triggers you will watch out for to align the call rate to the repo rate? As you said in the Business Standard interview, there have been many times when the call rate is below the repo rate when you want transmission. What will be the triggers you will look at to align overnight rate with repo rate?
No, as you have mentioned, the target for us is certainly the call money rate. It has to be certainly, within the corridor, which at present is 5.25 to 5.75. And while we would like it to be, at the policy rate, in times of transmission, and transmission is happening. I mean, I'm happy to note, I reviewed the figures recently, and I would like to inform you, transmission is happening well. On new loans, there is a 24 basis points of transmission already till May. Okay. We have data only till May, which means only 3 months. In 3 months, since we did the first policy cut on fresh loans, we have a transmission of 24 basis points. On outstandings, we have a transmission of about 16 basis points. So that's quite good. So we'll keep balancing, our need for transmission and, of course, our target, how to align it. We already did, VRRR starting end of June, you are aware. It has brought up the call money market rate as I speak. Morning, it was 5.44, so it's quite close.
Yes.
Friday it closed at 5.45. And so our effort will be to, while, maintaining it as close as possible to the policy rate, it should also help us in the transmission.
Well, from market questions to bank questions, ownership of banks. You said that there is a review. Personally, what is your opinion? Would you want at some point conglomerates also to have banking licenses?
This is a very, very old question. This is a very...
It doesn't go out of fashion, sir.
Yeah.
Or out of the desires of conglomerates.
Yeah, so I think this question primarily comes from the fact that some of the corporate groups, they have deep pockets. And the banking industry, at the same time, needs capital, whether it is the existing banks or whether it is, the new banks. So that's certainly, a valid question. But at the same time, let's also keep in mind that conducting business, financial business, and real economic activities within the same group has a conflict of interest. And I would say, that this counter argument is equally valid and equally relevant, even today.
Okay, you were talking about that you will review bank ownership rules more in the instance of
Yes, we are of course reviewing it and seeing, as to what can be the other ways, means to raise capital, who can be other participants, because you have the small finance banks, you have the payment banks, you have the cooperative banks, how, we can tweak, change some of these, the foreign banks, how, we can make some of the changes so as to be able to attract more capital for the banking industry.
That's why I brought this question, really.
Yes, yes.
There are two foreign banks wanting to buy stakes in Indian banks. SMBC, the announcement from Yes Bank has already come and they are awaiting your permission.
Right.
Now, hitherto RBI had only given permission to foreign banks to cross that 15% when the bank was in trouble, like in Catholic Syrian's case or in Lakshmi Vilas, where of course DBS bought the whole bank. Now, Yes Bank, you have the odd situation of State Bank having, its own banking license and owning 24% in Yes Bank. So, RBI probably wants that to end. But in the case of RBL, we understand NBD is very interested. So, what is, first of all, have the cases come to you? And more importantly, if you are going to give permission, like even IDBI is apparently, the interested parties all want 26%. So, as a rule, will you want to change from 15 to 26?
See, as per the FDI policy, the foreign banks are allowed up to 74%. Yes. All right. And the foreign banks can actually start business in our country as even up to 100%. So that's even more than 74%.
They don't want that. They want to get into, established Indian banks.
Yeah, so, Indian promoters are already allowed up to even more than, 26% stake to be brought down to 26% stake within a period of 15 years.
Yeah.
Voting rights, of course, because of the Banking Regulation Act, cannot be, even if the share financial stake is more than 26%, cannot be more than 26%. So even foreign banks can certainly have, 26% stake, economic interest, voting rights. Yeah. There should not be any difficulty in them having, up to 26% stake in a bank, in an Indian bank.
Okay. No, it's just that until now it was only given.
They have not come. So we have not, your question as to whether some cases have come to us for having 26%, they have not. But if they come, we will certainly, we are already reviewing the policy, as you are saying. There is some kind of, clarity is not there, some ambiguity is there, as you are saying. No, we'll try to bring in, these clarifications and bring clarity in these guidelines.
Okay. And no, until now at 15%, it was kind of a hard stop. And case by case, Reserve Bank was allowing. So I'm just asking if that 15% hard stop.
As I mentioned to you, for foreign banks, they can go up to 100%. So if you don't allow them even 26%, that kind of seems to defy logic.
Fair enough.
So we will be okay in allowing them, or whether it is on a case-to-case basis, whether it is as a general matter of policy. These are matters of detail, which we'll work out.
Let me come to the final growth picture that you have. The e-way bills have dropped a bit. GST collections in May was excellent, June was unimpressive. Car sales are unimpressive. And the global uncertainty is not going away at all, if anything compounding. Would you worry about growth at this juncture? Is this 6.5 also possible?
Well, that's 6.5, is our latest number. Yes, there are mixed signals, high frequency indicators, more or less, they are aligned with our projections. We'll again, revise them in case needed. We will again reassess them, review them for our monetary policy, which is due in another 15-20 days. Urban, yes, you're right. Air traffic is subdued. Passenger cars are again, that is subdued. FMCG sales, of course, are doing well in the urban areas as well. There is robust growth of consumption in rural areas.
Yes.
Monsoon is favorable. We are hopeful of, a good trade deal. Hopefully, that's in the final stages. Let's see. Let's keep our fingers crossed over there. There is good optimism that we see in our surveys of consumer surveys that we see. We'll again reassess the situation on the growth front.
Welcome back. Well, it's turning out to be a good session for the markets, better for the broader markets, you'd have to say. So the Midcap index is up around 0.7%. We have the advanced decline ratio, which is holding up at around 2:1. And the BSE small cap index is also outperforming. So the BSE small cap index at this point in time is up around 1%. The auto stocks are doing the best today. So we have the Nifty auto index, which is up around 1.4%, completely not impacted or affected sentimentally with the Tesla launch or the Tesla launch in India. So Hero Moto is currently your top gain on the Nifty, up around 4.5%. Bajaj Auto doing well, up around 2%. So it's really the two-wheelers. But nonetheless, even Tata Motors is showing good traction along with M&M. Both those stocks up anywhere between 1.3 to 1.4%. So that's what's taking place in terms of the markets at this point in time. And let's stick with the entire automobile space. The Indian automobile industry posted a flat performance in the first quarter of FY26. Shailesh Chandra, the president of SIAM, says Q1 is seasonally slow. Our colleague Rachna did catch up with him and began by asking about the slowdown. Listen in.
You know, this has been continuation of the trend that we was also seeing in the last financial year, that the growth has been a bit muted and it slowed down. Also, you know, Q1 is typically a slow quarter for the industry seasonality-wise, if you see. So it's continuation of the same trend. The sentiments remain where it was as we exited the last financial year. I think, you know, going forward, I believe that there are certain tailwinds which can be helpful for the industry, and different categories have different outlook, I would say.
You mentioned seasonality and monsoon. We've seen an above normal monsoon so far and a festive season ahead of us. How does that bring in the sentiment for the second quarter?
You know, these are the factors which really is a big hope for all the categories of automobile industry. And therefore, we believe that therefore H2 should be better for the industry.
You also mentioned RBI's 100 BPS push. How do you think that would shape up?
Yeah, I think, by the time, you reduce the repo rate at RBI to the time it reaches to the retail level, which is vehicle financing, I think we have already started seeing some of the positive signs. And especially for the segment which is very dependent on vehicle financing, also in the commercial segment, as well as, the consumer segment on the car side or a two-wheeler side where they are really worried about what is the EMI they are going to pay. I think this should be helpful to multiple categories.
In the presentation, you mentioned that there are about 30 applications pending for rare earth magnet supply to come into India. With the delay that we're seeing in these application processes and the China curbs not easing, how do you think EV industry is going to shape up?
No, it's impacting, EV as well as ICE, both, because there are components which are dependent on that. Right now, everybody is managing the situation with the stock that is available. And there's a process of, discussion going on with the Government of India as well as through our Indian Embassy in China. We are reaching out to the Ministry of Commerce there to get the approvals. About 30 applications have been made by the importers in India through their Chinese suppliers. We are hopeful that this gets resolved as soon as possible.
Right. Lastly, today is the day we mark Tesla's entry into the Indian segment. How are you looking at it?
I'm very neutral to it, I can say, because it's a very attractive market as a country, very favorable EV policies. So there will be all kind of OEMs who would like to also participate in the growth journey that we might see in the EV industry.
Okay, neutral towards the launch of Tesla in India. So that's the word coming in from the Siam head. Let's talk about some stocks now. HCLTech is under pressure, post a mixed set of earnings. Margin comes in below estimates. Rima is here with more.
Thanks so much for that. So let me quickly outline a couple of reasons why the stock is under pressure today. Reason number one is the margin miss in Q1. EBIT margins declined by 160 basis points on a quarter-on-quarter basis, 16.3%, much lower than consensus. This led to a drop. This led to the company lowering the margin guidance by 100 basis points. And now the new margin guidance stands at 16 to 18%. Two, some of the brokerages have downgraded their assessment of HCLTech. So JP Morgan downgrades HCLTech to a neutral. They say AI deflation is playing out via margin erosion. Nuvama too has downgraded the stock and cut the target price to 1630. Ambit also echoes in a way what JPM says. The results corroborate our view that margins will be the next casualty after growth. Also, the third reason is HCLTech outperformed some of its larger peers. So in the last 1 year, HCLTech was the only one with flat, no return or no contraction in share price, but its peers had underperformed. In the 5-year, HCLTech share price has gone up by nearly 150%. That said, there are many brokerages who still are upbeat on HCLTech. So Nomura maintains a buy, and they say the street should ignore the near-term margin miss because the management themselves is saying that margins will revert, come back to the original levels in FY27. And focus should be on revenue outperformance, growth outperformance, which HCLTech is doing. Jefferies too. Jefferies, in fact, has upgraded HCLTech today. Back to you.
Okay, all right, Rima. Thanks very much for that. That's all the time that we have on the show. Do stay tuned. Closing bell will take you through the last hour of trade.
Go beyond market headlines to understand the reasons for the day's movers and shakers. And get your portfolio ready for tomorrow. Beaming live from the CNBC-TV18 Motilal Oswal studio.
Hang Seng, that index is up almost 1%. All the other indices as well are doing quite well.
It's only the Model Y which is going to be displayed and showcased and offered to Indian customers.
If the 40-day exponential, the market stays under it, then you're looking at 24,940 as the next level.
Around this 1,20,000 contracts odd, we sometimes see a bit of a short covering bounce that does play out.
Ultra low inflation number, it's a 6.5-year low, the lowest since January 2019.
Environment remains stable from an overall perspective, with some variations across specific verticals.
25,090 on the Nifty, absolutely flat. Even the Nifty Bank, which is absolutely flat as well.
Bikes are getting a lot of positive response on social media, in our customers, in our community.
Nifty above that 25,100 mark currently. It's a 75-point uptick that we are sitting with. At least so far, Nifty is in the green.
We can go in either direction.
Well, that was the day so far. Hello and welcome to Closing Bell. We're coming to you live from the CNBC-TV18 Motilal Oswal studio. I'm Reema Tendulkar. With me is Nigel D'Souza, and we're up around figure 100 points. The Nifty is just shy of the 25,800 mark. After a flat start, we've managed to gain close to about 0.4%. But we're off from the session highs too.
Well, that's right, Reema. I think we're still in a bit of a band. On the upside, the 20 DMA remains elusive. The good news actually today is that after a while, we've made a higher high. All these days we've been making lower highs. So we made a higher high and a higher low. So that's giving you some kind of positive. And even the tech numbers have been quite disappointing. But the tech index, at least for today, has been quite resilient. Some of the stocks have seen a good bounce actually from the low point of the day. So you have, both the opening batsmen, that's the Nifty Bank as well as the IT stocks. Both of them are doing pretty well. So that's good news. But that 20 DMA, that's going to be the line in the sand. The important mark, lot of call writing being seen, and you have shorts in the system. So the hope is that some of the shorts will be forced to cover. Otherwise, a revisit to the 24,800 could probably be on the cards. But I think with the kind of shorts that we've seen, with the kind of recovery we've seen from the lows, and the way the markets have taken bad news, I think maybe, in fact, the bias could be on the upside for a couple of 100 points spots.
So let's just put the numbers. So today, the intraday high on the Nifty was 25,245, while the 200-day moving average, the immediate hurdle, is 25,272. So we're still about 90 points away from that level. Sectorally, the top honors, go to the auto industry. The Nifty Auto Index is up close to about 1.5%. We'll talk more about Tesla's entry into India, its pricing, and what it means for the auto majors. But across the board, you've got the auto stocks leading. Hero MotoCorp up 4.5%, Bajaj Auto, M&M, Eicher, all of them higher. IT, other than HCLTech, is right on top. Wipro 1.25% higher ahead of numbers on Thursday. Infosys has got a gain of 1%. And then you've got strength in some of the heavyweights. So HDFC Bank is batting for the Bulls. And Sun Pharma, where there is news, is also up and about in trade. But let's find out how you should position yourself in the last hour of trade. Mitesh Thakkar is now with us with a few closing strategies. Mitesh, what have you made of the day so far? And what would be the last hour calls?
The day has been positive, very clearly markets 100 points up. But again, when I said on the pullback, you might see the index travel around this 25,300 zone, give or take a few points, and we got a high of around 25,245. So I think around these levels, as long as you don't clear 25,340, I would not be convinced about the recovery. I would believe that we could retest the lows of 25,000 maybe even day. But in that sense, that view is not positive, but the market is showing some resilience, which is a good thing. On the stock side, I have a buy on Petronet with a start of 307. The four targets around 315. And the other one which I like is PNB Housing Finance, which is a buy with a start at about 1,088 for targets around 11.
Okay. All right. So two stocks, PNB Housing Finance, and what's the other one?
Sorry?
What is the other one that you were talking about? Petronet.
Yeah. The trading calls Petronet and PNB Housing Finance.
Got it. All right, Mitesh. And the biases to the downside, going by what Mitesh has to say, towards that 25,000, 24,800 odd mark could possibly be the case. Mitesh, just to confirm, the line was a little scratchy. So that's the case, right? You're not getting overexcited on the upside.
No.
Got it. Okay. All right, Mitesh, thanks a lot for joining in and giving us that view. Well, let's focus on a couple of stocks and then we go across to Dharmesh Kant to give us his sense about some of these names. ICICI Pru reported their Q1 numbers. Yash is joining in with the fine print of those numbers. Yash? Well, the numbers for ICICI Prudential Life in the first quarter have been strong as far as the total new business premium is concerned. That is bang in line with what the street was anticipating. Total AP as well is absolutely in line at about 1864 crore rupees. Apart from that, there's a beat which has come in as far as value of new business is concerned. The number which has come in here is about 457 crore rupees. The CNBC-TV18 poll, that threw up a number of 440 crore rupees. So that's ahead of the street estimates. More importantly, the margins. Margins have shown a beat of as much as 100 basis points. The VNB margin, which has come through, stands at about 24.5%. CNBC-TV18 poll threw up a number of 23.57%, so almost 100 basis points beat as far as margins are concerned. The company's conference call is lined up at 2:45 p.m. A few things which the street would want clarity on. One, of course, would be the stand on bank assurance and the communication there. B, as far as the full year guidance is concerned, does the company stay on track? Is there any revision with respect to that guidance for full year FY26 or not? And C, more importantly, how does the ULIP portfolio, perform for the rest of the year? What's the expectation there? Because that will have a direct implication on the product mix and hence the margins for FY26 for ICICI Prudential Life. Okay, all right, Yash, thanks a lot for that. Well, let's welcome Dharmesh Kant, Head of Research at Chola Securities, who joins us on the show. Hi, Dharmesh, good to have you on the show. Tell us your view on ICICI Prudential. Now, we've been getting so much of bad news with regard to these tech names that it's good to see a positive earnings reaction. Your view on ICICI Pru?
Yeah, good afternoon, Nigel. Thanks for having me for the show. See, the numbers have been in line with what the expectation is. Usually, Q1 is a soft quarter for all the life insurance. But having said that, I think the trajectory has been quite well. And this number, after a while, a slew of bad numbers has come as a line of, silver lining. I think given the fact and the valuation comfort with LIC enjoys in the life insurance space, that's looking more attractive to me from a valuation perspective. I mean, it's available at around 1/4 of the valuation multiples which other private insurers enjoy with the largest market share. So I would be a buyer in LIC rather than, SBI Life or HDFC Life or ICICI Pru Life. As a basket, you can play all of them with the highest weightage on LIC.
Got that. Let's talk about Hero MotoCorp. That is one of the big movers today, top gainer 4.5%. The annual report was out and okay, we'll get to Hero MotoCorp in just a bit. That's 4.5% higher on the back of what the company said in its annual report, which has given investors a lot of confidence because they are talking about an acceleration in growth. And plus, all eyes on whether the rural recovery will, rural economy will finally pick up. But Sudarshan, as promised, is now with us to tell us more. Sudarshan?
So amid all the buzz around Tesla, one stock that is gaining ground in today's trading session is Hero MotoCorp. All the other two-wheeler names are higher in trade as well, but Hero MotoCorp has a reason to move higher. Yesterday in the late evening, Hero MotoCorp has released annual report for FY25 in which its executive chairman has talked about FY26 and it has termed FY26 as the year of acceleration. And in the strategy for FY26, he has mentioned few points. In that first one, he has said global expansion, and second one is unlocking value in the core segment. Third, focus on premiumization, and fourth, the expanding footprint in the electric mobility space. Now, first talking about global expansion. So in FY25, companies recorded growth of 43% from international market, and that growth has come majorly from two markets, and those markets are South Asia and Latin America. Now, by the end of Q2 of FY26, companies looking to expand the presence in global markets and looking into entering in countries like Germany, Spain, France, and the UK. Second point that he has talked about is premiumization. So currently it has a partnership with Harley Davidson. It's saying that growth so far has been as per expectations. Now, under that partnership, company is looking to launch a platform to increase the growth further. Third point he has talked about is retail market. So currently it has been gaining market share overall in the retail segment, and company believes that the market share gain speed will continue even in remaining part of FY26. One concern that all the other auto companies had raised about retail financing penetration. But even after Q4 earnings, Hero Moto had told that its retail financing penetration remains healthy, and even after Q1, it stands at levels around 65%. One segment in which company is the leader is 100cc and 125cc segment, and there also it's saying that it has been gaining market share, and it believes that it will continue to gain market share even going forward. So considering all the strategy that company has put out for FY26, stock is sharply higher.
Wow, it's ticking all the right boxes, entering into Europe and some of these mature markets like UK, Spain, Germany, plus premiumization. And even in their core market, 100 and 125cc, the company is gaining market share. You know, this stock in the last 5 years has underperformed peers. I was just checking. Hero MotoCorp is up 60% in 5 years. Bajaj Auto, 176%. TVS is up 640%. So it's got a bit of catch up to do. Dharmesh, do you want to, give your view on Hero MotoCorp? What is the Chola Security House view on Hero MotoCorp and the two-wheelers in general?
Yeah, Dr. Riva. We have a positive view on Hero MotoCorp, and we have covered that in our one of the high conviction large cap portfolios around 20% when it was down around 37, 3800 kind of a stock price level. And since then, we have been maintaining a buy on Hero MotoCorp. Primary reason being once the catch-up is happening with the run rate of the monthly sales. Last month, it has reported 5.5 lakh of bikes being sold. And we are expecting the same for the month of July and August. And this will fall in conjunction with the low base of last year, July, which was around 3,70,000 bikes. And August was 5,12,000 bikes. So optically, the numbers will appear much better. Margins have been stable and is likely to be so. Our dealer check suggests that inquiries from the retail clients has been robust because of the falling EMIs. And the monsoon season and other interest rate variables are playing in favor. So to our mind, it's available at around 18 times 1 year forward price to earning multiple. So going by that, around 15-20% kind of an upside can be expected on the stock price going into the festive season, and continue with your buy holding. That is what we have been recommending to our clients.
Okay, all right. So that's a stock. Hero MotoCorp is something that Dharmesh likes from the two-wheeler pack. Well, let's talk about earnings then. We had HCLTech that reported a mixed set of numbers in the first quarter. Margins coming in below their estimates. In the earnings call post the numbers, Mr. Vijay Kumar, the CEO and MD of HCLTech, says that the margins were impacted due to lower utilization and delayed ramp-up of projects. Let's listen in to his comments and then come back and get a view from Dharmesh.
We observed that the environment remained stable from an overall perspective, with some variations across specific verticals. It also did not deteriorate as feared at the start of the quarter. Our operating margin came in at 16.3%, which was lower than our plan. While Q1 has been historically the weakest quarter for us, the below-plan operating margin was driven by the fact that our utilization dropped due to a delay in ramp-up for a specific program. We also had a one-time impact from a client bankruptcy. We had a couple of large deals in the pipeline which were expected to close in Q1. These deals have moved to Q2. This delay is unrelated to external factors or macro factors. We are optimistic about their conversion, and if all goes as per plan, the TCV number should see a step up in the coming quarter.
Okay, that's HCLTech, the only one in the large cap IT space which is nursing a cut of close to about 3%. Dharmesh, do you think the large cap IT companies, because they're such a mature industries, could be in for a long phase, 4-5 years of subpar revenue growth, 3, 4, 5%? and margins will increasingly come under pressure. These companies have all built so much bench strength, demand is not coming, and that's putting pressure on their margins, and generative AI, for all you know, could be potentially deflationary going ahead. So, I mean, the fear in the market is that, margins could start. We've seen revenue contraction over the last 2 years. But now going ahead, margins could come under pressure. What's the call on large cap IT? And then give us your view on mid cap IT.
Yeah, definitely. Yes, Rima. I mean, last 2 years, we have been maintaining a negative stance on all the large cap IT companies. And 4 or 5 years is a long time. I mean, IT industry is a very disruptive kind of an industry. And the only, silver lining of out of the world kind of a thing which can happen for these IT companies, large caps, is that they come out with some kind of a product which is disruptive in nature and able to compete with the generative AI kind of a software model. So they have been late in getting up to the mark, and they have been trying hard to garner business. But my own sense is that at least for next 2 to 3 years, it would be a mid-single digit kind of a profitability growth, with trying to maintain the sustainability as far as TCVs are concerned for the large cap IT companies. But in mid-cap space, there are opportunities, specifically on the engineering, research and development side. And there, I think Tata Technologies came out with a okay set of numbers, but the management commentary was quite encouraging. And we have been tracking this company. We have a coverage on this company as well. And we do think Q2 onwards, things will start picking up. And we do agree the management comments that EBITDA margins are going to improve, and 20% is gettable in next 2 years time frame. And the three deals which they have done, BMW, Volvo and Airbus, basically they are very large kind of a deal which can have a very large potential. Translation around 2,000 odd crores can materialize in next 2 to 3 years kind of a time frame. Going by our interactions with the management, if things progress as they have been anticipating, which to our mind, given the expertise of Tata Technologies, is likely so. So FY27 earnings estimate for Tata Technologies is around 1,000 odd crores. And based on that, around 25-26 kind of a PE multiple, we have a price target of around 1,100 for Tata Technologies with a 2-year kind of a time frame.
1,100 is the target price on Tata Technology for them. But Dharmesh, in FY26 at least, it's likely the company, the management is saying it's not going to degrow on the top line, but it's not going to have, brokerages are saying it could be a -4, -5% kind of a growth. I mean, for a company which is struggling on the top line, 34, 35 times forward multiple, FY27, is that the fair valuation multiple you would ascribe?
Yeah, definitely, given the niche area in which the company operates, and they used to command 50-55 kind of a PE multiple. This was not only with the case of Tata Technologies. Even if you look at KPIT Technologies or Tata Elxsi, all the basket used to enjoy the same kind of a PE multiple, and there has been a degrowth. And I mean, last 3 quarters, orders have been delayed or deferred because of new model development were not happening, and maybe they were anticipating this tariff kind of a saga playing out, and which is the reason why most of the new launches have been delayed. Almost the run rate would have been 60 new models of automobiles every year for next 2 or 3 years. So to our mind, going into Q3 onwards, when this entire US tariff deals get settled, primarily the European auto OEM manufacturers who are supplying to US get settled down, the orders will start trickling in thick and fast. So with that, hindsight, with that trajectory in play, 34-35 times looks reasonable for Tata Technologies. And once the disruptions are, for Airbus, the market size itself is around $11 billion. So 2% there translates to 2,000 odd crores. So it has to be seen, definitely. But going by the way Tata Technology has demonstrated its proneness, I mean, JLR used to be 75% of their revenue, which has come down to 40%. But because of VinFast deal loss, it has gone up back to 50%. But again, traction is happening. So we are going with this kind of a PE multiple.
All right. Got that, Dharmesh. And from the defense pack, anything that you like? We have had a lot of these stocks are on the offense. Earlier this morning, there was some good news on HAL as well. But that stock even for profit taking, the various rumors with regard to Midani, how big an order are they getting? The stock was up, I think, 18%. Now it's up some 6-7% or thereabouts. Anything you like from there? Defense was on the offense, but it seems to have paused for a bit.
Yeah, Nigel, it looks like there is a pause and it's a healthy pause going into the kind of run-up which we have seen in all the defense stock. And luckily, we have been holding a bias in the defense space for the last 2 years, and the top picks out there being HA and BAL. So we have been liking the space very much. I think the justification for valuation will have a time-wise kind of a correction setting in, but overall growth trajectory is a very big for entire defense space. So apart from HA and BL, from the small cap space, we do like DCX system. Again, the order book is very strong out there, around 2,800 crores of order book. They are sitting out with 1,000 crores of cash on the balance sheet, and the new clienteles are getting into their foray. For other than Elta system, they have also tied up with GE, Rafale, and L&T. All those orders are flowing in. So slowly and sequentially, it will keep on nudging higher. The only thing is you have to buy these counters when there is a deep correction setting in. And if you're invested, stay invested. And the top picks as per hierarchy, HL, BEL, and from the mid to small cap space is D6 system.
Okay, all right, Dharmesh. You keep an eye on that, HAL as well as DCX Systems. Thanks a lot for joining in, giving us a view on all those names. So Dharmesh likes a few stocks in the defense pack, which is DCX, HAL. From the tech pack, he likes Tata Technologies. And from the auto pack, Hero MotoCorp is something that they were in earlier, and they continue to ride on that particular bike. Time to slip into a short break. On the other side, Vaibhav Sanghi is waiting for us with his take on the markets as well as sectors and themes that he likes. Welcome back. Well, the markets are sitting with gains of close to 90 points. We've come off a little bit from the top. The problem today is we're not able to build onto those gains, though we're having a green session. And in the last few minutes, a few stocks actually have slipped. SBI Life has moved to the low point of the day. I think we should get that that stock up for you. And Tech Mahindra is another stock that comes out with a set of numbers. Well, that one as well has slipped from the day stop. So keep an eye out on both those two names. I think the problem is big boy Reliance Industries flirting with its 20 DMA. It's a larger weight, and when that slips, it puts some pressure on the index as well. Vaibhav Sanghvi, a CEO of Ask Hedge Solution, joins us on the show. Hi, Vaibhav. How are you feeling about the markets? It seems to be a bit of a lack of a positive trigger to push the markets higher. How are you feeling about the Indian markets?
See, of course, Nigel, I think, as you rightly mentioned, that from a catalyst perspective to trigger the market up, either the quarterly numbers have to be pretty good, or from a overseas perspective, from a global perspective, we need to see that dollar kind of index kind of depreciates even from here onwards as well. But unfortunately, both of them, are not giving that kind of indication at this point in time. So maybe a time for some amount of consolidation on the market is probably on the cards.
Vaibhav, hi. When we last spoke to you, it was around the end of May, or at least that's a conversation I remember. You were slowly, incrementally getting a bit more constructive on IT. You said the earlier call was neutral, but now you're looking at IT. Earnings have been disappointing, right? Whether it's TCS on the top line, HCLTech's margin contraction. Have you changed your view, or based on the numbers, how is your thesis changing on IT?
No, of course, Rima. I think last time around when we spoke, we did mention about saying that let the quarterly numbers come about. And depending upon the commentary, we will see whether to get even more constructive or not. Of course, at that point in time, the view was that from a valuation perspective, from a free cash flow yield perspective, it was appearing pretty good. However, when we see the quarterly numbers and when we see the revenue and the margin trends which have been there, to say the least, we are underwhelmed in that sense. Our bigger worry at this point in time is basically to understand that how are the clients or the customers actually looking at from a software services perspective when AI is actually increasing huge amount of efficiencies. So in that perspective, I do think that the overall revenue might be under pressure, or probably they will get, a big bang for the buck for the dollar spent. So interesting times, but we'll have to wait and see how it kind of pans out.
So IT, you're neutral? You did add only, or what's the positioning?
No, we continue to be neutral at this point in time.
Neutral. So you all didn't add at all?
No, we didn't. And as we speak, we are still waiting for the whole season to get over from earnings perspective so that we get a holistic view. But initially or preliminary kind of numbers do tell us that there is some under pressure on both revenue and the margins.
What about consumer discretionary? You like that, but now some on the street, they believe that the time has come for consumer staples. You don't think so?
Nigel, if you remember all our interactions, I've been consistently maintaining that consumption is a sector which from the next 12 to 24 months is a sector which needs to be owned from a portfolio perspective. Now, we did say that initially the move will probably start from a discretionary segment, especially from segments of travel and tourism, eating out, quick commerce, retailers to some extent. And then we'll move to traditional staples as well. What we've heard from the quarterly updates, we do think that the numbers or the updates have been, I would say, encouraging at the margin. So we will eagerly look forward to this space. And our thought is basically that this is something which will probably make from a medium to long-term perspective.
In discretionary, where do you stand on hotels? You've got the giant there, Indian Hotels, then Schloss Hotel Leela are listed. Then I hear even Brigade Hotel Ventures is now looking to hit Dalal Street. What's the call on hotels?
See, from a hotel perspective, if you see from the last quarter, there were few days of disruption purely because of the operations in a particular area, right? So my view would be that from a quarterly perspective, the numbers would be a little subdued. Having said that, I think hotel industry is definitely one of those kind of beneficiary from a business standpoint. I'm not coming to the valuations yet, but from a business standpoint, to continue to see that momentum. However, as I mentioned, from a valuation standpoint, things look to be fairly valued in that sense. So we will wait for either further upgrades coming about or ARRs kind of improving from here onwards to be pretty constructive on this segment. But on an overall basis, it forms part of that consumer discretionary spend as well. So at the margin, we would be positive.
How much do you like cement now? You're looking at buying it on the dip earlier. Monsoon, so actually that's sometimes a good time to buy because the stocks get a little bit weakish, pricing as well as weakish. But the positive, I think, in the last 3 months or so is that some price increases have stuck after those price increases just falling through. What do you like? Any sector, specific stock, something you could name?
No, of course, I think sector on a per se, I think we've seen good amount of price increase in the last few months. As kind of things kind of problem in terms of monsoons kind of progress, we may see some amount of pressure on the pricing. And to be very honest, cement is a very seasonal sector in terms of price performance. Forget about the business performance, but from a price performance, it's a very seasonal. There's a huge amount of seasonality in their performances. So if you see from April to September or July or August, you will see cement companies on an overall basis do pretty well, and then subsequently kind of starts to taper off, for at least a quarter or so, right? In the hope that, once that, I would say the decrease in prices gets incorporated into the numbers incrementally gets changed, and it's a typical cycle every year it kind of follows. So while we talk about longer term perspective, that cement is a great, it's a sector on the increasing infrastructure, but it generally keeps on trading within a band. And if you are able to catch the lows and the highs of the band, it gives you a few opportunities during the year to trade.
In two-wheelers, Vaibhav, the clear leader over a longer term has been Eicher Motors with its premium offering. Hero MotoCorp has sort of lagged, when entry-level segment, there was stress there and consumer pricing pressure, etc. Do you have any positioning in two-wheelers?
See, from a two-wheeler perspective, and let me highlight our view rather than highlighting the position. From a view perspective, it forms part of that whole consumer discretionary basket, where because of the tax rebates, because of the overall decrease in terms of the interest rates, our view is that this segment is likely to see uptick in terms of the volumes. Also, when monsoons are pretty good, if you see the sowing area also has been pretty encouraging. My view is that from a two-wheeler perspective, which are on the cheaper motorbikes in terms of the products, I think they will start to incrementally do better from here onwards as compared to the premium motorcycles as well. So you may, probably want to focus on mass segment at this point in time, and that's where we do see an uptick. So it again forms part of our whole consumption basket as well.
But here the view is that the mass segment is likely to do better than the premium segment. Thank you very much, Vaibhav, for joining in. Great conversation and good to get your perspective in. It's time now for our segment D Street Chat, and Nimesh is now joining in to get us an insight into what dealing rooms are saying, doing. Nimesh?
Hi, Rima. A technical pullback, I would say, from an extremely oversold levels. We've seen in the past as well, PCR close to 0.65, 0.7, you see a bit of a pullback, and that's clearly playing out in the Nifty today. But from a flow perspective, again, a mixed day of trade, not much in terms of institutional participation. That's been the trend for the last many days. But the PSUs are well bid, again, is what I understand. And within that, today's a day for the PSU banks to outshine. So that's that one pocket which is doing well today. Technically, 25,500 is the resistance on the upside. So that's the level to watch if this rally continues on the upside. But broadly, it's been more of a broader market outperformance for the last many days. Even last week, we saw a big outperformance in the small cap names, micro cap names. So that trend seems to be continuing even in today's market. So the mid cap index is up close to 0.7, but there are a lot of individual names which are buzzing in trade. So mid cap outperformance continue, but on the Nifty and the bank Nifty, it's more like a technical pullback and not much support from the FIs.
Nimesh, just hold that thought because the SpaceX Dragon spacecraft with India's Subhanshu Shukla and 3 other astronauts on the Axiom 4 mission's much-awaited splashdown is done. I think we're getting some, footage from that. So let's just quickly cut across as Axiom 4 makes its way down on Earth.
SpaceX copies 400 meters. Reminder to brace for splashdown.
Okay, so today marks the conclusion of what's been a remarkable journey as Axiom 4 mission has now returned to Earth and it splashed safely down the coast of California. It's been 18 days aboard the International Space Station. One of the crew members was the ISRO pilot, Subhanshu Shukla. The commander was Peggy Whitson. So this is a landmark and clearly one for the history books.
Indeed, important moment there. But let's get back, I think, to Nimesh, and we'll keep cutting back and, in fact, tell you the latest on that front. Nimesh, tell us individual stocks that you're looking at.
So, Nigel, the first stock on my list today is PG Electroplast. That's been buzzing in today's market. The volumes are on the higher side. I understand there are buy flows at FI desk and some large domestic mutual funds have been accumulating as well. In fact, one long-only fund also seems to be an active buyer in PG Electroplast of late. So that's the first stock. The second stock is Minda Corp. That's been buzzing in the last couple of days, essentially on the back of that there has been a clean-out trade in the last couple of days and one large sovereign fund has completely sold out of Minda Corp. So that explains a big move there. The third stock is RBL Bank. It's in the FNO ban, but might get out of the FNO ban today. But there has been consistent delivery-based buying in RBL Bank in the last couple of weeks. In fact, some large domestic mutual funds have added in the last few weeks into RBL Bank. And I guess for RBL Bank, the next big trigger would be the fundraising. So that's likely to come after the earnings season. So that's something to track there. And the last one is Centrum Capital. Small stock in terms of market cap, 1,600 crore. But I understand there is a board meet scheduled today for fundraising. A couple of large HNI investors are likely to invest via preferential issue. So that's a trigger in Centrum Capital.
Thank you very much for that. The footage of, I guess, relieved family members, delighted family members, as the crew makes its way back on Earth after a remarkable landmark 18-day space mission. So it's a very significant moment in space exploration as the Axiom Mission 4 crew has successfully returned to Earth. I think it's been 18 days and 288 orbits around our planets, and they've covered nearly 7.6 miles. And I think it's a great example of international collaboration because one of the crew members was the ISRO, one of our, the Indian ISRO pilot and commercial space flight. So it's been great collaboration. So, historic, groundbreaking, and you can see, the
emotion,
the emotions, the adulation, and the running high.
Yeah.
Proud moment.
Indeed, extremely proud moment out there. But let's get back to the markets for now. We have with us Mr. Anshu Malik, who is the MD and CEO at AWL Agribusiness. Hi, Mr. Malik. Good afternoon. Thanks a lot for joining in. Past quarter, I think on expected lines was a little bit softish. But tell us, what's the outlook on edible oil prices? And prices are lower from the highs, I think so. So how much of high price inventory are you all sitting on?
See, thank you. Last quarter has been a mixed baggage. The edible oil prices have been steady, and with the duty cut on 31st of May, we have seen the edible oil prices come down. Particularly palm oil, which was ruling high, has come down. Today, it is the cheapest oil as compared to soybean oil. So we see good movement going ahead because now that the prices are stable and palm has come off, so that palm also drives good volume. As far as high-priced inventory, we need to pass on the way the market behaves, and edible oil has been very, very common in terms of you pass on the benefit or the whatever is the price reductions immediately, and that the market accepts it.
I think in the first quarter, sir, your volumes have contracted. There has been a 4% decline in overall volumes. What is the outlook on volumes for FY26?
In this, the major volume drop has been in one is the edible oil. We have dropped by almost 4%, mainly because of the palm oil. The prices in April and May were very high. And we gained on mustard oil because that has done very well. What we lost is the volume on rice because we had good G2G business last year, same quarter. That was not there this quarter. So obviously the volumes of rice came down. We also consolidated our regional rice so as to make it a little more profitable. And hence you will find that the food basket has made better margins because of the consolidation in the food business.
All right. Mr. Malik, I think earlier the volume growth guidance was what, 7 to 9%, correct?
Yes.
You're sticking to that?
Yes, surely, because coming quarter onwards, we see a good consumption pattern happening, particularly with edible oil, our main basket, which we will see growth, and followed by wheat, flour, and rice, because that also, after consolidation, we are on the growth trajectory.
You lost market share last year, particularly in palm oil, which led to the overall edible oil. There was a decline in a market share. What does it stand at, and what's been the change in Q1 versus Q4?
See, we lost around 1.3% in palm oil, and that is why our overall refined oil pack came down by 0.4%. But going forward with palm oil now...
Give us basic details, sir. Volume growth is going to be 7 to 9%. What is your revenue growth going to be for the company and the profitability, which is EBITDA margins?
As far as revenue is concerned, it is generally guided by the commodity market. If the edible oil prices goes up, the automatic, you will find this quarter we have grown by 21% revenue. But then volume-wise, we have come down. So the prices will decide the revenue growth. So we will not take that much seriously. But volume, yes, we are looking at volume growth. As far as margins are concerned, we have been a steady margin. We have been delivering that in the EBITDA range of around 3,600 to 3,800. And that we expect to continue.
Food and FMCG was a bit of a struggle. You spoke about, a volume decline in rice also. Volume growth down 21%, value growth down 13%. What do you expect for the food and FMCG business in the remaining 3 quarters? And is there a guidance you can provide?
See, if you take out the G2G business, then the volume growth in food is only 7%. That also because we consolidated our local rice, that is the non-basmati rice, we wanted to consolidate that. Last year we grew rapidly, but we wanted to consolidate it. But going forward, wheat, flour, rice, pulses, nuggets, sugar, all these are growing fast. And I am sure we will continue to grow at around double digit in food.
All right. By when does this top sources start contributing to your financials, sir?
This you will find already it has started. We have started giving some margins in the food business every quarter now onwards. And going forward, I think with other products coming in, things would be much better.
We leave the conversation here. Thank you very much for joining us on CNBC TV 18. Stock down nearly 2%. Get into a break. On the other side, we'll get back to the market technicals, a few trading ideas, BTST calls coming in from our experts.
Welcome back. Well, keep an eye out on the broader markets. HDFC EMC, that's a stock that's actually bucking the trend. That's moved to the high point of the day. I think we should get the intraday chart out there. Savita Oil, another rank underperformer. I think it corrected from around 600 rupees where they did a buyback. It corrected big time. But now, in fact, that one is moving up a little bit. Last few days as well has seen a bit of a recovery from the recent close. That said, let's get Mitesh Thakkar back on the show. Mitesh, how are you feeling about the markets? We're struggling to see follow through on the upside. But what about individual stocks?
So, on the upside, as I said, I think we'll see this 25 up to 300 zone coming to play time and again. But for the timing, on the BTST side, Sun Pharma, something which was caught pretty high. BTST here with the stop at 1719 for targets of 1740. And I think Nimesh mentioned the stock PT Retropast. I think that's also turning around on the upside. So BTST here with the stop at 803 for targets of 825.
Okay, all right. Thanks, Mitesh, for that. Let's focus on Tata Technologies. That's, actually recovered from the day's low. It reported a weakest set of numbers, but the guidance for the way ahead was quite optimistic. We had earlier spoken to Warren Harris, the CEO and Managing Director at Tata Technologies. We asked him about what is he targeting in the time to come. Let's hear him out.
Yeah, I'm very, very confident that we will not degrow, and certainly Q2 will be better than Q1. We will grow and we will improve our profitability position, and I'm very confident again, given the order book that we've got, that we're going to have a very strong second half to the year. And we are very, very confident that we will trend towards 18% this year. And our North Star is 20%. I expect to get back to a run rate of 18% as we progress towards the end of the year. Whether or not we'll be able at a consolidated full year level to get back to 18% will very much depend upon how the next three months goes. But we are very, very confident that the headwinds that we are grappling with at the moment are short term. And are driven by the macroeconomic uncertainty.
Okay, the earnings season has kick-started with full force. Let's talk about HDFC Life, whose numbers will come post-market hours. Yash Shoinson with the expectations. Yash.
Well, that's correct. Post-market hours around 3:45, 4 o'clock is when we're expecting numbers from HDFC Life. As far as numbers are concerned, the total new business premium, that is expected to grow by 15%. The number that we're waiting to see there is about 3,186 crore rupees. The total AP is expected to grow by 11%. Retail AP expected to grow by 10% at 2,717 crore rupees. Value of new business, importantly, the expectation here is a 14% growth. The number that we are looking at is 817 crore rupees. Value of new business margin, that is expected to grow by about 53 basis points. The number that could come through is about 25.63%. The margins are expected to remain range-bound with slight improvement. That is largely because the expectation is that the book will be more ULIP dominated, and ULIP showing growth would keep the margins more range-bound, and the expectation, as I said, is about a growth of 53 basis points. Brokerages, they expect APE to be driven by ULIP and the non-par segment. Margin expansion to be limited as product mix likely to be ULIP heavy, and also VNB is largely expected to remain stable on a year-on-year basis. But do remember, the stock in the last 6 months has rallied 23%. In the last 3 months, it's up about 8%, trading at 2.2 times FY27 estimated price to embedded value.
Thank you very much for that. Some IT stocks are correcting a tad bit. In the green still for Infosys and Wipro, but some moderation from the top. And on the way up, there is more power coming to JSW Steel, trying to trim its losses. Bajaj Auto, ICICI Bank is also getting a tad bit softer. But let's get to the big exclusive conversation. RBI Governor Sanjay Malhotra spoke to CNBC-TV18's Lata Venkatesh and discussed a whole host of issues, including potential rate cuts, the inflation trajectory, foreign bank ownership norms. Hear out what he had to say.
See, we are in a neutral stance, as you are already aware. So the MPC, this is of course, first of all for the MPC, not for me. But you are right that the MPC has decided to change the stance to neutral And so what this means is that we can go, in either direction. It gives us the flexibility to move upwards or downwards depending on how the outlook, more importantly, rather than, the current data which we have, now only for Q1. Rightly, you have said that it has come down. But how is it going to look like going ahead? And we do our own internal assessments. Whether it will be 3%, I really don't know, because those calculations we are still in the process of doing them. We will certainly come out with our latest projections. One can't really say that it is inflation which is more important than growth numbers. For us, as you are aware, it is primarily we look at price stability. That is our core mandate. That is the primary objective. And then we look at growth also. Both are equally important. And I would not say that, we would give more emphasis as of now to either numbers. We also need to be aware of the composition of the inflation, and especially when I say composition, I mean, the momentum and the base effect. Current inflation is known. Of course, that is known. That's not an outlook. That's not an estimate. That's more or less, reasonably certain. And so that does feed into the outlook. But it is the forward-looking outlook which is more important. Foreign banks, they can go up to 100%. So if you don't allow them even 26%, that kind of seems to defy logic. And so we will be okay in allowing them, or whether it is on a case-to-case basis, whether it is as a general matter of policy. These are matters of detail which we'll work out.
All right, and you can catch the entire conversation with the RBI Governor at 3:30 p.m. only on CNBC-TV18. Okay, all right. Well, let's get back to markets. Jay Bala from Cash the Chaos joins in on the show. Jay, it's been a bit of a grind, right? The market's not, getting that positive trigger to move up. What do you think? A couple of 100 points down and then we move up, or do you think a sharper correction is in store?
Hi, Angel. Good to be here. See, there are other things that are indicating the markets that are positive for the market. First, the Nifty, it's a bit ambivalent for the very short term. So I say from 2 days to 2 days to 12 days, so that sort of perspective. The Nifty could either drop to 24,400 and then get back to all-time highs, or the 25,001, the low we saw yesterday. That might even be, be a low the market is trying to launch for fresh all-time highs. But, the other thing I spoke about, there are the Nifty small cap index, Nifty micro cap index, they're all above the June high, so they're clocking higher highs. The mid cap index is very close to doing that. And the key auto sector, that is showing a very positive sign that it might take out the 24,175 or 24,200 high resistor in June. So, there are in a broader market signs that are saying that the market is in good health, and we don't have to fret about the Nifty not showing too much sign. It's probably a matter of time.
You're saying the auto sector is likely to break out on the way up?
That's right.
What about individual?
That's right.
Sorry, yeah?
Yeah, 24,175 was the June high, I think. So once that's crossed, I think that will propel the overall direction of the market. Even the sector rotation is happening into pharma, which was fearing some tariffs from Trump. It's had a inverse head and shoulder breakout. So I think although it's a lightweight in the Nifty, it's a good sign of the market breadth widening out.
Okay, all right, Jay, request you to stay with us for the time being. We'll slip into a short break. As we do that, we'll bring our viewers some good news. India's business news leaders now just a click away. Introducing CNBC-TV18's all-new app. Get instant access to breaking news, in-depth articles and financial world updates. All of this at your fingertips. Download the CNBC-TV18 app now from the Google Store or from the Apple Store. Or you can simply scan the QR code that's up for you on the screen.
In conversation with Jay, we've got about 6 minutes left for markets to close, and we're going to close, looks like, above the 25,200 mark. So picked up a little bit of gains in the last 30 minutes or so. We were sub 25,200 when we started the show, and now we're at 25,220. Midcap index up a full 1%. Jay, you were telling us about how auto and pharma is looking good, and we're seeing the broadening out of gains in the market. Any individual stocks where you have a trade?
I have one from the auto space and one from the real estate space. The auto stock is the leader. M&M has been the leader for the last 2 years in the auto space, and it also has an overlap with the defense sector. So, and the price structure of the recent move showing that the recent pullback to about 30.50 was a corrective decline. So the stock has got potential to take out the 52-week highs. That's roughly about 32.50, and then possibly progress to somewhere about 3,400. So stop loss at about 30.50 is essential for the stock. DLF, we've been bullish on the real estate sector since May, and it looks like the pullback for the real estate sector is done from the June highs, and today's overlap with the pullback of the June first leg of the move is saying that the drop was a corrective move, and DLF possibly targeting somewhere close to 4 figures. Need not be exact 4 figures, but just around the ballpark, about 960 or slightly above that. So a stop loss about 780 would make sense for the stock. So the quantities should be add-on quantities. We are still being a little cautious, but we are bullish. So allocate sensibly.
All right. I think on Mahindra making an interesting point out there, right? There's no nervousness on that one. And just the structure is giving you a sense that something's got to give. Maybe, in fact, something's in the offing. So let's keep an eye out on Mahindra. That's one of your picks that you've given us. Lemon Tree was a stock you liked last week, right? What's happening on that one? I think later on in the week, it went gap up. It was up 10%, I think. You still want to check in?
I'm still bullish. We have different types of trade setups. This is a pullback setup. What we had last week was a breakout setup. So I think it's clocked 161 and change, and then pulled back to about 150. I don't think the stock is likely to drop below 140. Maybe even 145 will be a good support. Anticipating somewhere about 170 to 200 in a few weeks time frame. So still continue to remain bullish on Lemon Tree.
What can drag us down? I mean, what are the weakest looking charts one should completely avoid?
Very pertinent question, Rima, and absolutely very important to know what sector to avoid, what stocks to avoid. And I'm neutral on FMCG space that's showing some positive signs though in the short term, but it might just be a corrective bounce. I've been quite held back on the Nifty IT index. I've been pointing out it's a possible counter-trend move to 38,000, 40,000. It's clocked 39,500, and Nifty IT index is struggling thanks to TCS. And so these are the sectors you need to be very careful within the Nifty IT index. Avoid frontline names for now. Maybe there is some life in midcap IT and small cap IT, but definitely stay away from Nifty frontline IT for now. Maybe things can change if Nifty IT index can cross 40,000.
All right, you're retaining your bullishness, Jay. There was many weeks when you were very bearish. The bulls were very angry to hear your thoughts. But good, you turned the corner. What about Bitcoin? Is risk on? If it's risk on, then that one moves like a rocket. More to go from here?
That's right, Nigel. Once again, in Bitcoin, I was pointing to 74,000 to 72,000 is a very important area. If that were given, I would have turned, extremely bearish. But thank God it held that. And we turned bullish in the middle of May. I'm anticipating 144K to come through for Bitcoin in a few weeks to a few months time frame. Risk on. And interestingly, gold and silver, it's even there is a change of opinion there. Gold is probably having one more pullback to come through, and if it were to cross 3440, possibly gold could head to 3800. So watch 3245. That should not break. That next leg of a pullback should hold 32.45. If that happens, possibly final leg of a bullish breakout for gold possible.
Okay, all right. Thanks, Jeff, for that. Stay with us. Well, just want to pull up a few stocks. Just pull up the intraday chart of Taj GVK. That's the one that we don't normally talk about. But that stock has seen a bit of a pullback after seeing a sharp correction from the recent peak. So that's one name. Genus Spa is another stock that was down close to 3%. That's moved into the green. So that should come up for you on the screen. And Savita Oil, another one that we were talking about, that as well has seen a bit of a spike up. Short point is from the broader markets, a lot of these stocks have seen a big correction. They are suddenly spiking up. That said, final few seconds of trade. It was a good trading session. The Nifty finally broke its losing streak and ended in the green. We went home with gains of around 140 points approximately. However, at higher levels, we couldn't conquer the 20 DMA. What did well in today's trading session? Hero MotoCorp. Good commentary coming in from their annual report with regard to premiumization, the way ahead, getting into the export markets as well. The street liked it. Bajaj Auto said, let's give it company on the upside. That was up 3%. Sun Pharma, favorable news came in, fundamental news, so that stock was higher. On the flip side, HCLTech, disappointing set of numbers, disappointing guidance as well. Street sold into it. SBI Life, another one that was under pressure. That as well was down close to around 1.5%. And in terms of other stocks, Ola Electric, the management is very, very confident that the bike is going to zoom ahead. However, for today's trading session, it was down 6.5% after rallying 20% yesterday. And Tejas Networks, good parentage. However, that one, in fact, did come in for profit taking because visibility is something that the street is not able to see. Well, on that note, we'll wrap up on Closing Bell. You stay with us, though. The RBI Governor interview up next.
Hello and welcome to the most important interview for financial markets. I have with me the Governor, Reserve Bank of India, Mr. Sanjay Malhotra. The governor who has stunned the market in the last 6 months by giving 10 trillion rupees almost in liquidity, by cutting the repo rate by 100 basis points, all in 6 months, cutting the CRR by 100 basis points, again in the last 6 months, effective September. With all this, the market still wants more, like Oliver Twist. So, Governor, thank you very much for your time.
Thank you. Thank you for the opportunity to be here.
So, first up is the Tuesday inflation number, June inflation number coming in at 2.1%, lower than most market expectations. And now the April, May, June number is 2.7. Reserve Bank's forecast was 2.9. And on the street, the expectation is July will be 1.8 and the full year will be way below the 3.7 that Reserve Bank forecast, probably close to 3. Therefore, does it open up space for a rate cut? In fact, for rate cuts?
See, we are in a neutral stance, as you are already aware. So, the MPC, this is of course, first of all for the MPC, not for me. But you are right that the MPC has decided to change the stance to neutral. And so what this means is that we can go in either direction. It gives us the flexibility to move upwards or downwards depending on how the outlook, more importantly, rather than, the current data, which we have, now only for Q1. Rightly, you have said that it has come down. But how is it going to look like going ahead? And, we do our own internal assessments. Whether it will be 3%, I really don't know, because those calculations we are still in the process of doing that. We will certainly come out with our latest projections. And the MPC, as always, will factor in the evolving situation, the outlook, and then therefore, take a call as to whether the economy really needs what kind of a policy rate it needs. If the inflation is lowered, the forecast, therefore, the outlook is lower, the growth is lower, certainly, the policy rates can be cut, but that is something that we have to wait and watch.
Okay. What is the trigger for a rate cut? Will it be more lower inflation or will it be lower growth?
It's a mix of the two. It's a mix of the two, really. One can't really say that it is inflation which is more important than growth numbers. For us, as you are aware, it is primarily we look at price stability. That is our core mandate. That is the primary objective. And then we look at growth also. Both are equally important. And I would not say that, we would give more emphasis as of now to either numbers. We also need to be aware of the composition of the inflation, and especially when I say composition, I mean, the momentum and the base effect. Of course, core and food is another way of looking at it. But how is this inflation going to look forward in future? That will be more important rather than, the 2.1% or the current inflation that we have.
Okay. So what you're saying is when you are looking at the neutral rate, it is not the current inflation minus repo rate minus current inflation. Will it be more repo rate minus 12-month forward inflation? Because in the MPC minutes, members are doing both. They're looking at current inflation. Some of them are looking at some points at 12-month forward. Where will your accent be?
See your this real rate, first of all.
Yes.
It is the long run rate, interest rate, at which the economy is to be, in a neutral state or a state of equilibrium or a state of steadiness. Now, it's very difficult. First of all, it's very, very difficult to calculate this. It's not observed. It's an estimate, and it's a difficult thing to estimate.
Yes.
Even, because you mentioned about this
real rate.
Real rate. So let's be very clear, that this is only a guidepost. This is not a precise number. Even in India, we have a range 1.4 to 1.9 or thereabouts. Even, in the US, they have a range. Each member, gives a very, very different estimate of this. And so John Williams, who's an authority in this, in fact, he says that, this is not a bright, this star, the so-called star, is not a bright point of light, but it is a fuzzy blur. So it's imprecise, and it's moving, it's changing. So while that is important, it's only a guidepost. Coming to your question of
12-month forward.
12-month forward, or whether it is the current inflation, as I already mentioned, monetary policy is forward-looking. And so for us, what is more important is the inflation going forward. But inflation going forward, you don't know, I don't know.
No.
It's only an estimate.
Yes.
It's an outlook. Current inflation is known. Of course, that is known. That's not an outlook. That's not an estimate. That's more or less, reasonably certain. And so that does feed into the outlook. But it is the forward-looking outlook which is more important.
Okay, let me persist with this just for one last question. See, the inflation is likely to be around 3%. That is well below 4% for practically all of 2025 calendar. And that makes it 2.5 percentage points, 250 percentage point real rate. For a good 9 months, from March, it is at 3% and it will be that way all the way till December. More importantly, sir, now the WPI has come in negative. So, that also impacts manufacturers, that level of deflation. So I'm asking, when you say neutral, is it 1/3, 1/3, 1/3 hike, pause, cut? Or will the percentage of cut be a little more, given the kind of deflation number we are getting in WPI and
No,
stuff?
see, firstly, let me say that monetary policy, as I'm mentioning, it is forward-looking. At the point of time when the MPC met last in June, the inflation numbers, even though at that point of time were about 3% or so, right? But forward-looking was 3.7%. So even if you want to give, weightage, again, going back to your question of this real rate of interest or neutral rate of interest, even if you were to give importance to that, which I'm not saying is not relevant at all, of course it is relevant. The difference was about 1.9, it's less than 2%, it's very much, within the band. And neutral, as I've already mentioned, it doesn't mean that we can't, move up, move down. We can certainly, move down. But for that, yes, the outlook has to change. Whether it will go down to 3%, I don't know. We will let you know.
The average of the street is 3.3 now for the full year, FY26.
Yeah, so we'll be coming out with our numbers. You're right, there is an expectation, correctly so, that the inflation will be perhaps, for this year, not 3.7%, but lower than that. That's certainly on the cards. Okay. And if that happens, the monetary policy will have a look at it and take a call. I don't want to preempt, what the MPC is going to do, but I'm only emphasizing that we will continue to look, we'll continue to be data dependent and continue to look at the incoming data, and especially, the outlook, and the situation so warrants, we can move either ways, which can, even be downwards.
Okay. Well, sir, that's on the rate cut. Let me come to the VRRR, the liquidity issue. Now, when you do, what are the triggers you look at when you take the VRRR action? Do you want to only impact the call rate and ensure that the call rate is at least above SDF 5/4 to 5.5 range? Or do you want the TREPS market, which is, a very big interbank market where even mutual funds participate? 90% of the overnight exchange of money happens in the TREPS market. So will you target that also and want it to come to 5/4, or only you look at call rate?
See, the operating target for the monetary policy is very, very clear, which is the call money rate. And so we are looking only at that. We are not looking at the TREPS rate or the market repo rate or the collateralized money market rates. That's certainly not something that we are targeting. Of course, we look at it. I may also mention to you over here that these are although they are very, very different markets, because one of them is collateralized, other is non-collateralized, the other has, the participants are very, very different, right? Over here it's mostly in the non-collateralized market, it's the banks and the primary dealers, whereas over there you have the mutual funds, you have the insurers, provident funds, etc., etc. So they're very, very, although their composition is very, very different, they move in tandem. And we did an analysis. The coefficient of correlation between the two, both call money market rate and your market repo, 0.98. 0.98 is very, very high. Any economist will know that. And similarly, the TREPS rate and the call money rate is 0.98. Both of them. One is 0.977, the other is 0.983 for the last 1 year.
Yeah.
So they are very highly correlated. They move in tandem if we target. So it's really not material so much, I would say. Okay. If you target one, the other gets targeted on its own. Okay. And it's not true, only for the non-collateralized market, even for the CP, CD, trade bill, and so on. The whole spectrum of the money market. So that's how we are looking at
which rate to target, which is your
target,
call. Yes. Which is your call rate. Okay. So what will be the triggers you will watch out for to align the call rate to the repo rate. As you said in the Business Standard interview, there have been many times when the call rate is below the repo rate when you want transmission. What will be the triggers you will look at to align overnight rate with repo rate?
No, as you have mentioned, the target for us is certainly the call money rate. It has to be certainly, within the corridor, which at present is 5/4 to 5/3. And while we would like it to be, at the policy rate, in times of transmission, and transmission is happening. I mean, I'm happy to note, I reviewed the figures recently, and I would like to inform you, transmission is happening well. On new loans, there is a 24 basis points of transmission already till May. Okay. We have data only till May. Yeah. Which means only 3 months. In 3 months, since we did the first policy cut on fresh loans, we have a transmission of 24 basis points. On outstandings, we have a transmission of about 16 basis points. So that's quite good. So we'll keep balancing, our need for transmission and, of course, our target, how to align it. We already did, VRRR starting end of June, you are aware. It has brought up the call money market rate as I speak. Morning, it was 544, so it's quite close. Yes. Friday it closed at 545. And so our effort will be to, while, maintaining it as close as possible to the policy rate, it should also help us in the transmission.
Okay, it should help you.
These are the two factors which will continue to guide us.
Okay, no, it's fair that transmission is a very important instrument, and you have the freedom from 5/4 to 575. But would you say we are still in early stages transmission?
Yes, of course, because see, when I said May, I have figures till May, that's only 3 months. And in June, we cut by 50 basis points. So there's a long journey, yet 100 basis points. As against 100 basis points, it's still, I do not have the figures for June, but till May it was 24 basis points. My sense is that it has, of course, improved, but there is still distance for us to cover over there.
Just a final question on this repo call rate thing. When will the liquidity framework be published? Because the market is very anxious as to what
there is an internal working group which was constituted. They have had extensive consultations with various stakeholders, banks, economists, etc., etc. There are multiple views, as with multiple stakeholders with divergent interests, which is.
So when does it come out, you think?
As I mentioned to you, it's not such a major issue. Okay.
No, I'll tell you why.
As I said, it's not a major issue because, as I mentioned to you, the call money, one of the important issues that this internal working group is actually deliberating upon is that what should be the operating target.
Yes.
As I mentioned to you, they move in tandem. They are very, very highly correlated. So that's really not a major issue, even though, as you are saying, the volumes are less, but the impact is, throughout the spectrum. So that's not, the report should be out, by the, I think, by the end of this month, we should have the report out. I do not expect major changes. We are trying, of course, to increase volumes in the call money market. We extended, the times for the markets.
Yes.
Made some improvement. We'll see how, we can further improve these markets. Let me emphasize that these are two different segments with two very different regulatory regimes. Some of them, we don't even regulate. And so, we need to keep that in mind when these questions are actually
in any case, as you say, the coefficient correlation is very high. Yes. Now let me come to the other big announcement you made on CRR, the big CRR cut. What is the trigger? Was it that our current account deficit is now under 1%, so we won't need so much money for intervention like we needed during Lehman crisis and all that? Or is it more because there is a lot of LCR? What's the trigger?
See, first of all, it's not a prudential tool. So LCR, is more of a prudential tool, right? It's not a liquidity tool. It's a liquidity tool for the banks.
Yes.
Not a liquidity tool for the system as a whole. You understand that, and so would your viewers. So it's more, of a monetary policy tool for the liquidity management of the system. Now you are aware, it used to be very high, 15% and all. 2006, we had this amendment in the Act. It's now, and then, later on it was brought down in 2013 to 3%, to 4%, sorry. Earlier we used to give an interest. And post the amendment, there is no interest. Interest has a bearing, because if you pay in interest, then you can have a higher CRR. The effectiveness of the CRR, however, decreases if you have the payment of an interest. And so that's why gradually, post 2006, it was brought down to 4%. 2013 to 2025, we have decreased it a few times, but never below 3%. So we have used only
very sparingly.
Not only very sparingly, the amount is only 1%. The ammunition that we have is 4%. We can pass on, 4%.
Yeah.
I can always withdraw as much as I want, from 4% to 5, 6, and there is no ceiling. But the amount that I can give, because I can't go in a negative zone,
yes,
and start, which also I can, in fact, I can start giving money, right? So I can go in a negative zone, but assuming that, I don't go into a negative terrain, I have the 4% cushion, which last 12, 13 years, including COVID, we have used only 1%. So, and it has a cost, as you are aware, it has a cost, and the cost is not only on the bank intermediaries, it gets passed on to the depositors and to your borrowers. And so, while, we have provided this certainty, you can always ask us, as to why we did it now. If we had to actually implement it from September onwards, why we did it now. But that was only, as we have been saying, we have been preemptive, we have been, so that, it gives us, in these uncertain times, to our banks, a little more certainty to plan things out. And so, that is the new kind of a normal, that I was talking about earlier.
Hello and welcome to Business 360. I'm Shireen Bhan. The headlines that we're tracking for you this evening. RBI Governor Sanjay Malhotra says policy rates can be cut if inflation forecast is lower or if growth slows further. Adds a neutral stance does not mean we cannot cut rates and can go in either direction. That's an exclusive.
For foreign banks, they can go up to 100%. So if you don't allow them even 26%, that kind of seems to defy logic.
RBI Governor says not allowing foreign banks to own a 26% stake in Indian banks defies logic. Says the RBI will examine cases if any requests are made. The Governor also ruled out any bank licenses to corporates. The Sensex and the Nifty snap a 4-day losing streak. Midcaps outperformed the blue chips. 2 stocks advance for every declining stock. Tesla drives into India. The showroom is now open in Mumbai. The Model Y will be available at a starting price of 60 lakh rupees. The cars are currently being imported from the company's Shanghai factory. A Federation of International Pilots says that the preliminary report into the Air India plane crash by its very nature raises many questions and any extrapolation can be regarded only as guesswork. Cautions against drawing conclusions from preliminary information. The External Affairs Minister Jaishankar meets China's President Xi Jinping, appraises him about recent developments in bilateral ties. This is Minister Jaishankar's first visit to China in 5 years after the Galwan clash between both armies. The Supreme Court directs Samay Raina and 4 other comedians to appear in person following a petition over comments made on differently abled people. The court observes the right to free speech cannot prevail over the right to life and dignity. India's Shubhanshu Shukla returns from the International Space Station along with 3 other astronauts of the Axiom 4 mission. He is the first Indian to visit the ISS and spent 18 days in space. Well, let's start with the market action today. The market snapping a 4-day losing streak. The Sensex gained over 300 points and the Nifty up over 100 points. Broader markets outperformed the blue chips today. The Midcap index gained over 550 points. But let's go straight to the big story this evening. In his first television interview since taking charge, RBI Governor Sanjay Malhotra said policy rates can be cut if inflation forecast is lower than the current estimate of 3.7% or if growth slows even further. Speaking to Lata, Governor Malhotra said RBI's neutral stance gives the flexibility to go in either direction and does not mean there will be no rate cuts. The Governor also asserted price stability is our core mandate and primary objective. He also said transmission of the recent rate cuts is happening on new loans. Another important statement from the Governor was about the foreign ownership of Indian banks. Governor Malhotra said not allowing foreign banks to own a 26% stake in Indian banks defies logic. He promised RBI will examine cases if any requests are made. The Governor was also asked about this in the context of Dubai-based Emirates NDB Bank potentially picking up a stake in private lender RBL Bank. The Governor also ruled out any bank licenses to corporates. Here are the excerpts from his first television interview. Here's the RBI Governor, Sanjay Malhotra, in conversation with Lata Venkatesh.
What is the trigger for a rate cut? Will it be more lower inflation or will it be lower growth?
It's a mix of the two. It's a mix of the two, really. One can't really say that it is inflation which is more important than growth numbers. For us, as you are aware, it is primarily we look at price stability. That is our core mandate. That is the primary objective. And then we look at growth also. Both are equally important, and I would not say that we would give more emphasis as of now to either numbers. We also need to be aware of the composition of the inflation, and especially when I say composition, I mean the momentum and the base effect. Of course, core and food is another way of looking at it. But how is this inflation going to look forward in future? That will be more important rather than the 2.1% or the current inflation that we have.
Inflation is likely to be around 3%. That is well below 4% for practically all of 2025 calendar. And that makes it 2.5 percentage points, 250 percentage point real rate. For a good 9 months, from March, it is at 3% and it will be that way all the way till December. More importantly, sir, now the WPI has come in negative. So, that also impacts manufacturers, that level of deflation. So I'm asking, when you say neutral, Is it one-third hike, pause, cut, or will the percentage of cut be a little more given the kind of deflation number we are getting in WPI and
No,
stuff?
see, firstly, let me say that monetary policy, as I've mentioning, it is forward-looking. At the point of time when the MPC met last in June, the inflation numbers, even though at that point of time were about 3% or so, right? But forward-looking was 3.7%. So even if you want to give, weightage, again, going back to your question of this real rate of interest or neutral rate of interest, even if you were to give importance to that, which I'm not saying is not relevant at all, of course it is relevant. The difference was about 1.9, it's less than 2%, it's very much, within the band. And neutral, as I've already mentioned, it doesn't mean that we can't, move up, move down. We can certainly, move down. But for that, yes, the outlook has to change. Whether it will go down to 3%, I don't know. We will let you know.
The street is 3.3 now for the full year, FY26.
Yeah, so we'll be coming out with our numbers. You're right, there is an expectation, correctly so, that the inflation will be perhaps, for this year, not 3.7%, but lower than that. That's certainly on the cards. And if that happens, the monetary policy will have a look at it and take a call. I don't want to preempt, what the MPC is going to do, but I'm only emphasizing that we will continue to look, we'll continue to be data dependent and continue to look at the incoming data, and especially, the outlook, and the situation so warrants, we can move either ways, which can, even be downwards.
Okay. You were talking about that you will review bank ownership rules more in the instance of...
Yes, we are, of course, reviewing it and seeing, as to what can be the other ways, means to raise capital, who can be other participants, because you have the small finance banks, you have the payment banks, you have the cooperative banks, how, we can tweak, change some of these, the foreign banks, how, we can make some of the changes so as to be able to attract more capital for the banking industry.
That's why I brought this question, really.
Yes, yes.
There are two foreign banks wanting to buy stakes in Indian banks. SMBC, the announcement from Yes Bank has already come and they are awaiting your permission.
Right.
Now, hitherto RBI had only given permission to foreign banks to cross that 15% when the bank was in trouble, like in Catholic Syrian's case or in Lakshmi Vilas, where of course DBS bought the whole bank. Now, Yes Bank, you have the odd situation of State Bank having, its own banking license and owning 24% in Yes Bank. So, RBI probably wants that to end. But in the case of RBL, we understand NBD is very interested. So, what is, first of all, have the cases come to you? And more importantly, if you are going to give permission, like even IDBI is apparently, the interested parties all want 26%. So, as a rule, will you want to change from 15 to 26?
See, as per the FDI policy, the foreign banks are allowed up to 74%. Yes. All right. And the foreign banks can actually start business in our country 100%. As even up to 100%. So that's even more than 74%.
But they don't want that. They want to get into, established Indian banks.
Yeah, so, Indian promoters are already allowed up to even more than, 26% stake to be brought down to 26% stake within a period of 15 years.
Yeah.
Voting rights, of course, because of the Banking Regulation Act, cannot be, even if the share financial stake is more than 26%, cannot be more than 26%. So even foreign banks can certainly have, 26% stake, economic interest, voting rights.
Yeah.
There should not be any difficulty in them having, up to 26% stake in a bank, in an Indian bank.
Okay. No, it's just that until now it was only given.
They have not come. So we have not, your question as to whether some cases have come to us for having 26%, they have not. Mm-hmm. But if they come, we will certainly, we are already reviewing the policy, as you are saying. There is some kind of, I mean, their clarity is not there, some ambiguity is there, as you are saying.
No,
we'll try to bring in, these clarifications and bring clarity in these guidelines.
Okay. And no, until now at 15%, it was kind of a hard stop, and case by case, Reserve Bank was allowing. So I'm just asking if that 15% hard stop.
As I mentioned to you, for foreign banks, they can go up to 100%. So if you don't allow them even 26%, that kind of seems to defy logic.
And you can catch that entire conversation with the RBI Governor at 5:30 p.m. and 9:30 p.m. right here on CNBC TV18. And now on to the big story of the day, Tesla's India launch.
2, 3.
The speculation, back and forth, deliberations. Elon Musk's Tesla has officially entered India. The EV maker opened its first India showroom at the Maker Max City Mall in Mumbai's Bandakulla complex. The EV giant has 2 variants of the Model Y on display at its 4,000 square foot showroom. The Model Y will be available at a starting price of 60 lakh rupees, which includes import duties and tariffs. The cars have been imported from Tesla's Shanghai factory. My colleague Parikshit Luthra takes you inside Tesla's Mumbai showroom.
Tesla is finally here in this 4,000 square feet space in Maker Max City Mall, BKC, Mumbai. They've only launched the Model Y for now, and this is the car that is available. Now, with a $37,000 price tag in the US, you have to add a 70% duty in India. That takes up the price of this car to 61 lakhs for the rear-wheel drive version and to 69 lakhs for the long-range version. Now, what do you get in terms of performance? In terms of range first, the car can go up to 500 kilometers with the rear-wheel drive version and 622 kilometers with the long-range version. In terms of speed, the top speed of the Model Y is 200 kilometers per hour. It can go from 0 to 100 in 5.6 or 5.9 seconds.
We are hiring. You have seen it. We are hiring, so we will local team. Yeah, we don't. We are doing. India has so much incredible talents. Yeah, so we don't need talents. We have many talents locally. So we're gonna hire local.
We're inside the Tesla Model Y right now. One of the highlights is this 15.4-inch screen that you get with this car. The seating is ventilated. You've got climate control settings inside the vehicle. You've got entertainment settings. And Tesla has its own audio system. You've got double LED acoustic glass that you've got all over with this Tesla. Let's move on to the second row to find out more about this vehicle. Well, now I'm in the second row of the Tesla Model Y electric SUV. Over here too, there is a 8-inch screen for the passengers sitting in this row. So if they want to control the temperature within the car, entertainment or lighting, all of that can be done with the touch of this screen.
Every purchase, limited offer, every Tesla order will come with a wall connector. You can install at your workplace, your home. We enable charging.
Tesla has announced that there will be 4 charging centers in both Delhi and Mumbai. They'll install 16 superchargers and 16 destination chargers in each city. Now, every Tesla customer who buys the Model Y will get this home charger for free. You can install it on the wall of your garage and you can charge your car overnight. There will be superchargers only in specific locations in Mumbai and in Delhi, and these can charge your car up to 250 kilometers in about 15 minutes or so. The pricing for charging your cars with the help of the supercharger will be announced by Tesla in the weeks to come. Tesla has announced that they will start deliveries from September this year for the rear-wheel drive version, and the long-range version will be delivered by Q4 of this calendar year. The company is also hoping that duties will come down with the India-EU FTA. Let's see what happens and whether the company will also come up with a plan to manufacture in India soon. With video journalist Bharat Kori from the Tesla showroom here in BKC, Mumbai, this is Parikshit Luthra.
Well, the suspense finally over, and here's IIM President Shailesh Chandra, who also heads the passenger vehicle division at Tata Motors, reacting to Tesla's India entry.
I'm very neutral to it, I can say, because it's a very attractive market as a country, very favorable EV policies, so there will be all kind of OEMs who would like to also participate in the growth journey that we might see in the EV industry.
And staying with EVs, VinFast Auto's Indian subsidiary, that's the Vietnamese EV maker, has commenced bookings for 2 premium EVs. The VF7 and the VF6 models will be sold in August after the inauguration of the company's plant in Tamil Nadu. The company said the deliveries will follow later. Shares of Ola Electric in focus today after the company's losses narrowed in the first quarter of this fiscal year. Speaking to CNBC-TV18, the company's chairman and MD Bhavish Aggarwal said Ola was looking into issues that the company faces in Maharashtra, adding that the management is engaging with authorities. He also clarified that the company has not heard anything from the Maharashtra government pertaining to stores being shut down. Take a look.
The confusion that happened was the registration and registration numbers mismatch in February or March, and I think in our Q4 results we actually clarified that with a proper walk of how the numbers stacked up. So I think in the public domain, definitely this issue has been now behind us. SEBI and we had many conversations, and whatever questions they asked, we definitely clarified.
Well, that's Bhavish Aggarwal. Up next, the Federation of Indian International Pilots says the preliminary report into the Air India plane crash by its very nature raises many questions, and any extrapolation can be regarded only as guesswork. That and more when we return. VWAC India has secured a green signal from market regulator SEBI for its IPO. The IPO will comprise an offer for sale component up to 4.3 crore shares. This includes 3.3 crore shares from promoter Embassy Group, JM Financial and ICICI Securities among the running lead managers. The Indian Sugar Mills Association has expressed concern after the government advisory directed the display of sugar and oil boards in public institutions. Now, these boards will inform consumers of hidden sugar and fat content in foods consumed on a daily basis. The Health Ministry said the move is aimed at making people aware of calories intake. ISMA has argued that it risks creating fear and confusion by focusing only on the negative aspects of sugar. The Indian External Affairs Minister Jaishankar met Chinese President Xi Jinping during his two-day visit to China. In a post on X, Jaishankar said he appraised the Chinese president about the normalization of bilateral ties between the two nations. This is the minister's first visit to China since tensions through the Galwan Valley clash along the line of control in 2020. Tech giant Nvidia has announced that the Trump administration has granted approval to sell its advanced H20 AI chips to Chinese buyers. Nvidia's CEO Jensen Huang has said that he hopes the company will resume these sales to China soon. This announcement came after the company's CEO met with President Trump. Now, Federation of International Pilots say the preliminary report into the Air India plane crash by its very nature raises many questions. The Federation also said that extrapolation at this stage can only be regarded as guesswork and has cautioned against drawing any conclusions from the preliminary information. Meanwhile, after the fuel control switches, the fuel valves of Boeing planes under the lens. The British aviation regulator has acted on a 2015 directive from the US regulator just a couple of months ago. Madhya standing by with more on all the recent developments. Madhya, let's start with the probe into the fuel valves. In the UK, what do we know so far, and why, after almost 10 years of the FAA issuing a directive, is the UK acting now?
Exactly. So this is this safety notice from the UK aviation regulator regarding the fuel shutoff valves was issued in May this year. The notice was referring to an airworthiness directive issued by the US FAA 10 years back, as you mentioned, in 2015. This is separate from the 2018 safety bulletin from the FAA that warned about fuel switches possibly moving on their own due to disengagement of the locks. So in 2018 directive, FAA had warned about a problem with the 2015, the FAA had warned about a problem with the fuel shutoff valves actuators on Boeing aircraft, including the 787 Dreamliner. Now, why that matters is these valves that are the valves that physically stop the flow of fuel to the engine when the pilots pull the fuel switch to cut off. The FAA had flagged a risk in 2015 that these valves might have hidden faults, what they call latent failures. So they may look fine from the outside but not perform their functions as needed. The FAA directive had said that airlines needed to test these valves every 10 days, swap out faulty parts and update their maintenance manuals. So the UK aviation regulators notice in May 2025 basically asked airlines to make sure they followed FAA's 2015 directive. Now, why this is significant? The AAIB preliminary report on AI-171 crash says it was the fuel control switches that transitioned from run to cutoff during takeoff, which caused both the engines to lose thrust. The report has opened debates on who could have moved the switches, since the AIB has not provided the entire transcript of the cockpit recording. It also doesn't mention how the fuel switches moved. Meanwhile, the International Federation of Airline Pilots Associations issued a statement saying, and I quote, "The preliminary report by its very nature raises many questions. It does not provide answers, and any extrapolation of its content can only be regarded as guesswork, which is not helpful to the good conduct of the investigation," end of quote. So the final report is still some time away. These older safety directives by the FAA might hold key clues to what really went wrong with the flight that crashed in Ahmedabad seconds after taking off on the 12th of June, killing at least 260 people.
All right, Madhya, many thanks for joining us. Moving on, before we wrap, Indian astronaut group captain Subhanshu Shukla has returned from the International Space Station along with 3 other astronauts of the Axiom 4 mission. The SpaceX Dragon spacecraft splashed down on the coast of California at 3 p.m. today. Astronaut Subhanshu Shukla is the first Indian to visit the ISS and spent 18 days at the space station. He will now undergo a 7-day rehabilitation program. And with that, it is time for us to wrap up this edition of Business 360. The news will continue right here on CNBC TV18. Stay tuned. We're back in a moment with more.
Hello and welcome to Commodity Champions. I'm Manisha Gupta. Well, the silver prices remain steady after hitting an all-time high in Indian markets and a 40-year highs on the COMEX amid safe haven buying and trade uncertainty. Last week, the US President Donald Trump said he will impose 30% tariffs on Mexico, which is the largest producer of silver in the world. Another factor supporting prices is that 2025 is the fifth deficit year for silver globally. Exchange-traded fund inflows have also contributed to the flight to silver. Estimates suggest that since the month of February this year, investors have added more than 2,500 tons of silver into their portfolios. The white metals prices have jumped over 35% so far this year. What is next for silver is really the question that everybody seems to be asking, and that's exactly what we will ask our guest. Joining us now to discuss the outlook for silver, demand, supply and prices is Michael Durenzio. He's President and CEO of the Silver Institute. Michael, hi, morning. Thank you so much for joining in. What is your sense, first of all, on the prices, the way they seem to be moving not too far away from $40 an ounce, a level that most people were hoping the silver will touch by the end of this year? We seem to be getting it sooner than that.
Yeah, I think so too. And first of all, thank you for this opportunity, Manisha. It's an exciting time in the silver market. I think the price is moving forward. I see the trajectory as just moving straight ahead. It's fantastic where we are today. We're up, almost 35%. We were 28%, I think, through the end of June for the first 6 months. So we're seeing real active silver price movement to the upside, and it's based on a lot of factors, Manisha. Industrial demand, safe haven demand, tariff concerns, economic uncertainty. It has a lot of room to run.
I know, Michael, you don't talk prices, but almost everybody seems to be talking about 41 and 42 and 45 going forward in this year itself.
I've seen that, and quite frankly, I don't see anything that can stop that momentum. Quite frankly, it's all cylinders are firing for silver. I've seen as high as 47, 48 in some of the bank projections. So look, it's an exciting time. We had a 21% increase in the silver price just in 2024, and to be where we are today, I know that our member companies and those that invest in silver are quite happy.
Michael, I also want to talk about the tariffs right now. And with 30% tariffs on Mexico, while of course silver as of now is exempted from it, is that another thing that seems to be fueling or supporting silver price rise? And what's your sense on how could you or what could it conspire into?
Yeah, so you're right. Canada and Mexico are exempt from paying taxes or paying higher tariffs on any bullion. But that doesn't discount the fact that the overall tariff concerns globally won't affect the precious metals complex. What we're seeing right now is a lot of back and forth, a lot of countries trying to come to Trump's table to negotiate a reduced tariff or no tariff at all. But he seems to be holding strong. He's backed away on several tariff threats over the last 6 months or so since he's been in office. But it appears to me and appears to many others that he's going to start holding firm on some of these tariff issues. And that will affect the silver price and the silver complex going forward. It will affect it in a positive way.
Michael, what's your sense on the investment demand? Industrial demand, we do understand, continues to be on the stronger side. China seems to be picking up now. The Europe numbers are slightly positive. US, it hasn't done so badly either, even as there have been some recession concerns there initially.
Right. So what we're seeing here on the silver investment complex is rather exciting. We're seeing record flows into ETPs. If you just look at the month of June alone, the ETPs reached about 1.13 billion ounces. And in that month of June, it accounted for nearly half of the gains. And it's rolling strong again in the month of July. The futures trading was quite exemplary for the first 6 months of this year. The net long position was up over 163%. So it's quite encouraging. Where we are seeing some concerns, however, is on the retail silver investment side. We have mixed fortunes across the globe. Europe is doing better. India is doing quite well with respect to retail investment demand, up about 7% year on year. But in the United States, we're being challenged. We're seeing some investors selling back into the market at these higher silver prices. We're seeing the premiums on bars and coins increase. And we think that as we look ahead throughout the remainder of the year, there's a potential for strong two-way activity in those markets. Like I said, India is doing well. Europe is doing fairly well. Even Germany with the VAT tax is punching ahead of its weight. So we can see a mixture of some profit taken by some, and we could see new investors coming into the market, especially if we hit that $40 an ounce marker.
Oh, well, absolutely. Michael, India has seen all-time highs in silver. It has been a one-way rally, the kind of catch-up that silver seems to be doing with gold. Do you see that impacting demand at some point in time? Because that's exactly a bit of a concern that the street has right now.
Well, I think it could potentially affect Indian demand, but ironically, what we're seeing, if you take jewelry, for example, Manisha, the higher gold price is making some gold-plated silver jewelry more affordable for the average Indian. And we're seeing that during the wedding season, which has typically always been solid gold. So there are some encouraging signs in India for overall demand.
Michael, every time we did see silver prices go to $50, and that has been a couple of times in last many years, silver hasn't sustained there. It was actually in the same year that we saw the prices decline very, very sharply. What makes you think that this time is different?
Well, if you go back historically, Manisha, you looked at the 1980 run up to $50. You look at the 2011 run where it got to 49 and change on a Friday night. And then President Obama made the announcement that Osama bin Laden had been killed. And that took the fear of terrorism off the table. And it wasn't just silver that decreased. It was gold, it was oil, it was a whole other basket of commodities. So I don't know. I don't know what's going to happen in the future, but I do know this, is that the momentum is strong. And while $50 seems to be a magic number, a number that can be very well attained this year, we'll just have to see.
Oh, well, yes. Michael, I remember speaking to you earlier, and you did tell me that the deficit, the fifth year, that is this year, could continue in the next year as well. Now, there are various reports suggesting that the deficit could actually extend, spill over into further years as well, perhaps a 27 or a 28 as well. Are you able to look that far?
Yeah, we are. As a matter of fact, well, we don't have concrete numbers for 27 and 2020 and 2026. We do believe that the deficit is going to continue. You know, initially this year, when we put out our World Silver Survey in April, we had called for 117 million ounce deficit, slightly smaller than what we've seen the previous year, but still quite impressive. The fact of the matter is there are no new mine projects coming to the market. Mine supply is expected to grow marginally this year, while industrial demand and other forms of demand for silver will increase. And we think that 117 million ounce number may even be higher this year. And yes, we do maintain that 2026 will also have a structural market deficit.
And would you say that it could spill over to 27, 28, 29 perhaps?
It very well could, Manisha. I mean, quite frankly, we've spoken at length about the fact that it's hard to develop a silver mine. If you take the United States, for example, it's 18 years. From the moment you first find silver either in an existing ore body or a new project, it's 18 years before you can strike and start bringing silver to the market. So, and we're seeing that regionally too. Look at our companies maintain, our member companies on the mining side mine throughout the world. And they mine silver sustainably and to the best of their ability to protect the environment. The rules in the United States and in other regions are quite restrictive toward new projects. I think where you're going to see growth in mine supply down the road will be on existing veins and at current projects.
So 18 years is the time that it takes for a newer mine to come in, and there are no mines in sight. So that does tell us that the prices can be supportive. And as you said, Michael, what we saw in 1980 and 2011 and where we stand at 2025 is very, very difficult. And we are looking at sustainable money inflows, money rotation even coming in for silver, and that perhaps makes silver rally so much more sustainable. But thank you as always for joining in and making a sense of what really has been happening, especially in the Indian markets where we have been hitting all-time highs for the last 2 or 3 sessions on silver. This was an important discussion. But on that note, it's time also for a break. But don't go anywhere, because we will discuss Health Ministry's advisory on oil and sugar content in food items on the other side. Stay tuned. Welcome back. You're watching Commodity Champions. The next time you decide to buy a samosa, jalebi or chips in a government hospital or a government institution, you may experience feeling of guilt. The Health Ministry has issued an advisory to all government ministries, departments, hospitals and public institutions to display boards with warnings on the oil and sugar content in these commonly consumed snacks. Projections suggest that by 2050, more than 45 crore Indians could be overweight or obese. The ministry's advisory aims to make people aware about the health risks due to excess consumption of oil and sugar, as well as to combat obesity. This could be part of broader awareness campaign that is being linked onto tobacco warnings or cigarette packets. Joining us now to discuss the implication of Health Ministry's move is Sumit Gupta. He's CEO at Wasida Global Commodities. Mr. Gupta, thank you so much for joining in. Clearly, the consumer angle seems to be very, very strong on this. But I want to talk to you about the industry angle on this. We do understand that for the last many years, we've seen population growth and we've seen consumption growth as well, as India has been creating more wealth, improving their standard of living. And that's exactly where this unhealthy food creeps in.
First, good afternoon, Manisha, and thank you very much. It's a very important topic because on one side, it makes you question about your food habits, and second side, you think about what can be the implication for the industry. So, especially, let's look at how it's going to, as you have mentioned about the income part. As India is going to become richer and wealthier, and more female population is going to come into workforce. One thing is for sure, there'll be more processed food and there'll be more people who will be eating food outside. And whenever this combination comes in, you have more intake of oil, sugar, and salt in your food. And going by that, I think sunlight, is the best disinfectant, and it is important for people to know that what they're consuming. Okay. And from that point of view, this advisory is good. But what is more important that it should not become an Inspector Raj, or it should not become a threat for the other industry or the small hukera segment of people, that it can be used as a tool to make it difficult for them. But if you ask me about specifically about this advisory, I think it is good in the long run.
I understand that. How would you look at the industry numbers then? Because we've seen growth in demand in the recent many years. As you also mentioned, that is because people are eating better, people are eating more, and people are eating out more. And that is where you have the major oil and sugar content coming in. I mean, as you said, advisory is great, but is it going to have a lot of impact on ground?
In terms of, let's look at the demand side of it. India is still a low-income country, though we are a fourth largest economy in the world. We are 140th on the per capita income. And as we will move from low-income country to middle-income country, which is still we'll have to make $10,000 per person per capita more. And when we are going to make that much money, where we are going to spend it? First, we are going to spend it, as you have mentioned, on eating out more, eating out healthy, and eating out what we know. And that is where the pendulum will shift from government, where today government decides what people are going to eat, to a place where people will decide what they are going to eat. And that is where, personally, if you ask me, I don't see any impact of this circular on the increasing consumption, number one, both in veg oil or sugar, because these two products consumption is going to continuously increase, because there is a big disparity between the consumption between the urban India and rural India. Though we look at the per capita numbers, then we put all regions into one. But when you divide this into urban, rural, north, south, then there are big disparities. And the consumption in rural/East India is going to continuously increase over the years.
Is there a number that you're willing to put there, Sumit? And I get your point absolutely that it's not urban India. Urban India demand perhaps may just plateau, but it is the rural India demand that would continue to grow.
And in terms of demand, if you look at the global numbers today, and let's compare it against the middle-income countries, per capita consumption of sugar, if I'm not wrong, in India is around 20 kg per person per annum. And average in the middle-income countries is around 35 to 36 kgs. And in vegetable oil, similarly, we are around 60% on the median consumption against the middle-income countries. So if you look at the demand numbers in terms of what is ahead of us because of the growing income, growing population, and reducing rural and urban disparity, I believe sugar consumption should grow at least at a factor of 1.5 to 1%, 8% per annum, and same growth rate should be witnessed in the vegetable oils. Over and above, let's come in from the government point of view. A country cannot become wealthy till the time its population is healthy. And we have sizable population with diabetes, around 100 million people, if I'm not wrong, and 20% of the urban and 10% of the population in the rural India. So that spread is also of a concern. And that is where, if I have to hold my view, I will say it is good for the industry also, because overall, the net consumption is not going to change, but the consequence of the consumption will change. How we consume it will change.
Well, that sounds really interesting. And this is just initial numbers coming in. As we go ahead, we'll know those numbers as well, whether or not we have seen that impact on ground. But thank you so much, Sumit, for being with us. Let's dwell slightly deeper in case of sugar. And we have Rahil Sheikh, founder and managing director at Mere Commodities. Rahil, it's good. It's perhaps positive for consumers. We have really bad numbers when it comes to obesity, overweight, and diabetes, etc. But what does this really mean, this advisory mean for industry as per se?
Manisha, last 1 week or 10 days after the Mann Ki Baat, this has been the debate across the country, I think. I mean, including your own house where you have to justify the consumption of sugar and edible oil. So I think personally from my take, I think on a very short-term basis, we don't see any changes happening, because the habits of eating does not change on overnight basis. I mean, we will continue to consume what we were consuming. Then there is, as my other colleague mentioned, that the disparity between India, urban India and rural India, that will continue. So I personally don't see a very short-term issues into it. I think on a longer term, we probably will have to see how our new generation look at it. I mean, the charts and displaying of things which are bad for health over a period of time, if that happens to change the mindset of how we consume food, then it will be a different aspect. But I think displaying a chocolate on a board in school, probably that chocolate will be taken off in the morning. So I think that the children needs to take this advisory of our Prime Minister over a period of years before we could see the changes. And adding India is all over adding the population. I think we are going to plateau on our population around 2071, 72. So until that 500,000 additional of people will come in and consume. So I think on sugar front, we are at 19 kilos per capita in the world today. If you look at Europe, it's about 27, US at about 29, Brazil at about 55. Most of these countries already have sugar tax, labeling to whatever they could. I mean, we can't compare ourselves to Africa, who's at 10 kilo per capita, but I think India is around 19. I think we'll continue to sort of have this range and adding the populations. I think we should continue to grow at 500,000 ton until the young generation decides that they are really off the sugar for whatever reason they would like to.
Rahil, I was talking to somebody in the industry and they said there are 17 substitutes today, as of now today, to sugar in sense of sweeteners, starting from date syrup to, I mean, there are various varieties there. You think the number that you're giving me, 500,000 ton per year of a consumption increase, will that stand the test of time in the next decade as well? Or do you think even before that, we could be looking at these substitutes more seriously?
I mean, look at alternative, out of 17 alternatives, the two major alternatives are jaggeries and khansari, which are imminent to sugar. I mean, leave aside the Diet Coke and all those which also have displayed now that there could be some other element due to consumption of those chemical-based or natural-based alternative sweeteners. Out of these two, I mean, how many of us have changed our habit of eating a jaggery-based mithai or a jaggery-based chai or things, as I mentioned, that our habits are not going to change in 10 days' time. Probably as the generation will pass by, I think we will pass on. I mean, we have passed on.
I get that. So Rahil, when you say 500,000 tons per annum of an increase, how long have we seen 500,000 tons per annum of an increase in India? Has this been?
I have seen it from 30 years now.
So for 30 years, every year we've been adding?
Except for the COVID years when we saw it dip. 1994, I remember we were consuming about 9 to 10 million tons. And in 30 years' time, we are at 30 million tons. So we have added 20 million tons. So I mean, there's science behind when I said 500,000 tons, because it's much easier to talk that those 500,000 tons as a number. We are adding population as well. I mean, if by sheer number, we may be highest in diabetic, but we are 1.545 billion people. So on any numbers will be on the highest. But I think today when you hit the gym and you hit better places, you see a lot of people to be fit rather than talking about not just consuming sugar and edible oil. You see them for 1 hour on the treadmill and in the gym. I think that should be also the advisory, because it's important that by just consuming the right amount of food, you can avoid a lot of things, but there are alternatives like exercises to be fit, and that should also be a thought process which should be continuously fed into population. Because just consuming sugar and edible oil will not change these impacts.
Absolutely, Rahil. That is something that everybody and the industry and at all sides have been saying, really, because it's not just about one or two factors. It really is a whole host of factors that change a thing. But I'm just coming back again on the 0.5 million tons here. This year is expected to be lower, and with the kind of numbers that we're looking at, and if this advisory actually works, are we looking at a slower growth, or do you think it's going to be sustaining, stable as 500,000?
I mean, you have to calculate things by basis of your surrounding. I mean, unless you go deep down and do the survey of the entire industry. I mean, when I look through the things, a labor who takes up about 4 cups of tea is not going to make it 3 just because sugar is bad for him.
I take that. But Rahil, is the
calories.
industry at all worried, concerned? I mean, as you said, these things don't change overnight or over a season or over a year for that matter, perhaps. From the side of industry, you don't think this is going to impact, nothing changes, nothing seems to be changing as of now?
On short term, I don't see any changes because we consumed 28.1 last year after smugglings and after Khansari export and all. This year we are on course to consume about 28.5 to 28.6. The dispatch number always get confused with consumption number, and I think if you look at all the pundits who are giving the number for next year, we are talking about 29.1 to 29.2. So I think until this becomes a daily YouTube and a short video which keeps feeding you. I mean, until then, I don't see an issue. But if my Facebook and my Instagram hits me 10 times a day, then I probably will tell you that I've stopped consuming sugar.
All right, that is what it needs to work on then. Rahil, thank you so much for joining in. And I get your point that even as the advisory is good in holistic nature there, but take a look at what the other countries are doing. We're at 19, Europe is at 27, US at 29, Brazil 55. So those numbers really need to be taken into consideration as well. But thank you as always for joining in and making sense of this. With that, it's a wrap on this edition of Commodity Champions. Thank you for watching.
After years of speculation, back and forth and deliberations, Elon Musk's Tesla has officially entered India. The EV maker opened its first India showroom at the Maker Maxcity Mall in Mumbai's Bandra Kurla complex. Hello and welcome to News Center. I'm Parikshit Luthra. The EV giant has two variants of the Model Y on display at its 4,000 square feet showroom. The Model Y will be available at a starting price of 60 lakh rupees, which includes import duties and tariffs. The cars have been imported from Tesla's Shanghai factory. I visited the showroom earlier today. Let's take a look. Tesla is finally here in this 4,000 square feet space in Maker Maxcity Mall, BKC, Mumbai. They've only launched the Model Y for now, and this is the car that is available. Now, with a $37,000 price tag in the US, you have to add a 70% duty in India. That takes up the price of this car to 61 lakhs for the rear-wheel drive version and to 69 lakhs for the long-range version. Now, what do you get in terms of performance? In terms of range first, the car can go up to 500 kilometers with the rear-wheel drive version and 622 kilometers with the long-range version. In terms of speed, the top speed of the Model Y is 200 kilometers per hour. It can go from 0 to 100 in 5.6 or 5.9 seconds.
We are hiring. You have seen it. We are hiring. So we will local team. Yeah, we are doing. India has so much incredible talents. Yeah, so we don't need talents. We have many talents locally. So we're going to hire local.
We're inside the Tesla Model Y right now. One of the highlights is this 15.4-inch screen that you get with this car. The seating is ventilated. You've got climate control settings inside the vehicle. You've got entertainment settings. And Tesla has its own audio system. You've got double LED acoustic class that you've got all over with this Tesla. Let's move on to the second row to find out more about this vehicle. Well, now I'm in the second row of the Tesla Model Y electric SUV. Over here too, there is a 8-inch screen for the passengers sitting in this row. So if they want to control the temperature within the car, entertainment or lighting, all of that can be done with the touch of this screen.
Every purchase, limited offer, every Tesla order will come with a wall connector. You can install at your workplace, your home. We enable charging.
Tesla has announced that there will be 4 charging centers in both Delhi and Mumbai. They'll install 16 superchargers and 16 destination chargers in each city. Now, every Tesla customer who buys the Model Y will get this home charger for free. You can install it on the wall of your garage and you can charge your car overnight. There will be superchargers only in specific locations in Mumbai and in Delhi, and these can charge your car up to 250 kilometers in about 15 minutes or so. The pricing for charging your cars with the help of the supercharger will be announced by Tesla in the weeks to come. We spent about 2 hours in the Tesla showroom speaking to the Tesla management. Clearly, there is a lot of excitement about the Model Y launch here in India. The company has brought all the latest features and charging options to the India market. But the full self-driving function is not available just as yet. The company would like to test it further on Indian roads before offering it to the customer. For the moment, the car is coming at a very hefty price tag because of the duty structure. The company would be hoping that India would soon have an FTA with the European Union and a trade deal with the United States, which will bring down the tariffs to possibly 10%. And that would make it much easier for Tesla to sell cars in India. With video journalist Bharat Khori in BKC from outside the Tesla showroom here in Mumbai, this is Parikshit Luthra. We're now joined by Vivek Vaidya, Associate Partner at Frost & Sullivan. Arun Malhotra, former MD of Nissan and automotive expert, is with us. And so are Arun Bhatt and Nikhil Chaudhary, founders of the Tesla Club India. Thank you very much, gentlemen, for joining us. Vivek, how do you think this moment is for Tesla? And why exactly did they come in at this point? Was this only because they were under stress in China, in Europe, and other key markets? Or was it also because they felt that India has matured now as an EV market?
Not at all. I think Tesla can't ignore a market like India, which is the largest country in the world by population. And today or tomorrow, they had to be there. So I don't think there was any pressure. I think it is just a question of a natural progression. And when they wanted to open the showroom in India, I don't sense any pressure here. If they want to be a serious player in EV, they have to be in India. There is absolutely no doubt about it.
Right. Let me go across to Mr. Malhotra. Mr. Malhotra, do you think Tesla will also find it tough to move in and navigate the Indian market, considering there are so many players? You've got domestic players who sell cars in the range of 10 to 25 lakhs. You've got EV options in the range of 30 to 40 lakhs, 50 to 60, and even in 60 to 70 range, the Tesla is coming in. You've got Mercedes-Benz, BMW, you've got Audi, BYD, VinFast also launching today. There's going to be a lot of competition.
Parikshit, first of all, the move by Tesla to come to India is welcome. I think it'll excite the market, and sometimes a new entrant and a famous name also excites the market and makes the market go bigger. But coming to the reality check, if Tesla had come 3 years before, where the brand value of Tesla was much, much higher, or you can say the aspiration value is much higher, today a lot of are new players like VinFast, which is coming from Vietnam. So effectively, you've got more than 12 players in the market. And if you slice the market today, above 40-50 lakh rupees, it's hardly 10% of the market, and it would be about 1,000 volume per month. If we assume the market doubles, it becomes 2,000 a month. There are about 7 to 8 serious players, as you mentioned, Audi, BMW, Mercedes, Volkswagen, VW, sorry. So clearly, it's a challenging time for them. I think the real crux is that if Tesla has to make really serious about India, it has to start manufacturing in India. Because at this price point, it will continue to be an aspirational brand, but a niche brands, and others are also catching up. So it will be difficult times, but knowing Tesla as a brand, they'll try their best. But it's not going to be at all a cakewalk for them.
Right. Arun, why do you think they brought in only the Model Y for now?
Well, I think the point was...
Sir, that's my question to Arun Bhatt from Tesla Club India. I'll just bring him in as well. Arun Bhatt?
Yeah, hi. I think it is the timing right now is more to do with the upcoming models rather than their market share in the world or the difficulties that they're finding in China or Europe. It's more to do with the upcoming models. So the upcoming models are expected to be lower cost and more compact, and they may be positioned well below the existing Model Y. So as a way to test the market, they've entered with the Model Y just to set up their sales, service, and aftermarket network. And this will act like a foundation when they bring across their lower cost model.
Right. Nikhil, don't you also feel that when you were coming to India and there was so much of expectation from you, why bring a model which you already have in global markets? Shouldn't Tesla have gone ahead and launched the low-cost model here in India, or maybe brought in a few more models such as Cybertruck, made more noise about it?
Hi, Parikshit. So Tesla has brought the Model Y because that's what they have right now. The lower cost models are currently in development, as Tesla stated in their recently earnings call. So they can't bought it right now, and they need to set up a factory, which will take time. So as Arun mentioned, to test the waters, they have brought the Model Y. And regarding Cybertruck is only made in left-hand drive right now. So yeah, it might have been good to that if they have showed it, but it wouldn't have been possible to sell Cybertruck in India right now.
Right. Vivek, if I can come to you, how do you expect Tesla to do in terms of volumes? Their timeline for launch is like this. Bookings have already begun. By end of Q3, the rear-wheel drive will start getting delivered. And in Q4 of this calendar year, they will start delivering the long-range version. How do you expect them to do in terms of initial volumes?
So I would say initial volume, Malhotra sir will be able to put a finger to it and give you proper numbers. But from my perspective, I think from where I see it, Tesla will have a good market and a good, I would say, booking pipeline as far as India is concerned. And the reason for that is there is a novelty value attached to Tesla, and Tesla has always entered from premium end and come down to a lower end. So basically, they want to establish themselves as a premium player first, and then bring in the cost competitive products for mass market. So I think that is what they have been following in the rest of the world. As Malhotra sir said, I think the market, premium market in India is just about 10%. But I think in short term, in my personal view, it will give run for its money to all the other players like BMW, Mercedes, and even the new entrants like VinFast and BYD. That's my personal opinion. For exact numbers, maybe we should check with Malhotra sir.
Okay, Mr. Malhotra, what do you think about the initial offtake compared to players like VinFast, BYD, and also existing players in this space such as Volvo, Mercedes? Also, as an automotive veteran, if you see this launch and compare it to the kind of launches that we see with Mercedes-Benz, BMW, the kind of budgets that they have, even Indian car makers like Tata Motors and Mahindra, Maruti, when they launch, the scale of those launches is much bigger. This was far more low-key, localized. Elon Musk was not there. There was one executive that they brought from South Asia, director of South Asia, Isabel Fan, who came, briefed the media, no interviews, just one car showcased, 1.5 hours of media interaction, everybody is out. So what does this really tell you about what the company has in mind and what could this lead to?
So, Tesla still has a certain image and aura and standing. So just look at the publicity they're getting, the free publicity they're getting across media, across social media. To that extent, awareness, I don't think will be a challenge. I think the challenging part would be that even the other luxury brands which do exist in India still have service network at least through 40, 50 cities. Whether it's Audi, BMW, Mercedes, and I'm not talking the mass market players whose network would be higher. So if you're having a model and you're just focusing on 2 cities, it becomes a challenge. Not that the market is concentrated there, but also people will drive around. To that extent, it's a challenge for them. But having said that, I agree, Vivek, the strategy is right, come with a premium product and then go to the mass market. But Tesla has to decide one point of time. If they are seriously in India, they have to start manufacturing in India. Otherwise, the 70%, 80% duties will just make them price uncompetitive. Other players, the other luxury brands, EVs contribute 7 to 8%. So their bread and butter is somewhere else. Whereas Tesla's bread and butter will be this. So they really have to make a big move. And the government policy, they have to get into it, which have been, there's actually a lot of people say it was made for them, but they've been slightly circumspect on that. So that's where the challenge is.
So, Mr. Malhotra,
the initial response will be good because there are Tesla lovers there. But I think the real challenge starts after 3 months.
So, yeah, do you feel that after that, the offtake may become a problem because there will be a lot of people in enthusiasm who have, who will go ahead and book and buy the car also for 70 lakhs if need be. But after 3 to 4 months, there won't be those customers left in the market?
So I'm not saying customers will not be left, but then you have to make a real effort. The people who are fascinated by Tesla, who are the Tesla lovers, they'll get finished off 3-4 months. Then you have to fight for your market share, for your position with all the luxury brands in the market. So then it will be you are maybe first among equals or equals among all of them. So the real game will start 3-4 months down the line.
Right. Arun, but I think it was expected that the full self-driving option will not be available here in India. But do you think customers will miss out on the big fun around FSD and autonomous driving options that Tesla had?
Tesla has always been very circumspect and very safety conscious while introducing any of the new driver assistance technologies. So I was expecting at least the autopilot suite to come in, which usually works on the highways. But there is no word on that too. And FSD, of course, will take a lot of time because the driving circumstances and the roads in India are quite different to anywhere else.
Right. And Nikhil, in terms of what this car offers, in terms of the features, everything is the same in terms of what's offered in the United States, in China. The same car, the latest model, minus the FSD. Is that correct?
Yes, Tesla does not differentiate between the features among their market. They have their latest model everywhere. And yes, everything is same that is in China and Europe and US.
Right. Going back to Vivek at this point, Vivek, who do you think will be Tesla's biggest challenger in India? And what does this really do to domestic car makers? Do you think domestic car makers will have to be far more careful now? They'll have to work much harder considering that duty reductions are in the pipeline. They'll happen soon in the next few months, either for EU or for the US. And then the price difference will become far narrower.
Yeah, I think for domestic manufacturers, if you look at the price range in which Tesla has launched and price range in which domestic manufacturers operate, there is a big, wide gap between the two. So what they will have to look for is not just the duty concession, but also Tesla introducing lower price models. I think that would be a bigger threat than just duty concession. See, even if US slashes the duties to say 10%, still it is unlikely that this entire import duty is likely to be reduced because there would be several other taxes. The inherent tax structure in India is quite high. So I would say in short term, the domestic car manufacturers may not have much to worry about, but they should watch out for Tesla bringing in their mass market model, and that's when the real threat to the domestic manufacturers will start. And I also wanted to add one more thing about your previous question about the full self-driving. It is not just about what Tesla has to offer, but it is also about what government allows. Because in most of the countries except US, it is a regulatory issue whether to allow the full self-driving or not. So the governments have to allow autonomous driving for Tesla to offer it to the customer. So maybe the cars are capable, but unless the government approves them, they will not be able to do it.
Right. Let me also ask a question about charging now. Mr. Malhotra, they announced their charging plan for Mumbai and Delhi, 4 charging stations each for Mumbai and Delhi. There will be 16 superchargers in each city, 16 destination chargers. Do you think that's a strong enough and robust plan? And Tesla, of course, has enough experience since 2008 in terms of putting across an ecosystem for electric cars.
So, superchargers will be there in the key cities. We're talking of Delhi, Gurgaon, Bombay. But I think the challenge is when people take EVs and we're talking of a long range, they will take it to places 500 kilometers away. And they're still, as a country, we're struggling in. The superchargers exist in some specific locations. So that doesn't help much because if you're in a local market, if you're in Delhi, Bombay, even if you don't have a supercharger, you can manage it. So clearly, when we're talking of superchargers, most other companies even offered it needs to be from a network basis, which in India is still struggling. I don't think Tesla has so many footprints in the country that can put superchargers in all key locations. None of the other companies have been able to do it. So that will be a challenge point.
All right. On that note, we'll take a short break, but don't go anywhere. We'll continue this discussion on Tesla's India entry with all of our guests today. Welcome back. We're discussing Tesla's India entry here on News Center, and the company has launched the Model Y in 2 versions, the rear-wheel drive and the long-range rear-wheel drive for the customer. Let me go across to Arun Bhatt now. Arun Bhatt and Nikhil Chaudhary are founders of the Tesla Club India. But Arun, don't you feel that many customers would actually want to wait for the duty reductions for a few more months? Because a trade deal with either US or European Union is imminent. If that would happen, auto tariffs would come down, the cars would become immediately cheaper.
In this regard, the US tariffs don't make any sense. Waiting for US tariffs doesn't make any sense because US makes only left-hand drive cars. And they do not make even the Model X and Model S with right-hand drive. All the cars that need to come to India right now have to come either from Berlin or from China. So the EU deal is what matters. And with regards to people waiting, yes, I am a 2016 reservation holder for Tesla India. But since I am located in Bangalore and options are not available for me to book a car in Bangalore, I'll be waiting. Similarly, other states and other cities in India too will wait. And regarding the pricing, I think it's to do with the duties, and we'll have to see how Tesla prices it for the reservation holders vis-a-vis new orders. So then I'll take a call.
All right. So, Nikhil, do you think you and Arun and maybe more Tesla Club members would buy the Tesla at this current price point, or would you wait? Nikhil, could you hear me?
Hi, yeah. So we know some people who have already booked one, and I think we know the first person who has booked a local Model Y. So some people are certainly going for it. And yeah, as Arun said, some would wait for some time.
All right. So yes, there will be that initial excitement for sure. What are some of the challenges that you foresee for them in the coming months, Mr. Malhotra?
Well, I think the challenge will be that one clearly will be the competition, because competition will also try to raise its game up, because you have no. Second of all, they need to at least be in at least 8-10 cities. It can't be very Delhi and Mumbai centric. Your cities like Bangalore, Hyderabad, Chennai, Pune, you need to add up to it, because these are cities where enthusiasts, car enthusiasts, and they're big markets for premium vehicles. And third is the charging infrastructure will also have to travel along with this. But clearly, there will be a lot of excitement there. But I think the positive part I see is the excitement created by Tesla can actually help in increasing the market size of luxury EVs, which is not happening. So that's the positive part. But challenges will remain. If probably it was 3 years before, then a different story altogether.
But do you feel that Tesla should not make the same mistake as many American car makers like General Motors and Ford have made before, and even European car makers sometimes, that they tend to run the company out of the headquarters in US or Europe, whereas India can be a very, very different market. So do you think Elon Musk should let the Indian team fold up their sleeves, get their hands dirty, localize as much as possible, and then see what can happen in the market?
So Indian management should be available. And I think this is happening now, more empowerment is happening. And it was mentioned in the press conference also before, which you showed on your screens also. So clearly that's a part of it. But getting to indigenous, it's not going to be that easy. I mean, there are certain clear components, so it takes time. I mean, auto industry is more like a marathon race. So clearly, I think the first idea would be that in the luxury brands or in the premium brands of 50 lakhs, Tesla should try to be number one. Volumes will be small, and then try to raise the game. But I'm sure the other luxury car brands will not be sitting idle. So these are interesting times, challenging times.
Interesting and challenging times. And Vivek, who do you think will be... specifically, I'd like to understand about the competition between VinFast and Tesla. VinFast has also opened bookings today. How do you think these two cars stack up against each other?
So as I see, it's a fight between the brand and the product. Tesla will fight with its brand because that's what Tesla is best known for. When you ask a Tesla buyer, he says that he owns a Tesla. He may be owning Model 3 or Model Y, but he'll say he owns a Tesla. And that has, I would say, aura around it. Whereas VinFast is concerned, customers will tend to evaluate it on the merits of a product and not so much of a brand. There is no, as I see, no big prestige associated with VinFast as a brand. So VinFast will have to stand on its own on product features, on what they offer as connectivity features, the size of the screen and the charging and the price and so on and so forth. Whereas Tesla is concerned, it's just Tesla. And people would be happier to flaunt a Tesla than a VinFast, of course. And therefore, I would say, as I said in the beginning, it's a fight between the brand and the product.
Yes, and clearly there will be a big fight between Tesla, BYD and all the existing luxury OEMs, global OEMs and domestic OEMs here in India. That's all we had time for, but thank you very much to Vivek Vaidya, Arun Malhotra, Arun Bhatt and Nikhil Chaudhary for being with us here on News Center. With that, it's a wrap on this program. Thank you for watching. Goodbye.
Hello and welcome to the most important interview for financial markets. I have with me the Governor, Reserve Bank of India, Mr. Sanjay Malhotra. The governor who has stunned the market in the last 6 months by giving 10 trillion rupees almost in liquidity, by cutting the repo rate by 100 basis points, all in 6 months, cutting the CRR by 100 basis points, again in the last 6 months, effective September. With all this, the market still wants more, like Oliver Twist. So, Governor, thank you very much for your time.
Thank you. Thank you for the opportunity to be here.
So, first up is the Tuesday inflation number, June inflation number coming in at 2.1%, lower than most market expectations. And now the April, May, June number is 2.7. Reserve Bank's forecast was 2.9. And on the street, the expectation is July will be 1.8 and the full year will be way below the 3.7 that Reserve Bank forecast, probably close to 3. Therefore, does it open up space for a rate cut? In fact, for rate cuts?
See, we are in a neutral stance, as you are already aware. So, the MPC, this is of course, first of all for the MPC, not for me. But you are right that the MPC has decided to change the stance to neutral. And so what this means is that we can go in either direction. It gives us the flexibility to move upwards or downwards depending on how the outlook, more importantly, rather than the current data, which we have, now only for Q1. Rightly, you have said that it has come down. But how is it going to look like going ahead? And we do our own internal assessments. Whether it will be 3%, I really don't know, because those calculations we are still in the process of doing that. We will certainly come out with our latest projections. And the MPC, as always, will factor in the evolving situation, the outlook, and then therefore take a call as to whether the economy really needs what kind of a policy rate it needs. If the inflation is lowered, the forecast therefore, the outlook is lowered, the growth is lower, certainly the policy rates can be cut, but that is something that we have to wait and watch.
Okay. What is the trigger for a rate cut? Will it be more lower inflation or will it be lower growth?
It's a mix of the two. It's a mix of the two, really. One can't really say that it is inflation which is more important than growth numbers. For us, as you are aware, it is primarily we look at price stability. That is our core mandate. That is the primary objective. And then we look at growth also. Both are equally important. And I would not say that, we would give more emphasis as of now to either numbers. We also need to be aware of the composition of the inflation, and especially when I say composition, I mean, the momentum and the base effect. Of course, core and food is another way of looking at it. But how is this inflation going to look forward in future? That will be more important rather than the 2.1% or the current inflation that we have.
Okay. So what you're saying is when you are looking at the neutral rate, it is not the current inflation minus repo rate minus current inflation. Will it be more repo rate minus 12-month forward inflation? Because in the MPC minutes, members are doing both. They're looking at current inflation. Some of them are looking at some points at 12-month forward. Where will your accent be?
See your this real rate, first of all.
Yes.
It is the long run rate, interest rate, at which the economy is to be, in a neutral state or a state of equilibrium or a state of steadiness. Now, it's very difficult. First of all, it's very, very difficult to calculate this. It's not observed. It's an estimate, and it's a difficult thing to estimate.
Yes.
Even, because you mentioned about this
real rate.
Real rate. So let's be very clear, that this is only a guidepost. This is not a precise number. Even in India, we have a range 1.4 to 1.9 or thereabouts. Even, in the US, they have a range. Each member, gives a very, very different estimate of this. And so John Williams, who's an authority in this, in fact, he says that, this is not a this star, the so-called star, is not a bright point of light, but it is a fuzzy blur. So it's imprecise, and it's moving, it's changing. So while that is important, it's only a guidepost. Coming to your question of
12-month forward.
12-month forward, or whether it is the current inflation, as I already mentioned, monetary policy is forward-looking. And so for us, what is more important is the inflation going forward. But inflation going forward, you don't know, I don't know.
No.
It's only an estimate.
Yes.
It's an outlook. Current inflation is known. Of course, that is known. That's not an outlook. That's not an estimate. That's more or less, reasonably certain. And so that does feed into the outlook. But it is the forward-looking outlook which is more important.
Okay, let me persist with this just for one last question. See, the inflation is likely to be around 3%. That is well below 4% for practically all of 2025 calendar. And that makes it 2.5 percentage points, 250 percentage point real rate for a good like 9 months, from March it is at 3% and it will be that way all the way till December. More importantly, sir, now the WPI has come in negative. So, that also impacts manufacturers, that level of deflation. So I'm asking, when you say neutral, is it 1/3, 1/3, 1/3 hike, pause, cut? Or will the percentage of cut be a little more, given the kind of deflation number we are getting in WPI? And
no, see, firstly, let me say that monetary policy, as I'm mentioning, it is forward-looking. At the point of time when the MPC met last in June, the inflation numbers, even though at that point of time were about 3% or so, right? But forward-looking was 3.7%. So even if you want to give, weightage, again, going back to your question of this real rate of interest or neutral rate of interest, even if you were to give importance to that, which I'm not saying is not relevant at all, of course it is relevant. The difference was about 1.9, it's less than 2%, it's very much, within the band. And neutral, as I've already mentioned, it doesn't mean that we can't, move up, move down. We can certainly, move down. But for that, yes, the outlook has to change. Whether it will go down to 3%, I don't know. We will let you know.
The average of the street is 3.3 now for the full year, FY26.
Yeah, so we'll be coming out with our numbers. You're right, there is an expectation, correctly so, that the inflation will be perhaps, for this year, not 3.7%, but lower than that. That's certainly on the cards.
Okay.
And if that happens, the monetary policy will have a look at it and take a call. I don't want to preempt, what the MPC is going to do, but I'm only emphasizing that we will continue to look, we'll continue to be data dependent and continue to look at the incoming data, and especially, the outlook, and the situation so warrants, we can move either ways, which can, even be downwards.
Okay. Well, sir, that's on the rate cut. Let me come to the VRRR, the liquidity issue. Now, when you do, what are the triggers you look at when you take the VRRR action? Do you want to only impact the call rate and ensure that the call rate is at least above SDF 5/4 to 5.5 range? Or do you want the TREPS market, which is, a very big interbank market where even mutual funds participate? 90% of the overnight exchange of money happens in the TREPS market. So will you target that also and want it to come to 5/4, or only you look at call rate?
See, the operating target for the monetary policy is very, very clear, which is the call money rate. And so we are looking only at that. We are not looking at the TREPS rate or the market repo rate or the collateralized money market rates. That's certainly not something that we are targeting. Of course, we look at it. I may also mention to you over here that these are although they are very, very different markets, because one of them is collateralized, other is non-collateralized, the other has, the participants are very, very different, right? Over here it's mostly in the non-collateralized market, it's the banks and the primary dealers, whereas over there you have the mutual funds, you have the insurers, provident funds, etc., etc. So they are very, very, although their composition is very, very different, they move in tandem. And we did an analysis. The coefficient of correlation between the two, both call money market rate and your market repo, 0.98. 0.98 is very, very high. Any economist will know that. And similarly, the TREPS rate and the call money rate is 0.98. Both of them. One is 0.977, the other is 0.983 for the last 1 year.
Yeah.
So they are very highly correlated. They move in tandem if we target. So it's really not material so much, I would say.
Okay.
If you target one, the other gets targeted on its own.
Okay.
And it's not true, only for the non-collateralized market, even for the CP, CD, Treasury, and so on, the whole spectrum of the money market. So that's how, we are looking at
which rate to target, which is your
target,
call.
yes.
Which is your call rate. Okay. So what will be the triggers you will watch out for to align the call rate to the repo rate? as you said in the Business Standard interview, there have been many times when the call rate is below the repo rate when you want transmission. What will be the triggers you will look at to align overnight rate with repo rate?
No, as you have mentioned, the target for us is certainly the call money rate. It has to be certainly, within the corridor, which at present is 5/4 to 5/3. And while we would like it to be, at the policy rate, in times of transmission, and transmission is happening. I mean, I'm happy to note, I reviewed the figures recently, and I would like to inform you, transmission is happening well. On new loans, there is a 24 basis points of transmission already till May. We have data only till May, which means only 3 months. In 3 months, since we did the first policy cut on fresh loans, we have a transmission of 24 basis points. On outstandings, we have a transmission of about 16 basis points. So that's quite good. So we'll keep balancing, our need for transmission and, of course, our target, how to align it. We already did, VRRR starting end of June, you are aware. It has brought up the call money market rate as I speak. Morning, it was 544, so it's quite close.
Yes.
Friday it closed at 545. And so our effort will be to, while, maintaining it as close as possible to the policy rate, it should also help us in the transmission.
Okay, it should help you.
These are the two factors which will continue to guide us.
Okay, no, it's fair that transmission is a very important instrument, and you have the freedom from 5/4 to 575. But would you say we are still in early stages transmission?
Yes, of course, because see, when I said May, I have figures till May. That's only 3 months, and in June, we cut by 50 basis points. So there's a long journey, yet. 100 basis points. As against 100 basis points, it's still, I do not have the figures for June, but till May it was 24 basis points. My sense is that it has, of course, improved, but there is still distance for us to cover over there.
Just a final question on this repo call rate thing. When will the liquidity framework be published? Because the market is very anxious as to what
there is an internal working group which was constituted. They have had extensive consultations with various stakeholders, banks, economists, etc., etc. There are multiple views, as with multiple stakeholders with divergent interests, which is.
So when does it come out, do you think?
As I mentioned to you, it's not such a major issue.
Okay. No, I'll tell you why.
As I said, it's not a major issue because, as I mentioned to you, the call money, one of the important issues that this internal working group is actually deliberating upon is that what should be the operating target.
Yes.
As I mentioned to you, they move in tandem. They are very, very highly correlated. So that's really not a major issue, even though, as you are saying, the volumes are less, but the impact is, throughout the spectrum. So that's not, the report should be out, by the, I think, by the end of this month, we should have the report out. I do not expect major changes. We are trying, of course, to increase volumes in the call money market. We extended, the times for the markets.
Yes.
Made some improvement. We'll see how, we can further improve these markets. Let me emphasize that these are two different segments with two very different regulatory regimes. Some of them, we don't even regulate. And so, we need to keep that in mind when these questions are actually
in many cases, as you say, the coefficient correlation is very high.
Yes.
Now let me come to the other big announcement you made on CRR, the big CRR cut. What is the trigger? Was it that our current account deficit is now under 1%, so we won't need so much money for intervention like we needed during Lehman crisis and all that? Or is it more because there is a lot of LCR? What's the trigger?
See, first of all, it's not a prudential tool. So LCR, is more of a prudential tool, right? It's not a liquidity tool. It's a liquidity tool for the banks.
Yes.
Not a liquidity tool for the system as a whole. You understand that, and so would your viewers. So it's more, of a monetary policy tool for the liquidity management of the system. Now you are aware, it used to be very high, 15% and all. 2006, we had this amendment in the Act. It's now, and then, later on it was brought down in 2013 to 3%, to 4%, sorry. Earlier we used to give an interest. And post the amendment, there is no interest. Interest has a bearing, because if you pay in interest, then you can have a higher CRR. The effectiveness of the CRR, however, decreases if you have the payment of an interest. And so that's why gradually, post 2006, it was brought down to 4%. 2013 to 2025, we have decreased it a few times, but never below 3%. So we have used only
very sparingly.
Not only very sparingly, the amount is only 1%. The ammunition that we have is 4%. We can pass on, 4%.
Yeah.
I can always withdraw as much as I want, from 4% to 5, 6, and there is no ceiling. But the amount that I can give, because I can't go in a negative zone,
yes,
and start, which also I can, in fact, I can start giving money, right? So I can go in a negative zone, but assuming that, I don't go into a negative terrain, I have the 4% cushion, which last 12, 13 years, including COVID, we have used only 1%. So, and it has a cost, as you are aware, it has a cost, and the cost is not only on the bank intermediaries, it gets passed on to the depositors and to your borrowers. And so, while, we have provided this certainty, you can always ask us, as to why we did it now. If we had to actually implement it from September onwards, why we did it now. But that was only, as we have been saying, we have been preemptive, we have been, so that, it gives us, in these uncertain times, to our banks, a little more certainty to plan things out. And so, that is the new kind of a normal, that I was talking about earlier.
ownership of banks. You said that there is a review. Personally, what is your opinion? Would you want at some point conglomerates also to have banking licenses?
This is a very, very old question. This is a very...
It doesn't go out of fashion, sir.
Yeah.
Or out of the desires of conglomerates.
Yeah, so I think this question primarily comes from the fact that some of the corporate groups, they have deep pockets. And the banking industry, at the same time, needs capital, whether it is the existing banks or whether it is, the new banks. So that's certainly, a valid question. But at the same time, let's also keep in mind that conducting business, financial business, and real economic activities within the same group has a conflict of interest. And I would say, that this counter argument is equally valid and equally relevant, even today.
Okay, you were talking about that you will review bank ownership rules more in the instance of...
Yes, we are, of course, reviewing it and seeing, as to what can be the other ways, means to raise capital, who can be other participants, because you have the small finance banks, you have the payment banks, you have the cooperative banks, how, we can tweak, change some of these, the foreign banks, how, we can make some of the changes so as to be able to attract more capital for the banking industry.
That's why I brought this question, really. Yes. There are two foreign banks wanting to buy stakes in Indian banks. SMBC, the announcement from Yes Bank has already come and they are awaiting your permission. Right. Now, hitherto, RBI had only given permission to foreign banks to cross that 15% when the bank was in trouble, like in Catholic Syrian's case or in Lakshmi Vilas, where, of course, DBS bought the whole bank. Now, Yes Bank, you have the odd situation of State Bank having, its own banking license and owning 24% in Yes Bank. So, RBI probably wants that to end. But in the case of RBL, we understand NBD is very interested. So what is, first of all, have the cases come to you? And more importantly, if you are going to give permission, like even IDBI is apparently, the interested parties all want 26%. So as a rule, will you want to change from 15 to 26?
See, as per the FDI policy, the foreign banks are allowed up to 74%.
Yes.
All right. And the foreign banks can actually start business in our country
100%.
as even up to 100%.
Yes.
So that's even more than 74%.
But they don't want that. They want to get into, established Indian banks.
Yeah, so, Indian promoters are already allowed up to even more than, 26% stake to be brought down to 26% stake within a period of 15 years.
Yeah.
Voting rights, of course, because of the Banking Regulation Act, cannot be, even if the share financial stake is more than 26%, cannot be more than 26%. So even foreign banks can certainly have, 26% stake, economic interest, voting rights. Yeah. There should not be any difficulty in them having, up to 26% stake in a bank, in an Indian bank.
Okay. No, it's just that until now it was only given.
They have not come. So we have not, your question as to whether some cases have come to us for having 26%, they have not. But if they come, we will certainly, we are already reviewing the policy, as you are saying. There is some kind of, clarity is not there, some ambiguity is there, as you are saying. No, we'll try to bring in, these clarifications and bring clarity in these guidelines.
Okay. And no, until now at 15%, it was kind of a hard stop. And case by case, Reserve Bank was allowing. So I'm just asking if that 15% hard stop.
As I mentioned to you, for foreign banks, they can go up to 100%. Okay. So if you don't allow them even 26%, that kind of seems to defy logic. So we will be okay in allowing them or whether it is on a case-to-case basis, whether it is as a general matter of policy, these are matters of detail which we'll work out.
Fine. Now let me come to small finance banks, which you already alluded to. You have eased the priority sector requirements from the earlier 60% to 40, from 75 to 60%. Will you see more reason to ease the rules further?
Yeah, we change. See, small finance banks can actually transition to the universal banks. And so this change that we did was primarily because the PSL targets requirements for universal banks at 40% was a huge difference. And so that would certainly, have impeded their diversification and their transition into universal banks. We consider the small finance banks as nurseries for universal banks. And it will certainly be our endeavor to provide them the right climate, the right regulatory regime, so that they not only grow as small finance banks, but they graduate into universal banks. Our regulations are not fixed in time. They are not frozen in time.
Yeah.
We keep evolving. We keep changing with the times. We have come out with you are aware, with a regulation making framework where we have said that we'll be reviewing each and every regulation every 5 to 7 years.
Yes.
Of course, we do it continuously, but as a practice, every 5 to 7 years, each and every regulation, so that we are aligned, with the times. So that is something which is applicable even for the small finance
banks as well. Okay, more generally, if you look at banks, they have a lot of, obligations. They have SLR obligations or LCR obligations. They have PSL, a priority sector, and then they have CRR, which was all okay. All this is a cost to the banks, which was okay when they were the king of all the savings. My father saved only in FDs, and perhaps that would be true of your father. But increasingly, mutual funds have become far more attractive for the savers. So will you consider even more of the constraints on banks need to be removed, giving them more of a commercial chance?
No, see, as I mentioned to you,
you removed CRR by 1 percentage point. But
not only CRR, we also changed priority sector lending guidelines that will help them. And over a period of time, changes have happened for the whole regulated space, not only banks, even the NBFCs, etc. All these, as you are mentioning, they have a purpose. It's not, that they are not without a purpose.
No, they all have it.
They all have a purpose,
Either prudential or...
Either prudential or liquidity or, stability or a socio-economic purpose, like the priority sector loans. But we do recognize, as you are mentioning, that they have also costs at the same time. And as I have, and these are trade-offs. So these trade-offs we have to balance.
Yes.
And we have been doing this. RBI has been, doing this. Yourself mentioned CRR was reduced, LCR, was amended to
tweaked.
Was tweaked. SLR was brought down. It used to be very high, 18%. Now it's only perhaps lost its relevance to an extent. Right?
Yeah, it's become mainstream.
So RBI has been very nimble-footed. We have always kept in mind and tried to balance these trade-offs. As I mentioned, we have now come out with a regulation-making framework. We'll continue to be nimble-footed. We'll continue to assess and analyze the evolving and the changing needs of the economy. I do get your point, that costs on the banks, especially, because these deposits earlier used to be quite high. In fact, last 9 years, from 43% savings, which used to go into the banks, from 43% they have come down to 35%. So that's a change of, in every year, if it is going to reduce almost by 1%, and others, shares, etc., small savings, shares, debentures, mutual funds, they have gained shares. So these are certainly to be kept in mind. while, we make our regulations. Our regulations have to be proportionate, to the purpose that is there, and we will continue to do so. As I mentioned, we are now, first of all, consolidating all our regulations. We came out with a Citizens Charter. We revised the Citizens Charter. Of course, not much was mentioned about it, and we also, didn't publicize it too much, but we have revised our Citizens Charter. We are now consolidating all our regulations. There are some thousands of regulations. We are consolidating into a few regulations so that all of them are in place. And more importantly, we will be reviewing all our regulations so that we are able to provide to all our regulated entities, not only the banks, but also the NBFCs and other payment banks, payment system operators, all our regulated entities, a competitive, so that they are competitive.
No, I'll tell you, more than competition, because the banks are seeing a fall in term deposits. That kind of money is going to mutual funds. They are hesitating for long-term investments altogether. I mean, it's not that too many infra projects have come, but they will be unable or unwilling because of the ALM mismatch, and they will become only retail lenders. Many of them have become increasingly retail. Is that a problem for you, or, the infrastructure will be financed by PFC, REC, NABFID, etc., and you're okay with banks becoming retail lenders only, largely?
No. See, infrastructure is certainly a priority. For the government and for the Reserve Bank, our country needs more and more of infrastructure. We are still, in a phase of development, and infrastructure is the foundation on which any economic activity can be done. So that's very important. We will certainly like that the banks continue to do infrastructure lending. The government has increased its resources for capex.
Yes.
And so would we like. I think over the last few years, infrastructure spending by banks has increased.
It's not much, sir. It's like, most of them have become retail banks. So
you are right that the share of retail has increased. Certainly, you are correct. The share of retail has increased. The point I was making is that infrastructure has also increased, maybe not in same proportion.
Aggregate.
But that you see even in large industrial loans, that has there is a lower growth of bank credit, about 5%, and similarly, infrastructure is also about 5%. Now, one of the reasons is, of course, that there have now, alternative means of funding them. We have now the InvITs. So some of it is being funded by the InvITs. We came up, with a development financial institution primarily for infrastructures. We have the NABFID, corporate bonds. Again, they are also gaining traction.
Yes.
So, and banks are also contributing. We have taken a number of steps. You are aware, infrastructure bonds can be raised, for infrastructure. Project finance, again, we have harmonized, the project financing guidelines, and we'll continue to push infrastructure.
No, it's just that because of the ALM, because you're getting short-term money, we are preferring retail. That's why I asked you. Let me come to the final growth picture that you have. The e-way bills have dropped a bit. GST collections in May was excellent. June was unimpressive. Car sales are unimpressive. And the global uncertainty is not going away at all, if anything, compounding. Would you worry about growth at this juncture? Is this 6.5 also possible?
Well, that's 6.5, is our latest number. Yes, there are mixed signals, high frequency indicators, more or less, they are aligned with our projections. We'll again, revise them in case needed. We will again reassess them, review them for our monetary policy, which is due in another 15-20 days. Urban, yes, you're right. Air traffic is subdued. Passenger cars are again, that is subdued. FMCG sales, of course, are doing well in the urban areas as well. There is robust growth of consumption in rural areas.
Yes.
Monsoon is favorable. We are hopeful of, a good trade deal. Hopefully, that's in the final stages. Let's see. Let's keep our fingers crossed over there. There is good optimism that we see in our surveys of consumer surveys that we see. We'll again reassess the situation on the growth front going forward.
Well, just two topical topics, brief ones. The finance minister, while speaking to NBFC, said that she wants them to become, 50% partners in funding by 2030 or so. But, RBI's upper level compliance for NBFCs is fairly rigorous. And maybe with good reason. I mean, when you're upper tier, you're like, prominent. Will you all do anything for them, considering that the finance minister wants them to have a much bigger role?
We would like everyone to have a bigger role. And whatever is needed for, as I mentioned even earlier, not only for the banks, but also for the NBFCs, payment system operators, and so on and so forth, for all of them, and even for the economy, even those which we don't regulate.
Yeah.
The overall objective is that India grows. We are at a critical juncture, Viksit Bharat by 2047, and we'll play our role, whatever is required, keeping in mind the aspirational goals of India, and not only of the banks or the NBFCs, but everyone.
Just the final question is, because there is this law that is sitting in front of the US House of Representatives, crypto law, in fact, they're calling it crypto.
I think it got passed recently.
Yeah. So I was just wondering if in the Reserve Bank, any chatter on this. Reserve Bank was opposed to it, and I thought with very good reason. But
see,
when you re-look, because the world is moving.
There is, I would not like to talk about it, because there is a group already constituted by the Government of India, headed by the Secretary. We are also represented over there. We have given our views. It has implications for monetary policy and financial stability, as we have already mentioned. I may also mention, see, that the landscape here for payments in India is very, very different.
Yes.
A lot of the issues which are there in some of the other economies, we have been able to resolve, because we have the UPI, we have the NEFT, we have the RTGS. The problem is basically for small payments, costs of small payments in these other countries and cross-border payments are high. We have been able to resolve it. So let's wait, for the final recommendations of the working group.
Okay, thank you very much, Governor, for your time. I just wanted to ask you one personal question. You landed in at a time when things were quite tense for the economy. I mean, the election in the US had made things a little difficult for the economy, uncertain for the economy. What was your learning curve as a central banker? I mean, usually when you come as a DEA secretary and then you already had one foot in. But you came, Revenue Secretary is not part of the board. So what was your learning curve like?
No, first of all, it's an honor, to be here. It's a challenging one, as you are saying, but at the same time, it's an honor. It's a very revered institution, and so it's a prestigious for me, to be heading this organization. We have a good, very good professional team. We in the IAS, of course, you are aware, we move. Yes. We move, from sector to sector, which are very, very diverse. And
no,
so
I would argue that is useful as a governor, because you all have seen a large part of the economy. But in 6 months to learn so much.
So that's the point I'm making, that when we move, I'm not saying, because we move, so we have a lot of experience. The point I was making is that because we move from one sector to another sector, there is always, a learning curve over there. Some will have a steep learning curve, some will have less learning curve. So without naming, sectors which had a steeper learning curve, but so that gives you, that kind of experience, to how to handle, and how to learn going into a new organization. Having said that, of course, I've had experience, I was the banking secretary for some time. I've headed an NBFC, one of the largest NBFCs in the country. That helped me. My course, in Princeton I did a monetary policy course there with Alan Blinder over there, so that helped me. And we have a very good team over here, which supports us. I am hopeful, that I'll be able to do my bit in these challenging times.
Okay, if Alan Blinder was a teacher, then you've already been coached very well in the theoretical foundations. Thank you very much,
my pleasure,
Governor, for spending time with us, and I'm sure you've answered a lot of queries that economy and the markets had. Thank you very much for your time.
Thank you. It's been my pleasure.
Tesla is finally here in this 4,000 square feet space in Maker Maxity Mall, BKC, Mumbai. They've only launched the Model Y for now, and this is the car that is available. Now, with a $37,000 price tag in the US, you have to add a 70% duty in India. That takes up the price of this car to 61 lakhs for the rear-wheel drive version and to 69 lakhs for the long-range version. Now, what do you get in terms of performance? In terms of range first, the car can go up to 500 kilometers with the rear-wheel drive version and 622 kilometers with the long-range version. In terms of speed, the top speed of the Model Y is 200 kilometers per hour. It can go from 0 to 100 in 5.6 or 5.9 seconds.
We are hiring. You have seen it. We are hiring. So we will local team. Yeah, we are doing. India has so much incredible talents. Yeah, so we don't need talents. We have many talents locally. So we're going to hire local.
We're inside the Tesla Model Y right now. One of the highlights is this 15.4-inch screen that you get with this car. The seating is ventilated. You've got climate control settings inside the vehicle. You've got entertainment settings. And Tesla has its own audio system. You've got double LED acoustic glass that you've got all over with this Tesla. Let's move on to the second row to find out more about this vehicle. Well, now I'm in the second row of the Tesla Model Y electric SUV. Over here too, there is a 8-inch screen for the passengers sitting in this row. So if they want to control the temperature within the car, entertainment or lighting, all of that can be done with the touch of this screen.
Every purchase, limited offer, every Tesla order will come with a wall connector. You can install at your workplace, your home. We enable charging.
Tesla has announced that there will be 4 charging centers in both Delhi and Mumbai. They'll install 16 superchargers and 16 destination chargers in each city. Now, every Tesla customer who buys the Model Y will get this home charger for free. You can install it on the wall of your garage and you can charge your car overnight. There will be superchargers only in specific locations in Mumbai and in Delhi, and these can charge your car up to 250 kilometers in about 15 minutes or so. The pricing for charging your cars with the help of the supercharger will be announced by Tesla in the weeks to come. We spent about 2 hours in the Tesla showroom speaking to the Tesla management. Clearly, there is a lot of excitement about the Model Y launch here in India. The company has brought all the latest features and charging options to the India market. But the full self-driving function is not available just as yet. The company would like to test it further on Indian roads before offering it to the customer. For the moment, the car is coming at a very hefty price tag because of the duty structure. The company would be hoping that India would soon have an FTA with the European Union and a trade deal with the United States, which will bring down the tariffs to possibly 10%. And that would make it much easier for Tesla to sell cars in India. With video journalist Bharat Khori in BKC from outside the Tesla showroom here in Mumbai, this is Parikshit Luthra.
and welcome to Startup Street. I'm Shruti Mishra, and with me are Arundhati Ramanan and Ritu Singh. These are the top headlines from the startup space. WeWork India, a flexible workspace provider, has secured SEBI's approval for its IPO, consisting entirely of an offer for sale of up to 43.75 million equity shares. The promoter, Embassy Buildicon LLP and investor One A Railway Tenant Limited, plan to offload significant portions of their holdings.
Artificial intelligence firm Fractal Analytics has secured $172 million through a secondary share sale as the company gears up for a public listing as per reports. The deal values the AI analytics firm at $2.44 billion.
1, 2, 3.
Tesla drives into India. Showroom is now open in Mumbai. The Model Y will be available at a starting price of 60 lakh rupees. The cars are currently being imported from the company's Shanghai factory.
The conclusion that happened was the registration and registration numbers mismatch in February or March. And I think in our Q4 results, we actually clarified that with a proper walk of how the numbers stacked up.
Clarification on vehicle registration data was issued in the fourth quarter, says Ola Electric Chairman Bhavish Agarwal. Adds the issue with authorities in Maharashtra is being looked into. Just yesterday, the company had released its first quarter numbers, while losses narrowed. Revenue improved on the back of successful Gen 3 scooter launches.
LinkedIn has agreed to make temporary changes to its contracting practices to settle a lawsuit by US users who claimed it schemed to prevent potential rivals from entering the market. Microsoft was not a defendant. LinkedIn denied any wrongdoing.
Those were the headlines that we're tracking for you this evening on What's Brewing Today. PE firm Chris Capital is set to acquire 90% stake in Theobroma Foods for 2,410 crore rupees as per sources. Now, the founding family will only retain 10% stake in the bakery chain. Rachna Dhanrajani joins us now to tell us more about this deal. Rachna, what are your sources telling you?
India's beloved brownie brand just got a big bite of the private equity funding. As we are learning from our sources is that Chris Capital has got a 90% stake in Theobroma Foods. Now they're buying it from ICICI Ventures, who had invested in Theobroma back in 2017. But they're also buying some stake from the promoter family. However, despite the deal going forward, the promoter family will continue to hold about 10% in the company. Now the deal is valued at about 2,410 crore rupees, which is at a discount of what we were hearing was the price ask, which was about 3,000 crore rupees when the negotiations started sometime next year, actually a year and a half ago. Now it was started by Tina and Kezan Messman here in Kolaba, and we are actually outside the first Theobroma store in Mumbai. But now the company operates around 200 stores in 30 cities. So clearly this is a big move going forward for Chris Capital and Theobroma at the same time, who will be who has emerged as the front runner in this bid to acquire Theobroma Foods.
Big move indeed. Rachna, thank you very much for bringing us that report. Now, moving on to what's brewing today, employee health benefit platform Plum has announced its foray into the direct healthcare vertical with a 200 crore rupee commitment for Plum Health Checkups, which is a new at-home screening solution. Now, with this investment, Plum is transforming from an insurance company into a full-stack healthcare platform. It now plans to expand its team fivefold to support the shift. For more on what the foray means for the company and how it will boost their growth going ahead, joining me now is Abhishek Poddar, the co-founder and CEO of Plum. Abhishek, welcome to Startup Street. Thanks for your time here. You've committed 200 crores to the healthcare vertical, a large figure. It is a shift from your insurance roots. From a financial lens, what kind of business outcomes are you targeting in the next 2-3 years, and the revenue contribution from this new vertical?
Hi, Ritu. Thank you so much for having me on the show. It's great to come back. Our 200 crore commitment that we have made over the next 5 years, it truly is a bold strategic evolution for Plum, from a single product corporate health insurance platform to a more integrated full stack healthcare company that we want to build. In the next 2 to 3 years, this investment is expected to drive strong triple-digit growth in our healthcare vertical that we have been slowly building over the last year and a half. We actually expect our healthcare to contribute anywhere between 30 to 40% of the total revenue in the next 5 years by 2030. So our healthcare vertical actually has been the fastest growing segment. We have been expanding by 125% year on year with a very healthy gross margin. But what's truly compelling as we have done this over the last year and a half is we saw over 60% of the first-time insurance buyers were simultaneously opting for healthcare for their team in addition to insurance. That means there was a latent demand for comprehensive healthcare plan for their employees. For every 100 rupees that an employer would invest, they would see an average of 296 rupees in employee healthcare savings. So this creates a virtuous cycle of adoption and recurring revenue for Plum, but also a very clear, very measurable ROI for the customers that we are partnering with.
Well, that's a significant contribution that you're talking about from this new vertical. How will your revenue model itself evolve? I mean, will these healthcare services like checkups, etc., are they going to become direct revenue drivers, or will they be primarily used for acquisition or retention?
So they are going to be direct revenue drivers for us. Our revenue model is evolving beyond just a transactional insurance to create a more holistic healthcare ecosystem. So our revenue stream so far hinged mainly on insurance premiums that we provided through group coverage. Now what we are doing is we are layering in this recurring revenue that comes from preventive care, such as the annual preventive health checkups that we launched, telehealth consultations, OPD wallets, and this transition is really designed to move the employer spending from just a reactive payout that happens via insurance to a more proactive health management for the employee and the employer.
Got that. But Abhishek, this is a large investment. You're talking about 200 crores. How will it impact your profitability? And also, how immediately will you have to go for another round of funding? And will you be on track for sustainable margins in the next 2 years or so?
So just a bit of background. So we as an organization have actually been profitable at both EBITDA and cash flow level for the last 2 quarters. So our investments into healthcare is a very disciplined, a very high confidence investment that we are making to actually accelerate our growth in both top line and bottom line that we generate. Our investment is going to come primarily from the existing cash flow reserves that we have and the profit that we have started to generate from the core business of group health insurance. But that said, because you was asked specifically around funding, so like any fast growing company at our stage, we are always open to further capital infusion, especially if it is helping us accelerate that mission that we have to impact the health of 10 million lives.
All right. There are several health tech startups in India that offer these kind of preventive solutions. What will be your edge, especially now as you straddle both insurance and healthcare services under the same umbrella?
Yeah, I think our advantage really is building this single unified platform that is very seamlessly blending insurance with a more personalized healthcare. So unlike a legacy broker or a single product player that exists in the market, our approach is one, how do we integrate this financial protection with a preventive engagement, employees receiving regular checkups, teleconsultations, diagnostics, mental wellness support, wellness perks under one roof. Number 2, we are leveraging AI a lot, especially for personalized risk assessment. Think of customized health reports. Think of actionable insights that it can generate for the individuals. Number 3, we are also building a nationwide access. So whenever we launch health checkups, it is available India-wide through our 4,000 plus partner locations, and it is very digital first management. And lastly, we are very focused on outcomes. It's not just transactions. Our data, in fact, tracks the employee health risk over a long time period and really helps them improve the actual health of that individual. So it's going from a transaction to a very impact-driven platform that we have built.
Abhishek, quickly, I know you're focused on health outcomes, but the outcomes your investors are looking at, revenue and profitability. What are the targets for the next year or so? And secondly, what next for Plum in terms of any other white spaces you're looking to fill in your overall offerings?
No, absolutely. So over the past 5 years, we have truly become the health partner of choice for the India's most forward-thinking tech companies. Think of companies like Zomato, Swiggy, Zerodha, as well as the trusted ally for all the founders who are even starting their company, even a 5 or a 10 people company. We have become that partner of choice. For us, the next natural step in our growth is bringing the same tech-driven, very integrated healthcare approach to the more traditional enterprises. Right now, we have experienced how to provide this to 6,000 plus organizations. Our track record has demonstrated that reliability and scale. Now we want to leverage this experience to really challenge the legacy insurance brokers. This market of employee health insurance, employee health benefits is over a 100,000 crore market in India. Our goal for the next 5 years is how do we get to that 10% of the market, right? And the 10% of the market is a huge premium. That means Plum managing over 10,000 crores in premium, right? So that is the kind of goal. It's ambitious, but that's the kind of goal that we have taken. So that's more on the top line. We continue to build this business in a very sustainable way. We want to continue to be EBITDA profitable. But we want to do all of this while staying very close to that vision of how do we drive healthcare impact.
Got that, Abhishek. That's all the time we had. But thanks very much for joining us here today. And we wish you the best and wait to hear more on what Plum does. Thank you
so much.
All right. Also on What's Brewing, B2B commerce company Moglix is making a big infrastructure push with the launch of its greenfield bitumen processing facility under DRG Industries in Mathura. With carbon-neutral heating, automated lines and an in-house R&D center, the plant is a strategic move to support India's road-building ambitions with future-ready sustainable materials. Backed by Tiger Global, Axel and Alphawave Global, Moglix is currently valued at $2.6 billion. And to talk to us about the road ahead, joining me now is its founder and CEO, Rahul Garg. Rahul, welcome back to Startup Street. Moglix has just inaugurated its greenfield bitumen processing facility under DRG Industries in Kosikala in Mathura. What's the strategic vision behind this foray into the energy and infrastructure space? And given that it is not just a manufacturing site, but includes an in-house R&D center, how critical is indigenous innovation to your long-term strategy?
So firstly, thank you for having us. I think it is always exciting. As Moglix, we started with the simple ambition that we want to partner with Indian manufacturing sector, Indian infrastructure sector, and really enable creating of a Viksit Bharat. And I think as we went through the infrastructure journey, we realized that many of the supply ecosystem is completely broken. Take, for example, I mean, we're starting to have the monsoon season, right? So
yes.
We will soon, I think few months later, we'll find all the potholes in the...
We're already seeing that, Rahul, already seeing that.
So I think, and I grew up in and around NCR to say that we used to have a joke that after every monsoon, you're back to square one of building the roads, right? So
yes.
I think we started to look at that problem and we said, now some of it is a supply side problem. If you don't put high quality material into construction of these roads, you're eventually going to land up with this solution. So therefore, there are two initiatives actually that happened. One, we realized that India needs to move towards value-added bitumen. In technical terms, people call it polymer modified bitumen. People use emulsions. And these products, which are in the Western world, are almost 70% of the roads are constructed using this material. In India, that number is 9%. So unless we use the right kind of material, we are not going to create reliable roads, and we will not get rid of the fact that there will be all these safety concerns, and you will start to see some crazy stuff happening in another city, Gurgaon.
Okay.
So that's the first initiative that we started. And then it is very important, this plant is having the R&D because it is bringing the best in class. What is the right way to mix many of these chemicals to construct the road? What is the innovation that, and it will become probably the best R&D center as well as the best manufacturing plant for value-added products in the future.
All right. You know, you've described roads as the veins of Viksit Bharat, and you mentioned microsurfacing emulsions and polymer modified bitumen, that they are some of the innovations that Moglix is betting on to make Indian roads stronger and last longer. But you also claim the plant uses carbon neutral boilers and sustainable heating. So Rahul, tell us, how central is ESG play to Moglix's manufacturing roadmap, especially with future facilities like this one?
Yeah, we think it is very important that these are downstream petro products, but in this processing also there is energy being consumed. And how do you make these plants more efficient? So this plant will use 44% less energy as opposed to any plant doing the bitumen processing.
Okay.
And I think that is very, very important because India needs energy efficient manufacturing all around for the future.
All right. Rahul, you've already invested 200 crore rupees in M&A over the last 2 years, including the acquisition of Khatema Fibers. What's the larger play behind these deals, particularly in traditional manufacturing? And with 500 to 600 crore rupees earmarked for FY26, where do you see your next big bets? Is sustainable packaging one of them?
So we are taking multiple bets because we deal in 150 plus categories of products.
Yeah.
We realize that there are at least maybe 50 categories where the manufacturing is not of high quality or there are brands that do not exist. Unlike, like electricals, we would know a lot of brands existing, but many categories like bitumen packaging, we do not have brands in the country. And therefore, we continue to look at both greenfield as well as acquisitive approach on this. I would say acquisitive is very unpredictable in India because there are many diligence related issues. So we are continuously looking at how can we create at least 2 to 3 manufacturing plants, if not more, in a greenfield manner every year.
All right. Let's go to packaging, which is one of your top 10 categories and is already nearing 500 crore rupees. You expect it to be 1,000 crore rupee vertical soon. What's driving that growth and how are you planning to scale it?
So we see packaging being used in daily lives of consumer. And what may seem like probably 10 years back, you would not care about the packaging, but how you brand products, how you deliver products, all of that requires packaging. And with food delivery, e-commerce delivery, FMCG companies becoming innovative on packaging, it's a category which is bound to grow. And we see over the next 12 to 24 months, we should be able to scale this category significantly and continue to become leader in the space. We are already leaders as an online player, but online plus offline together.
All right. Moglix clocked nearly 5,000 crore rupees in revenue in FY24, and you've significantly narrowed your losses. What were the key levers, Rahul, that drove this financial turnaround?
So we believe that there's mantra at Moglix is speed, scale, and profit. So as you scale, profit automatically improves. So that is the operating leverage that we are driving. As well as I think at every point you reset the company towards a more leaner structure. So I think both of these approaches have continued to make us more and more closer to profitability. We should be crossing it sometime this year and continue our journey from there.
All right, finally, my last question. An IPO is on the cards within the next 2 years, you say. When do you plan to begin conversations with investment bankers, and will that kick off by the end of this year?
So we are a Singapore holding company. We are in the process of determining how do we switch back to India, and that has regulatory aspects. So I wouldn't say that we can truly predict the timeline, but we are working on how do we flip back to India, and then we'll start those conversations. But yeah, we do hope to go live in the next 2 years.
All right. On that note, it's time for me to wrap up our conversation. Many thanks, Rahul, for joining us on Startup Street today, and wish you the very best for all your aggressive growth plans.
Yeah. Thanks a lot for having us again.
On that note, it is time for us to head into a short break. But coming up next, villa rental platform Stay Vista bags 40 crore rupees in a Series B round. Will use the funds to expand its offerings, enter new geographies, and a whole lot more. We put the firm's founder on the hot seat to find out more. Stay tuned. Welcome back. You're still with us on Startup Street. India's appetite for luxury travel is evolving, and one startup is riding the wave. Stay Vista, the luxury villa rental platform, has raised over 40 crore rupees in a fresh Series B funding round led by JSW Ventures, with continued support from DSG Consumer Partners and Capri Global. With over 1,000 high-end homes across 100+ destinations and more than 1 million guests served, Stay Vista is now doubling down on expansion, tech innovation, and premium guest experiences. As India's $22 billion villa rental market surges, Stay Vista is eyeing a much larger slice of the pie. Joining me now to discuss this further is Pranav Maheshwari, the co-founder of Stay Vista. Pranav, thank you so much for joining us here in the studio. It's great to have you here with us in person. You know, like I said, you're a luxury villa and homestay rental startup. You have both sort of a B2C and a B2B business, right? If you can sort of elaborate on what led you on this journey, what you have on offer, and if you can sort of tell us what was the gap that you saw that you were trying to solve for?
Yeah, sure. Thank you for having me over here first. So we are a marketplace or platform, a very curated platform, and the focus is to build a brand in the homes segment. In India, we have more than 1 lakh of homes. These are high luxury homes across the country. Most of these homes are second homes, and they're not very frequently used by the primary homeowners. So the primary insight was, as an Indian, as a society, over the decades, if you see, we used to earlier stay joint and travel nuclear. Over the period of time, last couple of decades, now we are staying nuclear and want to travel joint.
Right.
So people want to spend a lot more time together, create great experiences around that, and our properties are fantastic for that. So it's a home. You step out of your home, go to a drivable distance across any part of the country. We have most of our properties about 2 to 4 hours in driving distances. You can step in. It's a fully serviced model. We have homeowners on one side. So homeowners provide us these homes. These are beautiful assets. They can use their own home for a few nights in the year. Otherwise, we are managing them, renting it out. For them, the maintenance takes care. And we have consumers on the other side. They enter into home without worrying about any standards, and the quality is assured. So it's a fully serviced end-to-end, taking into consideration all the needs, personalized, privacy, as well as great experiences.
Absolutely. And you know, you've raised a little over $4 million in this Series B round, right? You have quite a few plans with the money that you've raised and the funds that you've raised. If you could sort of take us through what's on top of the agenda, where will the money go to begin with?
Yes. So how we build this business is very sustainably. To build today the business, we spend about 30 crores to build almost a 250 crore business today. The new money which we've raised, the company is profitable. We are market leadership position in this segment. The new money is towards focusing in terms of building on a technology to drive more efficiencies, to creating a better bottom line, enter into new geographies and new verticals. So we've just launched Vista Residences in cities. These are premium service apartments catering to corporates over there. And the other focus is to ensure that how do we keep building on a guest service and experience level. So we are creating a training and development school. Right. So we directly and indirectly employ almost 3,000 people today. So most of these people do not come from regular hospitality management schools. So we're creating a learning and development center wherein we can keep building and providing them the training, which ensures the guest experience continuously keeps raising up.
Right, and you have like sort of a holistic approach to, you know, what you're servicing for.
Yes.
Stay Vista has scaled to over 1,000 homes across 100+ locations, right? What key operational or tech decisions enabled you to achieve this kind of capital efficient growth? If you could throw some light on what's next and what's the expansion plan, you know, what's the current presence and how many more geographies do you hope to be in?
Yeah. So technology plays a very important role. We are a hospitality first company. However, technology is at the heart of everything. So on the guest side of it, we have our website. Everything is taken care end to end. You can book your meals, predefine your menus. Everything goes over there. On the operation side, everything is driven through apps. We have apps for our villa caretakers, app for our operational teams, and also an app for our home owners. And everything is layered around dynamic pricing and a very personalized kind of an experience. We collect a lot of insights. Most of our guests, almost 70% of them are repeat and referrals. Right. So they've stayed with us some time earlier. We collect those data points. So we exactly know that this person loves his dessert in this manner. And in a group, you can have different people, different generations catering to those needs. So I think that is something very interesting about the model. The expansion plans are big. We want to, over the period of next 5 years, we want to grow it to a 1,000 crore company. And while doing that, we want to ensure that our journey of profitability is not compromised. So we want to continue to build that journey. And in 5 years' time, we want to ensure that we are the trustworthy leading hospitality player in the country. How you have a Taj or a Marriott in the hotel segment, our aspiration is to build a trustworthy brand in the home segment.
Absolutely. And if you could sort of tell us some of, obviously people within India are looking to travel locally as well and look for, properties like this to stay at, like you pointed out. If you could sort of tell us the trends that you're seeing, where are people choosing to go? What are the more, famous locations that people want to go to?
Yeah. So we operate in typically 100 cities. These are all driving distances or taking a one flight distance from where they stay. Few areas which have come up for us, Alibag, Palghar, Sindhudurg, offbeat locations. In Himachal, we are in Kasauli, Chandigarh. We just launched Kashmir last year, which was fantastic for us. We have about 45 homes over there. So largely all leisure travel destinations. And across them, these are most of the homes are a bit offbeat from the primary location or the center point of the city. So these are beautiful properties, great surroundings, an acre of a land parcel. You have a lot of open spaces for creating memories, and a group comes together, the privacy. So those are the kind of homes which we are going after.
Right. And, you did point out that you've turned profitable. Congratulations on that. You had losses last year, but this year you are profitable. If you could sort of, take us through where you hope to end this year, and will you sustain this profitability? What's the plan?
Yeah, absolutely. So principally first, I think we want to build this business sustainably. Over the period of the last 5 years, out of 5 years, 3 years were profitable for us, and we continue that journey forward. The investments, like I said, will be focused towards building in newer geographies and new areas of capability. So we absolutely want to ensure that we continue on this journey of profitability. What kicked in profitability was largely three things. Operational efficiencies through use of technology, which we had made investments over the years. So that started kicking in. With the scale which we are today, we can get those efficiencies. A lot of dynamic pricing and smart pricing algorithms really helped us. And for any brand, repeat and referral business. So almost 70% of the guests are repeat and referral. So for them, we're not acquiring new customers. And it's a network effect which has started playing in. So somewhere that leap curve has started for us. That is what we believe in. And we want to continue in this journey while we keep investing in other places. This year, we should end at about a 250 odd crores of business. And while doing that, we'll be almost 10 crores profit.
Great. And so you want to grow sustainably, and that's the target that you set for yourself. All right, Pranav, thank you so much for taking time out and being here with us on Startup Street. And we wish you all the best on this journey going forward.
Thank you so much.
All right, moving on, the UAE India CEPA Council has launched the Startup Series to fast-track 5 top Indian startups into the UAE. The winners will get full support, mentorship, workspace licenses, as well as residency. 20 finalists are going to pitch to a high-level panel, and the move comes as bilateral trade hits $83.6 billion, up 15% since CEPA began. My colleague Ishwarya Anand spoke to the UAE ambassador Abdul Nasir Al Shali at the launch. Take a look.
Could you elaborate on the broader goals of the UAE India Startup Series? What long-term outcomes are you expecting to come out of this?
To contribute to the non-oil bilateral trade as well as the overall bilateral trade, to contribute to the investments between the two countries. We do see startups as an instrumental part of this relationship, and the way this relationship is going to be driven forward when it comes to the numbers that we're targeting, and even higher than those numbers.
So talking about the numbers that you're targeting, how many startups are you looking to onboard via this program? And, what kind of support will they be receiving?
So the first part of the question, you should ask me once we have concluded the startup series, because there will be 3 different stages. They'll have to submit their pitches. Those pitches will be screened and evaluated, and then they will be coming in person to basically present those pitches. Once they are successful, then they will be basically connected with different entities, different parts of the UAE, where they will be supported when it comes to getting their business license or trading license, getting to understand the regulations, the laws, what do they need to do, what do they need to apply for to be able to operate in the UAE. If they need financing or if they need capital, this also can be done and can be worked out.
Okay. Are there going to be certain metrics in place via which you'll be looking at accepting the applications and who to onboard?
We are looking for interesting startups. We have had a lot of successful stories, Ultrahuman, Ola, Policy, Bazaar, Purple, and other kind of businesses where UAE investors have actually put money into them.
Okay. I also want to understand from you that what are some of the strategic sectors that you're very bullish on when it comes to the India market and something that you'd be looking at very closely?
We're targeting all sectors, and we want all sectors. So there's no limit when it comes to what kind of sectors they should be from, the startups. For example, the companies that I mentioned, they operate in different sectors, and it doesn't mean that one of them is a strategic sector and the other one is not. We're targeting all sectors. Now, if we do get startups that are in certain strategic sectors that are important for both countries, maybe that will be a bonus or an addition when it comes to how we evaluate those startups. But to us, and from where I stand and where the team stands at the embassy, we're looking at everyone with the eyes of making sure that they get a fair shot.
Okay. Are there any specific policy incentives and or funding mechanisms that are being developed under SEPA to facilitate joint ventures between UAE and the Indian ecosystem?
So we have spoken to different partners in the UAE. I'm unfortunately not able to share the details now, but the idea is, so we're not just doing it at the embassy level and in India, but we have also presented the idea and presented the details of it to people back home so that they know that this is happening and this is coming. And there's a lot of interest and there's a lot of excitement back home.
Okay. And since signing the SEPA in 2022, how many UAE-based investments have already flown into the Indian startups?
About
a ballpark figure.
$10 billion US, give or take, to different kind of startups. One of them is Purple that I mentioned, and there are other also startups where the money has flown, and they are from different sectors.
Okay, all right. With increasing bilateral trade and technology exchange, how does UAE plan to support Indian startups expanding into the Gulf region?
So we want to make sure that they know the information that they need to know, and that when they come to the UAE is a great place to expand into, because then whatever projects that they're offering, services or whatever, can be tested on hundreds of nationalities. And once you have done that, it will become clearer to see, okay, since I have tested this product, it works with this nationality, I want to expand in this country next.
One final question, looking ahead, how does UAE envision its role as a global innovation hub, and what role will India, a UAE partnership, play in that?
Well, this partnership is very important, very crucial for us in terms of supporting the UAE's goals as much as the UAE is supporting India's goals. Startups are a very interesting, very exciting chapter. They feed into this relationship. They are important for the future of this relationship when it comes to economics and trade. And this is why there's so much excitement and so much interest in making sure that this is a great success, and hopefully that we will have even future iterations of the same.
And with that, it is a wrap on this edition of Startup Street. More news and updates coming up on the other side. Stay tuned.
and welcome to the Medicine Box. I'm your host, Ekta Batra. Today we are addressing a deeply worrying and increasingly common trend, the rise in sudden cardiac events amongst young Indians. It's no longer rare to hear of someone in their 30s, 40s or early 50s seemingly healthy and active collapsing without warning at the gym, at marathons, at concerts, at home and not getting back up. These aren't just statistics anymore. They're people we know. From Ranjan Das, the 42-year-old CEO of SAP India, to 39-year-old banker Amit Kasat, 40-year-old actor Siddharth Shukla, 41-year-old cardiologist Dr. Gaurav Gandhi, 50-year-old singer KK. From a 19-year-old in Ghaziabad, a 24-year-old constable in Hyderabad, to a 35-year-old gym goer in Himachal. And most recently in Karnataka's Hassan district, 23 people between the ages of 30 and 55 died of heart attacks in just 40 days. What's truly alarming is that in many of these cases, the heart attacks were silent, with little or no warning, no obvious symptoms, and often no prior medical history. Sometimes the collapse happens just weeks or months after a clean bill of health. So what's really going on? Is it chronic stress, lack of sleep, poor lifestyle habits, hidden genetic flaws, post-viral complications, or overexertion unmasking a silent underlying condition? And perhaps the most unsettling question, could this happen to any one of us? In this episode, we break it down. Why are these events happening? What role do supplements, sleep, stress, and unseen genetic vulnerabilities play? And what exactly needs to happen in those crucial seconds or minutes after someone collapses? Because in many cases, CPR and access to an AED can mean the difference between life and death. Joining me are Dr. Ashwin Mehta and Dr. Ashok Seth, two of India's foremost cardiologists, because today we're not just telling stories, we're asking the questions that could save a life. Joining me are Dr. Ashwin Mehta and Dr. Ashok Seth, two of India's foremost cardiologists, because today we're not just telling stories, we're asking the questions that could save a life. Dr. Mehta as well as Dr. Seth, welcome to the show.
Thank you, Ekta.
Well, Dr. Mehta, let's start with you. What is your reading of events where young, seemingly healthy individuals collapse at gyms, marathons, or in environments where they seem to probably be pushed beyond their limits?
This is an enigmatic problem for cardiology fraternity also. The reason is when the coronary arteries get choked up by the deposits of fats and cholesterol and etc., till they are clogged up to 70%, no symptoms occur. So the patients or the normal person, or I might say not even a patient, does not see a need to see a doctor. And even if I do his tests, they may turn out to be completely normal. What happens is when a non-flow limiting obstruction suddenly ruptures due to external or internal stress, the one which is 40% blocked, that block becomes almost 100% in a matter of few minutes or hours. And that produces sudden heart attack. And 33% of the people, sudden cardiac death is the first symptom of heart attack. They don't get a chance to even contact a doctor. That is very enigmatic. So people who put themselves to an exercise or a gym where they're exercising, suddenly the blood pressure and the pulse rate go up. And the rate of rise of pressure in the blood pressure, the combined product, puts so much of stress that the plaque ruptures, a soft plaque ruptures. And what is 40% becomes occlusive to 100% and produces heart attack. That is the problem.
Many of the times, or most of the cases that we hear about, is that the person is at the end of the marathon. The person is at a gym and it's been a very intense workout, or they've been at a concert and it's, a high intense environment also when at a concert. So give us a sense in terms of why exactly it happens towards the end of a certain event, rather than, at the start where the stress is not probably that much.
Exactly, to some extent, Dr. Mehta did explain that.
these people do not know that they have blockages in the arteries of the heart. The blockages in the arteries of the heart do not cause any symptoms till they grow beyond 70%. But extremes of exercise, like heavy weightlifting, like severe running, like even marathon running, or in a constrained and very sweaty atmospheres, a performance to the extreme where the heart rate goes up and the blood pressure goes up will suddenly cause that blockage to rupture and a clot to form on the blockage, suddenly blocking the artery up and creating a heart attack. It's almost like a drain where there was a narrowing but still the water was flowing, and suddenly kachra got stuck on it, and suddenly the flow to our pipes stopped. And that is why that sudden, and when it comes suddenly from a 40-50% blockage to suddenly 100% blockage, then the chances of not just the heart attack does happen, but the chances of it presenting as a cardiac arrest are a lot more. And that is why we say that those who want to go to extreme exercise, to gymming, to long distance running, or to extreme sports, climbing, trekking up the mountains, should always get a checkup done prior to these extreme exercises or sports.
Like it did happen, Ashok and Ekta, both, that a 23-year-old girl who was performing a dance performance on the stage just collapsed and died. But that could be a serious and vigorous exercise.
Yeah.
But that, I think, is one should understand that exercise is meant for fitness. We are not competitive.
Yeah.
We should not be competitive. That's a different ball game. We should not indulge into that. And that, I think, is important. Because you do not know that you have blocks or you don't have. Your doctor does not know that you have blocks or you don't have blocks. So in that situation, one should play safe.
Okay. Well, Dr. Ashok, you know, that's exactly the case. A lot of these marathoners, people who, there are doctors who've collapsed also while running a marathon. So they obviously have had their medical checks and their medical work done. These are CEOs that we're talking about as well. So they have gone through that medical check, but despite that, they've still had an issue in terms of sudden cardiac arrest. So what has gone wrong, or what hasn't been picked up during that medical check, Dr. Ashok?
So here is what we presume that they've had their medical checks. Firstly, a lot of this happens in smokers. Clot formation is a problem which is very high in smokers, especially during severe exercise. And many of these always say, oh, but I've had a checkup, I'm healthy. It depends upon, and then they are smokers. Now, smoking itself is a known risk factor for creating that clotting during severe exercise. So that's my first point. Second, what is the checkup they've had and what's the quality of checkup? A checkup always has to involve not a blood pressure check. So it's not just an ECG, an echocardiogram, a sugar test, and a cholesterol test. If we actually have these are major risk factors on us. And we are then able to control these risk factors in a much better manner, especially if there's a family history of a heart problem in our family. So we must understand that checkups are not expensive checkups. These are common checkups, but we need to know our risk factors. And in that risk factors, we got to control our hypertension, sugars, cholesterol, especially if you've got a family history of sudden cardiac death. We need to have an echocardiogram, which is a simple, straightforward investigation, and an ECG. By the way, it's also more important to understand that smoking is a no-no. A lot of patients come to me and say, I lead a healthy life. I do exercise. I walk daily. I eat well. Look at me. I'm so, health conscious. And then you ask them, what about smoking? Yeah, but I smoke, but that's okay. So I think we've got to understand all this. Finally, I'll also have to say, just like we've talked about, that blockages cannot be picked up by any testing. We can pick up risk factors, but we cannot pick up pre-existing blockages. So those who have a family history of a heart attack, which means any parent having died or having had a heart attack or having sudden death before the age of 60, we emphasize on them more personalized testing, which could even mean doing a calcium score on a CT, or even picking up early blockages on a CT angio, be sure that we can put in preventive factors for them at an early age between 20 and 40 so that they don't get into the same problem as their parents did.
There are a couple of people who have all these tests cleared, right? The ECG, the calcium score, but they still have these events after many years of an exercise regime, which they're still used to. So what happens in those cases? What have they missed there?
So the basic issue is the fundamental cause, irrespective of any amount of risk factors, be it diabetes, smoking, or stress, obesity, abnormal lipids, whatever it may be. The basic fundamental issue, A, presence of a plaque within the coronary artery and the rupture of the plaque suddenly. So the issue comes, can we pick up the plaque? Can we pick up the plaque? Do we know how to treat it? These are the fundamental issues. Now, to pick up the plaque, ordinary non-invasive methods are useless. They can tell you only the function. Are the plaques flow limiting or not flow limiting? Are they there or not there? Is inferred. We do not know. We don't see. There is no non-invasive except CT coronary angio, which to some extent can tell you, yes, there is calcium, there are plaques, be a little more attentive. And even if the CT detects the plaque, at this point of time, how do we treat asymptomatic individuals? The medical science still is not decided about it. Had there been a situation that doing a plasty or a bypass carries a 0% risk and 100% success and it's cured forever, I would do it for everybody.
Yeah.
But that is not the truth. The truth is that the procedures have their own inherent risk, that the disease will progress or not progress, also it's not known. I would say this way, that like what Ashok said, that those individuals, we should weed them out. We should separate them out. That those who are at a high risk of developing coronary disease, acute heart attack, and sudden cardiac death, they should be treated intensively.
Okay.
That's all the message that I can say.
Well, Dr. Ashok, you know, there was a case of a CEO who actually collapsed and was a very regular runner and around early 40s and collapsed one day. But one of the things that stood out was just about 4 to 5 hours of sleep for that person. How critical is sleep for cardiac health and for fitness, or for those who focus on high fitness activities?
Firstly, I must emphasize there is no single factor. It is multifactorial and it is a combination. For example, this CEO, and let's not even talk about individuals, but let's take that example. That CEO, who I don't know as a person who you're talking about, may have been doing all this, but I'm not sure whether he was a smoker, not a smoker, or she was a smoker. Secondly, lack of sleep could be just one of the reflections of many other factors. For example, lack of sleep is an important factor, but also could cause hypertension. He could be under a lot of stress, trying to meet numerous deadlines all the time. So stress comes in as another risk factor. We don't know whether he was a diabetic or not a diabetic, but was there a family history, which none of us would know apart from he himself.
Yeah.
And therefore, yes, let us also add into the two other important things in the recent times, which added on to this multiplicity of risk factors. And that's viral infection, mostly COVID, and secondly, pollution. These two are the most recent factors over the last 6 years to 7 years. We've increased the incidence of heart attacks. Again, like we say, a multiplication factor. So we must understand that when we put a single risk factor, that's not the risk factor. That single risk factor is just a reflection of a person having multiple risk factors and the person was not able to identify those multiple risk factors, which led to a heart attack. By the way, I also want to emphasize that 10% of these sudden cardiac arrests could be a viral infection affecting the heart, which leads to weakening of the heart muscle, which leads to irregular heart beating, And those irregular heart beatings can suddenly present during exercise as well. So
Sure.
there are a 10% usually of other risk factors, say perhaps a young footballer suddenly having a cardiac arrest in the field could have a genetic disorder of a cardiomyopathy, which could have been picked up in an echocardiogram
Yeah.
or genetic testing, but he just couldn't locate that and would have had that.
So, Dr.
We must keep a lot of things in mind and not just one risk factor.
Would you recommend such individuals to exercise the way they do?
Healthy lifestyle should be the way of life. It's not a treatment. It has to be practiced in your day-to-day life as a routine. And I would say that the key point is moderation. I mean, nothing is wrong in taking alcohol. Nothing is wrong in taking sweets once in a while, as long as you are in moderation. And I think the checkup, the health checkup, having established risk factors and having treated them, we must also monitor, are we achieving the targets? Are we achieving the goals? So that I think is very important. My message to people, that those who are at a high risk or even otherwise should get regular checkup done. I would put now the age limit of 25 and above, and therefore control the risk factors. Absence of disease does not, absence of symptoms does not mean absence of disease. That I think is my message.
Okay. What about COVID-19 and cardiac events?
See, people are attributing it to vaccine. That I don't think so is the truth. It's not established. COVID-19 can present as a heart attack during COVID-19 time. There were many patients who came to the hospital exactly simulating heart attack, including ECG changes, turned out to have a normal coronary angiography. So they were not actually the heart attacks of the natural history that we see with the blocks and whatnot. And second thing, those who have an existing disease, it could get precipitated by COVID-19. It happened that way. So this is the way the COVID-19 played its role in posing the problem to heart patients.
Okay. Well, Dr. Seth, what we've noticed is that most of these cases take place with men and rarely with women. Why is that? Is that because they have the estrogen protection?
I would dispel that completely right now on your in your messaging. Women, the biggest cause and the biggest killer in women is heart attacks, cardiovascular diseases, the same as men. It has changed completely. It is 6 times more than any cancer, all cancers put together. And we talk about cancers in women, we talk about breast cancer, we talk about ovarian cancers, take all the prevention, but we've not emphasized to women that the biggest cause at the moment is cardiovascular diseases. So firstly that, and let's dispel that myth around being protected, etc. And the risk factors, by the way, are the same, but there's clear understanding that women have more severe heart disease. When they have heart attacks, their symptoms, by the way, can be totally atypical. It could just be sweating, nausea, vomiting, ghabrahat, and may not be typical. We also know that the ECGs in women are not entirely the same as men. And we also know that women present later because they're more interested, they're really focused towards taking care of the men folk and the family at home. And even when they have heart disease, they tend to take a backward role in that to say, oh, but I'll get my investigations done later. It's just because the sacrifices that they make for the family all the time present later. They have smaller arteries and they don't respond to many treatments as well as men. So why are we emphasizing that? We're emphasizing that because women need to understand that any atypical symptoms in themselves also may present as coronary artery disease, and women need equal checkups as much as men to make sure that the risk factors are well understood and they're well taken under control. I just want to emphasize 2 other important things or 3 other important things which are very clear. And this is going to be very simple for people to understand. Those who have a family history of heart attacks or sudden cardiac arrest in their parents, brothers, or sisters need to start getting every checkup done by the age of 20 which should also include an echocardiogram and a blood test. And this can be done by a cardiologist and is very cheap, inexpensive. Those who are men or women, excuse me, but have risk factors of diabetes or hypertension or raised cholesterol should actually get their checkups done regularly. Otherwise, if they don't have the risk factors, like just like Dr. Mehta said, by the age of 25 onwards, they can get it done every 5 years. One of the important things about those who go for running, there's nothing wrong with people running, cycling for a long duration. Running, fast walking, cycling, swimming are aerobic exercises. Heavy weightlifting, gymming are anaerobic and exercises which are bad for the heart. Those who go into these aerobic exercises anyway, and those who go to gymming should have checkups done by a cardiologist prior to going for extreme exercising in a detailed manner, which the cardiologist would advise related to the extent of their extreme sports. It is so important that they have it done prior by a cardiologist. And finally, women need to present themselves early and understand that they may have atypical symptoms and they are a reflection of coronary artery disease, which is still the biggest killer in women. And finally, even just simple exercise of 200 minutes of brisk walking, what does it transfer to? 5 times of 40 minutes walking can decrease our chances of heart attacks by 25%.
All right, Dr. Mehta, what is it that one needs to do if in case there is a cardiac event? Or let's backtrack a little bit. What are the symptoms that one needs to respond to immediately of their own body if they think that they're having a heart attack?
Well, quite contrary to the popular belief that the heart attack is often associated with severe unbearable chest pain, in reality, the symptoms are very often mild. Discomfort in the chest, heavy weight as though mountains are on my chest, or compression or a constriction of the chest as if there is a tight bandage across my chest, pain sometimes radiating to the jaw or to both the arms, shoulders are common symptoms. Occasionally, rarely, the symptoms could be very mild symptoms, like just simply pain in the jaw. My suggestion is that any unusual symptoms which has not occurred before in the trunk, be it from the jaw to the upper abdomen, should alarm an individual to seek medical help.
Okay. All right. Now, this sudden cardiac event that takes place, how important is CPR and AEDs at that point in time?
I would say that the family where the member has suffered a heart attack, every member of the family should learn CPR. Apart from that, I think CPR should be mandatorily taught in the schools and in the colleges also. And you never know when you will be required to use it on your bystander and your family member, so on and so forth. So I think it's important. More importantly also, important telephone numbers of ambulance, nearby ICU, family members, etc. should be handy. This I think is very, very, very important.
AEDs?
Yeah. At important public places like in movie houses, in public railway stations, etc. I think all public places AEDs should be available. And I think it also can be taught. In fact, in Mumbai, we had started, there was a move which was undertaking how to teach CPR and also AED.
Okay, all right, Dr. Seth as well as Dr. Mehta, it's been an absolute pleasure. Thank you very much for taking your time out and speaking to us about something that is so important in terms of a topic and something that we'll probably revisit as we go on. Thank you very much for taking the time out and speaking with us. Hello and welcome to the Medicine Box. I'm your host, Ekta Batra. Today we are addressing a deeply worrying and increasingly common trend, the rise in sudden cardiac events amongst young Indians. It's no longer rare to hear of someone in their 30s, 40s, or early 50s seemingly healthy and active collapsing without warning at the gym, at marathons, at concerts, at home, and not getting back up. These aren't just statistics anymore. They're people we know. From Ranjan Das, the 42-year-old CEO of SAP India, to 39-year-old banker Amit Kasat, 40-year-old actor Siddharth Shukla, 41-year-old cardiologist Dr. Gaurav Gandhi, 50-year-old singer KK. From a 19-year-old in Ghaziabad, a 24-year-old constable in Hyderabad, to a 35-year-old gym goer in Himachal. And most recently in Karnataka's Hassan district, 23 people between the ages of 30 and 55 died of heart attacks in just 40 days. What's truly alarming is that in many of these cases, the heart attacks were silent, with little or no warning, no obvious symptoms, and often no prior medical history. Sometimes the collapse happens just weeks or months after a clean bill of health. So what's really going on? Is it chronic stress, lack of sleep, poor lifestyle habits, hidden genetic flaws, post-viral complications, or overexertion unmasking a silent underlying condition? And perhaps the most unsettling question, could this happen to any one of us? In this episode, we break it down. Why are these events happening? What role do supplements, sleep, stress, and unseen genetic vulnerabilities play? And what exactly needs to happen in those crucial seconds or minutes after someone collapses? Because in many cases, CPR and access to an AED can mean the difference between life and death. Joining me are Dr. Ashwin Mehta and Dr. Ashok Seth, two of India's foremost cardiologists, because today we're not just telling stories, we're asking the questions that could save a life. Joining me are Dr. Ashwin Mehta and Dr. Ashok Seth, two of India's foremost cardiologists, because today we're not just telling stories, we're asking the questions that could save a life. Dr. Mehta as well as Dr. Seth, welcome to the show.
Thank you, Ekta.
Well, Dr. Mehta, let's start with you. What is your reading of events where young, seemingly healthy individuals collapse at gyms, marathons, or in environments where they seem to probably be pushed beyond their limits?
This is an enigmatic problem for cardiology fraternity also. The reason is when the coronary arteries get choked up by the deposits of fats and cholesterol and etc., till they are clogged up to 70%, no symptoms occur. So the patients or the normal person, or I might say not even a patient, does not see a need to see a doctor. And even if I do his tests, they may turn out to be completely normal. What happens is when a non-flow limiting obstruction suddenly ruptures due to external or internal stress, the one which is 40% blocked